actually is having an effect. There is an effect, I guess. Okay, maybe I'm taking it too far, but there is an effect. Do you think the market also perceives the national rally as being preferable and more quantifiable than the left, and therefore a win for the national rally versus the left would be perceived as positive?
I think the markets are seeing the right as possibly more predictable.
Yep.
I think they feel that they have got a better chance in 2027 if they keep their nose clean between now and then. I think the far left is more unpredictable.
Yep.
I think there was a bit of surprise at how well Glucksmann did at the European elections, and also a bit of surprise at how fast the left was able to knit itself back together. I think it took the best part of 24 hours, which I think surprised commentators as well. So maybe a little more unpredictable on the left side. That being said, the sort of dominant party is the traditional left, so that could keep that side in check.
Do you think, therefore, we get a positive reaction to a Bardella win? Say you got a majority, would that be perceived as being positive by the market relative to where we are positioned now?
I think one has to go back as well to the sort of setup of French politics, because you've got the president and then you've got the prime minister. So I think the sort of international standing will be on the president's side and will stay with Macron, and we'd have a form of cohabitation on the French side. But as a result, yes, you would have most likely Bardella as prime minister, and his role is going to be more on the economic front. So I do think that commentators are going to see that. So you might have a bit of a relief initially, but it depends how much he tries his hand afterwards. So I do think that one thing we're looking out for is for further volatility in terms of the spread now in the French context.
Henrietta, I wonder where you see the rise of the right going, from linking it to economics, though, very carefully here, because I wonder if you draw a line from the spike up in inflation that we saw in many different geographies and the rise of the right. Are they linked? And therefore, if you have expectations that we've peaked in inflation, that we're in a disinflationary environment, sure, it's a little stickier than we thought maybe 6 months ago, but things are heading in that downward direction. Does maybe we'll leave it for the political commentators to say whether that means the politics changes, but is that your expectation, and do you see a link between the two?
I think the inflation picture is more of a global phenomenon, so I wouldn't necessarily put that on the rise of the right. I think the impact is going to be more on the growth prospects of France, and that I think we possibly have a bit more clarity there. If you look at what Macron's been trying to do over the last few years, is to favour growth and is to make France. And I think a lot of the reforms have gone in the right direction in that sense. I think there'll be a bit more questioning of the direction of France and how business-friendly it's going to be going forward. So I think the sort of casualty, if there is one, is going to be on the growth front more than on the inflation front.
That's interesting in the European context, then, because you make the point in your notes that maybe the US growth exceptionalism is showing some chinks in the armour, but the European story is turning a little bit more positive at this point.
Exactly. I think we have seen sort of a few more green shoots on the European side. Well, PMIs last week being a bit of an exception there, so it's still fragile, but we have sort of seen more of a positive momentum there. It would be a shame to lose that, and I think this has the potential to sort of put a bit of a damper on growth prospects.
Is there when you look at the broader European, or even, dare I say the EM, but we'll keep it in the European kind of context as well, is there a hunt for yield at the moment where perhaps if you're looking at, say, 12% average gains in any stock market globally, or 5% on the Treasury, is there then more appetite to be invested in things like the Italian bonds or even the Spanish ones, for matter, the periphery, to get more of that yield?
I wouldn't say there's the same degree of yield hunting that we had when we were in a zero interest rate environment. So I don't think we're quite there. But there's certainly interest in having yield in the portfolio. And I think investors are looking at a broader set. Why? Because you've got a lot more opportunity on the fixed income front. So, yes, government bonds is a play again.
How much tolerance do you think there is in the gilt market for the UK government, let's assume it's a Labour one, to borrow more?
I think the UK really is in a tricky situation. They're going to have to be very thoughtful about how they fund their promises. The market is going to be watching the UK like a hawk. I think it is a slightly different environment, and I do think we're in a slightly different setup compared to the sort of exercise we went through towards the tail end of 2022. I think some of the sort of embedded leverage in some of the government positions isn't quite there in the same way.
I think it's an interesting question, though, because just days ago I read in other media a report saying, quoting lots of voices in the market saying, oh, if they borrowed to invest, the market will say that's discernibly different from just borrowing to fund everyday spending, and that might be okay. They might be able to do a little bit more. And then we have a story from Pictet saying, actually, that's where the market will be worrying, or at least the market will overall be worrying about gilts if there is more borrowing. Is it too early to say?
So I think it's too early to say. I think the technical picture in the gilt market is different to the trust event. So it'll be interesting to see how it plays out. But I think the markets are out looking at deficits. They're looking at spending plans for sovereigns at this point.
Nice to see you. Thanks for stopping by to see us, Henrietta.
Pleasure.
Frankmore, Head of Global Fixed Income at Allspring Global Investments. Thank you very much indeed. Let's take a quick look at the Core 6, see what is happening around Europe this morning. We keep our firm eye on Airbus and on Merck this morning. Those seem to be the biggest casualties in the stock market. But as you can see, writ large across Europe, you are seeing quite significant weakness in a number of leading stocks. Novo Nordisk, though, investing in the United States, up by 0.2%, but everything else certainly seeing some softness this morning. Let's get some more details on some of the other individual movers. Joe Easton joins us for the details.
So it's a really rough morning for the aerospace sector today, Guy. Lots of red across the screen. We're seeing Airbus now down 9% as they downgrade their earnings guidance and their production, potentially meaning 20% cuts to analyst estimates. And we're seeing a ripple effect across suppliers here. Safran, Thales in France, MTU Aeros in Germany, all hit lower. And we're actually going to flip over and do a second board. We don't normally see this kind of read across, but take a look. Another board here, Rolls-Royce, Melrose, Dassault Aviation and Leonardo in Italy. All of those stocks hit as a feed through from that shocking warning from Airbus. As I said earlier, Deutsche Bank saying that this is affecting the company's credibility, and it really is feeding through into the market this morning. We'll take a look at some other stocks that we had. The first one was going to be Merck. Now we are seeing a deep decline in that one. The company halting this neck and head cancer drug trial, saying it doesn't prolong survival among patients that were in that trial, and that is a bit of a shock. It was expected to be a 1.4 billion euro drug for Merck, and as such that stock coming down 9% now, the biggest drop in around 3 years for those shares today. We're going to flip and look at another one over in health. I believe it's going to be Eurofins Scientific. Now you will remember that yesterday we did have a bit of a short report out of Muddy Waters on this one, questioning some of their accounting methods, but we have got a statement out of the firm today saying it does stand by their audits and stand by their financial documents as well. So we're seeing a bit of a gain in that one. Pairing some of that decline did fall by around 15%, almost 25% at the low yesterday. In terms of your chips, I wanted to bring those up because a 7% drop for Nvidia yesterday, a 13% drop over 3 days. Not really a huge fundamental reason, perhaps just overbought, but we are seeing declines in ASML, BE Semi and the other chip makers like Infineon, ST Micro today. Really a feed through from Nvidia. We saw Broadcom, Qualcomm, all of the US peers down as well, so feeding through into the European market this morning. Then we'll take a look at a couple of others. We were going to do some morning calls in a moment. There we go. We've got Ocado. We mentioned that one. That was in stocks to watch earlier. Ocado has a biggest bear on the street. This is Morgan Stanley. Bear in mind, this stock's already down 60% heading into today's session. We're down another 4.6%. The analysts at MS have a 215 price target. See it trading at 298. Still lots of downside according to them. Finally, we'll end on some positivity. Not too much positivity today, but there is an upgrade in the UK insurance space, and that was the best performing stock at the open of trading this morning. Admiral upgraded at Berenberg. Berenberg says the company is gaining market share in the home and motor insurance space. They like that one. Recommend you buying shares of Admiral this morning, and that one is gaining 2.7% in London.
Joe, thank you. Joe Easton from our equities team with all of those stocks on the move. Plenty to choose from those affected by the Airbus story to the chip story. In terms of Airbus coming up, Airbus cuts guidance for the year as persistent supply chain issues worsen. We'll get more on that next. This is Bloomberg.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New season starts July 10th on Bloomberg Television.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Minutes into the session, Europe is down. The reason Europe's down is, well, a few things. A chip read across out of NVIDIA. You've got a Merck story that is hitting the pharmaceutical space. And then you've got the Airbus space as well. When I talk about the Airbus space, I mean basically Airbus and its supply chain very much being impacted this morning by what we're seeing, which is why we are seeing actually some quite significant underperformance, not only for the CAC but also for the DAX. So that's Merck and the Airbus story being affecting those two markets in particular. The FTSE 100 looks okay. I will take that.
The FTSE managing to skirt its way around those two curveballs.
Energy stocks.
And benefiting from a rise in energy stocks as well. Let's talk more about what's going on in the aviation sector then. Airbus shares deep in the red this morning as the aircraft manufacturer cuts its guidance and aircraft delivery goal for this year on supply chain snags. Let's get back to Bloomberg's global aviation editorial leader, Benny Camel, who's with us this morning from Berlin. Benedict, you went through with us last hour a few of the things that are weighing on this business. Were all of them a surprise, or is it just the sort of addition of one plus another plus another plus another plus another, that adds up to a bit of a shock for the market this morning?
Yeah, I think shock is the word that sort of sums it up nicely. There's a bit of a bloodbath on the stocks. We see Airbus down 9%, Safran, MTU, even Rolls-Royce in the UK. They're all down. And in some ways, a surprise, yes, given the breadth of the warning. They really revised most of their, if not all of their targets. But on the other hand, not a surprise, because this is something that Airbus has been talking about to various degrees for the last year at least. You know, I remember we talked to Airbus CEO Guillaume Faury at the start of the month, and he said that the supply chain issues would be with us for 2 to 3 years. But I guess they've gotten worse and worse, and that's sort of the tone that he struck last night on a quick call with reporters saying it's really everywhere you look. It's the engines that we're not getting. It's the aerostructures that are missing. It's the interiors of the cabin. So wherever you look, all these complex parts that go into a plane, we don't have them. As a result, we are at risk of building what they call gliders, so planes that are fully built, but they lack one crucial part, and that's the engines. And that's not a situation you want to be in.
Yeah, the joke is that you actually bolt an aeroplane onto an engine rather than the other way around because of the complexity of those pieces of kit. Let's extend the thought and think about what else this is going to affect. Who's not going to get their aeroplanes? How long does this last? How long does this mean that the airlines are going to be flying older aircraft for? What does this mean in terms of fares, Benny?
I mean, you and I were in Dubai at the IATA annual general meeting a couple of weeks ago, and one of the big takeaways from that was, where are my planes? You know, all of the airlines were complaining, we need to fly older kit longer, we have to refurbish older planes, and that's where it sort of becomes almost a circular problem. They have to refurbish these planes, the older ones. That means there's less kit out there for the new planes, and that's something that will probably remain with the industry for several years. It puts a whole list of issues on the table, not least, you know, sort of the comfort of the plane, but also sort of their aspirations in terms of sort of flying greener. They have the goal of being net zero by 2050, but you can only do that with newer planes. So there's a whole tail of issues attached to that. You know, we're now seeing 770 planes delivery goal for this year rather than 800. You might think that's not a big number, but remember, we're only at the halfway point of this year, so a lot can still go wrong, and the deliveries so far each month haven't been looking great. They should be ticking up. This should be the time when Airbus improves. Instead, they've been sort of level at best.
Benny, the sell-off today in Airbus and its suppliers reflects a more negative outlook now this morning than we had yesterday, so versus prior expectations. But were those expectations elevated too much then, perhaps, by the business itself? Did it sort of get carried away with the sense that it was going to have a good year whilst its main rival was struggling on a number of fronts?
I mean, it was always a bit of a split-screen story this year, just given the level of issues at Boeing that was just so pronounced that the thinking was, you know, Boeing is in such a rut that whatever Airbus do, they can't do any wrong. And there was long a bit of a thinking, you know, is that production rate that they're targeting 75 A320s by 2026? That was the old target. Now they've pushed that out for a year. But was that target too ambitious? Can they really pull that off, given all the issues that exist in the supply chain? The answer now, as we hear from Airbus, is no, we can't do it in the time. We have to give it that extra year. But even so, some people are wondering, is that still too ambitious? You have some pretty negative comments out of the analyst community this morning. There's a Deutsche Bank note saying, you know, this is all pretty awful. The credibility of the company is on the line. So lots of questions to be answered there.
Let's turn our attention to Boeing and think about what is happening here. And in some ways, the Venn diagram overlaps with Airbus here too. We're waiting for news on how Spirit, the acquisition, the reacquisition, you could argue, by Boeing of Spirit, its big Tier 1 supplier, is going. This affects Airbus as well because Spirit also supplies wings, etc., and other pieces of kit for Airbus too. How much of what we're seeing right now is Spirit related? And once that issue, that split between Boeing and Airbus is resolved, how much of these issues go away or at least are more controllable?
Yeah, I think more controllable is what you're looking for charitably. This will take a while. I mean, Spirit is a hugely complex operation to pick apart. As we said, most of it will go to Boeing, a part of it will go to Airbus. That's what they're working on right now. We are hearing that they are sort of on the finishing line. There was a bit of a sort of last-minute snag over the financing that we heard. It looks like Boeing now wants to throw in some equity rather than cash. I mean, you've got to remember, this is a company that has, you know, dare I say, 99 problems, and so they need to fix that.
Yep.
We're going to get that in the next couple of days.
Benedict Cowell, great stuff. As ever, fantastic coverage. Thank you very much indeed. Up next, we'll get back to the industrial story. Daniela Costa joining us from Goldman Sachs. This is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lyons deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Welcome back to the programme. This is Markets Today, 30 minutes into our European trading day, and it's a negative one for European stocks outside of London. The Stoxx 600 down by 0.4%. We see some real variation across the different geographies this morning. It's chips and it's healthcare stocks in the shape of Merck weighing on the DAX. The DAX is down by 1.2% this morning. The CAC 40 down by 0.7%. There's a bit of the chip story in there. There's also the aviation story in there as well. The FTSE 100 then benefiting a little from some gains around energy stocks, and we see that the FTSE is pretty flat, and that's about as much as we can hope for on the upside this morning. Let's get more into, Guy, the aviation story and its bigger picture, its read across.
So, yeah, technology's down as a sector, but industrial's hot on its heels this morning in terms of the impact we're seeing from that Airbus narrative that we got from Guillaume Faury, the CEO of Airbus, on a call last night, downgrading expectations for deliveries this year and pointing firmly at what is going on within supply chain that it has, not only in Europe, but really around the world. Engines are a big part of that story, but engine manufacturers also have big supply chains. Anyway, this is a large component of the industrial sector, and we're seeing the impact this morning in that sector story, down by 1.6%. What lessons should we learn from this? Daniela Costa is the head of European capital goods research at Goldman Sachs and joins us now. Danielle, I don't want you to talk specifically about Airbus or any of the supply chain stocks that we're kind of watching so carefully this morning. We've already talked about that. But as you look at what is happening here with this story that Airbus is giving us about European industrials and its supply chain, what lessons should investors and industrials take from this?
Hi, good morning. So supply chain has been a massive topic really since the pandemic. We've seen it with semiconductor shortages back in 21 and 22. We've seen it with container shortages around that time. I would say aerospace and defense remains the one pocket where we are still seeing it now. Obviously, the drops in activity during the pandemic were very significant. The restart of activity maybe took place in a more staggered manner than in other areas. It's also a quite consolidated industry in terms of its suppliers. So it is still seeing a bit more than other areas. I would say pretty much elsewhere in industrials, we have now seen a significant easing of the supply chain situation. But in this pocket remains a big topic. And I guess the learning for manufacturers really since 2020 and all the problems that have been ever since has been more towards localization, and that's a trend that we have continued to hear. So we're hearing more and more about capex in where closer to where demand is, rather than these long value chains.
But can European industrials deliver upon that? Airbus is flagging a number of things, one of which is labour. They continue to struggle with labour. They continue to struggle to get what they need. Can Europe ramp up its industrial base with the capacity constraints that exist more broadly in the labour market and elsewhere? We talk about wanting to reshore, but how possible is this? And is the industrial base in Europe being held back by sort of that side of the fence, i.e. the supply side of the fence, rather than the demand side of the fence at the moment? Because I look at the PMI data, which continues to be weak, and I'm wondering what the root cause of that is if we are trying to reshore, if we are trying to bring industry back into the European economy.
So I would say a few things in here. We actually, when you look across other areas, aerospace is in a quite specific place where demand is very strong. Backlogs go to 2030s for the big OEMs. The rest of industrial, the backlog situation has largely normalized. Capacity utilization in Europe across manufacturing is actually below the long run average now. In the US, it remains above, and there are definitely very tight pockets of capex over there, of capacity utilization over there. In Europe, I think we have low demand, and we are not seeing a huge amount of capex on reshoring towards Europe. Globally, we are seeing a lot. It is basically the US and places like Mexico and India where we are seeing that activity. It is also very concentrated by industry. Aerospace is still a strong industry, as I mentioned. Utilities, power grids, data centers, semis. This is where we are seeing a huge amount of investment. The more general manufacturing, traditional capital goods areas, their capacity is actually low in Europe, and it's not very elevated at the moment globally. And inventories are actually quite high from all the restocking that you had when their supply chain problems were happening and manufacturers were worried to run out of stuff.
Daniela, good morning. Yeah, really interesting then, the extent to which aviation and defence is its own story, and that the hangover from the pandemic is perhaps greater there for the sector for the reasons that you point out. I want to turn to inventory levels and your research on that front, because there was talk all the way through the pandemic and post-pandemic that would we be moving from a just-in-time sort of assumption for many industrial businesses and other manufacturers to something that's more just in case, so basically carrying higher levels of inventory just in case you're going to need that. And I wonder where we are on that story, how normalized that picture looks.
Yeah, sure. I would say for most of the end markets that we track globally, this includes the 3 regions, we are still above the 5-year average on inventory, so the pre-pandemic levels. I would say a few exceptions to that are places like U.S. retail, U.S. chemicals, China's semiconductors, but pretty much elsewhere, we're somewhere between 10 to 30% above what we would think like historical normalized levels. Now, there's obviously a good question, as you mentioned, on whether people will go back to old levels given all the problems that they had in terms of supply chain. I think the jury is still out there, but the view is that for the activity that we have now, we are elevated for the most part.
Okay, so we're elevated apart from the areas that you mentioned. Guy was talking there about reshoring, and there's a lot of talk in various Western markets about the extent to which production facilities are brought closer to home, friendshoring, even if not reshoring entirely. Daniela, within the space that you follow, the capital goods space, what are you seeing on that front? How much is that evidenced in the flows that you follow?
Yeah, absolutely. To give you an idea, sort of we track about 4,000 companies globally. Looking at sort of a capex tracker of all of their spending plans, we do see over 5.5% average growth in the next 3 years, which compares to the 20-year average of about half of that. So we do see very solid activity in terms of fixed capital investment being committed. This is very concentrated in a couple of areas. So it's the energy-related areas. Power grids is seeing double-digit growth. Utilities and renewables in general, semis, data centers, and that those areas really pull forward the overall numbers. We also see that manufacturing construction put in place in the U.S. in particularly has been a big driver of that. But in general, we do see quite solid levels on the capex side, and obviously we talked about before in terms of the more short cycle OPEX activity, the inventory levels are a headwind, but on the fixed investment, it's a positive picture.
Daniela, you talk about the energy sector and the investment that's going in there. Everybody's having to figure out the energy story. All industrials are having to figure out exactly what they're going to do with this. To what extent has the European industrial base adapted to higher energy costs? How much more of that maybe is still to come?
Yeah, sure. I would say so. We had a period in 22 when the gas spiked, and we saw very weak activity and shutdowns in things like chemicals that are very energy sensitive. We've also seen more of these announcements of capex towards the U.S., where structurally the energy price has been lower for longer. I think by now we're actually sort of on the other side, which is energy prices have actually fallen quite a lot. This is not so much of a major headwind that the companies are announcing at the moment. Still, yeah. I think we continue to see this capex elsewhere rather than in Europe, with the exception of really power grids and the defense segment, which are strong sectors where we're seeing investment in Europe. The rest is still going elsewhere due to the fear of that volatility, even though the headwind is not necessarily here anymore.
So there is an expectation maybe that it does come back. As you say, energy prices have come down. I'm hearing rumblings that next winter we could see energy prices picking back up again. This is a long-term structural story now, that there is a belief that energy prices in Europe will remain higher on average for longer.
Yeah, I think the geopolitical situation also leaves people worry with that. And obviously the potential upcoming discussions around energy policy, the implications that the European elections might have on that, leave people sort of on the fence of being comfortable to assume a low energy for longer, and the fear of volatility that is still definitely there on corporates.
Yeah, Daniela, you just referenced their political, a lot of voting taking place this year. And here in Europe, political change perhaps coming in a number of geographies. We're certainly watching the elections in France, in the UK, but elsewhere as well. What's at stake for the European capital goods space when it comes to the electoral events that we see this year?
Yeah, I mean, I think if you look at the last couple of years, the main policy actions that have helped drive this sector, and this sector has re-rated, the companies have seen better demand, is the capital goods sector in Europe is very heavy of electrical equipment companies, which are major beneficiaries towards the net zero policy, towards investments in utility grids, investments in the renovation wave for construction driven by electrical equipment. So a huge part, sort of roughly a third of the sector, is sensitive to the demand if we do see any sort of changes in terms of the approach to energy efficiency and to net zero. So that's something clearly key to watch.
Daniela, thank you very much. Daniela Costa, head of European Capital Goods Research at Goldman Sachs. Thank you very much for joining us to talk about that sector. Coming up on the programme, we've mentioned political change. President Macron warns over the plans being put forward by France's opposition parties. We'll get more on that story. That's next. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
So we would seek to raise taxes on those with the broadest shoulders to increase the funding on day-to-day spending. And then in terms of the investment that's needed in the transition to a green economy, the capital investments in things like public transport, insulating our homes, renewable energy, we would be willing to do some borrowing for that, because that's about borrowing for investing in the future. And the economic opportunities that come with that are huge for all of us, and actually the costs of not acting on the climate
Japan's Finance Minister Suzuki says we will closely monitor currency moves.
The UK Green Party co-leader Adrian Ramsey speaking to Guy, in fact, ahead of the general election.
Suzuki also says we shared serious concerns over the weakness of the yen and the won with South Korean counterparts.
Is it an opportunity? Is it a cost? Is it both? You know, all of those views were expressed on the stage yesterday.
Yeah, I think it can be both. It clearly is going to cost money, and it's interesting that we were talking to our last guest about... If you think about where the industrial story has been in Europe over the last few years, it's been in the grid, it's been in electrical components, it's been in figuring out a way to get power from over there to over there and then store it. All of those things are kind of where the industrial story is at the moment. If we see the politics slowing that down, what is the ripple effect? Or is that process just continue to unfold? The voting in the European elections seems to suggest that the population is deprioritising it, but will industry deprioritise it?
Right, and sometimes what industry does, or even what happens on the ground in terms of energy diversification and transition is removed from the politics, as we see in Texas. You know, people often look at that as a real interesting example of where renewables have really taken off in conjunction with a Republican,
But that market's completely ring-fenced. It's not even associated with the rest of the grid, which is fascinating as well. What they're trying to build, therefore, is some sort of diversity into their system. And it was interesting, we were talking about the fact that Europe... There's this worry about volatility about the energy price, and maybe the energy transition solves that as well.
Yes, let's pivot our conversation. The Greens over in France, incidentally, part of that left coalition that we talk about fairly often. Elsewhere in European politics, though, it is the French far-right leader, Marine Le Pen, who's making headway against the government of Emmanuel Macron. She's been saying that the French president, Macron's accusations that the agendas of the far-right and far-left blocs could lead to, quote, civil war, indicate that he knows he's going to lose. That's her perspective. Joining us now with more, Celia Belin, who is Paris head of the European Council on Foreign Relations. Celia, we covered a number of elements to the conversation as we approached our conversation with you. But let me go to the comments that we've had from Emmanuel Macron talking about the possibility of civil war. How do you view those comments from him, and how should those outside France look at that wording?
Well, for President Macron, at this point, there's only one choice, is to raise the stakes of this competition and try to scare back some of the voters away from the National Rally, from the far right, but also away from the new leftist coalition, the new Popular Front that just coalesced together last week. Because the reality, or 2 weeks ago, the reality is that Emmanuel Macron jumped into these snap elections with, the sense that he would probably be able to rally all those centrist forces around him. And a few days before the first round, it seems like it's not working very well for him.
Right, so that's and that's what we see in the polling, at least, isn't it, Celia? With the National Rally coming out top, the leftist coalition second, and Emmanuel Macron in third. When you look at that polling, what do you think that means for the French Parliament? Cohabitation is the word that many people are using, and what will that mean for France?
Well, you have to remember that those legislative elections are happening in 2 rounds. First round will be this Sunday, and it will already clarify who makes it to the second round. So polling is not everything. If you look at polling strictly, the National Rally is between 30 to 35% of the vote, way ahead of Emmanuel Macron, who polls at 20%. And then you have a sort of a leftist coalition that polls quite high at 28, 29%. But what happens is that between the first round and the second round, you will have to have some clarification on who's ready to unite against the far right. There is so much bad blood between the new left and the new leftist coalition and the Macron centrist camp that it's difficult to imagine that they will unite between first and second round. So the reality is that there's a high possibility of a hung parliament with 3 big forces, the far right probably dominating with maybe 200 seats, and then the rest of the 577 member of parliament being split between the remaining forces. But the other possibility is of a national rally that is so close to power, maybe close to the 280 that they need, that in the end they are able to govern, at least either alone or in a coalition with other right-wing forces.
Celia, good morning. It's Guy. Let's think about how that would work. What lessons do you think the National Rally is learning from Italy? What lessons do you think they are learning from Giorgia Meloni? They clearly have aspirations to the president's seat as well. 2027 is obviously a big date and not very far away. How do you think the far right would actually govern? How do you think the right would govern if there's some sort of a coalition with that aspiration for 2027?
So it's likely that the far right will be stuck between two aspirations, actually. One would be to mirror what they consider a model, which is Giorgia Meloni. It would mean a pragmatic approach to European affairs, one that is in the vein of what they've been doing in the past 2 years, which is present a reasonable front, respectful of institutions, very often, during that time, abstaining, refusing political fight. But this contradicts very much the fact that they would come in a victorious move. They would come in with electors determined to have them put in place their program. They have made many, many, many promises over the years. And a lot of them are on the fringe ideological far right. So if they put those in place, including at the European level, for example, getting out of the European energy market, for example, refusing any form of EU-wide cooperation on defense or on migration, then they will not be in the Giorgia Meloni pragmatic camp. They will be on the ideological, much closer to an Orban camp.
Let's say they manage to achieve some sort of a more Meloni-like outlook. How do you think that would affect the rest of Europe? At the moment, Giorgia Meloni is clearly being antagonized, you could argue, by other capitals and by those in Brussels. And we're going to see that maybe come to a head at this European leaders gathering that is going to be taking place later this week. If you have France and Italy leaning right, how does that change politics in Europe, and how does that get reflected in some of the key jobs that maybe are going to be divvied up between the main parties in Europe? How fractious do you think this could be, and what does it look like in terms of the outcome?
So for the moment, it's even if the National Rally makes it into government, it's going to be a two-headed France, because the President Macron, will still be there. And as you know, President Macron has made Europe his signature policy. He will want to remain influential. So you actually run the risk of having an unreadable French policy, which makes the likelihood of having a sort of a strong French voice uniting with Meloni very low. And again, because of the ideological roots of the National Rally, it is again quite difficult to imagine that they would follow the Meloni route. However, what we are seeing and experiencing all across Europe is this rise of nationalists, which either are coming into government or are rising in every single country. And this will have necessarily an impact on the next commission, maybe for making it, less influential, for potentially, reverting back on some of the biggest item and biggest ambitions, such as raising, a common budget, such as, structuring European defense. For all of these matters, the arrival of National Rally to power in France, it would have a high cost on these ambitions.
Really interesting, Celia. Thank you very much indeed. Celia Bellin, Paris, head of the European Council on Foreign Relations. Thank you very much indeed. Let's stay in France, or in Europe at least. Airbus is one of the big stories that we're watching in terms of the stock market story this morning. It is down. Its supply chain is down. The aerospace sector is down. Look at some of the numbers that we're posting here this morning. Airbus is down by over 9%, nearly 10% this morning. Airbus has been warning this supply chain story has been a risk for quite some time. it's come as clearly quite a big shock this morning to the market. It's interesting, like, the whole sector is being hit by this. Rolls-Royce does not make engines for the narrow-body market, yet it is being marked down, Anna, in quite a significant way.
Yeah, sort of a sell first, ask questions later mentality, perhaps, for the sector as a whole. Elsewhere, we see energy stocks gaining this morning, so the likes of OMV, Eni, Aker BP, a host of names going higher. That sector doing the best of all the sectors in Europe, and in fact, most stocks within that sector are higher. The oil price is pretty flat, down 0.1%, 85.93 on Brent. Seems to be geopolitics this week that's pushing the oil price higher, from Yemen to Russia, whereas last week it was a risk-on sentiment for assets broadly that was pushing things.
Let me link NVIDIA to the sector you're talking about. It appeared yesterday there was a rotation out of tech into the energy names in the United States, and some of that may be being reflected first thing this morning. European chip stocks are under pressure. The NVIDIA sell-off over the last 3 days has been significant. 430 billion wiped off its market cap. You are seeing an effect here this morning. Some big names, and these are heavyweights. ASML is down pretty hard. BE's down. Infineon's another heavyweight. ST Micro. These are big names that are taking a hit this morning as we see that NVIDIA read across into Europe being crystallized.
Yeah, let's go over to Merck. This is the biotech business, global pharmaceuticals and chemicals company, the German company called Merck, of course. They had some disappointing trial data. That stock is down by more than 10%. Weak trial data around a head and neck cancer drug Joe was talking to us about before. And from an investor perspective, there are a lot of buys. He was making this point as well. A lot of buys on this prior to the announcement this morning, and so perhaps that positioned us for some kind of sell-off, which we are then seeing.
What else we got later today? I think you want to watch consumer confidence data out of the States. They've got a 2-year auction as well. We've got a French election debate a little bit later on tonight. I am going to be watching that very carefully. See if I can understand some of it.
Yes, let's all try that. I think there's some football happening as well. Maybe. Less said about that, the better. We'll have a choice, won't we? French election debate or the football. What will we watch? That is it for markets today. The Pulse is up next. They'll continue to take you through what is a fairly busy day for European stocks. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. these are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London, stepping in for Francine. Here's what's coming up on today's programme. European stocks fall on growing speculation the tech rally may be running out of steam. It comes after Nvidia fell into correction territory, shedding $430 billion in value in 3 days of trading. Airbus tumbles, also dragging its suppliers into the red as the plane maker lowers its earnings and delivery targets. Plus, the Chinese premier warns of a, quote, destructive spiral if the world decouples from Beijing. We discuss the pressure on global supply chains in our exclusive conversation with the CEO of Marsh McLennan. Let's take a look on how European markets are performing then. Yes, Airbus and its suppliers are a drag, as is the tech sector. There's a shift, it seems, into the value stocks, energy, utilities, seeing some upside in an otherwise pressured European session. Currently, across the benchmark, you're seeing losses of just shy of 0.4%. And if we can get you the regional map, we'll show you the breakdown, because the FTSE 100 here in the UK is performing slightly better than the rest of its partners across the Eurozone, currently posting very modest gains of just shy of 0.1%. The FTSE 100, though, essentially flat at 8,285, adding 4 points. Over in France, the CAC 40 down 0.6%. We continue, of course, to monitor the politics of France ahead of that vote, the first in the 2 rounds that kicks off this weekend on Sunday. The DAX over in Germany taking a bigger hit, down 1.3%. Let's flip the board and look at the US futures. Again, it was the drag, of course, coming through from Nvidia. We talked about the fact that in terms of market value, the biggest 3-day loss for a company on record in history. Whether or not this is a turning point for this market or indeed a buying opportunity will remain, of course, a question. We'll look at the pre-market trading price, of course, from Nvidia when that crosses in the next few minutes. In terms of your cross-asset board, we'll run you through what's happening on the US benchmark. Not a lot of volatility in the Treasury space, at least not now. We count down, of course, inflation data out of the US on Friday with personal consumption expenditures index, the preferred gauge for the Fed, coming through, of course, on Friday. The Japanese yen once again in focus, intervention risk. Mizuho saying 170 could be the line you're looking at. The next move lower for the Japanese yen, the lowest level that would be since around 1986. Currently 159.50, brushing off, it seems, some of the jawboning coming through from Japanese officials. Brent trading at $85.97. And spot gold taking a bit of a knock so far in the session, down 0.4%. Now to the central bank story. In the Fed's San Francisco, President Mary Daly has warned the US labour market is nearing an inflection point where further slowing could mean higher unemployment.
So far, the adjustments in the labour market have been modest, not really pushing up the unemployment rate. But we're getting nearer to a point where the outcomes on employment may be less benign.
Joining us now is Miles Bradshaw, Head of Global Aggregate Bonds at JP Morgan Asset Management. Miles, thanks for joining us in the studio.
Morning, yeah, thank you.
Markets pricing in 2 cuts, 48 basis points, close to that by the end of this year. The dot plot, of course, is for 1 cut. You're taking into account what we've heard from Mary Daly in terms of the labour market of the US. What are the markets pricing in when it comes to potential further softness in the labour market in the US? Unemployment 4%, but maybe there's further to go on that front.
Well, I think the markets are pricing the Fed to be cutting rates in line with the fall in inflation. That's the first thing. And then obviously we've got the PCE inflation data coming up on Friday, and that's largely known. And we've had a moderation in the labour market, and that's really been seen by a fall in labour demand, slightly decline in wages, which is all consistent with the Fed easing rates in a gradual fashion. That's what the market's pricing, September and broadly December. I don't think there's that much difference between the market and the Fed. As we saw at the Fed, the dot plot is between 1 and 2 cuts this year. So really critically, it depends on the next couple of inflation prints, whether they're actually going to be cutting in September. I think it's likely. And then the risk is that the unemployment rate or the labour market deteriorates at a slightly faster pace. And that's going to see the Fed cutting rates much more aggressively. The market is not pricing that.
What would
that's
that look
the risk.
like? What would the levels you'd be looking at? What would be the metrics that you would be looking at that tell you, okay, they're going to have to go harder?
Critically, it's the payroll data. I mean, you look at the holistic labour market data, you look at initial claims, they're sort of broadly tracking levels they were tracking in 2018, 2019. The unemployment rate has edged up a little bit. We're all looking at the SARM rule, which suggests that if unemployment goes up by more than about half a point, it tends to move in a non-union fashion. But it's not a rule, it's an empirical observation. So really it's going to be about the payroll data. And if the payroll data decelerate, that would be consistent with a lot of other data that show a waning in labour market demand, and that would see the market pricing in a faster pace of cuts. It's not to ignore final sales. You know, the key thing is about the overall balance of the economy, not the labour market in isolation. So, you know, it has to be considered with the whole data, but the payroll is the key one.
So we scrutinise the payrolls data, but if we go back to your assumption, your consensus, or at least your benchmark at this point, your baseline at this point, which is 2 cuts from the Fed starting in September, followed by December.
Yep.
How much of that is priced in? Does that first cut in September trigger a bond rally, and if so, which part of the curve is going to be most reactive?
It depends on the messaging, but I think more important is the data than necessarily the cuts. So I think from my perspective, the bond market looks compelling value. You know, 2 cuts priced is broadly what the market's pricing, with them pricing broadly a cut every quarter. That looks quite reasonable. The risk that the Fed start raising rates looks very low. We've seen inflation fall very quickly. We've seen the Fed's own rhetoric be along the lines of holding rates for a longer period of time, so that seems a low risk. And so really the question is, if the labour market deteriorates at a faster pace, what positions do you want to put on today? And for me, I think the key thing you want to be overweight is the front end of the bond market. You want to be putting on yield curve steepeners, because if the labour market deteriorates at a faster pace, we could easily be looking at 200, 300 basis points of Fed rate cuts. And that's how you're going to get excess returns on your fixed income portfolio.
Where would that take the 2-year then, if that's what you're looking at? A 473 right now on the 2-year?
Well, the 2-year could easily be down in the 2% type of level, but that's contingent on...
That's by this time next year? What kind of time frame?
I think so, yeah, because the market will be very fast in terms of pricing a much sharper pace of cuts. But I want to emphasise this is all contingent on the economic data actually deteriorating at a faster pace, and that's not our core expectation. The core expectation is actually Fed rate cuts, quarterly pace, enables the expansion to continue. It's a critical ingredient for the soft landing scenario, which is the expansion continues, we don't get a recession, and you have a slight pivot and adjustment of monetary policy which supports easier financial conditions and continued expansion.
What do you do with French sovereign debt at this point? So the spread on the benchmark 10-year 080s versus the Bunds is about that 80 basis point level. Does that look attractive to you? Some guests we've spoken to said you need to get to 100 basis points above before you dip back into that market. How are you thinking about French?
Yeah, I mean, it's a very good question. We're dealing with the sort of situation that we've been dealing with elsewhere, is that macro supports carry trades, and then you've got these political risks. And I think for the market, the first thing is, what government are we going to get? How does that increase uncertainty or not? And I've seen the recent comments from the RN suggest that if they were in charge, they would continue with a more moderate, and I heard your previous speaker, sort of mimicking what we've seen in Italy with a moderate economic policy and not large fiscal expansion. And I think the other key risk is obviously a hung parliament, and I think, again, that's not about fiscal expansion. So I think those 2 scenarios do support stability, let's call it, in the European sovereign complex. Is France the best place to benefit from that? I would say there are other places that offer better risk-reward. You know, Italy has double the spread of France. Italy has already got a far-right government, has already got the moderate economic policy, so I think Italy will match any rally in French spreads. And if you have uncertainty in France, I think, again, that, you know, Italy isn't going to underperform France in a sell-off. So I think they're a better place to invest within Europe, you know, Italy being one, Spain being another. They can talk about covered bonds that give a better risk reward than in France, where the upside of owning France is perhaps 10, 15 basis points, that kind of amount.
Very interesting in terms of your call around Italy, Spain maybe benefiting on the back of France, if those scenarios play out as you outlined for us. Where else are you finding opportunity before I let you go, Mark?
Yeah, emerging markets. I mean, political risk.
Is contrarian?
Well, we've seen the political events in emerging markets. I mean, obviously, earlier this month, India, South Africa, Mexican elections created volatility. There is attractive risk premia. So things like Mexico has already factored in a lot of this risk premium about a shift in economic policy. I'd argue Brazil is also attractive. Again, there we're capturing risk premium associated with a shift in the government's fiscal approach and a shift possibly in the potential composition of the central bank. So I think keeping powder dry to buy into markets that have sold off because of uncertainty is the best strategy at this moment. And then when that uncertainty is priced in, it's time to be actually buying those.
Miles, fantastic stuff. Always appreciate you coming to the studio. Really, really interesting insights. The 2-year potentially at 2% with the caveats, of course, that Miles laid out there. And potentially looking at Italy, Spain in terms of the sovereign debt upside if you get some scenarios a little bit more benign when it comes to the French political evolution. Miles Bradshaw, of course, head of global aggregate bond strategies at JP Morgan Asset Management. Let's check in on the pre-market pricing for NVIDIA, of course, given that rout that we've seen in the maker of GPUs and AI chips, of course. Down currently at 1.3%. So the sell-off, it seems, continues for NVIDIA after the historic moves wiping off about $430 billion US dollars. Now back below Microsoft and Apple in terms of market cap, with the market cap just shy of $3 trillion. It's got a 2 handle once again in terms of the total market cap of NVIDIA, but it seems like there's further pressure on that stock as we lead up, of course, to the open in the US. We'll keep across that story for you. Coming up, how effective are sustainability disclosures and why are investors demanding them? We're going to speak to the chairman of the International Sustainability Standards Board. That is next. This is Bloomberg.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
Was going to keep Rain World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New season starts July 10th on Bloomberg Television.
It is Tuesday, the 25th of June. Welcome back to Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Tom McKenzie in London. Now, Korean chemical manufacturer LG Chem says the Inflation Reduction Act would not be impacted by a Trump presidency. Speaking to Bloomberg, the company's CEO says he doesn't expect changes in U.S. sustainability spending.
I don't think fundamentally the spirit of IRA and the framework of IRA will not change because fundamentally what is looking for is to induce more local production in the United States, induce more foreign capital into the United States to localize the supply chain, to secure enough source of supply. So I think the fundamental framework will stay the same. However, there may be some slight changes here and there, and that's maybe inevitable in the midst of administration change.
LG Chem's Shin Hak-chul there on why he believes Biden's signature climate law will remain unchanged. Let's broaden the conversation to discuss sustainability disclosures and why investors are demanding them. Very pleased to say I'm joined by Emmanuel Faber, Chairman of the International Sustainability Standards Board, the ISSB. Emmanuel, thanks for joining us in the studio. Let's start with the question of how much success you and the team have had in terms of persuading countries. You've been around the world, traveling around the world, trying to persuade countries to adopt ISSB standards into their national rules, their national terminology. How much success have you had? How much uptake is coming through on that front?
Thanks for having me, Tom. It's great to be here to report on the progress of ISSB standards by the IFRS Foundation. We started at COP26, that was 2.5 years ago. We've published our first two standards, the general accounting rules for climate and other sustainability issues, and the climate standards exactly a year ago, which we launched here in London. We are 1 year after, and we already have more than 20 jurisdictions, countries, that have decided to adopt the standards, which means basically 50% of global GDP, 50% of greenhouse gas emissions. I would never have anticipated that it would go so fast, so far. And I think the reason is because these risks and opportunities are real. Investors want to understand about them, and companies want to express.
So 20 nations signing up in a relatively short time frame, as you've outlined. Yeah. Who is missing from the list that you'd like to add? What's your target?
There are a lot in the global south, of course. I mean, we've got jurisdictions like Nigeria, Bolivia, Sri Lanka, Bangladesh, and others, which is absolutely great because you cannot have a sustainable business model globally or macroeconomics without having an inclusion of all in the supply chains. Those supply chains are really global. And so you need to have also those emerging economies, smaller economies, et cetera, but they're still missing probably 100 on one side. And they will come over time, given the gravitas and the gravitational force that has started with these 20 plus jurisdictions.
What is the kind of resistance you might face from some countries, or reluctance if that comes through?
I think it's a matter of investment because financial statements are now in place with the work of the IFRS Foundation, which hosts our work and which is a public good entity that has provided accounting systems across 140 different countries in the last 25 years. Financial statements don't, because of their rules, useful rules, they don't allow to express all the risks and opportunities that are down there in the supply chains, that are in the mid to long-term horizon, yet companies want to be able to express that. And this is why there is success behind what we do. Yet it is an investment because you need to understand where your supply chain is. You need to adopt this new language. It's full of estimates. It's many things that I think the CFOs, the chief investment officers, the chief investor officers as well need to grasp. The assurance profession needs to be there, of course, because the very special aspect of our accounting language for sustainability is that it will be assured. And therefore it will be reliable and comparable, and therefore investors are going to be, and banks are going to be able to allocate capital against those risks and opportunities in a manner that is commensurate for the amount of resources and the price at which they will be able to allow those resources, which will create a competitive advantage for companies. Many companies have understood that, but the resistance is, and again, in the fact that it is an investment. It's probably a 1 to 2 year investment learning process before it really starts coming. And we know it's going to be a journey.
A big question, of course, is how you get that global uptake in terms of agreement, in terms of the terminology, in terms of reporting and aligning. And a number of organisations, including the ISSB, have got together to try and align and work more closely together. How much progress have you made on that front? What does it mean for companies?
Well, I think, and again, probably the best that I could say is that this 50% of GDP, global GDP, is now locked from a commitment by jurisdictions to progress on their journey towards the adoption of the standards. So it means in at least half of the global economy, if they get there in a couple of years' time, there will be a common language about those disclosures that you can describe as part of your financial reporting to investors and to banks. And so now there will quite quickly be a cost for not joining. Yes, it is an investment, but if you stay outside of that, or if you develop as a regulator a specific language that is really yours without fundamentally using that baseline that we provide. You could always add more if you want to, but making sure that there is no carve-out to this baseline is fundamental for investors and for banks to understand all the risks and opportunities. And therefore, there will gradually be a cost of not joining as long as this gravitational force continue to build around the momentum.
There's a gap, there's a difference, isn't there, between disclosing and then taking action? And I'm drawing.
And so at 4:30 a.m. Eastern Time, we do see a release of our Hong Kong imports and exports numbers. Imports with a forecast of 8.5% on the prior 3.7%, and exports with a forecast of 14.8% on the prior 11.9%.
Fiscal, legal consequences. Would that be something you'd advocate for?
It's not my role. It's not the role of ISSB. We provide disclosure, which provide transparency. We're not asking companies to take action. We're asking them if they take action, or if they say they take action, what kind of action, and precisely describing their action in a manner that is comparable to their competitors, so that investors can understand who is going to be more resilient, at what cost. If you take, climate, water is an issue already, will be even more. Two competitors that are willing and saying that they plan to increase their market share. If one of the factories or the supply chain, the transportation, which is related to water, the Panama Canal and many other things, happen to play against that company versus the other one, there will be a cost to that. And so this is exactly what investors want to understand.
So that cost is already there to some extent. Emmanuel Faber, we have to leave it there. Thank you very much indeed, Chairman of ISSB, on how this story is evolving in terms of trying to get closer to that point where you have a global language and a global set and a global framework around sustainability. Coming up, Airbus shares slump after the company lowers its full-year guidance. We're going to dig into what is holding back the world's biggest plane maker. That's next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month. From the world of politics to the world of business, 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything.
welcome back. Let's bring in Benedict come on now, because Airbus shares are down heavily, close to 11%, on the back of a change to its guidance, a cut to its guidance. Benny Campbell standing by, Bloomberg's global aviation editorial leader. Benny, what's going on at Airbus?
Well, a lot of negative things going on at Airbus. They came out with that profit revision last night. It was a pretty wholesale cut across the board. They reduced the number of planes they wanted to deliver this year to 770 from 800. They cut their cash forecast. They cut their operating profit forecast. They cut their longer-term production forecast for the A320 aircraft. So really quite a wholesale downgrade here. A lot of analysts quite spooked by this. You're seeing it in the stock reaction this morning. Airbus shares down 10%. That's a really steep drop for a company of this size. And you're seeing it not just with Airbus, but there's also sort of collateral damage. Safran, the French engine maker, they're down. You see MTU in Germany are down. So really across the board, quite a bloodbath.
Benny Campbell, Bloomberg's global aviation editorial leader on Airbus. Thank you. Coming up, we're going to focus on supply chains and geopolitical risks with the CEO of Marsh McLennan. That's coming up. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
So it's less than 1 minute away now to get our Hong Kong imports and exports. I will lead with the imports number.
This is Bloomberg.
Welcome back. European stocks fall on growing speculation. The tech rally may be running out of steam. Nvidia falls in US pre-market after shedding $430 billion in value in 3 days trading. Airbus tumbles, also dragging its suppliers into the red as the plane maker lowers its earnings and delivery targets. Plus, the Chinese premier warns of a, quote, destructive spiral
10 seconds.
if the world decouples from Beijing. We discuss the pressure on global supply chains in our exclusive conversation with the CEO of Marsh McLennan. Good morning and welcome to The Pulse. I'm Tom Mackenzie, stepping in for Francine Lacroix here at our European headquarters in London. Now, the Chinese Premier has warned of negative consequences for the world if countries choose to economically part
Imports out at 9.6%, that is 9.6% higher than the forecast of 8.5%, and exports at 14.8%, that is 14.8% in line with the forecast.
Has led to overcapacity.
Maximizing one's own benefits at the expense of others' interests, or even resorting to regressive actions of decoupling, disrupting supply chains, and building small yards with high fences would only push up operational costs, sever the economic links between regions, and aggravate tensions and disputes. This would drag the world into a destructive spiral where the fierce competition for a larger slice ends up in a diminishing pie. This is something we do not want to see.
The Chinese Premier Li Qiang there speaking at the World Economic Forum, warning against what he called regressive actions. For more on how geopolitical tensions and trade disputes have disrupted supply chains and continue to do so, very pleased to say I'm joined by John Doyle, CEO of Marsh McLennan, the parent company, of course, of businesses like Marsh, Guy Carpenter, Mercer, and, of course, Oliver Wyman. John, thank you very much for joining us in the studio. We have a reminder today in the news flow of the supply chain constraints. Yes, inflation is moderating, becoming less of a concern post-pandemic, but the supply chain issue remains a problem for many companies. We're seeing that with Airbus. We have a reminder from the Chinese Premier Li Qiang that the tensions between China and the US and its other trading partners, the EU as well, remain pretty pronounced. How are your clients adjusting to this world? Where are we in terms of addressing some of those supply chain constraints?
Well, good morning, Tom, and it's great to be with you this morning. There is a complexity to the events of today that is a challenge for our clients all over the world. Supply chain risk being one of them. Broader geopolitical risks are a challenge, of course. You've got economic uncertainty. You mentioned inflation. While we're seeing signs of easing inflation, challenges like supply chain, tight labor markets, tariffs, isolationism in different parts of the world continue to create challenges. A frequency of extreme weather events. And on top of that, social issues, some from geopolitical risk, but tight labor markets and immigration challenges around the world. And so there's a complexity to today's events that businesses are trying to navigate. And I'm proud of the work our colleagues are doing, trying to help them make decisions with confidence in this complex world.
Of the here and now, is there one of those that really stands out? There's all of those issues coming to play, as you say, but is there one that really comes out that's driven home to you when you speak to clients? That is a preeminent concern right now?
I think broader geopolitical risk and the economic consequences of the geopolitics of today really sits at the top of the list. But to me, what stands out about today is all of these issues. We've confronted all of these issues as business leaders in the past, but they're all at an elevated level today.
Across the business, we focus on the consulting side of the business.
Sure.
And Oliver Wyman, of course, in that business. We saw a lot of demand for consultants during the pandemic. That's started to slow. Some of your competitors are starting to reduce costs, some to reduce headcount as well in a targeted way. Is that something that Oliver Wyman's going to have to think about doing as well? How important is cost control across that business?
Well, Oliver Wyman is part of what is a unique mix of capabilities that we have across risk, strategy, and various people-related advisory businesses. And so increasingly, we're addressing these challenges that our clients are confronting together. And I think that's enabled our business, our consulting business at Oliver Wyman, to continue to put up good results. And so we're going to continue to invest in our consulting capabilities. The demand from the events of today remains strong for services that we provide to help, again, our clients navigate the complexity.
What does that mean for headcount at Oliver Wyman?
Well, I think we've added to headcount. We've made some minor but strategic acquisitions over the course of the last couple of years, and we again are going to look through the cycle and continue to invest our businesses to help our clients.
And you talked about the economic uncertainty. Are you seeing and getting a sense that clients are becoming more cautious?
Well, I think many of our clients entered the year a bit more defensively, just given all of the events that we've talked about here this morning. But our role is to help them give the confidence to thrive through this complexity. And so we're working with them so that they can make decisions and put capital to work with greater confidence.
On a regional basis, when it comes to consultancy part of the business, where are you seeing the strongest demand? We're hearing that the Middle East is pretty strong generally for the sector. Are you seeing that strength come through?
The Middle East has been an area of strong demand for our consulting businesses. We're seeing good growth in Europe as the continent continues to navigate all of the issues, again, that we've talked about. And so, but we've seen generally good demand for our services around the world.
Are you finding the talent that you need in the Middle East? Are you thinking about maybe moving headcount from Europe or elsewhere to meet that demand in the Middle East?
We made an inorganic investment in the Middle East a couple of years ago. The timing of that couldn't have been better for us. But more important than what it means for us, it's helping economies and big clients navigate all of this uncertainty today.
You talked about acquisitions. How acquisitive do you plan to be in the next 12 months or so? And if you are planning to be acquisitive, what are you going to be looking at?
Well, we've been a consolidator over our history. We're a 153-year-old business. We expect to put capital to work inorganically. We've seen really attractive opportunities in our risk business. In 2019, just before the pandemic, our largest deal in our history, JLT. But across all of our businesses, we continue to see attractive opportunities to add to our capabilities.
On the advisory side, and particularly with the focus on technology, how are you thinking, how are the team thinking about that demand around integrating some of this generative AI across businesses and making sure that the spend is efficient? Because there's a concern that there's a massive, that CFOs and others within the organization are under pressure, often in companies, to invest in generative AI when the outcomes, the use cases, the monetization is not necessarily that clear.
Yeah, look, let me start with us. We're excited about the possibilities around AI. We've been investing against those possibilities. And Mercer and Oliver Wyman are helping our clients think through how to bring these new technologies to their workplaces. So we're optimistic about what's in front of us all. I think the value creation, the scaled value creation, though, is not in 2024 or likely in 2025. And so, and our clients are in different places in their ability to invest earlier or later in that cycle or to be a fast follower. There's a range of that, but we're helping our clients think through that. And again, I think the impact to our businesses, I think, can be quite meaningful over time.
Do you see it as a value add for your own team, for individual members, or is it a cost efficiency story as well?
I think there's some of both, but for the most part, the use cases that we're developing today are going to make our talented professionals even better.
Okay, we've been reminded in the reinsurance space, we've been reminded of some of the challenges in terms of climate change once again, the climate crisis. How are you thinking about the reinsurance part of the business? What are premiums looking like? What is demand looking like within that space?
Well, the reinsurance market plays a critical role in financing extreme weather events, and we've seen it here in Europe with increased flooding, wildfire risk in Italy and Greece, for example. But increased frequency of extreme weather events have been happening all over the world. The reinsurance market, after several years of losses, really adjusted in early 23 and all throughout 2023. Markets have settled a bit. We'll see, as we enter the hurricane season, the wind season in particular in the United States, where there's a massive amount of insured value. That'll have an impact on what happens to the reinsurance cycle in 2024. But it's a much more orderly market today. But clearly the cost of risk is rising, and so that's meant higher insurance and reinsurance costs for our clients.
Is that the new normal in terms of the cost of risk?
I think it is, and it's not just related to weather. There's inflation impacting and social inflation impacting loss costs all over the world. We're still digesting, again, the impacts of supply chain issues, as we talked about a bit as well. And so for me, clearly the cost of risk is rising faster than GDP is.
Okay. John Doyle, thank you very much indeed. The CEO of Marsh McLennan. On some of the supply chain challenges, inflation, of course, continued concerns about the global economy and how it adjusts to some of those challenges and how corporates are thinking about insuring against those risks, of course, as well. Coming up, we're going to look at what's behind the NVIDIA sell-off. It continues pre-market. It's raised more than $400 billion from the company's market cap. What does it tell us about appetite around the maker, of course, of AI accelerator chips? That's next. This is Bloomberg.
studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The conversations that matter and the insights you need. This is The Pulse. I'm Tom McKenzie in London. Now, NVIDIA has entered correction territory with a sell-off erasing an historic amount of value. The three-day drop wiping out $430 billion from the chipmaker's market cap. So we wait to see where this signals more concern about the semiconductor space. Certainly here in Europe, there's been a challenge in terms of the pricing in the session today across the semiconductor makers of Europe. Currently pre-market, though, NVIDIA turning around slightly, just pointed to modest gains of 0.6%. For the context, over that three-day period, that was the biggest drop in market value of a publicly listed company on record in history ever. But as I said, pre-market pointed to modest gains of 0.6%. At this point, for the details, let's bring in Bloomberg's Joe Easton. Joe, what is the reason then for this sell-off in NVIDIA?
Yeah, so the short answer is there weren't any real fundamental reasons for it. We kind of had some really good news last week where NVIDIA overtook Microsoft, becoming the world's largest company by market cap, so potentially that was a signal as maybe this has gone too far. The stock's been in what analysts would describe as technical overbought territory, meaning it's rallied too hard, too fast, and therefore there are concerns that potentially we might be in bubble territory. Has the rally just gone too far, and therefore people looking to get out? Of course, we also had news of them doing the 1-for-10 stock split, making it more accessible. You'd think that would actually be a positive, but actually it's come at the time of that positive news actually has sent the stock lower to some extent.
Yeah, some insider trading as well. Nothing wrong with that in terms of the insider. Yeah. And what I should explain is, of course, executive CEOs, the CEO, the CFO, perfectly legitimate, of course, pre-planned sales of some of their stocks, $700 million US dollars. What are the next catalysts then that markets are looking for in terms of whether or not there's a potential turnaround for NVIDIA, or indeed if this sell-off continues?
Yes, I think traders are looking at technical levels where you might have seen the stock finding technical resistance. I mean, it's trading about 20% above the $100 level. If it got down to 100, you'd start asking serious questions. The other thing is, just broadly, if we get to the next earnings season, we start seeing the impact of AI on earnings, not just in NVIDIA, but other companies. If companies start saying we're actually already seeing the impact of AI in some of our earnings reports, that could be a catalyst. In terms of AI having an impact on the economy, which is obviously NVIDIA's main game here, main role, we're probably a few years away from that. But if we start to see the initial impact of AI on earnings in chip makers like NVIDIA and other companies, maybe that would then give people, right, let's buy this rally once again.
And for the market, I mean, just as a reminder with the context, so year to date, the S&P with those double-digit gains, about a third of that coming from the upside of NVIDIA. So NVIDIA accounting for about a third of the gains that the S&P has posted so far year to date. There's the concern, there's been the hand-wringing around the concentration risks for some of these big tech names.
Yeah.
How do you see that story evolving, or at least what are market watchers focusing in on when it comes to the evolution of the market concentration story? Are you expecting to see a broadening out as we head into the rest of this year?
Yes, I saw a good stat, another stat to add to those you went through there, that 40% of the S&P is now exposed to AI. I don't want to keep banging the same AI drum, but that does seem to be the thing. But in terms of the concentration, you know, these tech stocks, you say, it's such a big part of the market, But then again, it is an uncertain part of the market because it's so exposed to even the interest rate theme. We think there will be rate cuts, and that's positive. Therefore, it should move the entire market. But if that's not as fast as expected, that big chunk of the market is heavily exposed to the rate cuts because of the way earnings are discounted and that kind of thing. So I think the concentration probably is a risk, but the big thing is what's going to continue saying is the AI impact, and almost half of the S&P 500 now has a stake in the AI outlook.
Okay, Joe Easton, thank you very much indeed from my equity team on what is moving and playing into this Nvidia story, with the stock now pre-market pointing to gains of 0.9%, just shy of 8% in terms of the gains for Nvidia pre-markets. Coming up, investment firms have been boosting their exposure to infrastructure and energy. We look at why the chairman of sustainable infrastructure investor Actis and the focus of that business, how they're investing their investments, and how that story is shaping up. That is next. This is Bloomberg.
The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
The conversations matter and the insights you need. This is The Pulse. I'm Tom Mackenzie in London. Now, major investment firms are boosting their exposure to infrastructure and energy. Earlier this year, Global Atlantic agreed to acquire Actis, which manages around $12.5 billion in assets. Very pleased to say I'm joined now by Torbjorn Caesar, Chairman and Senior Partner at Actis. Torbjorn, thanks for joining us in the studio.
Yeah.
Talk to us about the massive spending on infrastructure and energy, and whether that's the AI play, data centers and feeding that and supporting that, or the renewable energy shift. This is happening at pace. How is Actis playing a role in that? What is your role, the centrality of Actis within those shifts?
I mean, the whole energy transition is, of course, an absolutely massive, colossal challenge, but also an opportunity. And if you're thinking what we are focusing on, so we focus on the non-US, non-EU markets. That's why you have 85% of the world population. And we have 2/3 of the opportunity set in infrastructure and in energy transition.
And so at 5 a.m. Eastern Time, we do expect to hear comments from ECB Sterner speaking.
2/3 are busy chasing the opportunities in US and Europe. So that creates, very, very attractive investment proposition for us in those markets. But clearly, energy transition is there, and it's just, more important than ever in the markets where we invest in.
So you have more space to play, less competition, arguably. What are the risks, though, in investing in some of those environments? How much political assurance do you need before you put capital to play, and how much of that is a question amongst your investor base?
I think that if you look at risk, it's a question of supply and demand of capital and opportunities. And if you take those stats that I said there, do you want to be in markets where actually the product you're selling, electricity, is in short supply? Or you want to be in a market where it's actually an oversupply of electricity, and you depend on the regulators to make sure that you have a priority. In our parts of the world where we invest, people are desperate to get their hands on the electricity. I think that's the best risk mitigation of everything.
So which parts of this ecosystem, which parts of this sector are providing the most opportunity for Actis right now?
Right. We are across the whole energy transition, in digital transformation and supply chain reallocation. But if you're looking at specifically then in the energy transition space, we're across the board there. We are on the power generation side, transmission side, and also in the electric distribution side.
On the AI story and the data center story, and Bloomberg had a big deep dive on this in terms of the energy need. So here in the UK, AI is expected to suck up about 500%. 500% more energy over the next decade.
Yeah.
In the US, data centers expected to make up 8% of the total energy needs in the US versus 3% from 2 years ago. So the demand is going to be excessive.
Yeah.
How do you think the industry meets that demand, and to what extent is that an opportunity for you?
It is a massive opportunity, but it's part of the same picture in terms of growth. If you're looking at the growth on a global basis and looking at the next, 20 years, the electricity demand will somehow double. So we need to build another planet of power plants. And all the associated...
Is that even feasible in this environment?
Yeah, I think so. But it's a massive, investment challenge and opportunity. But if you think about that, and I'm saying that the electricity system, everything from generation, transmission, and distribution, that's humankind's largest investment ever. And now we're going to do that over the next, 20 years again. And on top of that, the existing planet needs to be decarbonized. So if you add those up, it's just almost mind-boggling type of a size and numbers that are there. So the question, will all of that come through? What is the pace? But, if it comes, in the pace that, you forecast or not, it doesn't really matter, because the opportunities that are that, huge. And in that, as you say, the AI, is going to play a very important role of that growth.
National governments, post-pandemic, fiscally constrained, budgets are under pressure. Is that a challenge for you because you need to align with public spending, or is it an opportunity?
It's clearly an opportunity. If you're in the markets, across Latin America, Africa, Middle East, Eastern Europe, Asia, where we invest, and governments, the priorities of their spending, if private capital is available to help out and invest into the electricity sector and help out, in the energy transition, on getting renewables in there, clean, greener energy, it's great. So it's a win-win from both sides.
On the risk, going back to the risk story, because you've got investment, you've got exposure to India, we've had elections there, you've got exposure in Mexico, we've had elections there as well. There's concern, particularly in Mexico, about a tilt towards a government that may be more interested in intervening more in some spaces, and particularly in the private sector. How do you mitigate the risk of a government stepping in and saying, we're going to set the pricing around energies or utilities, or we're going to take over utilities? How do you factor that into your investment decisions?
I'm coming back to the same supply and demand of capital and the opportunity set. And even if you're looking at Sheinbaum now in Mexico, first woman president, that's great. But if you're thinking about, yes, it's more left-wing, and there's some noises about what that means for the private sector. However, she's been very clear that electricity and making sure that you cover that shortage of electricity needs the private sector to participate. And we have invested a lot there, as you say. So,
you're not concerned about the politics of Mexico right now?
We are cautious about it, but on the other hand, if you're taking a step back and looking at the big picture, the amount of investments required, and if a politician cannot deliver reliable electricity to people, that is a disaster from a political point of view. So they need and want the private sector to come in, participate, help out, and making sure that deliver delivery of electricity happens.
You're in the process of being absorbed by General Atlantic. Where are we in that process? How's the integration going? What does it mean for your business?
Yeah, and I mean, that's great. I mean, so much looking forward to join forces with Bill and the team at General Atlantic, and we will then through that become a stronger platform. We'll continue what we do.
So it's less than 5 minutes away now to reduce. We're taking comments from ECB's Denara speaking.
Customers, so if they want growth equity or more venture, or if they want credit or tech investment into the climate space, or for us, what we deliver in infrastructure, boring, stable, contracted, cash flows. So that means that the LPs can then get an opportunity to have a variety of risk return.
Okay, you didn't make it sound boring, Torbjörn. So thank you very much for coming to the studio. We appreciate it. Torbjörn Caesar, Chairman and Senior Partner at Actis. We are going to keep across, of course, the NVIDIA story for you, and of course the supplier story when it comes to Airbus with that downgrade and the stock hit to Airbus, but also its competitors. We watch, of course, Boeing and its supply chain as well. Airbus currently down 10.5%. Pre-market, NVIDIA turning around, looking at gains of 1.3% after, of course, wiping out around 430 billion in market cap in the last 3 trading days. We keep across those stories for you. The brief is next. This is Bloomberg.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always going to be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New season starts July 10th on Bloomberg Television.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning from our global headquarters in New York. I'm Manish Krenny. You're welcome to Bloomberg Brief. Let's set that agenda. Deeper into correction territory, Nvidia loses $430 billion in value over 3 sessions. The bounce back begins. Supply chain turbulence. Airbus falls short on millions of parts, hurting delivery plans and earnings forecasts. China hits back at criticisms over industrial policy, while President Xi urges his nation to combat its rival countries' tech dominance. Were you nervous yesterday? A lot of people were. Nvidia dropped by 6.7%. It took the NASDAQ down by 1%. We're clawing our way back. Nvidia this morning, you can see, is just managing to galvanize itself, bouncing back. But it wiped out $430 billion over 3 days. It didn't desecrate the rest of Mag 7. You've got to have a look at Meta, have a look at Apple. That cascade lower perhaps offers a magnificent buying opportunity. That's what we'll debate over the next hour. To what extent does a correction in Nvidia provide a buying opportunity? Get ready for a little bit more paper to come down the pike today. $69 billion worth of 2-year paper will come. 10-year yields. Mary Daly warns that we are at an inflection point. There's a dual mandate, just to remind you, which is not just an inflation target of 2%, but it is also an unemployment number. Mary Daly talks about this inflection point. Goolsbee says that he's hopeful. There's somebody out there they've got a March 2.25% rates bet on. That is a hell of a hedge against recession. CAC down 0.6% because Airbus has basically said we're short of everything from engines to the seats that you sit in. We're only going to be able to deliver 770 aircraft, not the 800 that we promised. And down goes Airbus by 10.46%. So if you think your airline fare for this summer is going to be more expensive, this is a choke point on supply of the very seats that we put our posteriors into. That's a sweep on the markets, a little bit of a bond action later on today. We'll bring you those results as they come through. Which takes us back to the Fed. The Fed officials are emphasizing the need for more evidence, well, there's nothing new there, on the cooling of inflation before they can lower interest rates. Now, the San Francisco Fed, Mary Daly, warns that the U.S. labor market is nearing, in her words, an inflection point.
So far, the adjustments in the labor market have been modest, not really pushing up the unemployment rate. But we're getting nearer to a point where the outcomes on employment may be less benign.
Well, joining us now is Mark McCormick, Global Head of FX EM Strategy at TD Bank. Mark, good to have you with me this morning. There's Mary Daly talking about that we're almost at some kind of an inflection point. It's interesting. I wouldn't call this a pivot, but it is an interesting shift in the language from Mary Daly about where we are economically. Suddenly the dual mandate becomes a little bit more prescient.
Well, yeah, I think what they're trying to do is strike a balance between growth and inflation. The Fed has been very heavily focused on inflation for a long time, and I think what they're just trying to do is inject some focus back on the growth side. That would give them some wiggle room if they did see some slowdown in the economic conditions, particularly in the labor market. That would allow them to cut and would allow them to ease and to kind of get out of restrictive territory. So while they're using this language, though, I think the evidence and the focus for the bulk of what the Fed's looking at is still an inflation mandate. And so we still need further progress on the disinflation story that allows them to cut at some point, whether it be September, November, or December.
Mark, before we get into the grip of your doom loop, I'm just going to sort of throw you a wild card, which is I spent, about a minute talking about NVIDIA. Do FX strategists, does anybody else out there in the world beyond the equity market talk about the potential impact if there is some kind of let's say, sort of Damocles hangs over the Mag 7? Do you talk about NVIDIA? Does it seep into the psyche of the FX world in any way?
That is what is fundamentally super exciting and fun about the FX market. It is a market of narratives. It's a market of stories. It injects politics, geopolitics, equities, kind of everything. So if you wanted to link it back to NVIDIA, key stories like you go back to the 90s. What drove the strength of the dollar was a productivity revival. It was the capital inflows that came into the U.S. equity market, linked in partly to another tech story. So I do think people in FX, and we specifically do talk about NVIDIA, because what we're talking about is even within our fundamental models that we run in an overlay portfolio, we look at equity momentum. And the thing that's happening for the dollar is our inflation factor, our growth factor, our terms of trade factor, and also our equity factor. If you recall, a couple months ago, people were talking about the outperformance of the Euro stock relative to the S&P 500. And now, again, all the pendulum is swung back. We're not focused on China. We're not focused on emerging markets. U.S. equities are outperforming. And even if it's just one sector or a couple companies, it matters.
Yeah, it certainly is pervasive in all of our psyche. I mean, whether the bargain hunters arrive and they go, something's down 13% and it offers value, well, that's another debate. But I do want to get, I was drawn to your quote a couple of weeks ago, and so I've resurrected it. And this is, the dollar wins when carry meets politics. But this is essentially what you're saying. We're in the grip of a doom loop. It continues to tighten ever so slightly. Markets are witnessing the typical behavior of a complex adaptive system. And it starts with idiosyncratic events in specific countries, and it morphs into a problem for everyone else. And of course, what you're referring to here is the political upsets that we've had around the world. You think that those will morph, but let's just put in context for our viewers this morning, the scale of the unwinding of the carry trade. Where has it been most pronounced? Because these political upsets are what have upended the carry trade.
Right. Back to the factors and the things that drive FX. Everyone for probably at least the last few years has been focused on carry. It was a very unique cycle for emerging markets where the terms of trade, again, most of these countries, at least in Latin America, are oil producers or they're commodity producers. So they had growth, they had high real rates, we had generally low volatility, and they produced the energy and the commodities that were in demand through a mini commodity super cycle. So the carry trade has been essentially a reoccurring theme across FX for 2 years, driven in part by Mexico, driven in part by Brazil. And I think a big thing that's happening here is the point of the doom loop concept is a simple fact that two conditions need to work for carry. You need rate divergence. So you need some countries with really high interest rates. You need other countries with really low interest rates you can borrow from and invest in. And you need low volatility. And I think the thing that we're looking at right now, and we've been talking about it all year, and you need the right conditions for it. But if you look at FX volatility or macro vol compared to geopolitical uncertainty or geopolitical stress or even inflation dispersion, FX vol is too low. So I think what we're starting to see, the tightening of the doom loop, is essentially all the conditions start to come together with things that are very unpredictable. If you look at South Africa, if you look at India, if you look at Mexico, and you look at the outcome of the French elections, people were able to predict who was going to win the parliamentary seats in the French election. They didn't know that Macron would call a snap election. So I think that the doom loop concept in regards to carry is going to continue to unwind because volatility is going to continue to shock us. And I think a starting point just for the U.S. election cycle is now this week. We look at Thursday, the winner of the debate will essentially decide, I think, some concept around how much we want to start trading the U.S. election and whether or not we want to start buying the dollar.
You really think this week could be that? You really think that this week, this one narrative between the two presidents could define the trajectory of the dollar? I mean, is the dollar a hedge to U.S. politics, or is the dollar just going to live on exorbitant privilege?
Well, I think this week's election will kickstart the attention span that people can place on the U.S. election. We'll start to see again if Trump is seen to have won convincingly. People are already talking about betting odds, and betting odds are basically they are leaning more towards Trump. And again, the polls are a little bit tighter. But essentially, it opens up people's mindset that it's like, I have to start tactically thinking about this event, which, again, markets get a little bit quiet in July and August just for specific seasonal reasons. But the dollar is ultimately the hedge to the U.S. elections because no one's really been able to trade the concept around, Trump's second presidency. And again, a lot of it swings around tariffs, swings around fiscal stimulus. But if we go back to the things that are driving the FX market, G10 carry, which is a long dollar position, is now outperforming a hybrid G10 EM carry basket, which is telling you that EM is losing its appeal. You don't want to just chase EM because of higher yield because you're worried about uncertainty. And also EM central banks have cut rates. So the rate divergence has compressed. And the dollar offers yield. It offers growth. It offers links to oil prices. And essentially what it could be is there's less certainty that the Fed is going to cut this year. And we already know that the G10 and even EM central banks have started to cut. So the election will kind of reinforce the movements towards a doom loop where we get more volatility through the second half of the year. The dollar is the hedge for that.
Mark, I'm with you all the way, and I didn't even get to put the question to you whether we were going to see Euro parity on the blowout of the French elections. Save that thought for when we're back, and a good stage setter for the rest of the week. That is Mark McCormick over at TD Bank. And tune into the interviews throughout the day. I'll be at Bloomberg Invest. We've got some great conversations coming up. Man Group CEO Robin Grew, along with the SEC Chair Gary Gensler, join the stage. Other top stories this morning, trending on your Bloomberg terminal with WikiLeaks co-founder Julian Assange to plead guilty to leaking U.S. national security secrets and return to his home country of Australia. The plea is part of a deal with the Justice Department, and it ends almost 15-year battle over his prosecution. Apple rejected overtures by Meta to integrate the social networking company's AI chatbot into the iPhone. That was months ago. The dialogue about a partnership happened back in March, and it didn't reach any formal stage. Apple has no active plans to integrate Meta's Llama chatbot. Nike's betting on $1,000 Air Jordan high tops to win over China. The athletics giant is launching a French push for the Jordan brand in the region, hoping to lay the foundation of a permanent comeback in one of luxury's key markets. Coming up in the show, Airbus, the stock slumps, the plane maker cuts the guidance. We'll delve deeper into the turbulence at Airbus. This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Manus Cranny in New York. Airbus is coming up short in millions of parts that make the company's commercial aircraft. The situation looks to be getting worse rather than better. The shares of the world's largest plane maker are sinking on the news. We're down 11.1% and change. Sid Phillip tracks our global aviation coverage for us. I mean, it wasn't supposed to be this way. We've been through COVID, we've been through supply chains, we've got roaring 20s in terms of getting us onto planes, and Airbus simply can't make them fast enough. Where is the breakage?
Morning, Manus. So Airbus is struggling with many part supplies, and they've sort of warned about how the engine supply has now deteriorated, and they can't get enough engines for their flagship A320neo jet. And that's really sort of key to Airbus's success, the fact that they can churn out all these A320neos and unable to be able to do that. They've sort of had to cut their guidance for the year, saying that they don't expect to be able to make up for the shortfall as the year goes by. And they've also pushed back their target to reach 75 a month to 2027. They were expecting that to be 2026. Now they've pushed that back by a year. So it is sort of a really tough scene for Airbus, especially at the time when airlines are clamoring for as many aircraft as they can get.
It's interesting that the CEO, I mean, it's almost like it's sort of like a shock moment. Wow, I don't have enough engines. Oh, I don't have enough kit to put inside. I mean, I'm very shocked that the CEO would say, this is a new situation that we were not expecting. I mean, what happened in January? Did he not see this coming down the pike? You know, whatever pressure they're under, it's nothing compared to Boeing, is it? I mean, they are the most embattled of all, the plane maker. Now, they're offering to buy Spirit Aerosystems. This was the great outsourcing deal that sort of has caused them multitude of issues. They're switching the purchase process. They're going from cash to an all-stock deal. Is this because they're just tight on cash, Sid?
Yeah, I mean, Boeing's been burning through, they expect to burn through about $8 billion of cash through in the first half of the year. And they've sort of, given the fact that they aren't able to ramp up production of the 737, which basically gets them all the cash that they need, they are sort of looking at alternatives. Bloomberg News reported that they're looking at an all-stock deal or a largely stock deal, and they're looking at about $35 a share for Spirit, and that sort of, they expect to take that deal through maybe in the next few days.
Okay, Sid, let's keep an eye on both those stories. That's Sid Phillip tracking the global aviation narrative. Now, a Bloomberg scoop. The Fed is weighing changes to its bank capital revamp. That would lighten the load to lenders. In a statement, the central bank said it has made no decisions on the timing, the process, or the substance, but its revamp instead focused on the substance of potential changes. Jenny Serene is with me. Jenny, this could be capital revamp light if you're an optimist. And if you're a trader out there, you should be saying to yourself, well, we're just about to get our hands on a little bit more risk, maybe for the old VAR model to the credit committee. What do you make of the potential capital lightness that they're proposing?
Yeah, no, I think you're exactly right. So I'm sure traders and probably even a few investment bankers out there are really rejoicing at the types of trades or deals that they could be able to put together if these rules really are rolled back as much as these banks have been hoping for. So I think in the report yesterday that we put together, really the headline number is that, you know, the new proposed changes that the Fed might make, it could mean that the capital rules really only increase capital requirements on these banks by as much as 5%. Now remember, last year when this was rolled out, we were looking at increases of as much as 16%. So that's a pretty severe pullback that these guys are thinking about now, and just shows that these banks have really spent all these months and months complaining about these rules, and it looks like some of that has actually come to fruition.
Well, certainly for once, the lobbyists will be able to stand in front of Moynihan and Jamie Dimon and Jane Fraser and go, you see, your money really has the potential to deliver. But this does, as it were, segregate for those systemically important banks like JP Morgan, as I was saying, like Citibank, which were set to hit a target of around 19%. If this comes in at 5%, what would it really mean in terms of the landscape for global banking?
Yeah, it'll be interesting because I think a lot of what we heard from these big banks over the course of the last year was that they were worried about the competitive footing that this would put them on. So they would have to, you know, take moves and set aside more capital that rivals across Europe or Asia or even non-bank rivals like the private credit firms and some of the private equity firms have never had to do. And so it'll be interesting to see if, you know, with this new, I guess, proposed change from the original proposed change, if it really has any impact on their actual business and their day-to-day models, or if this just means they can kind of keep going and duking it out with these players that they're going up against every day anyways. So I think that was their big point, was they didn't want to be left on a less competitive foot. And so if the regulators do respond in kind, it could just mean that they're able to kind of hold their own just as they have been.
Okay, Jenny, well, certainly the cry from the European and the Swiss CEOs over the years has always been that Wall Street has such a material advantage of them in terms of the differential. Let's see what happens now. Jenny, thank you very much. Jenny Serrain there, tracking the finance stories. Coming up on the show, the end of a 15-year legal battle. WikiLeaks co-founder Julian Assange reaches a plea deal with the US court. That's next. Context matters on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month. From the world of politics to the world of business, 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lyons deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything.
Bloomberg Brief. A very good morning. I'm Manus Granny in New York. Global business leaders are flocking to Dalian, China's summer Davos. Bloomberg's Stephen Engel is on the ground at the Economic Forum.
Chinese Premier Li Qiang opening up the World Economic Forum annual meeting of new champions, also known as the Summer Davos, here this year in the northeastern Chinese port city of Dalian, by striking a tone of openness and welcoming foreign investment into this economy. But he also warned against moves to decouple the global economy, saying it will cause a destructive spiral where the fierce competition for a larger slice ends up with a diminished pie. He also mounted a defense against claims in the U.S. and Europe of overcapacity in industrial areas like green technology and allegations of dumping of such goods on the world economy. He says the pursuit of new technologies should not be a zero-sum game. This, as Canada moves to align its import and tariff policies with the United States, which recently raised its import duties on Chinese EVs to more than 100%, and Europe is now weighing 48% tariffs on Chinese EVs to protect their domestic producers. Li also, though, sounded a fairly domestic tone on the Chinese economy, saying despite the struggles in the property sector and elsewhere in consumer confidence and the like in the Chinese economy, They are confident, Beijing is confident, that they will achieve their goal of around 5% GDP growth this year. Stephen Engel, Bloomberg News at the World Economic Forum Summer Davos in Dalian, China.
And certainly that 5% target for growth will have global ramifications, as well as the deglobalization story, with a lot of tariffs ramping up around the world. What's making you front page news around the world? This is what we've got for you. We're going to focus in on Julian Assange's wife. She tells the BBC she's elated. This is after he agrees a plea deal, which was touch and go at times, she said. Assange will be a free man once the deal is signed. It ends 15 years of a lot of coverage as he was held up in one of the embassies in London for many years. Next up, the information rights Anduril Nears $12.5 billion valuation round led by the Founders Fund, Sands Capital, 7-year-old defense startup closing its final $1.5 billion investment, co-led by Peter Thiel. And the FT leads with this. Sheen files confidential paperwork, we understand, ahead of a possible London listing. The online fast fashion group files with the UK markets regulator. The Chinese company is valued at around $50 billion. So let's just show you what's happening pre-market. We'll get another snapshot of NVIDIA in just a moment. I mean, it's fighting the good fight. It was down 13% over 3 days, wiping over $430 billion. This is the MAG, well, it's the MAG 5. MAG 4, excuse me, if I can count. A spirited fight back by NVIDIA up to 1/8%. Apple, of course, you know, Apple and Meta never really took the bruising. They were down by 1/8, by 2.8% over the past couple of days. Meta is flat at the moment. We'll check in on stocks in just a moment.
So just a reminder, at 5:30 AM Eastern Time, we do see Germany calling for bids on an auction of 4.5 billion euros of 2.9% 2026 bonds. The 2-year Bund yield is on the prior 3.01%, with the 2-year bid to cover on the prior 2.7%.
Just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like,
Yes.
How does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
our global headquarters in New York, I'm Manus Crenny. Let's set your agenda. A pause for thought on NVIDIA after losing $430 billion over 3 sessions. Supply chain turbulence, Airbus falls short on millions of parts, hurting delivery plans and earnings forecasts. And China hits back at criticisms of its industrial policy, while President Xi urges his nation to combat its rival country's tech dominance. Good morning to you. Are you nervous? Are you a bargain hunter? Do you believe that after 13% of value destruction in NVIDIA, wiping $430 billion is an opportunity for you to step in and buy the dip? Marko Kolanovic warns on equities that this worsening breadth situation is ominous. Laurie Calvasino, a little bit more optimistic. Potholes are something of a temporary nature. Bond markets, if you're a bull, you're going to latch on to Mary Daly's warning that we're at an inflection point in the jobs market. Goolsby is hopeful that the data is getting a little bit better. You've got $69 billion worth of 2-year paper coming down the pike later on today. 474 is where you are on 2s. And to the Paris market, down 0.6%. Airbus cutting back its targets for this year is the ultimate drag on the Paris market. Leave politics aside for the moment. This is the reality of a supply chain which has struggled to deliver seats, engines, and aerostructures to Airbus. So injurious to the company's outlook. So that's the state of play on the equity markets this morning. Well, NVIDIA, as I've just said, is taking a little bit of a breather pre-market. We've had 3 days of a loss, shaving nearly $430 billion in market cap off the top. Henry Wren is with me. I mean, Henry, this is... Look, many people would say this was ultimately going to happen. You're going to take a breather. That inexorable rise of NVIDIA would run out of steam at some juncture. Are you surprised that we did 13% in 3 days?
Yeah, it all happened in quick succession. I mean, the key catalyst has really been a slew of filings have been showing that some NVIDIA insiders have been selling down shares into the rally. For example, the company's CEO and founder, Jensen Huang, have offloaded around 700,000 shares in the past 2 weeks. It's also not Huang himself have been selling. Some other insiders, including the company's CFO, has been selling as well. Not to mention some other companies in the AI supply chain. For example, Micron has been seeing insiders share sell activities as well. So all those news taken together have been perceived as negative by investors. And we recently seeing not just NVIDIA has been seeing some drops in shares, but also some other key companies in the AI supply chain as well.
I was just looking at the Mag 7 over the same 3 days. The Mag 7 overall as a basket came down by 2.46% relative to the NVIDIA Cascade lower by 13%. Meta held up, Apple held up, and even Tesla held up in this.
So seeing the 2-year yield for Germany at 2.8%, with the bid to cover at 2.4.
Yeah, indeed. So NVIDIA has been definitely one that get hit the hardest, but we have to take into perspective that NVIDIA has risen around 140% this year to date. And its 140% rise this year has accounted for 1/3 of S&P's advance in 2024. And if you take Meta, Apple, Microsoft, all those 4 stocks together, that's half of the market's advance. So from a market, from investors' perspective, this has caused some concerns because this has been bringing a huge concentration issue. If there's a significant slowdown in AI supply chain, that could be an issue for the broader market as well.
Okay, Henry, thank you very much. Henry Wren there on the NVIDIA stock price drop. My guest this morning is Fiona Bowe, Global Head of Equities at S&P Dow Jones Indices. Fiona, good to see you this morning. Were you shaken by NVIDIA 13% in 3 days? A little bit of a drive-by?
Look, I think, one constituent does not make an index. The S&P 500 is a market cap-weighted index. It's done what it said it would do on the tin, and it's still performed very well this year, up year to date, sort of around 14%.
Do you think when you look at this kind of a moment in markets, it is pervasive because all asset classes in many ways look towards these juggernauts at the top of the S&P 500. Are you worried about breadth? I was looking at some comments coming through from a number of people. Kolanovic over at JP Morgan warns of this lack of breadth as something that is ominous.
Look, we know that there's significant concentration in the S&P 500, the top 5 stocks accounting for about 28% of the market cap. That is undoubtedly high, but there are alternatives to investors if they are worried about breadth. They can look at equal weight strategies, they can go down the cap table, look at the 400 and the 600. So there's lots of options when it comes to particularly the US market.
What do you think the hedge is here on moments like this?
I think investors need to consider their long-term strategy. As I said, those that might be worried about diversification have options to look at things like the S&P equal weight, which over a long period of time has actually outperformed the S&P 500. They can look at capped indices, products based on capped indices, or they can go down the cap table and look at things like the 4 and the 600.
In terms of moments like these for equity markets, we're getting ready for politics, a big political debate. My guest a little bit earlier on the FX side suggested that this window of the first debate certainly would focus the minds and the attention of the foreign exchange market in terms of how they may need to tactically position, prepare for more volatility in the FX space. How does this week present an opportunity to focus the mind of the equity market and equity trade?
As you said, there's certainly a lot of geopolitical events, macro events coming up over the coming months. One way historically that we've seen investors play those events has been around sectors. In a traditional month, the sector effect on the 500 on dispersion is only about a third. When you get to the Novembers where we have US election, that dispersion influence of sectors grows significantly. So we know that investors use things like sectors to play particular themes, especially around major geopolitical events.
I mean, geopolitics have been unsettling, haven't they? Both in Paris at the moment, our eyes are trained on that. I got UBS coming on yesterday telling me, look, don't worry about it, this will blow over. Now is a golden opportunity to take advantage of these drawdowns in some of these European indices and step in there. Do you share that sort of optimism that it's a moment of a shakedown, but not something more structural or fundamental that we need to worry about in terms of capital outflow, wealth destruction? I mean, if you look at the UK and you look at France, I mean, the one biggest risk is, of course, wealth and capital outflows post these elections.
We know that markets, over long periods of time will always have points where they react very violently to things like changes in regulation, to macroeconomic events, and of course to politics. But I think, over the longer term, we can be confident that the indices that we have are doing what they say they should do. They're representing the market, and investors have, an enormous variety of index-linked products to look for as things change and evolve.
Talk to me about the flow. I was just looking at the overall flow. $95 billion has gone into equities over the past 9 weeks. So the momentum is there, and the heaviness of that momentum is here to the United States of America. That flow show continues. But I just want to get a sense from you whether there's any sense of that being stretched. You talk about a diminished buyback. We go into a period of where the buybacks perhaps run out, and some of the alpha may be diminished.
Flows have been impressive into equities so far this year. That is definitely the case. We'll have to wait and see whether that continues. But we know that investors hold large portions of their total portfolio in equities, and while the mix might change slightly over the long term, equities are the place that most end investors want to be.
When you look back in history, this was something Julian and Emmanuel reflected on. So we're trying to debate whether this is an expensive market by valuation, by PE, choose your metric. This is what he said. While all prior expensive periods are unique, well, everything's unique in history, isn't it? 1993 to 1995, 1998 to 2000, that was tricky, and 2020 to 21. That wasn't as tricky as 2000. But they all illustrate that valuations alone are not a sufficient reason to sell. You've got a Fed looking to cut, an AI revolution to support the 2024 upside. How much do you think sentiment is driven by AI revolution, evolution, and how much of it is driven by, you know, the uninversion of the curve and those cuts to come from the Fed?
If you look at the dispersion of sector returns, you would say the market remains solely focused on an AI structural change to the economy. You've seen those sectors that tend to be more domestically focused in the US, maybe more sensitive to interest rates, haven't performed as well, whether that be real estate, you know, industrials, even financials to some extent. So there does seem to be differing views there around, you know, what's driving the economy and what's driving the performance of the equity markets. I would say to the point we are today, it's definitely been the view of a major structural change that will come from AI.
Fiona, thank you so much for being with me. That is Fiona Bowler at S&P Dow Jones Indices. And tune in throughout the day. We've got some cracking interviews for you. We've got the Man Group CEO, Robin Grew, is here in New York. The ACC chair, Gary Gensler, joins Bloomberg Invest through the day. Stay tuned for those conversations. The bond market, we are counting down. We've got a reasonable amount of supply to come through in the US. Today it's the turn of the twos, the terrible twos, $69 billion of two-year paper. Of course, many people have sort of said, look, you want to be at the shorter end in duration. You don't want to be out of that longer end because of the fiscal risk and the political risk going into next year. Yields are flat at the moment in the US, and 240 is where we are in Germany. Will the ECB be bounced into a little bit more aggressive action on the geopolitical situation in France and beyond? Coming up, we'll talk more about geopolitics. China warning against economies decoupling. This as the World Economic Forum kicks off in Dalian. Context matters on Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New season starts July 10th on Bloomberg Television.
maximizing one's own benefits at the expense of others' interests, or even resorting to regressive actions of decoupling, disrupting supply chains, and building small yards with high fences would only push up operational costs, sever the economic links between regions, and aggravate tensions and disputes. This would drag the world into a destructive spiral where the fierce competition for a larger slice ends up in a diminishing pie. This is something we do not want to see. As we Chinese often say, range far your eye over long vistas. In the current context, the right choice is to approach development issues with a longer view and broader mind, and join hands with others to make the pie bigger while pursuing one's legitimate interests. This is how we could sustain the growth of the world economy.
Microsoft risks an EU fine after antitrust warning over the Teams app. Microsoft Smith says the company will work to find solutions.
Kicking off the World Economic Forum in Dalian in China with a warning on economic decoupling, a potentially destructive spiral. Jill DeCease is with me from Hong Kong. Jill, I mean, look, we've had story after story from the Germans trying to get an off-ramp on EV tariffs, the US smacking tit-for-tat tariffs. I mean, this is the fight back from China, but is it falling on deaf ears given the current post-COVID world that we live in?
Well, Manus, I think we'll have to see. I think, first of all, Li Qiang, so he's the premier, the number 2 in China behind Xi Jinping. I think his words were pretty strong there. I mean, you just reiterated that you know, him calling this a destructive spiral. I'm not sure how much this speech necessarily moves the needle, considering these are words that we've heard from Li and others in China for well over a year now. This was actually something that he had brought up just last summer, months after becoming the premier in China. But right now, it's a very, very tricky time for China's relationship with the rest of the world, of course. I mean, we've heard everyone, you know, particularly in the U.S., really criticizing China for these issues of industrial overcapacity. Obviously, China's pushing back against that. I think when it comes to those European EVs, I mean, we certainly know that China is trying to, you know, make some headway there. The Germans were just in China a few days ago, where it sounds like there were some conversations there about, you know, whether or not they kind of ease back on some joining in on this really, you know, this U.S.-led effort to kind of put in these curbs on you know, EVs, other types of Chinese goods. It's still a long way to go before I think we see any kind of major breakthrough there, it seems.
I think the reality of the whole decoupling, deglobalization, in essence, is ultimately higher prices, which is ultimately a global monetary policy issue, which is inflation. And then normal people like you and I have the reality of what global decoupling is, which is higher prices for everything that we go for. Look, in the end of the day, this is about China standing up for itself, building its own narrative, and becoming more independent. And this is what the president himself has been touting: the importance of building China's tech sector. We saw the Broadcom deal yesterday, which will be within the rules, but it is about getting up that tech curve, Jill, isn't it?
Yes, I'm glad you brought that up, Manus. I mean, we did just hear from Xi Jinping himself. He was speaking separately at a science conference yesterday about the importance of some of these issues. I mean, you know, sort of building advanced tech for China and becoming independent from the rest of the world on this issue has been a major, major platform for Xi Jinping over the last 5 years or so. I mean, we know how much China really, really wants to create its own types of advanced chips, for example, particularly when you've got all of these US-led export controls on things, trying to prevent them from doing so. We've seen breakthroughs in China over the last couple of years. I mean, I continue to go back to that Huawei smartphone last year that really did seem to move the needle a bit on tech. But I think what Xi Jinping really envisions here is a much broader, much more forceful show of China's ability to sort of break away from the U.S. and sort of create its, you know, this advanced technology, particularly if China is expecting a continued tension with the U.S. on trade and over, you know, the potential for additional sanctions that could curb its ability to develop this really, really advanced technology.
Yeah, well, of course, there could be political change in the United States of America, and that will add fuel to the tariff fire, which has not been extinguished in the past 4 years. Jill, thank you very much. Jill DeCease there on the China story. Shares in Airbus are sinking by double digits this morning after the surprise warning that they're short of millions of parts that make up its commercial aircraft. The CEO, Guillaume Fauché, saying that analysts, quote, jet engine supplies are in particular have recently emerged as the bottleneck, and they have contributed to Airbus lowering its outlook. That is a new situation we're not expecting. I thought CEOs were supposed to be forward-looking, planning and strategic, seeing the obstacles in the way of growth. Sid, what went wrong?
Yeah, morning. So for Airbus, the biggest problem at the moment is supply chain. I mean, you can't put together an aircraft without all your parts being available. And they're talking about how there is a shortage of parts across the spectrum, particularly engines at the moment, and also sort of cabin interiors and other parts. And so for the plane makers, it's impossible because they have huge demand. Airlines are clamoring for new planes. Aviation has taken off post-pandemic. And instead of being able to deliver on that demand, they're sort of dealing with supply chain crisis after crisis. And this has been something that's been coming for a while. So since the pandemic and the ramp up since, they've been talking about how supply chains have been sort of struggling. And that sort of seems to be the theme that continues as they go forward.
And Boeing obviously slipping as well. I'm just looking at the pre-market. It's down 1.3% at the moment and change. They've got issues as well. I mean, embattled would be the understatement of the year on that company. They're in the process of trying to buy Spirit Aerospace. This is to try and sort of consolidate their supply chain, bring it in-house, so to speak, after the folly of great outsourcing. But they're flipping the deal structure to all stock from cash. Is that because they're short of cash, or is it just a more prudent deal making to get it over the line?
Yeah, so it's still early days on that, and we understand Bloomberg News reported yesterday that Boeing is looking at a stock deal instead of an all-cash deal. And that's, I mean, Boeing has been burning through piles of cash. I mean, they've talked about how they expect to burn through $8 billion in the first half of the year. And given the fact that the FAA has constrained their ability to ramp up production on the 737 MAX, which is their workhorse and sort of biggest source of cash, they are looking at alternatives, and in the scenario that they aren't able to sort of generate enough cash. And so I think for Boeing, this is a sort of existential question. I mean, they're bringing back the Spirit Aerosystems, which was spun out in the great sort of when they were sort of dissolving the whole Boeing supply chain, and now they're sort of trying to bring it back in as they sort of try and bring back quality and sort of focus on quality and basically putting planes together much more efficiently.
Okay, just think of the bank exposure to Boeing. Nobody wants any more trouble, really, in the structure of that company. Sid, thank you very much. Bloomberg's Sid Phillip. Coming up in the show, Fed speak. Yeah, you got it. Treasury auctions, you got it. We've got everything. Context matters right here on Bloomberg. Good morning from the city of New York. It's going to be a hot, hot day.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything. countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m., only on Bloomberg Television. Context changes everything. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Manus Cranny. It's a live shot of Central Park South. I have it on good authority. It's 70 degrees right now out there. We're going to coast up to a mild 90. It's going to get sweaty in the city. We'll keep you appraised of the temperature. Stay hydrated and stay off the subway, I'd say. Let's check out what else we've got for you today. This is what's on the agenda. We've got more Fed speak after Mary Daly yesterday. We've got the Fed governors, Michelle Bowman, Lisa Cook, 7 a.m. and 12 noon Eastern, respectively. Never far from an auction, $69 billion of two-year notes. We've got 2s, 5s, and 7s. Just under $200 billion of paper coming down. Let's hope we don't get indigestion. You like a cruise, Carnival? The results are going to hit before the bell. And if you're using FedEx, we're also going to find out what kind of margins they have delivered. There's really only one stock that matters. It matters pretty much every day, but there you go. There is NVIDIA. It's a spirited fight back. We wiped out $430 billion over the space of 3 days, down by nearly 7% yesterday, so it's up by 3% just at the moment. Spirit Aero Systems. Boeing switches to stock-funded bid. We're just talking to Sid about that. Stock is down 1% pre-market. I'm off out to enjoy the sun. I'm not. I'm off to Invest America by Bloomberg. Some cracking interviews today. This is Bloomberg.
So what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
face bigger challenges next.
It was going to keep rain World Cup.
This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It does feel like for the first time in a while, the market has really been attuned to downside risks and growth.
The economy is clearly showing signs of deceleration.
I don't like the situation with the Fed, and I don't like the fact that the economic story seems like it's slowing a little bit right now.
In the next couple weeks, we could start to see just a continuation of the softer economic momentum.
A sharper downturn by no means is guaranteed, but I think the risks of that are higher than they were, let's say, a few months ago.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
It's NVIDIA's world, or is it? Welcome back. This is Bloomberg Surveillance for our audience worldwide. Anne-Marie Hordern, Danny Berger, I'm Lisa Abramowitz. John Farrow off until Thursday. We begin with a sort of question around NVIDIA. Yesterday, we saw a $430 billion sell-off over the past 3 days in shares of NVIDIA. Huge declines. Or are they? Danny, how much is it NVIDIA's world that we're all living in?
I have to say, this is probably one of the most constructive sell-offs we ever could have imagined for NVIDIA, because sure, the most ever for any stock selling off that $430 billion, but the S&P is only down less than 1% for those 3 days. It feels more like just a month-end rebalancing of shifting in to some of the losers. It's a technical thing. That's the flavor of it, not necessarily a fundamental thing.
I have a lot to say on that. I don't know that I totally am on board, considering that there's a 140% gain in these shares that year to date, including the 13% sell-off over the past 3 days, and the $400 billion of market cap is greater than the market cap of Johnson & Johnson, Home Depot, Merck, Bank of America, as well as Netflix. Anne-Marie, there is this question. We'll get to it. You can rebut but we can debate this the entire show. It raises this question, Anne-Marie, in my mind: how much were people pushed into NVIDIA because there was no other visibility on anything else, given some of the political uncertainty?
Well, when you have JP Morgan coming out with a note talking about the shrinking share of stocks that are driving the climb in U.S. equity futures, and then you start looking at, is this the summer of malaise, as Greg Peters is calling it a PGIM? He's going to be joining us, and he's talking about the fact that if you are an investor and you think November, and politics has become a big issue this week because the debate really kicks off the season, if you think that it's a coin toss, November 5th, then why would you do anything other than hunker down right now? And potentially that's what people are going to start to do.
And it raises the question of what is hunkering down? Is it just buying NVIDIA? Or to your point, Danny, and I think it's a really valid one, there are other stocks that have offset the decline that we saw in NVIDIA, which raises this question: is it any company that can deliver cash flows and people see a lot to like?
Well, I guess the question is, if it is month-end rebalancing, that doesn't necessarily mean people like the small caps and the underloved stocks. It's just a simple shifting because they have to, because certain correlations, certain things got out of whack. I guess the question is if you're worried about election risk, I mean, can you really buy some of these smaller companies? Can you really buy duration if you're worried about the fiscal deficit? I think you're right. I think you need to sit on your hands to some degree, but I'm just not convinced what we're seeing right now, Lisa, is any clear trade. I really feel like it's technical.
That's a very fair point, which is the reason why people are doing a lot of technical analysis this morning to try to figure out, are we there yet? And can they go back in? Just to your point, Anne-Marie, Sarah Malek of the Nuveen, the CIO, who's going to be coming on the show later this morning, pointed out that by the end of 2024, more than 4 billion people, representing close to half the world's population and 57% of the global GDP, will have participated in national elections during the year. The implications of this are dramatic, and yet it's so hard to predict what those are going to be.
It's really hard to predict, but now people are really starting to focus in on policies, especially in the United States. Axios this morning is leading with an article, a letter they saw from 16 Nobel Prize-winning economists, and they're talking about how their headline is that Trump's policies, notably tariffs, are going to be an inflation bomb. So you are going to start to see people start looking at potentially some of the noise and the rhetoric from what policies could be and what that'll mean for the real economy.
And that's the reason why people are watching the Treasury auctions coming up later today, kicking off the week. Just wanted to throw that in there. Meanwhile, in the markets, you could see crisis over. NVIDIA shares up 3.4%, so everything is Goldilocks once again. S&P futures up 0.2%. The outperformance coming from the tech names because of NVIDIA. So even though, yeah, maybe they don't drive everything, those shares are really conducting a lot of the market activity under the hood. Euro just fading just a touch, weakening versus the dollar, 107.25. It's basically been stagnant in this area. 10-year yields up just marginally, but down yesterday, really flat. The stability in the Treasury market is really notable after so many period sessions of just incredible volatility, and crude still hovering around that $81.30 level. Coming up, Sarah Hunt of Alpine Saxon Woods, with stocks coming off 3 days of losses. Sarah will be with us for the full hour. Peter Scheer of Academy on the geopolitical risks facing markets, and Bloomberg's Mandeep Singh, guess what? On NVIDIA, whether it matters, whether it is the crucial stock for this market. Let's begin with our top story. U.S. stocks suffering 3 days of losses following, that's right, NVIDIA's slump. Sarah Hunt of Alpine Saxon Woods writing this: we see the U.S. spending boom on AI continuing, perhaps to the detriment of other technological spending. Whether it can continue to drive equity markets will be the question, and the blistering pace thus far this year seems difficult to sustain. Sarah joins us now. Sarah, good morning. Thank you so much for being with us and waking up at this hour. Let's just start with this question of, is it NVIDIA's world and we're all living in it? Or to what we heard from Danny, is this basically evidence of the resilience of other names that can pick up when NVIDIA falls down?
I think to the extent that we have the market wants a theme and a story, it's NVIDIA's world and we're all living in it. To the extent that there are other parts of the economy that are starting to participate in certain ways, it's a dual thing that's going on. It's not just one thing. And I think, given how fast NVIDIA moved, it's not shocking that it's having some sort of a pullback, but it's not like retracing all of the insane gains that it's had thus far this year. So to us, it seems sort of normal that you would have some sort of a pullback. It was a very fast pullback and probably a little quicker than people expected. But that seems a little bit like you need to digest some of this, which is a word I hate to use in the markets, but it's true.
Well, that's the reason why maybe people are buying today. Maybe this was a dip, it was buyable, even though the shares are still up 140% year to date. There is this larger question, though. What does it do when one company can rise or fall and create or erase the market capitalization of some of the biggest, most well-known U.S. companies out there? What does it mean in terms of how much this market depends on NVIDIA to keep gaining, to keep going forward, and frankly, for the success of the U.S. economy?
Well, I think it is the poster child for the AI story, and the AI story has driven a lot of the technology performance year to date. And I think that it is the big growth story out there. It is the big technological revolution. The question is going to be, what are the use cases? Right now, people are scrambling to put in infrastructure that can handle these large language models, and that's where NVIDIA is getting so much traction. That's going to continue. The question then becomes, okay, now I have that infrastructure. What do I do with it? There may be a pause there, too. But right now, the driver is, I have to put in a brand new technology infrastructure, and that's going to be expensive, and I have the money to do it because all of their customers are sitting on a lot of cash. So right now, that's a major growth driver, and people are responding to that.
See, that's the thing. A lot of people question NVIDIA and say, at some point, this thing needs to come back down to reality. The thing people have a harder time grasping is what that thing is. You mentioned this idea that at some point, people will build up this infrastructure and take a pause and say, okay, what do we do with it? Is that the catalyst for it to come back down to reality, or is it something else?
It's hard to say because I don't know what the pace of that is going to be. Right now, the pace is blistering of what people are spending money on because it's a land grab. Everyone is jumping to say, I have to get these servers together, I have to get this capacity, and I have to be able to handle not just one large language model, but possibly more than one. So right now, the scramble and the spend is on getting that done. Microsoft's making money on ChatGPT. That's one of the reasons that Microsoft is doing so well. Who else is going to be able to jump in there and do that? And how fast is that going to happen? And I don't think we have the answer to that. I mean, I think the expectation is it's going to be great and it's going to be fast. We don't know yet.
Well, see, I think that's such a good point because one way you could look at NVIDIA's revenue is, as you say, it's these other companies' spend. They're putting huge amounts of money into it. So Microsoft, sure, a winner, they can monetize it. But are we potentially overlooking some of these other companies that are, again, plowing money into NVIDIA, the viability of that actually paying off?
I think the question is, like every other technology, what people expect the use case to be is probably not what the use case is going to end up being, but we still don't have an answer as to exactly what that is. So to the extent that we don't know where that's coming and that something might come in and all of a sudden people realize, oh, I can use this to do that, then you might get a new set of enthusiasms. But right now, the enthusiasm is for the infrastructure.
So when it comes to the AI-adjacent technology companies, if NVIDIA rises and falls, does that mean they're going down with it?
Well, it depends on why NVIDIA is rising and falling. If people back off on spending, then that's a big difference, and yes, they will fall with it. If it's backing off because it had such a huge run and people are now looking outside of it and saying, what else can I put money into that is also going to benefit from this spend? You know, you've got memory differences that have to be used with large. There's a whole lot of other parts of the technology stack that are going to change because of this movement in having bigger servers with GPUs. You know, liquid cooling, there's an enormous amount of stuff that goes along with this. So I think that it's a little bit more about looking for the other parts of the ecosystem than it is about walking away from NVIDIA. Right now, they're still in the catbird seat. They have a position that nobody yet can rival. At some point, will there be rivals? Probably, and certainly that will start more on the lower edges than the top, but it will happen.
So do you think that this is a point, though, investors should come in and buy if they potentially weren't already in NVIDIA?
I think that very much depends on your time frame. If you have a very long time frame, absolutely. If your time frame is very short, you'd want to see where this really settles. I mean, yes, it's up today, but it's had a big move down. So I would think that it really depends exactly what you're looking for. And on the short term, I would see a little bit more how it settles before I would jump right in.
How frustrating is it to understand things like valuation in a market like this, especially at a time where right now we see stability in benchmark Treasury yields, but there's a lot of uncertainty going forward, given the fact that we can't really project out how far this has to go or exactly what form this will take in? How difficult is it to have any kind of historical reference that you can bank on for a model going forward for more than just a couple months at a time?
Well, I think the very difficult thing is that right now it's not necessarily about modeling out the next 6 to 12 months because we don't know what they're going to look like. I mean, people will do that and that's their job and they will extrapolate earnings from here to there. But I think you really have to look at, okay, what's the bigger picture and where do I see the growth coming from and where do I see opportunities and what am I paying for it? So you have to think about all those things. 6 months ago, 3 months ago, NVIDIA was, relative to its cash flows and what it looked like was doing, was not that crazy expensive. And the move up has just been people going, oh, it wasn't that expensive, we should go buy some. So there's a lot of back and forth, but I think timing is important, so we try to keep an eye on that. But it is, right in this market, it is difficult.
I want to ask you that question about where the growth comes, but for the rest of this market. To Lisa's point, it has been tech the only loved thing, perhaps except for a minor blip. So if you're looking at these more cyclical stocks, you're looking at small caps at a time that we start to see the consumer maybe paring back, some of the growth metrics getting a little bit weaker. Where does the growth come for the rest of the market?
Well, there's an infrastructure build that's going along with a technology build, and that's going to be a positive for the industrial stocks. And I think, you know, to the extent that there's been a big move in utilities, that's a longer tail because it takes a long time to permit and to add capacity on the utility side. But are we going to need more energy? Are we consuming more energy? Yes. Do I believe that the technology will bring some of that energy usage down eventually? Yes, because that's what they do. But I think that there are plenty of places where this can broaden out that are about this infrastructure. But there's also, the consumer is, at the moment, a little bit more stressed than it was, and the larger tech companies are not particularly financially stressed at all. So right now, that's where a lot of the big spend is going.
I'm really happy to say that you are joining us for the rest of the hour. Sarah Hunt of Alpine Saxon Woods is sticking with us right now. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Apple has no plans to integrate Meta's AI chatbot into its iPhones, according to people familiar. The Wall Street Journal had reported the iPhone maker was in talks with the social media company, but Bloomberg News has learned those talks didn't get very far. Sources tell us Meta approached Apple months ago, but was turned down because the iPhone maker doesn't think Meta's privacy practices are tight enough. Shares of Germany's Merck are falling in European trading. The company says it will discontinue development of a drug that was meant to treat head and neck cancer. Analysts had estimated that that drug could reach peak sales of $1.5 billion. This marks the second high-profile drug failure for Merck since December. And Airbus is missing millions of critical parts needed to make its planes. The aircraft manufacturer warning late Monday that it's experiencing a shortage of engines, aerostructures, and cabin interiors. The delays are causing the plane maker to cut back on longer-term goals in everything from its operating profit and jet handovers to monthly production of its A320 model. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I agree with you, Anne-Marie. We don't want to hear about another airplane issue, this time with Airbus.
More delays, which basically get through all of it, supply chain, whatever you want to call what the issue is. At the end of the day, it likely will mean higher airfares.
Because there are fewer planes getting delivered. It also raises this question of what kind of hangovers are there in the physical world from the pandemic that really did hamper certain supply chains. Up next, flying blind into 2025.
there's a bit of fog here when you think about the 2025 outlook that the election is creating, even though there's not a sense that people really know exactly what to do right now with either outcome.
Which is why people just buy NVIDIA. That's coming up next. You're watching Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
NVIDIA trying to claw back some of the losses, and as a result, people are feeling good, at least in the stock market, except for the Russell 2000. Once again, lagging behind once as you get tech that's actually leading. Under surveillance this morning, flying blind into 2025.
Is this going to end up being something that sort of paralyzes the investment community for a period of time? And that is a thought that I think makes a lot of sense. I think there's a bit of fog here when you think about the 2025 outlook that the election is creating, even though there's not a sense that people really know exactly what to do right now with either outcome.
Here's the latest. The U.S. election kicking into gear on Thursday with the first presidential debate, followed by the first round of French elections on Sunday. And if that wasn't enough, the UK election happens next week. Peter Shear of Academy writing this: while the wild card risk is difficult to identify, there is a real sense of global unease, a lot of opportunities for troublemaking, and fewer reasons for the bad actors not to behave badly. Markets, in our assessment, are underpricing these risks. Peter joins us now. Peter, this has been the tricky thing. It's felt like this for a while. We've talked about the auctions. I've been hyper-focused on them and mocked endlessly for it. And yet we haven't ever seen the bond vigilantes come to the table and express their fear in the form of market pushback. How can you express concern in a market that can't identify risks and loses if they bet on them?
So one, I've been kind of avoiding the Treasury market as a way to express any geopolitical concerns, because normally we would get that flight to safety. But I think anytime we get geopolitical elevation, everyone gets concerned about spending, both domestically and foreign. So we've been playing it much more from the commodity markets. I think the commodity markets are underinvested. They're cheap. There's a potential for some sort of commodity shock. You know, when you look at this, you have China kind of built around all these autocratic, resource-rich nations, Iran, Russia, not good countries, right? And it's all, to me, going to feed through commodities if something happens. So that's where I like to express my bets, is via the commodity market and the commodity stocks.
Peter, in your latest note, you also say, is this a one-stock market? Calling it that seems a bit extreme, but is it? To Lisa's earlier point in the show, if you're so concerned about the election risk and the geopolitical risk around the world, is the answer just so simply to buy NVIDIA?
No, I don't think so. To be honest, it's one of these, right? We talked about this, I think, just last week when I was on your program. Momentum has worked very well. Momentum kind of feeds on itself. You have these ETFs where 50 cents on the dollar basically goes to 8 or 9 stocks every time money goes into QQQ. So I think that momentum built, it's starting to fall down. I think that's why so many people are now looking at technical levels, as you mentioned, right? The 50-day moving average in NVIDIA could be in play, and that's at $98, I believe. So I think there's more room to the downside on the momentum stocks. With the way the economy is shaping up, I don't see a lot of, good certainty for other stocks. So I think we get this pullback, and to the extent we get this quote-unquote catch-up trade, it's going to be in a down market where those stocks perform less badly rather than it's some sort of trend like we had last fall where the laggards really did well.
So Peter, what you're seeing then over the past 3 days, $430 billion wiped out of NVIDIA. Are you saying that this is the start of a sentiment shift? Because there's plenty of arguments out there, perhaps I need to be corrected at the start of the show, that it's just portfolio rebalancing towards the quarter end. So which is it?
I think momentum has a way of feeding on itself, right? So as it keeps going up, it forces more and more people in. It gets people stopped out. People feel they're missing the rally. People need to show, hey, I own NVIDIA. It doesn't matter what price I bought it at, or those types of stocks. And I think now that's unraveling a little bit. You start seeing that decline a little bit, right? To me, the fact that you have a 2 times leveraged ETF on a single stock strikes me as completely bizarre. That shows me just how much froth there is in that, and that it's moved to me to trading like a number, right? It's not trading as a market cap. It just trades as a number and who gets in last or not. So I think there's more room to the downside. I think people are going to try and buy these dips, but I think we're not done seeing the lows on this stock in the next month or so.
Good morning, Peter. I agree with you there, and I just wonder how you are expressing your conviction in commodities and in which direction right now, because if the rest of the market is going to catch down and you're seeing some wobbling into the China property markets and some of that other stuff, where is it that you are looking at the moment at commodities favorably?
I think mostly right now at the energy stock. I think the energy companies, there's some good driver stories behind that anyways, right? We need some energy for all the AI that we're going to develop. That's going to get done. So energy's been my favorite place. Industrials a little bit. I do like the potential companies that could be part of rebuilding Ukraine if some sort of a truce comes around there. But in general, it's really been mostly focused around the energy space.
How long-term is your bet? I guess that's one question as we sort of look at week-to-week volatility based on a lot of headline noise. What is the appropriate amount of leeway to give yourself in order for a trade at this point?
So for me, I think one reason I'm gravitating towards energy, I like it for the next 2 or 3 years regardless. I think there's a lot of opportunity in the energy space. I think we're going to have to continue building out new sources of energy and renewable energy, but we're also going to continually have to reinvest in traditional energy sources. You see what's going on in terms of the growth in India. India is going to suck in more and more commodities into their system. So I think there's a lot of potential for that. So to me, I kind of get the geopolitical risk, not quite for free, but I feel like I get that potential bump without having to, detract from my overall thesis.
So just to sort of take a step back, overall, you're saying the geopolitical uncertainty creates a lot of questions. The question is how you want to play that, since it's very difficult to do, say, in the Treasury market. You're looking at commodities instead. You see NVIDIA as seeing more downside losses. When you zoom out, how are you arranging what your ballasts are? Is it just energy and cash? Is it energy and short-term T-bills, and then basically a cadre of energy stocks that you think are going to be most relevant? Can you give us a sense of what you're shifting overall?
So we've been shifting in and out of duration. I love the 10-year Treasury when it's above 450 and above. I really don't like it at 430 and below. So right now I'd be much more in cash in terms of where I want my fixed income. You have to keep equities. And again, I think the U.S. has probably still been the best place to be. I actually don't mind Chinese equities. I think this friction is going to create more and more opportunity for Chinese stocks. I think there's deglobalization. I think we're headed on a bad path. I would not want to invest in China long term. But I think for a trade, you can get back into those FXIs, KWebs. And a lot of our attention right now is being focused on what's going on with the Philippines and the Second Thomas Shoal. It's kind of off everyone's radar screen, but there's more and more escalation there. And one of the real problems is we actually have a treaty to come to Philippines aid if they have a military service person die. So what happens there when you have something that's 100 miles off the Philippine shore? China's becoming more and more aggressive. There have been injuries now. Those are the little things that are popping up, and we're also watching, does Putin try and do something ahead of the election, because if any global leader would seem to want Trump, it would be likely Putin, and certainly a commodity spike, anything that hurts oil, would hurt the Biden administration, so Putin might be, emboldened to try something over the summer.
Peter, in the same breath, you said you're going into Chinese equities, but you're concerned deeply about the geopolitical risk around the Philippines and China. So what's your timeline for being a traveler in China?
I think for the next 3, 6 months, maybe even a year, I think part of our thesis has been this made by China, where China is trying to sell their brands globally. They're not going to have immense amount of success in the U.S., though maybe that I'm even underestimating as places like Temu continue to take off. But you look what they're doing with their EVs. They're trying to sell those globally, right? Our view has been China has these autocratic, resource-rich nations where China generally has trade deficits because they've been buying their commodities. We think they're going to start selling more and more of their brands into that, so that will actually be good for the Chinese companies, as they kind of become global brands. I don't like it. It's not necessarily where I think we should go as a nation, and we should probably have to do more to defend that. But that's how I see that playing out. So I think if we get any sort of economic turnaround in China, it's going to benefit Chinese companies much more than global companies, unlike the past, 2 decades.
Peter Scheer of Academy, thank you so much. Enjoy London. Have a great vacation. We'll see you on the other side. Sarah Hunt's still with us. How much do you agree with that? Buy Chinese stocks because the idea of trying to sell to the rest of the world will gain traction on some level.
I think that there is a trade in there for certain. We definitely tend to stay much more on the U.S. markets than we do on the foreign markets. I think to the point that the deglobalization is problematic in terms of the kind of growth that historically would ramp up the rest of the world, which is a point that he was making towards the end there, that a big amount of Chinese growth has usually been good for the rest of the world. And if you are starting to see a bifurcation where you've got a bunch of countries that are working together and trying to sell into those markets and not so much the cooperation that we've seen between the OECD and China, I think that's part of the reason that there's an inflationary forces that are even without some of the current things that we've seen now, and one of that is deglobalization.
So in other words, you're not convinced on Chinese stocks?
Not right here.
I'm just trying to put it together because this is some of the aspects that people are looking at. Coming up, NVIDIA looking to bounce back after erasing $430 billion in market value over 3 days. We're going to be speaking with Bloomberg's Mandeep Singh coming up next to talk about Danny's point, which is essentially, isn't this a sign of resilience? Because A, it's bouncing back, and B, other stocks took up where it left off.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big. With $1 trillion of assets almost, we're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Trying to claw back some of the $430 billion of market losses over 3 days for NVIDIA and bringing the rest of the market with us. Good morning. Welcome back. This is Bloomberg Surveillance, taking a look at stocks edging higher, led by the tech shares. NASDAQ 100 futures up 0.4%, a reversal where the NASDAQ had really lagged behind. S&P futures up 0.2%. Russell 2000 struggling to get above red, which really is a reversal again based on the outperformance. Raises a question, how much do we really care about this? And I say this not as somebody who's losing or gaining a lot of money, but Danny, to your point, how much is this just sort of technical rebalancing that everyone is making a big deal about because there's no certainty to talk about anything anywhere else?
Well, that seemed to be the move to me because it was so sudden, no clear catalyst. But you listen to Peter Scheer, who says this thing can continue, that if we're getting momentum that's flipping, if you have these strange ETFs where you can 2 times leverage NVIDIA, if sentiment is turning, it will turn hard and it will continue.
In the meantime, it seems like there is sort of an uneasy calm under the surface. And when I say under the surface, I'm talking about the bond market. Take a look at 2s, 10s, and 30s. You can see that stability. And I say stability because if you look at a graph looking at the past 5 days, it has barely moved. And when that's really a shocker considering some of the volatility, some of the gyrations that we've seen so far year to date. 2-year yields 473, 10-year 423, 30-year 436. That all could change with one auction. And that's really why I'm watching the $69 billion in 2-year notes being auctioned off at 1 p.m. Sarah Hunt still with us. Sarah, how much are the auctions instructive at a time of relative stability where why bother betting big on treasuries if they're just going to whipsaw around and end up at the same place anyway?
I think the auctions don't matter until they matter, and they only matter if something goes wrong or if it looks like there isn't enough demand for U.S. Treasuries, because we are refunding so much and that deficit is continuing to go up even in an economy that's not terrible. So I think to the extent that people only worry about it when it starts to look like there's a problem and all of a sudden that's going to change yields, then it becomes an issue. When they go well, people don't notice as much because it's not a problem. It's only when they go, oh my goodness, there's a problem with demand on the Treasury side. We have a lot of Treasuries that need to be sold. So then it becomes an issue.
And that's the reason why people watch them and then they're non-events, and then people say, why do we even watch them? And then they watch them anyway. Meanwhile, you transfer this through the currency space, the foreign exchange space, as we await what's going to happen in France. You can see a marginally weaker euro, but some stability there as you have a number of people saying, go into French bonds, go into French debt, go into this idea that maybe some of this is overblown. I'm thinking of Bank of America in particular, which brings us to under surveillance this morning. Marine Le Pen's far-right party widening its lead ahead of that first round of French elections this weekend. Le Pen's party rising to 35.4% in Bloomberg's poll of polls ahead of the leftist alliance, with Emmanuel Macron's party in third. And Marie, this to me is fascinating because even if Marine Le Pen's party wins, still unclear what that actually means for policy.
That's right, because you're going to have basically a split and divided government. But you can see Macron is clearly nervous. Yesterday he came out talking about how whether it's the right or the left, their policies are invoking a civil war. But all of this rhetoric he's been talking about hasn't fended off what we've seen, which is them just continue to rise, whether it's the right or the coalition of the left, continue to rise in the polls. You mentioned Bank of America saying go in. Allianz last night is actually saying that these French officials need to come out and reinsure investors, especially foreign investors, given the share foreign investors have in the French bond market, that there's not going to be a euro crisis, because any woof of what we saw in the past when it comes to the sovereign debt crisis in Europe, that is going to spark fear.
French officials are trying to do that. Marine Le Pen's party is trying to do that. We had her right-hand man, Jordan Bardella, come out and say, look, we're going to be reasonable with this budget if you elect us into office. We will bring the deficit back in line with what the EU wants. There is this feeling that Liz Truss changed everything, that everyone looked at what happened to her and said, okay, she essentially got kicked out by the bond market. This is a real threat. We need to come in and we can't shake the boat too much. I mean, we saw it with Meloni. Meloni, before she was elected, had these much more far-right economic policies. She gets into office and she moderates. So that might be what we're witnessing with France, too.
The ghost of the Liz Truss moment hovers and disciplines all. Meanwhile, shares of Airbus tumbling, the plane market cutting its outlook amid a shortage of parts caused by supply chain constraints. Meanwhile, Boeing's bid for Spirit Aerosystems will value the supplier at around $35 per share, about a 6% premium to Spirit's stock price. All right, so we knew that Boeing was going to buy Spirit. The more interesting story to me, Danny, is really this question around, we've bashed Boeing, we've dragged it in the mud, we've talked about how it's this, really troubled plane maker, Airbus, the gold standard, and then this.
I mean, it just shows that the pain is going to be here for some time. Guillaume Faury said something like it'll be 3 to 4 years until the supply chain is back to normal. Great. So we can't fly on a Boeing because we're all scared. We can't fly on an Airbus because there aren't enough on there. We're all just going to be on older planes, which means more fixes, more delays. It is the summer of discontent, Lisa.
But Sarah, to this point, how much are we not seeing the full effects yet of just how much industrial areas were really disrupted by retirements, by people leaving the workforce during the pandemic, not to have returned, especially with their expertise, at a time where we're depending on the physical world to continue to support some of the technological advances?
I think it's absolutely an issue. And I think that, like everything else where there are long lags, people don't think about how long that can take to resolve itself. And if you had a long period of time where the factories weren't running properly, machines need to be restarted, everything needs to go back to where you were, and there's going to be some slippage in there, and you're seeing that now with Airbus. And it's interesting that you're seeing it now as opposed to 6 months ago. You would think that there would have been an eye to the supply chain a little bit earlier, but this is also where we got so used to just-in-time inventory that when you take something and throw that out of whack, I don't think people realize the ramifications and how long that was going to take. And not only are they going to be more expensive, but those planes are going to be absolutely full. Having just flown yesterday and the day before on 4 flights that were absolutely full, I think that we can just continue to look forward to that.
Well, and this actually raises issues also about some of the disruptions that we see in the Red Sea going forward. What kind of further other kinks could you get to the system? I don't want to think about it. Meanwhile, I do want to think about NVIDIA because that's evidently what all people can think about. Shares of NVIDIA rising in the pre-market after a 3-day slump that wiped out about $430 billion in market capitalization. That's the biggest 3-day value loss of any company in history, and saw NVIDIA's market cap dip below $3 trillion under both Microsoft and Apple. Mandeep Singh of Bloomberg Intelligence joining us now. Peter Scheer saying it's just a number really resonated with me. At this point, it just sort of monopoly money, because it's hard to sort of imagine the idea of the gain or loss of a Johnson & Johnson or a Bank of America in a couple of trading days. As hard as it is to imagine $1 trillion of market capitalization created in just a couple of months. So at what point can you put any credence on these moves other than just technical rebalancing?
So you're right, nothing has changed fundamentally to validate these kind of moves. But, at the end of the day, this is a stock that's trading at 40 times price to sales. It's the largest market cap company, or it was a couple of days back. And you have to ask yourself, how long can it sustain that path? Because everyone is excited about the prospect of AI. That's why they had 126% growth last year. And look, I think everyone realizes this is not sustainable. But in the end, it comes down to when are they going to really slow down? And that's where you have to look at the different moving parts, whether it's the cloud service providers' CapEx spending, or the end market demands from the software guys, or even Apple jumping into AI. Now that they have a large language model, Are they going to invest in AI and ramp up the capex spending the way other hyperscalers have done? So these are the unknown questions that's going to drive the momentum. But that's what market is grappling with right now.
I mean, something very similar that Sarah was talking about, this idea of everyone is, I mean, it's consensus at this point that NVIDIA is overvalued, but also consensus is this is a rock star of a company that has huge transformational changes. So what could bring it back down to earth? Is it in earnings? Is it competition? Is there any really clear threat at this moment?
Yeah, so if you look at it historically, whenever we had a chip wave, for every $1 in chip revenue, you generate $4 in software revenue and probably $6 to $7 in services revenue. What the market is waiting for is, look, we've spent almost $100 billion in data center GPUs last year. Has that translated into software revenue of $200 to $300 billion, another $300 to $400 billion in services revenue? If it hasn't, will there be a pause? Will there be a digestion to figure out when does it translate into software revenue? Because the semi companies always see that demand early. That's been the case always. What's different is NVIDIA having mid 70% gross margins. So that's where, is it really different this time, or the value gonna accrete to the software guys, and the services guys will have the services to show. So that's what market is waiting for.
So when will we find out?
Well, so I think this quarter earnings will be a good kind of reflection of where we are in terms of the software monetization. Everyone is talking about copilots, the fact that GitHub Copilot is successful, chatbots, customer service chatbots. So there are some tangible use cases that everyone recognizes. It's just how does it translate into revenue? Adobe gave us a data point where they did beat expectations. Salesforce didn't. They talked about high single-digit growth, going forward. So clearly there is a divergence in terms of how these companies are looking at AI contribution. And in the end, it comes down to hyperscalers. That's where all the AI capacity is getting deployed. If the hyperscalers see an acceleration in their cloud revenue, that's when this is going to translate into revenue near term.
Mandeep Singh of Bloomberg, thank you so much for being with us, as always, and for the insights. Sarah, I'm curious from your perspective, how much the idea of U.S. exceptionalism is tied up in this idea of AI adoption? Is that really what's been fueling the divergence between the U.S. and the rest of the world's economy?
I think it's the AI boom, but I also think it's technology in general. The U.S. has been much more of a juggernaut on technology than some of the other countries. It doesn't mean that there aren't places in those countries, but it's not the infrastructure in the U.S. and what's gone on in the technology sector. A lot of that innovation has come from here. When people talk about exceptionalism, I think part of it is the things that have been built on the technology side.
So it's AI, everything that is adjacent to it. If it's not in the United States, who else can benefit from this?
Well, the areas where you've got people that are making companies like ASML and TSMC, right? The companies that are in this infrastructure. But if you think about the Googles that have been built and Metas that have been built, all of that, and Amazon, all of that was built in the U.S. So it's not just AI, it's that whole technology stack that people have gone, again, you start out with something at Amazon and you go, I'm not sure where it's going to end up. Nobody, when it first started, thought it was going to end up a web hosting, the major web hosting company. But there's that change there and there's that continuous innovation. And I think that that is something that tends to be centered more in the U.S. than outside of it.
You have this infrastructure in the U.S., but Sarah, I am struck that this is coinciding with the whole onshoring, friendshoring kind of thing, that you want to have your AI infrastructure and you want to have it closer to home. So could one make the argument Europe's going to have to catch up at some point? Europe also is going to need the infrastructure closer to home. I know Apollo and Intel partnered to build something in Ireland, that trend's going to have to continue.
I think this is part of the issue. What is inflationary about regionalization and a lack of globalization is that you have to add capacity in places where before you were like, well, globally there's enough capacity to do this, so I'm not that worried about it. Now, because of the things, and Airbus is a great example, because there's something where that supply chain was global, and now you're seeing the problems that has when you have a major disruption. So that isn't in and of itself is not deflationary, it's inflationary because you're adding to costs by doing that. So that's part of the tension that we're seeing with all the things that are going on right now. And how do you rein back inflationary pressures when they're not just about too much money chasing too many goods?
I just wonder, as everyone talks about the physical world and creating all this stuff and the industrialization, are younger people going to be able to do some of the skills that require actual physical work other than just looking at a phone? I know this is crazy, but I just wonder about what kind of training there is. I don't know. Does anyone talk about that ever?
Well, I will tell you that the person who does talk about it the most is Nick Pinchuk, who's the CEO of Snap-on, because they've actually had to create an innovation center locally for them because they can't get people who have the trade skills to do the things that they need to do actual physical work. So there's going to be a question about how that plays a role. And right now, we went so far to the other side of that I think you're starting to realize that that's a problem.
Thank you so much. It just is my internal concern based on home side issues. Meanwhile, let's get an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Novo Nordisk plans to invest $4.1 billion into another U.S. factory as it plows more money into its biggest market. Novo saying the project will double its production footprint in the U.S. and add 1,000 jobs. The new site is the latest multi-billion-dollar investment by the Ozempic maker, with the company saying it plans to pour $6.8 billion into production investments this year. That's up from $3.9 billion in 2023. The nearly 15-year battle over the prosecution of Julian Assange may finally be coming to an end. The WikiLeaks co-founder is expected to plead guilty on Wednesday to leaking U.S. national security secrets. Assange was accused of publishing sensitive U.S. military documents back in 2010 and 2011 in one of the largest breaches of state secrets in U.S. history. The plea deal would allow Assange to avoid prison in the U.S. and return to his native Australia. And the Florida Panthers have won their first ever Stanley Cup, defeating the Edmonton Oilers. The Panthers had taken a 3-0 lead in the best-of-7 series, only for Edmonton to win the next 3, forcing a deciding Game 7. Both sides scored in the first period, but a second-period goal for Florida was enough for them to seal victory and the championship. Despite being on the losing side, Edmonton superstar Connor McDavid was named the series MVP. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, waiting for the inflection point.
So far, the adjustments in the labor market have been modest, not really pushing up the unemployment rate. But we're getting nearer to a point where the outcomes on employment may be less benign.
That's coming up next. Mary Daly with some really interesting comments. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Well, coming into a day trying to gain after 3 days of losses on NVIDIA. Welcome back. This is Bloomberg Surveillance. Under surveillance this morning, waiting for the inflection point.
Both supply and demand factors have contributed to the reduction in inflation, and we've done all of this without a big disruption in the labor market. When I put all this together, I think monetary policy is working, but there's still more work to do. So far, the adjustments in the labor market have been modest, not really pushing up the unemployment rate. But we're getting nearer to a point where the outcomes on employment may be less benign.
Here's the latest. Investors looking ahead to another read on the U.S. economy with consumer confidence data due at 10 a.m. Eastern. Plus, more Fed speak today from Michelle Bowman and Lisa Cook. Nick Benenbrook of Wells Fargo writing this. Recent U.S. inflation news has been more encouraging, likely keeping the Fed on track to start cutting rates in September. Against this backdrop, U.S. dollar strength could persist for now through late 2024. Nick joins us now. Nick, good morning. Welcome. Thank you so much for being here. I want to start with Mary Daly's point of the San Francisco Fed. She's talking about how at this point is when you might start to see a nonlinear increase in unemployment. Is that something on your radar in terms of a real risk, or is this more interesting in terms of where the bias may be on the Fed?
Probably the latter, the bias on the Federal Reserve. I mean, it's fair to say that, when you look at a lot of the leading indicators, job openings, we could start to see a slightly accelerated increase in the unemployment rate. But overall, if you look at the consumer fundamentals, we're not that worried about a recession of any kind. And therefore, we're not really worried about the unemployment rate spiking.
So if we do have Mary Daly changing her language, and it is more interesting from just a Fed perspective, do you think that she's potentially not alone in this? That if the Fed is starting to get concerned about a shift in the labor market, that it's not just vacancies that aren't filled, but it's actual layoffs, a cut could be coming sooner?
I don't know about sooner. I mean, what I would say, though, is if you looked at the early part of the year, there was a lot of frustration on the part of the Federal Reserve, those inflation numbers that really weren't helping out. Now the labour market's kind of improved. We're seeing some softening in the labour market, which helps from that inflation perspective. But I think more importantly, inflation has started to cooperate. And so at that point, we're still comfortable with the idea that, yes, we're in September. We were thinking maybe we'd get pushed back to December. We're holding steady at September.
I think that the CPI numbers last week were part of that ability to look at September again, because the employment stuff looked so strong the week before. But if I think about the idea of, cutting ahead of time because you don't want to be behind the curve, and where does that sit right now? Because it does seem like that labor market is getting a little bit softer, and sometimes that goes from a short softening to that can spiral pretty quickly. So how are you thinking about that and how that works for the Fed? And what does 25 basis points do for that?
Well, I would say 25 basis points. I mean, it probably doesn't do a lot, but you have to start somewhere, I suppose. I do think that's part of their calculus. I mean, I believe the Federal Reserve policymakers, they were certainly scarred, shall we say, by the experience of the pandemic and the way that inflation got away on them. But they are looking at the softening in the jobless claims, for example, the job openings, and the real Fed funds rate is extremely high now, sort of 5.5 relative to sort of 2.5, 3% on the PCE. So from that perspective, even though they're not quite at their inflation target, they are probably at the back of their minds worrying about that more excessive slowdown and thinking, yes, we need to start moving ahead of time.
Which is the reason why you see September as a feasible date to start cutting rates, and yet you still expect dollar strength. Is this because of this expectation that the Fed's not going to cut as much as the ECB, or is it actually independent of any central bank and just simply the U.S. is less dysfunctional right now, at the moment, at least the appearance of it, than, say, France?
Yeah, I mean, I think a little bit of that political uncertainty in France is holding the euro back for the time being. But, and to be fair, I think our main story is maybe a little bit more dollar strength through until the end of late 2024.
So starting at 7 a.m. Eastern Time, we do expect to hear comments from Fed's Bowman, giving a speech on U.S. monetary policy and bank capital reform in London. Both a text and a Q&A are expected.
We're seeing hints of a U.S. slowdown at this particular point in time. And so while the U.S. rates remain high and while the U.S. is still sort of moving forward, that's kind of probably going to keep the dollar on the front foot for the time being. But I think the longer term trend, as we see US softness, as we see US rate cuts, 2025 is probably more a dollar weakness story.
When you look at France, what do you make of what's going on with the bond market in the sense that Zurich Insurance says we're not going back to that place we were? This new spread we have between French bonds and German Bunds, that's here to stay. Would you say then this is an area you should avoid, or do you not think it's going to be as bad as some are maybe fear-mongering and it's time to get in?
Yeah, I mean, I think on that perspective, I would probably be in the camp that says it's not going to be quite as bad as feared or worried about. I think that spread is currently 75 basis points between French and German bonds. And I think a lot of the bad news is priced in. Now, we know France isn't Mexico or South Africa, but they had elections there recently as well. There was a lot of concern immediately after the elections that policy would move in an unfavourable direction, but some of the fears have calmed down. I think with the French election, so long as we don't sort of see an absolute majority by, say, the National Rally or one of the opposition parties, I think that most of the bad news is probably priced in. I wouldn't be surprised if we saw that spread narrow a little bit. Maybe not all the way back to the 50 basis points, but I think we can get into, say, 70 and 60 basis points. I think at the end of the day, it's not going to end up quite as bad as we think.
Nick Bedenbrook of Wells Fargo, thank you so much for being with us and for your thoughts. Sarah Hunt, we've got a couple minutes with you. Thank you so much for spending the hour with us. I want to start with just the idea of, are we really playing this game of who's the most dysfunctional political house in the world, and then just sort of going to the other side of the boat until tensions calm down?
Unfortunately, I think we are playing a game of where is the least bad, right? And this has been the story for so long about currencies. It's been the story about markets, almost since the financial crisis. It's like, where is it the least bad? Let's go there. And I think that is part of the issue. And you look at the political calendar globally, and it's difficult. I mean, we're finally starting to focus on the U.S. election. We'll see what happens this week. But people really haven't been focusing on it because it's out there. And now all of that is coming and coalescing. And I think that's one of the reasons that we feel that this summer is going to be a lot of push-pull on the markets. There's no direction. And this is part of why people are having trouble finding conviction in a trade at the so much out there that's unknown. And I think that, to the extent that you want to be in the least dirty part of the whatever, it's just, that's not a good thing, right? But it's the way that it is. And that's what we all have to contend with.
If November 5th is a coin toss, though, which the polls show it is, how do you trade this summer? How do you prepare at all for that?
Well, even the discussions about what would be worse about a Trump presidency versus a Biden presidency on the tariff side, I think there's a lot of rhetoric, and the question is what would actually get done. And in the end, there was a lot of discussion when Biden won that he was going to change some of the policies that were there, and they didn't really change. So I think that there's a lot of discussion that happens, and then you get on the ground and you realize that there's only so much you can do without the potential of throwing things off too far kilter. And I don't think any politician wants to do that because nobody wants to throw the U.S. into a recession.
Sarah Hunt, thank you so much for being with us and for spending this time with us. Sarah Hunt of Alpine Saxon Woods with a real insight into a world in turmoil. Danny, I'm struck by when we're hearing about Sarah's talking about sort of this, or implying this paralysis almost. How can you get ahead of some of these elections when it's staring into an abyss? Which raises the issue of some of the technical discussions that you're talking about, because it's sort of dancing on the head of a pin.
And it's also just this environment of where do you go that is safe right now? I mean, the least dirty shirt in the laundry, I guess, is NVIDIA, I guess, is tech. But what happens when you face an environment like this week where it's not safe? Where do you go? Can you go to duration? Maybe not, because we're worried about the deficit. We're worried about auctions. You're just kind of stuck in this no man's land that I think maybe just brings us back to cash. I'm not really sure.
Well, we'll get some insight on just those questions coming up next. Morgan Stanley's Mike Wilson, Bloomberg's Benedict Kamel, and Greg Peters of PGIM Fixed Income. Right now, markets trying to stage a rebound after 3 days of losses on NVIDIA, although not dragging down markets as much as you might think over those 3 days. Today, pushing up markets higher with S&P futures up 0.2%, yields pretty much stasis, 422, down a basis point.
From the world of politics to the world of business, 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on
that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this
So just less than 1 minute away now. We do expect to hear comments from Fed's Bowman speaking on monetary policy and bank capital reform. Again, a text and a Q&A are both expected.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New season starts July 10th on Bloomberg Television.
10 seconds.
This is a fairly complex market. Like say,
Fed's Bowman says we remain willing to raise rates if inflation progress stalls, so we're not yet at the point where it's appropriate to cut rates. Further saying to expect inflation to remain elevated for some time, saying we see a number of upside risks to the inflation outlook. Bowman also adds by saying only seen modest further inflation progress in 2024. Bowman also says should data show inflation moving sustainably to 2%, it will eventually become more appropriate to gradually lower the policy rate, so a bit more colour on that prior headline.
Welcome back. This is Bloomberg Surveillance.
Bowman says the baseline outlook continues to be inflation will return to 2% with the policy rate held steady for some time. Bowman also says we are willing to raise the target rate at a future meeting if inflation progress stalls or reverses, saying we will remain cautious in approach to future changes in the policy stance, saying that other central banks may ease monetary policy sooner or more quickly than the Fed.
Long-term fragility and sort of being leveraged to one stock and one stock alone.
It does show vulnerability of this market, but I don't think it yet shows a narrative change. This is still such a loved company. You can even see it in the discussion we had for the past hour. What else can you buy right now?
Which really is because we're looking at a political backdrop that, as Lori Calvasina said, is like staring into the sun. We are looking at elections around the world, accounting for about 50% of global GDP in terms of potential political shifts. How do you real sea changes in policy that have been the bedrock of a lot of bets made in the market?
Well, in the last hour, my big takeaway from Peter Cheer and Sarah Hunt was no one's going to fault you from owning NVIDIA. And if you're so concerned about the U.S. election, and it's what Lori Calvasina is talking about, staring into the sun, and now you have this period basically of paralysis and angstiness this summer, then maybe you want to stay on the sidelines and only just buy NVIDIA on dips like we saw yesterday.
Which is sort of a difficult thing on a moment when people are saying it's time for active management. I do want to get right to our guests because we've got some wonderful guests coming up, and right now in markets we do see a little bit of a lift, but really calm. What I've really struck by over the past couple of days, as Danny pointed out, and she's really right to do so, this idea that we haven't seen a massive rout in tandem with NVIDIA. Other shares have been offsetting it. You pointed that out. You're seeing that again today. S&P futures up 0.2%, even with NVIDIA up some 3.5%. It speaks to almost a resilience, a stability under the hood.
It does. We have gone through over a year now with a less than 2% decline. I mean, there have been longer stretches, but it does show even if NVIDIA drops the most by any stock has ever done in market cap over the past 3 days, just a rotation happened over the surface. Sure, it's not lasting today, but there is some form of resilience in this market.
It's almost like the cylinders are just offsetting each other in tandem. What you can see is a little bit of dollar strength versus the euro, but kind of more abound in this range of 107.23. And you can see real stasis in the yield space, which I find fascinating given some of the fluctuations that we've seen over recent months. Coming up this hour, Mike Wilson of Morgan Stanley saying growth right now is more important than inflation, echoing a bit of what Mary Daly was saying. Bloomberg's Benedict Campbell on new worries for plane makers. And Greg Peters of PGIM Fixed Income saying it's still time to take on risk, but with a real eye toward the uncertainty in the political sphere. We begin with our top story. NVIDIA is looking to bounce back from a $430 billion slump. Mike Wilson of Morgan Stanley expecting narrow market performance to continue, writing this: we continue to recommend a barbell of large cap quality growth with defensives while fading lower quality cyclicals and avoiding the temptation to play for a true broadening out. Today is a good
So also
example of that,
noting
Mike,
here,
given
Fed's
the
Bowman
fact
says
that
she's
we are
still
not seeing the
open
Russell
to
2000
raising rates if
participate in
inflation
today's
does not
enthusiasm.
improve.
Mike, wonderful to speak with you. Really appreciate it. You've been talking about this for a while, that it's not necessarily this all boats are going to be lifted by this AI enthusiasm. What's your takeaway from the volatility in NVIDIA shares? And to Danny's point, the idea that we have not seen it broaden out to some sort of contagion or real market weakness.
Yeah, well, look, I mean, I think the market's pretty smart, as usual. It's figured out exactly what's going on. We go back to, I think, probably our main narrative, which is probably not consensus yet, which is that this policy mix that we've had is very unusual, right? We have this incredibly strong fiscal policy, which is keeping pressure on the Fed to keep rates higher. We know rates are too high because the yield curve has been inverted. So that is sort of hollowing out or crowding out a good part of the economy and stocks. And so what does the market do? It gravitates to these lifeboats that can actually perform in this very challenging economic environment for most operators. When I say most operators, I'm talking about consumers and corporate. And that's reflected in the data, right? And it's not just the Mag 7, by the way, that's high quality growth. There are some really good high quality growth stocks outside of tech and comm services that have been performing well. And I think you said earlier, this sort of almost like pistons moving around. The VIX is really low and volatility in the S&P 500 is low, but the volatility under the surface is enormous. And so, because it's sort of like the boat that's tilting back and forth. If people are running to different sides of the boat can actually remain fairly stable. And that's what we have going on until there's probably going to be some sort of shock. Maybe it's the elections. And by the way, the elections don't have to be necessarily worried about bad outcome. It's just higher volatility for the broader averages. Like, elections have consequences. And we're seeing that all around the world now. Why is our election going to be any different? When I say consequences, I mean consequences for obviously the economy and for policy, but also consequences for volatility in the marketplace.
So before we get to the elections, we'll talk more extensively about that in a bit. I do want to talk about the idea of a shock. And you laid out 3 different potential shocks in your recent research, talking about the potential for upside acceleration in inflation. You say nobody's really counting on that, neither do you. Then you talk about some sort of liquidity shock. You talk about the Treasury auctions and some sort of issue with market functioning. And then you talk about what you see as the most likely, which you just flicked at, which is this idea of growth. Right. And that potentially you could see a real fall off in growth, which was kind of what we heard from Mary Daly. What are the signs that we're getting closer to that? And when do you sort of throw in the towel and that being a near-term kind of reality if we don't see more material weakening?
Well, the market is already leaning in that direction, right? It's saying that growth is probably going to disappoint. By the way, growth has disappointed this year. Most of the economic surprises have come on the downside. That continues to be the case, which is why that upside case is probably less likely. So how has the market dealt with that? Well, it's gone to large cap, quality growth and some defensiveness, which is very typical in a late cycle economy. The reason we bring this up is because look, the market's priced for a soft landing, and that is sort of the base case consensus view. That's all well and good. The problem with that is that let's say it happens, well, where's your there's a lot of upside, which means you got to pick stocks. And so that's what the market's doing. It's doing the best it can in that sort of a setup. So what's the key trigger going to be for us to say, okay, that growth is turning into a real growth scare or potentially recession fear? It's the labor market, right? The labor market, if the labor market breaks down, by the way, that's what the Fed's looking at too. So if we were to see a non-farm payroll number under 100,000, unemployment go to 4.3, 4.4, you better believe the Fed's going to probably cut rates. The market's probably not going to love that initially unless they cut 100. 25 basis points into a real growth slowdown, the market will correct probably 10% on that sort of an announcement.
I was going to say, usually the argument of, oh, stocks can survive is because if they cut, then they get some support. But to your point, it needs to be some cut sort of in size. So if we kind of take a step back and say, all right, NVIDIA, clearly there's a lot of valuation here that shouldn't be baked in, that it's been multiple expansion. If you just strip that out, does the rest of the market make sense to you, where we are with everything else?
Well, I mean, like I said earlier, the market makes perfect sense. It's paying up for quality, and it's paying up for growth that is, idiosyncratic from the economy, and maybe some defensive properties. Okay, great. So I think the market totally makes sense. The question is, are those multiples now in those particular stocks too high? I think if you get a perfect, soft landing on this plane, it could be fine. If you get any aberration from that, it's going to be a problem. And that's why we wrote about it this week, which is there's these three risks. Could inflation pick up again? Could there be a term premium spike because of the fiscal unsustainability? Or could there be a growth slowdown? Of the three doors, to put it in Monty Hall terms, I'd take door 3 as the highest risk today. Okay, that could change. And this is another lesson from the last year and a half. I mean, how many times have we changed the narrative in the last 18 months? We've gone from hard landing, soft landing, no landing. I mean, it's like, musical chairs. So right now it's soft landing. Great. As long as that remains stable, we can kind of stay in this sort of environment that we're in. But we have to be, as macro investors and traders, we have to understand these are the risks.
But there's an irony in it, which you already pointed out, is that underneath the surface, you are getting these big moves in stocks. You talked about going from one side of the boat to the other. The other way it's expressed that stocks is just correlation has broken down between individual stocks. And it's not even just an AI thing, because within sectors, stocks are no longer correlated. Is that a troubling turn? Is it a problem that that's happening? Do we need to completely rethink how we judge sectors and how stocks should be moving together?
Well, it definitely affects the latter part of your comment, meaning the idea that you're going to trade sectors is out. Okay, that's not working. So that relative value trade, which is what we kind of made our career, trading relative value in sectors, is not working really well. What's working is factor trading, which is why we're going back to things like quality, defensiveness, large cap over small. That's working really well. Operational efficiency. These are the factors that are working, which is more idiosyncratic. By the way, the breadth in the market today on a 1-month rolling basis is the lowest we've seen since 1965. Okay, that's even older than me. Okay, that's bad, and that's old. So, I mean, that's a long time. It doesn't mean it's necessarily the end of the world. We have many examples where breadth got really narrow and then it broadened out again. But typically, it requires some sort of a regime shift, right? In other words, if we stay in the soft landing narrative, nothing's going to change. If we move to a higher growth, higher inflation, it's definitely going to shift probably more towards cyclicals. If we go into a growth scare or even recession fear again, that's going to be a rotation into defensiveness. So, we're open for anything because that's our job. We have to be prepared for that.
If we do see a reacceleration of inflation, where would it be coming from?
Well, I think commodities could pick up. I mean, there's this talk of maybe China's going to re-stimulate again, so maybe commodities could seep back into it. I don't think it's going to come from housing. I don't think it's going to come from, this owner equivalent rent. I think that's probably on the downside. Maybe it's in services, services inflation. We saw that in the insurance market, things like that. But we're not looking at a groundswell of inflation like we saw in 2020-21, because I don't anticipate this same, impetus from, say, fiscal stimulus really driving the bus in the way that it did in 2021. We need an exogenous shock to get growth to drive kind of a broader inflation. That's why that's sort of number 3 on our list of things that will upset the apple cart right now.
I'm thinking about liquidity right now as your second risk, this idea of treasuries and some of the auctions and what could happen if you get higher yields. But on a broader level, this idea of the lifeboats and the lack of diversity, the sort of lack of breadth in the market, as you said, going back to 1965. At what point does that make the market more fragile? Not less, given the fact that if you have a true downturn, at some point you have to imagine these lifeboats are going to feel it too. It isn't just going to affect everything else that, frankly, in some places have been actually signaling some warning signs about what's ahead.
Sure, and look, all year we've seen one by one some of these lifeboats, sink. I mean, and then, or they at least take on water. So that's normal too, is that, eventually everybody goes to that one boat and then it gets too crowded and it sinks and they jump to the next one. So everything that's going on makes perfect sense in the context of a late cycle economy. That's why we haven't changed our view on that. Like, we don't think it's mid-cycle or this is the beginning of some new expansion. This is classic late cycle behavior, just like 2019 or 2016, 17. I mean, this is exactly what tends to happen. I expect more of the same. And look, once again, I think it's really critical to make this statement again, which is that it's not just tech stocks. Okay, there are plenty of it's like almost like the Nifty 50, right? There's like Nifty 50 stocks that are really, people are gravitating to, and they're even more expensive than some of these tech names.
Well, but I guess what I'm trying to get at is, are you going into those names too? Or are you steering clear of them because of concentration risk and the idea that one of them could sink, and that could become really problematic?
Well, right now, I mean, we're with everybody else because I think that's what, it's a momentum market. Now, I think where we're different than other people is we're saying this isn't stable. To your question earlier, it is fragile. So you just have to understand that, and look, these are liquid stocks. So you could, if you're running a portfolio, you don't want to be, doubly overweight some of this stuff, but you need to be leaning in that direction, understanding that you're going to have to move it around in the short term. And if there's a shock, and I think once again, that third door is the biggest shock to these Nifty 50 names, meaning a growth scare. A growth scare / recession concern is the one that will take them all down together. That's not a risk today. But that's the one that we're kind of looking at as potential risk in the third and fourth quarter to come back into the marketplace.
Mike, as you're talking about these different lifeboats and some taking on water and maybe less of them out there, I'm kind of reminded of this conversation I had with Pete Stavros from KKR, just the fact that public markets have been shrinking. Since 95, I think, which was the peak in how many public companies we have, there 40% less. Is there some degree where there's just less lifeboats because there are less companies, that some of the really good companies out there, the OpenAIs of the world, what have you, just aren't public anymore?
Well, I think what's happened is, because of maybe the AI narrative in particular, we've seen people perceive certain boats as lifeboats when in fact they got holes in them. Okay, so like that's a mistake. I think there's been a rising tide in many cases that has taken a lot of stocks up, probably incorrectly. So those are the names that we're talking to clients about right now. We're saying, okay, there's sort of the AI winners, and then there's the AI pretenders. Okay, there are many, many companies that are talking about AI. They mention AI, the stock goes up like 2 multiple turns. Like, okay, I mean, those are the things I think you need to be more worried about than buying the true AI winners and saying, well, this actually has a business plan or a potential beneficiary, whether it's an enabler or an adopter. And by the way, just to make it clear, we're more interested in the adopters now than we are the enabler trend that's sort of played out. That's gotten priced. So you got to be a little careful. Now it's about who's going to take advantage of this technology to make a better mousetrap, a better business model to win competitive battles with their competition.
You want to tell us any of those names?
Sure. We've written reports about this. So I mean, if clients can draw them down, but we have baskets and everything else. I mean, we publish this every week.
Mike Wilson of Morgan Stanley sticking with us. Thank you so much for being with us. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Nike is betting on pricey Air Jordans to win over Chinese shoppers. The athletics giant is launching a fresh push for the Jordan brand in the region, where it has lost ground due to a struggling economy and rising nationalism. But with the launch of limited edition sneakers and splashy campaigns, Nike is hoping to lay the foundation for a permanent comeback in one of luxury's most key markets. 3 states are set to hold down ballot primaries for seats in Congress today. Congresswoman Lauren Boebert of Colorado is seeking re-election after changing to a new district across the state. In New York, Representative Jamal Bowman faces a challenge from Westchester County Executive George Latimer. And in Utah, several Republicans are vying for the nomination to replace retiring Senator Mitt Romney. And U.S. travelers continue to fly at record numbers. The TSA broke a new level over the weekend, screening nearly 3 million travelers on Sunday alone. TSA expects to break that record again this Friday as people travel for the July 4th holiday. They expect 32 million people will fly between this Thursday and Monday, July 8th. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. If only they can find the planes. Up next, investors prepare for the Biden and Trump rematch.
The point is that it's a close election. It can go any way, but you can just look at history to get some sense of how the market has behaved.
That's coming up next. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month. The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
Staring into the sun, that has been the political scene for quite a while. We're going to dissect all of that, given the fact that you have elections across the world. 70%, I believe, of the world's population are going to be going to the polls in the next 12 months. Under surveillance this morning, investors prepping for the U.S. version, and that is the Biden and Trump rematch.
The point is that it's a close election. It can go any way. But you can just look at history to get some sense of how the market has behaved. The biggest thing right now is focus on what policies they're touting and try and see what the impact on the market is.
Good luck with that. Here is the latest. President Biden is preparing for Thursday's debate at Camp David with aides and advisors helping him hone his performance. The president will face off against presumptive Republican nominee Donald Trump, who is still on the campaign trail after holding a fundraiser in New Orleans last night. Mike Wilson of Morgan Stanley still with us. We aren't going to ask you about your impression about the debate. Actually, we may do that. But instead of doing that, to begin with, how do you even understand what to listen for in terms of the most market impactful policies from something like the debate that we're expecting on Thursday?
Yeah, I mean, look, this is going to be a challenge for the moderators to draw some answers out. By the way, it's not just because of this debate. This is the way the debates have gone for the last decade. I mean, it's just turns into not really a debate about issues. It turns into personal attacks and whatnot. So let's see if we can focus on a couple things. What I would love to hear about is, what is your plan for fiscal sustainability? Okay, is it going to be any different? Is it business as usual? Right now, it looks like both parties are on this freight train of, we're not really concerned about, cutting expenses or even raising taxes. I think the Democrats have talked a little bit about raising taxes, but that's going to be the main one for me. Like, what are we doing about this fiscal sustainability issue? Number two is going to be tariffs, how they differ on that, and of course, immigration. And some people might say, well, those are social issues. Well, they're not really. I mean, immigration is really an economic issue. I mean, it's a massive positive labor shock. So I think that's going to be a really hot topic from an economic standpoint. And of course, tariffs. I don't see as big a difference between the two candidates as some people do because of the actions more recently by the Biden administration. But I think there'll be some nuances. But those are the three big ones for me, economically speaking.
But there is a difference in the sense that Trump is calling for a 10% tariff wall around the United States plus 60% on Chinese imports. When you say you don't think there's a big difference, do you mean that you think this is just rhetoric and he might temper those numbers if he were to become president?
Well, I think he already has. I mean, that's his strategy, right? He's a negotiator where he'll set his BATNA over here and then, kind of move to the middle. That doesn't mean he's going to be softer on tariffs than the current administration. But, he tends to be extreme and then kind of move it over this way. But look, there's no doubt that I think that the Trump administration would probably be more hawkish on tariffs overall than the Biden administration. All I'm saying is that I think this is turned into more of a bipartisan support issue for tariffing in general, particularly against China. So I just don't think it's as big of a deal as it was.
Axios this morning has 16 Nobel economists writing that Trump would be basically very inflationary. We believe that a second Trump term would have a negative impact on the U.S. economic standing in the world and a destabilizing effect on the U.S.'s domestic economy. Do you think Trump is more inflationary for the U.S. economy?
Well, Trump wasn't. I mean, that was our call in 2016, was that, Trump wins, it was going to be really positive for the economy because he is inflationary. At the time, though, we had capacity for that. So I think that in the bond market, participants who we speak with are kind of thinking about this already. In the event that it becomes clear, we don't know yet, but in the event it became more clear that Trump was going to win, then the bond market may start to price in a bigger term premium, which is one of our potential concerns. I don't think it's a risk right now because it's truly a 50-50, and you do need some congressional support. So It's not clear to me that there's going to be big coattails on this election, meaning whoever wins the presidential carries Congress. But if that were the case, then the risks of that go up. You would get maybe even more aggressive tax cuts in some way, and maybe tariffs can offset some of that. But generally speaking, yes, it potentially could be more inflationary. So better growth, but potentially higher rates.
Okay, so there's potentially an impact on the bond market, but will equity markets care?
Well, they will if it's term premium. And that's been our call now for the past year, which is if rates are going up because of growth and inflation being higher, stock market really doesn't care, at least at the index level. Now, if rates are going up because term premium is widening, that's a bad thing for multiples, generally speaking. We saw that in the third quarter of last year. So, in a situation where the bond market starts to worry about fiscal sustainability in a more acute manner and term premiums started to widen, that would not be great for multiples.
Is this the reason why you don't believe the Fed put saving everything? I mean, this has been one of the arguments of the stock bulls, is that the Fed could cut by 100 basis points, and that could offset any of the weakness and create a real momentum to the market. Is the idea of term premium and the fiscal overhang the reason why you don't know whether the Fed put could actually have the same effect?
Well, what I would say is that the term premium, I think, has been under control more recently for reasons that have nothing to do with rates. It has everything to do with the liquidity provisions they put into place, smartly, by the way. So the reverse repo has been a big helping hand to help fund the government. Now the Fed, of course, is tapering QT, which is essentially $500 billion of potential bond buying across the curve on an annualized basis. So I think they have provisions in place to get us from here through the end of the year. I think if that stays the course, once again, 2025 is probably the bigger risk for the term premium to widen, no matter who wins. Because that's the whole point, Lisa, is that this fiscal sustainability issue is a bipartisan issue, and we bought ourselves time. I think the government, the administrators have done a good job of finding ways to fund the government for now, but that risk increases as we go through the end of the year.
Steve Weissman's going to be joining us shortly, and he came on earlier and said there are all these the deficit people who've been worrying about it for a long time. You've replied to it saying, actually, it does matter this time around. But does it matter if the U.S. is just as bad, if not better, than, say, what's going on in Europe, what's going on around the world? Essentially, does it matter that the U.S. is not disciplined if the rest of the world has even less?
Yeah. In other words, you got to be not the slowest hiker for the bear to catch you.
Correct.
No, I think that's, and look, we still have the reserve currency, and I'm not one of these guys who says we're losing the reserve currency and all that. No. I mean, we are in a very privileged position. Okay, I think we've abused that a little bit, and I'm not in the camp that we're going down the tubes. We can't fund the government, but we can get spikes. We can get temporary spikes like last fall, where the multiple went from 21 times to 17 times on the equity market. That's all we're trying to do. We're not here to call the end of the world. I mean, that's silly. Okay, we're just saying that this is a risk that's not currently priced. Term premium is 0 today. And I think that's probably inappropriate given the path that we're on right now, given both candidates, right, no matter who wins.
Mike Wilson of Morgan Stanley, thank you so much for spending time with us this morning. Coming up, we're going to be speaking about the industrial sector. Bloomberg's Benedict Campbell as Airbus slumps on lowered guidance and missing parts. Somehow I just have trouble saying that, considering the fact that I don't want to think about planes struggling with parts, but this kind of goes to the industrial technology and supply chain disruptions that are ongoing. Right now, in markets, you are seeing just a marginal lift ahead of the open as people look at NVIDIA trying to claw back some of those losses. This is Bloomberg.
names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m. only on Bloomberg Television. Context changes everything.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Heading into Tuesday with gains, at least marginal gains, with NVIDIA trying to claw back some of the losses after 3 days of about 13% declines on those shares. NASDAQ 100 futures gaining the most, not surprisingly, given the NVIDIA rebound, up 0.4%. S&P futures up 0.2%. In the Russell 2000, really struggling to find footing here. What I find interesting is this idea that Mike Wilson was going over, Danny, which is basically lifeboats. And a question of which are the lifeboats, saying that you sometimes get a lifeboat that sinks and you move on to the other, but how much do these lifeboats keep the market afloat regardless of some of the cylinders that are raising some issues underneath?
I had great boating metaphors, because the other one I really liked was this idea that we're just running from side to side. One area takes on water, you go to the other side, and what you get is this calm that appears to be on the surface, this VIX that's incredibly low, but underneath there's this tension. And the question is when does the tension come to a fore in a bigger sell-off for NVIDIA that does take the entire market and the sentiment down with it?
And that is not happening just yet. Amy Silverman also with the paddling duck metaphor of the under the surface, the duck's feet going like this. Meanwhile, we're looking at the bond space. Not a lot of action, which is actually interesting in and of itself after a lot of volatility and huge swings by 10 to 20 basis points a day. Today, not that, less than a basis point move throughout the 2s, 10s, and 30s, ahead of $69 billion of 2-year notes being auctioned off, 422 on the 10-year, 473 on the 2-year, and 30-year yields at 436. Meanwhile, when you look at the currency market, and this is interesting to me, not seeing the same kind of fear being baked into the market that you saw last week, even though the French election is getting closer, 107.14, a little bit of euro weakness. But Anne-Marie, we've been talking about this throughout the morning, that basically you've had more people actually say, maybe this is overstated in terms of the risk around some of these elections.
They think it's overblown, but and also to Danny's point, earlier, when you have members of the RN coming out and Marine Le Pen's party basically saying, look, we are going to be prudent. We are not the Eurosceptics that potentially you thought we were for decades. This is almost Marine Le Pen, who for decades has been trying to have influence, kind of taking the Meloni route, being like, I cannot freak everyone out because I want to be able to govern. And also to everyone's point, it's going to be cohabitation. So we don't know exactly yet what that looks like or what that means.
You know, the fact that you're both talking about this, the idea that the markets will ultimately provide a check on fully populist governments. And that's sort of been one theory out there, whether it's Donald Trump, whether it's Marine Le Pen, this idea that they can't go too rogue because they will want to cater to markets, which is a key question. Meanwhile, the question is how much will the economy give them? Under surveillance this morning, San Francisco Fed President Mary Daly showing more concern for U.S. jobs. Daly saying, in quote, so far the labor market has adjusted slowly, but we are getting near to a point where that benign outcome could be less likely. Danny, I thought this was fascinating given such a shift in tone.
Huge shift. Usually she's more of a centrist. This feels much more to the dovish side, because the argument for a while had been that the reason inflation has been so stubborn is because we have this strong labor market. So what happens when it's not strong anymore? I think this is something that someone like Neil Dutta from Ren Macro would love to hear, because he's been making this argument that the labor market is starting to turn. It is at this inflection point, that inflation is starting to come down, and the Fed is looking in the rearview mirror. They're looking at past past data instead of what's looking forward. So the argument goes that they're more likely to make a policy mistake. Mary Daly is kind of starting to reflect some of that language, that if we keep pushing hard, the labor market could move non-linearly.
So she's basically saying inflation's not the only risk. We've been talking about the past few weeks how jobless claims continue to tick up higher and higher. Potentially, is that a trend? Maybe it's getting her attention. But I also loved how she told this room of founders and the San Francisco elite, get your workers back to the office. It will help the local economy.
Well, that's been a tone that we've heard quite significantly, usually from the big bank CEOs, but also, I guess, from the San Francisco Fed president as well. The Biden administration, talking about home prices and commercial real estate, the Biden administration is looking to take on the rising cost of housing, kind of the flip side of things. Treasury Secretary Janet Yellen is promoting new efforts to increase the supply of homes, including a measure which would provide $100 million over the next 3 years to help finance affordable housing. A lot to unpack here, AMH. It's interesting to me that this is coming at a time where it is a political hot button issue. How much is this politics and how much is this real?
This feels like a springboard into the political narrative in the upcoming months ahead. When you look at some of the polling and the data that's been done, Morning Consult recently done some of this, 74% of respondents that they surveyed believe that the lack of affordable housing is a significant problem in the U.S. You see that sentiment. And then if you look at Gallup, their survey over the course of years, we're looking at this past April, when you ask people, is it a good time or a bad time to buy a home? 21% only say it's a good time. 76% say it's a bad time. Why? Because mortgage rates are so high and the supply is not there. We've been talking about this, and clearly the Biden administration is trying to tap into that.
Which potentially goes a long way to explain why consumer sentiment surveys have been so bad on the economy, despite the rest of the economy being pretty okay. But to that point, Anne-Marie, I mean, is adding supply on really going to change the game? The reason that the affordability index, the Atlanta Fed has one, it's its worst since 2007, is because of mortgages. Unless you get some cuts in size matched with supply, it's not necessarily clear that housing affordability will get better. And just to make us all more mad, we also learned in the post-financial crisis that, low rates on their own also don't solve the affordability issue.
But this actually, and something that you said, AMH, really stands out to me, which is essentially the reason why you see sentiment shifting to such a degree, especially among younger voters, is because they can't get access to home price, to owning their own home. They're facing increasing prices across the board. If they don't have assets in the stock market, they can't offset some of the inflation the way that people who are older and more established can. This is a fundamental problem, and it's unclear how anyone could really shift in this face of this.
That's right. They can't get on the housing ladder, as you say, and also they are still being dogged down by inflation. And this is the biggest issue going into November. It continuously comes up in polls, and it's going to be a huge issue on the debate on Thursday. You're not allowed to bring props, but over the weekend, Trump actually pulled out a little miniature Tic Tac container. And he said, this is Bidenomics, and when I come into the office, we're going to have Maganomics. And he's going after what people feel about these rise of prices. It's very hard to talk about rate of inflation coming down when people are just thinking in terms of price levels.
And if they're concerned about the price levels of things that they do all the time, the question is, what are the price levels of flying around, given the fact that some of the deliveries of airplanes are going to be slowed not just from Boeing, but also potentially from Airbus. Airbus is slumping after a new warning on missing parts and fewer deliveries. The jet maker saying it's experiencing a shortage of millions of parts and will have it to cut back expectations on new planes, including the A320. Bloomberg's Benedict Kamel joins us now from Berlin. Benedict, before we get into this specific issue, why is it there are still supply chain delays and disruptions now, whether it's hungover from the pandemic or not, given the fact that people have been saying, we've right-sized, this is the normal economy, we are beyond the pandemic disruptions?
You raise a very good point, and that really is the question that hangs over Airbus and Boeing. Their answer would be the complexity of our product is such that you can't compare it to anything else out there. It's not a car. It's not another industrial product. We're lacking the engine parts. We're lacking the aeronautic components. We're lacking the interior elements to our planes, so sort of seats and tables and things like that. We're also lacking the skilled labor that we need to do this. And it's not just Airbus and Boeing proper. It's the suppliers, so the smaller tier 2, 3 type companies that are really struggling to get their products to Airbus and Boeing. So this is really a supply story. It's not a demand story. I mean, this is sort of they find themselves in the weird situation that they are actually selling their planes very well, almost too well. The demand is really hot, and they just can't keep up with it.
Benedict, you raise an excellent point, which is that basically they're having issues with the parts, with the expertise, with the talent to be able to manufacture that. And that's really what's causing some of these kinks. This is not about the pandemic. Going forward, given all of the localization that people are looking for, what does this say in terms of the workforce and the lack of training at a time where everyone's on their phones for everything? It's not like there's some sort of natural
Lottie
training.
Feds Bowman says the central bank independence is very important and that the Fed is apolitical.
Younger populations.
Yeah, this
and
is
so
really
that is from Bowman's
effort
Q&A
to
now.
sort of resize the industry and to get people interested in this industry again. You know, what kind of training do you have to introduce? What kind of incentives? And ultimately, what does a relatively cash-rich company like Airbus, what can they do to stabilize the supply chain? The ultimate sort of fix would be to go into some of these small suppliers and actually prop them up. We're not at that point.
And so
yet,
also just worth noting here, EU's von der Leyen is to be given
which is in the
another
process of
term.
being
That's gone to
bought by
FAS
Airbus
there.
and Boeing, that this is a case where one supplier that is in trouble is being bought back up. And you might see more of that going forward, that Airbus and Boeing will get into some of these mission-critical suppliers, because all you really need is sort of one missing part and you can't build your plane. You know, these are very complicated products. They have millions of parts. And as I said, one piece missing, two pieces missing, and your plane is stuck on the factory floor.
So we have Airbus on top of Boeing cutting back on their targets. What are the domino effects now for the airlines that want to buy these planes?
Yeah, this is obviously going to play out with the airlines, and ultimately, people like you and I who get onto these planes and have to pay higher prices because you're going to have fewer planes out there, you're going to have less capacity, fewer seats available. That's going to drive up the cost. And one big theme from the recent IATA annual general meeting in Dubai was, where are our planes? We can't get them fast enough. We have all these orders outstanding. We want the new kit. We want the more fuel-efficient planes. Fuel is a huge cost element for the airlines, and they just can't produce them fast enough. You heard from Airbus yesterday. They're cutting back on the rate of production. They're going to make 75 A320 planes a month, not in 26 as they had planned, but in 27. So that means 1 year later, they're going to reach that rate, and that will have that ripple effect to the airlines, but ultimately, the humble customer.
It was also at IATA.
And so let's take a look at the market wrap now for the European session. Shares of computer giant Nvidia are cut in pre-market trade. Stock futures indicated gains at the Wall Street Open. Trade on the tech-heavy NASDAQ and the S&P 500 was up 0.4% and 0.2% respectively, on expectations that the three-day sell-off that erased almost $400 billion from Nvidia's market value was exaggerated. Tuesday's pre-market trade saw a 3.5% increase for the chipmaker. The aircraft manufacturer Airbus had a decline of over 10% in its stock price, which contributed to a 0.3% decline in European stocks as supply chain problems persisted. Yield spreads over Germany are declining from their highest point in more than 10 years, suggesting that calm is finally returning to the French markets. The US Treasury will later issue $69 billion in two-year notes to begin the first of this week's three-bond sales. It is anticipated that demand for the shorter, rate-sensitive paper will be higher than it was for the sale last month, especially in light of data that on Friday that is predicted to indicate a slowdown in the Fed's preferred inflation measure.
Airbus, is not taking any pleasure
And seeing comment coming through from Fed's Bund, who says, I've begun to shift my view on policy to a more scenario-based approach.
We need a healthy industry out there in order to help the supply chain as much as ourselves. So Airbus also has an interest in Boeing, catching its breath again and getting back on its feet. So, in a couple of years, once you have a new Boeing CEO, once that company is stabilized again, they will sort out the supply chain. But if anyone thought this is something that is a quick fix and once the pandemic's behind us, that's not the case.
Benedict Kamel of Bloomberg, thank you so much for being with us. Right now, let's shift gears a little bit, get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Fed Governor Michelle Bowman says she sees a number of upside risks to the inflation outlook and reiterated the need to keep rates higher for longer. In prepared remarks in London, Bowman said a tight labor market, geopolitical developments, fiscal stimulus, and a loosening in financial conditions presents risks to the inflation outlook. Bowman also pointed to a more open immigration policy in the U.S. as a reason for differences between the U.S. and other major economies.
Feds Bowman says, I need to see how subcategories of inflation evolve.
To integrate Meta's AI chatbot into its iPhones, according to people familiar. The Wall Street Journal had reported the iPhone maker was in talks with the social media company, but Bloomberg News has learned those talks didn't get very far. Sources tell us Meta approached Apple months
Bowman adds by saying, I'm closely monitoring the labor market for deterioration.
Doesn't believe Meta's privacy practices are strict enough. And Italy is headed to the knockout stage of the Euro 2024 tournament after a dramatic match against
Bowman
Croatia.
says, I don't see any rate cuts for 2024, shifted cuts to 2025.
Draw and avoid an early exit from the tournament. Meanwhile, France is set to welcome back captain Kylian Mbappe for today's match against Poland. The striker is set to play with a face mask after breaking his nose in the first opening match against Austria. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, gaming out a patient Fed.
The Fed probably by September is likely to conclude they've made enough progress to start easing rates. So even if the economy is resilient, I still think September is very much on the table.
That's coming up next. This is Bloomberg Surveillance.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
It was going to keep
in World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Coming into Tuesday with some gains, NVIDIA trying to claw back some of the losses after 3 days of declines. You can see an upward tilt, but just modestly so. S&P futures up 0.1%. NASDAQ 100 also just up about 0.4%. Euro losing a little bit of steam after gaining yesterday, strengthening versus the dollar today, weakening 107.12. Yields heading a bit lower, 4.21% on the 10-year, and this comes after a series of comments. Mary Daly coming out and seeing more downside potential risk to growth. But what we're hearing from Michelle Bowman this morning is that there could be upside risks to inflation and saying it is not the time to cut, which raises the question under surveillance this morning, gaming out a patient Fed.
If you continue to get market progress on inflation, even if the economy holds up well, the Fed probably by September is likely to conclude they've made enough progress to start easing rates. So even if the economy is resilient, I still think September is very much on the table. But that case that we talked about earlier of a continued easing after September, there I think you really need that sharper downturn. Otherwise, the Fed's going to start easing, but be very patient.
Here's the latest. Treasury is holding steady as traders look ahead to consumer confidence, as well as remarks from Fed Governor Lisa Cook. Greg Peters of PGIM writing this. This remains a reasonably decent backdrop for risk, taken from an overall top-line perspective, yet the valuations are seemingly priced for much of this positivity and perhaps then some. Greg joins us now. This is fascinating to me, Greg, because you're talking about how you get the risk on, but the upside risk from here seems somewhat limited. So what do you do?
Yeah, so I think you have to tread quite carefully, honestly. So, if you strip away valuations, which is impossible to do, of course, we'd be much more bullish. But if you look at spread sectors, for example, you're at very much at the tight end of the historical range, both on the high yield side and investment side. I think investors continue to overpay for levered credit risk. So we see more value in the unlevered or the top of the capital structure. So I think what it means in short, Lisa, is that you have to pull back, make sure you're getting paid for the risk that is on the horizon and always lurks.
So in other words, if I'm hearing you correctly, Greg, right now the concern is that there could be some kind of growth scare akin to what Mike Wilson was talking about with respect to the idea that the credit component could widen out, but not necessarily on the high end of things where it's more duration sensitive. Is that what you're saying? That essentially yields are going to go down. It just matters how quickly and in the face of how much weakness.
Yeah, I think that's right, Lisa. And it's not so much about preparing for a growth scare. Like, that's not a base case over the short term, but you just never know. And these unforeseen circumstances do arise, and you as an investor have to make sure that you're appropriately paid. And we are priced very much for perfection here.
You have seen some of that turn in the high yield market, Greg, where the worst among them has started to finally underperform. That spreads are finally starting to spread out. But in this more leveraged part of the market, the one that you're worried about, why are you worried? How bad does it get in an environment where we maybe get just 1 or 2 Fed cuts this year?
Yeah, so I mean, that point is an excellent one. So what we're excited about in the lever part of the credit markets, like high yield, for example, is that you're seeing this dispersion. And so the markets are differentiating. So that's great news for active managers like us. But in kind of a beta standpoint, it's less exciting. But you don't necessarily need to have a recession or a real downturn to see these levered credits start to bite. And the reason is just the persistence of higher rates starts to eat into these already levered capital structures, and it takes time. And that's why you're seeing higher default and distressed activities for quite some time.
So I guess is 50 basis points of cuts enough to solve that? Or is it cuts in real size to prevent some of the distress?
I don't think it's enough, but it's important to dissect why they're cutting. So if there's a cut because growth is rolling over, that typically means that the top line is also rolling over. And so is that really enough? And my guess is no. If they're cutting because growth is really quite strong, but it's just disinflation in the system allows for some scope, then that's a better narrative. So I think the markets continue to conflate those two narratives. Is it labor market weakening? Is it disinflation? I think both is somewhat heroic.
In the meantime, if you wait for about 2 seconds, you'll get a new narrative. So just hold on 1 minute, and then we'll have a different thing dominating market activity, which really raises the issue that we've been talking about a lot. Lori Cavacino, we keep quoting her, staring into the sun in terms of this election season, given the fact that there's a whole deal of uncertainty. You talk about how most people are just sitting on the sidelines, at least when it comes to bold bets ahead of what we're going to expect in November, but frankly, around the world. So how do you know when you can kind of have conviction given some of the policy uncertainty, or do we kind of already know the outcomes regardless of who gets into office?
I don't think we do know the exact outcomes. If you think about, what's happening in France currently, we saw it in Mexico. It's very much a shot across the bow for, a very big election. But here in the U.S., it's been a very good year thus far. So I just don't see the appetite to take a lot of risk going into the U.S. election. But once we get to the other side, I think the policy differences are quite different and matter a lot. And I see, as a bond investor, I see more concerns around higher bond yields due to inflationary type of policies, and those are the areas that I'm most focused on.
But Greg, isn't that going to be the case for either candidate if they become president?
Not exactly. So I think we're all of the mind that fiscal is very much an issue that's embraced on both sides of the aisle, but the contours of that fiscal are very different. So tax cuts have a very different multiplier effect, let's say, than spending on infrastructure. You look at some of the trade policies, highly inflationary. I just think the details matter here. So just to say, fiscal is going to rage regardless of who's in office and who has control, I think misses the contours of how that fiscal is achieved.
We also need to know the makeup of Congress to really understand what these policies could look like. Do you have a base case of what potentially you're planning for after November 5th?
No, I mean, at the end of the day, I'm a bond investor, right? Not a political analyst. We do provide scenarios because we have to think about it. But I will say, if you just pull it back, zoom out for a moment, everywhere I look, I see more inflationary pressures, not less. You think about it from, defense spending standpoint. You think about it from just the trade war standpoint. You think about it from, spending on energy, both current needs and then for the future, all inflationary. So the one thing that seems common wherever I look is that there's more pressure for inflation than disinflation.
Just quickly here, do you like French bonds?
Too early, but it definitely looks like there's a path for success here. That's a great example, Lisa, because kind of in the meat of the distribution looks quite attractive. But the extremes are the things that the markets are worried about. And the setup of the French election just makes it difficult with investors trying to kind of game theory that out.
Greg Peters of PGIM Fixed Income, thank you so much for being with us. Really appreciate it. And for giving Anne-Marie a reason to bring up cohabitation once again. You really love that phrase, don't you?
Well, he's saying that it doesn't look like it's going to be as bad. And that's because people are looking at cohabitation amongst all these parties. That means no one party is going to get their way. So those Euro people who are worried about maybe the Euro skeptics coming in, they could pump the brakes a bit.
Well, and I like the idea that you bring up, which is the ghost of the Liz Truss moment, and how much that's kind of hanging over a lot of this.
Yeah, exactly. They know that the market can bully them out of the office. They don't want to be the next Liz Truss. But by the way, might I just add that the reason cohabitation is so wonderful is because it also just implies that they're like there but not getting along. They're like we're cohabitating because we have to. I don't know, it's just evocative. It's a good one.
Yeah, well, it also implies other things as well. Meanwhile, coming up, Steve Eisman of Neuberger Berman, Sarah Malek of Nuveen, as well as Mark Zandi of Moody's, as we plow forward to consumer confidence, to a 2-year auction, to Fed speak, and then on to Friday, Thursday and Friday, when we get core PCE as well as income and spending.
Fed's Bowman says we need to look forward and understand banking risks of the future rather than use liquidity ratios to solve problems of the past.
Dollar strength, yields strong. This is basically where we're at. Stability. This is Bloomberg.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
things like solar or wind, it's nice and environmentally friendly, but really it's not going to be a
Feds Bowman says, I hope a number of things in the current Basel III proposal will be changed.
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show, weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time. Host Joe Matthew and
Skid overnight financing rate 5.31% for June the 24th, unchanged from June the 21st.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power live around the world twice a day at 1 and 5 Eastern. Only on Bloomberg TV and radio. Context changes everything.
It does feel like for the first time in a while, the market has really been attuned to downside risks and growth.
The economy is clearly showing signs of deceleration.
I don't like the situation with the Fed, and I don't like the fact that the economic story seems like it's slowing a little bit right now.
In the next couple weeks, we could start to see just a continuation of the softer economic momentum.
A sharper downturn by no means is guaranteed, but I think the risks of that are higher than they were, let's say, a few months ago.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Heading into a day where there's a real question here about NVIDIA and whether it makes the market more stable.
Feds Bowman says that the Fed needs to stick to its knitting and allow other agencies to address things like climate.
I'm Lisa Abramowitz. Jonathan Farrow will return. He will return on Thursday. Right now, still a lot of discussion around the importance of NVIDIA and whether this is a stock that makes the market more secure in terms of just the AI dominance or more fragile, Danny, given some of the huge fluctuations in market cap that we've seen recently.
I'm just still really struck by the fact that NVIDIA can fall so much in 3 days and the overall S&P falls less than 1%. I mean, it's kind of like the most constructive sell-off we probably could have had for NVIDIA. And again, it points to this idea that we're not necessarily in a narrative shift, maybe just a breather, maybe just a quarter-end rebalance.
Which is something that Mike Wilson was talking about, that it would take some sort of shock to shift the narrative to something where even the lifeboats, the NVIDIAs, but also other stocks that have similar kinds of attributes to be pegged to some of the growth, that it would take something significant to really bring them down, and that could be some sort of growth shock. And Anne-Marie, this is something that we're hearing about from the likes of Mary Daly of the San Francisco Fed. It's not an economy that usually turns slowly. And if you start to see that softening in the labor market, it could be the beginning of something that's a little bit deeper.
Right, and this is actually a little bit different than we normally hear from Mary Daly. And basically what she's saying is that it's not just all about inflation right now. We have to keep an eye on what's going on in the labor market. We've talked about it a lot. We do see jobless claims rising. Potentially, when you see maybe more cracks in the labor market and consumer sentiment, does it start to shift people's minds as well about a Fed cut before the election? Maybe September is becoming a little bit more in play.
Which is the reason why people are looking at consumer confidence, which we get at 10 a.m. today. The reason why people look at the University of Michigan sentiment survey, even if only 500 people answer the phone, and even if it's now being conducted online. But Anne-Marie, Danny, there's this question now going forward of just how much we can really see the narrative shift that much more, or whether in some ways the Fed has kind of put a put over the market, where essentially growth risks they're going to respond to, and otherwise not so much.
Especially when you have Michelle Bowman coming out. I mean, look, she's always hawkish, but coming out saying they have more work to do. So the question is when we get to that point where maybe the cracks in the labor market are more apparent, when some of the doves on the FOMC want to cut, will there be a big pushback? Is there enough of a disagreement at this point that even though we hear Mary Daly starting to shift her sentiment, that's not enough to really get us going?
Right now in markets, you're seeing a lot of stability, at least some sort of firming up in equities. You could see the S&P up about 0.2%. Euro weakness, 107.12, kind of stabilizing in this area after going south of 107 last week. And then you can see the 10-year yield, 421, marginally lower. Crude also inflecting lower about 0.8%, $80.96 on the NYMEX. Coming up, Steve Eisman of Neuberger Berman, who coined "Oi the deficit," but he's going to be talking about the AI trade. Naveen Saramelek on election year market volatility, and Mark Zandi of Moody's Analytics on why a Fed policy error is the biggest threat for the U.S. economy. We begin with the big issue. A tech rout pushes markets to take a breather for a hot second. NVIDIA shedding close to $430 billion in value, the biggest three-day loss for any company in history. Even with that slump, and this is the key, the chip giant is up close to 140% this year. Investors still flocking to the company given the sky-high demand for its chips, which are powering a broader AI push. Steve Eisman of Neuberger Berman remains bullish on the AI play, saying the AI frenzy and a correlating boost in infrastructure is powering the U.S. economy. Eisman also expecting Apple to benefit from AI with a major upgrade cycle, and he also has a couple of reviews for the latest Marvel Marvel movies. Steve, I'm so pleased to say, joins us now. Steve, who coined "Oi the deficit," I literally quote you every single day on that. We're not going to talk about that just yet. I don't know if that's good or bad. I'm not sure either. A lot of people push back, but I think it perfectly encapsulates what a lot of people have been thinking. And it goes to this broader angst in markets that you kind of push back on. I'm going to start with the question we've been asking all morning. Is the huge swing in NVIDIA shares a sign of market fragility, or actually market strength, as Danny pointed out, given the fact that we're not seeing some broader retrenchment?
I mean, if you look at the chart on NVIDIA, you can barely see the correction. So, I mean, on a percentage basis, it's down something like 10%, but you have to peer really, really carefully at the chart to see that move. So, I don't think it means anything.
There is this issue, though. How do you even understand the valuations at a certain point? How do you even understand how much future profits are you actually factoring in? I understand the idea of being bullish on AI, but how do you understand when it's so fully valued that you're jumping on a train that's so overpriced?
I absolutely never do. I just don't know. I mean, and I'll take the converse to it, which is, one of the things I learned running a hedge fund is that shorting a stock solely because of valuation is a death wish. I made that up too, by the way.
That's great. Trademark.
But what I mean by that is, you go short a stock because you think the valuation is insane, but your entire thesis is just, it's very expensive. The people who own that stock know it's expensive, but they're buying into a story. And as long as the story is intact, like NVIDIA is obviously intact, the story is going to continue. So you have to have, when you short something, not just that it's expensive, it's that the story is going to break. And as far as I can tell, the NVIDIA story is going to last for years. So, I don't think all that much about the valuation of NVIDIA.
So maybe you don't want to short it because it's a narrative and it's an enduring and a powerful narrative.
I own it.
So you own it. Okay, question for you then. You look at 10% dip, 12 whatever it was on the chart. Do you buy more?
Well, we own a lot. So, there's portfolio construction issues about, how much you can have in a portfolio. One of the interesting things about this market, which presents a problem to portfolio managers today, which I don't think has existed before, is that some of these stocks, NVIDIA, Apple, Microsoft, represent very large percentages of the S&P. And so, normally, if you would take a position in the stock, you would say like a 5% position would be a big position in the stock, but those stocks have bigger positions in the S&P. So you're sort of, the normal risk parameters that apply to constructing portfolio don't necessarily apply to these
I think
stocks.
that's such an interesting point. Also, because if you're an active manager and you want to outperform, you kind of have to be so overweight these stocks.
Or at least equal weight.
Or at least equal weight, which again is kind of beyond the normal risk parameters to have so much concentration in these stocks. So even though the story is there and it is powerful, does that do something to your volatility profile, which you maybe don't like, when you can have swings like this in NVIDIA over a 3-day basis?
I don't really focus that much on the volatility. I have a colleague at Neuberger who likes to say that one of the benefits of buying and holding is that you only have to make one decision. Whereas if you're a trader, you have to make multiple decisions, and it increases the probability of you making a mistake. So if you like the NVIDIA story, you own it, and you keep owning it until something changes. And I don't think it's going to change for a long time, so we'll own it.
If you like NVIDIA, do you also like Micron and AMD? I mean, do all of the sort of semiconductor stocks benefit equally?
But you can't own everything, unless you just own the index.
Yeah.
So yeah, we like AMD. We don't own every chip stock. One of the things that I think is very interesting is, when you're talking about, leave out Microsoft, software versus hardware. So for years, software outperformed hardware. And one of the reasons that software outperformed hardware is that the whole software industry moved to the SaaS model, which everybody went crazy about, et cetera, et cetera. There's an argument to be made that hardware, which has recently outperformed software, is going to continue to outperform software. And this is an outgrowth of AI. And this is not my theory. I'm not smart enough to create this one. But it's a very interesting theory. I think we should talk about it for a little bit. It's a very long-term story. And the thesis is that because of AI, the cost of creating software is going to collapse. And so therefore, some companies, unclear who, in the software industry, which people value very highly because they have these very large moats, those moats are not going to be so high anymore. Now, if this thesis becomes true, then hardware will continue to outperform software, and software will get derated. That's a very long-term story, but I think it's very interesting.
But this hardware is coming from Taiwan. Do you have any sort of concern about the geopolitical?
I'm petrified.
No, seriously.
No, I think, look, God forbid we wake up one morning and China has invaded Taiwan. Our economy gets hurt very, very, very badly, because where are we going to get our chips? I mean, that's one reason why Taiwan Semiconductor is building plants in the United States, but they haven't been built yet.
Yeah, but we're years from that. Years.
No, I agree. Is that
your biggest risk for holding all this NVIDIA?
That geopolitical risk is the biggest risk, I think, to the market, and I have no way to predict it.
Well, so to me, this sort of raises a question. Is it going to be geopolitics or a growth scare? We were talking to Mike Wilson earlier, and he was saying a growth scare could torpedo some of these lifeboats in particular, some of the semiconductor providers, just simply because there won't be as much investment. Are you saying that's even less of a risk?
I don't see a growth scare at this point. I really don't. I mean, you guys were talking before about the Fed. My view on the Fed is it's not relevant. And the reason why I say that is, I mean, the Fed was relevant when it was raising rates 500 basis points. That's relevant. That's repricing of money. I mean, the people who are the most dovish, I mean, what are they talking about? One rate cut this year, maybe 1 or 2 rate cuts next year. In the scheme of things, that's de minimis. It's not really. I mean, it'll be important on Fed Day. Like I think I said here before. On Fed Day, they treat Powell like Moses coming down with the tablets. Let's check to make sure the 10 Commandments have the same words in them that they had last time, because that'll change morality forever.
Good.
But other than that, it's not that relevant.
Okay. So just putting this all together before we shift to politics in just a bit. I am curious about the idea of crowding risk. If there is potentially a catalyst, some innovation, or even just increasing tensions in around Taiwan, how difficult could that be given how crowded some of these names are? in order to exit? What could potentially happen? I mean, is that something to even prepare for, or is it just something that's so cataclysmic it's not even worth it?
The way I think about that is look, like I said, God forbid China invades Taiwan. We'll have a lot more problems than what's in my portfolio. So we'll all lose money. You know what? That'll be the least of our issues.
Okay, well said, Steve. Okay, with all of this, I can't help but wonder why I should do anything other than just hold the S&P 500. Why I should do anything other than just hold a passive portfolio, because that gives me exposure to all the big caps.
That is fine for a lot of people.
Sure.
I have no arguments about that. I do think that we are in an era of stories, more so than we've been in a very long time. And you can construct a portfolio which emphasizes some of those stories more than just the S&P does, and you could outperform. That's how I look at it. But I don't have any argument. If somebody wants to invest in the index, God bless.
Basically, if this were a movie, it would have a lot of stories, and the plot would be AI, and it would be a good one, according to Steve Eisman, who will be sticking with us and maybe giving us some movie reviews. Right now, let's get you an update and stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. The Biden administration is looking to take on the rising cost of housing. Treasury Secretary Janet Yellen is promoting new efforts to increase the supply of homes. This includes a measure which would provide $100 million over the next 3 years to help finance affordable housing. The rising cost of homes and rent has put added pressure on Americans. The average 30-year mortgage in the U.S. is 7.25%, according to Bankrate.com, the highest in decades. The nearly 15-year battle over the prosecution of Julian Assange may finally be coming to an end. The WikiLeaks co-founder is expected to plead guilty on Wednesday to leaking U.S. national security secrets. Assange was accused of publishing sensitive U.S. military documents in 2010 and 2011 in one of the largest breaches of state secrets in U.S. history. The plea deal would allow Assange to avoid prison in the U.S. and return to his native Australia. And OpenAI has warned developers in China it will begin blocking access to its tools and software starting July, according to local media. Screenshots posted on social media appear to show the Microsoft-backed startup already sent memos about the impending move to developers. It's unclear what caused the move, but it comes amid growing pressure from Washington to curb Chinese access to advanced AI technology. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the morning calls, and later, Nuveen's Sarah Malik and Mark Zandi of Moody's Analytics on Fed policy and more. That's coming up next. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
morning calls, not just movie reviews. First up, Deutsche Bank downgrading Airbus to hold as the plane maker lowered its earnings and delivery targets. The analyst citing a, quote, rather damaging profit warning. Next up, Goldman Sachs initiating coverage of Paramount with a sell rating. The firm encouraged by progression towards streaming profitability, but doesn't see enough to offset linear cable headwinds. And finally, TD Cowen upgrading Gap to a buy. The analyst saying the retailer is in the, quote, early innings of a transformation across its brand portfolio with underappreciated growth potential, talking about years and years of lost growth after a lot of people said, why are you not coming up with more staples? What is this with this fast fashion? Neuberger Berman, Steve Eisman still with us, not to talk about fast fashion, but I did want to get you on politics because you have some pretty bold stances on it, and I want to know whether you're actually betting on that sort of 200% confidence that you have that Donald Trump is going to be the next president. I mean, how do you translate conviction in politics into actual wagers in the market?
This is going to sound a little strange. I actually think it doesn't matter who's president for the market overall. I really don't. I just think some of these themes of AI and infrastructure are just so powerful that it doesn't matter. Now, on the margins, there'll be, certain sectors. So if Donald Trump gets elected, I'm sure natural gas stocks will do better. Some solar stocks will probably do worse. So there'll be subsectors where things will be better and things will be worse. But for the overall market, I don't think it matters. I just don't think it matters at all.
Well, what do you make of these 16 Nobel laureate economists coming out today saying that Trump's going to be an inflation bomb on the economy and he's worse in terms of inflation than Biden?
I think it's ridiculous. I just think it's ridiculous. I mean, based on what? Because there'll be more tariffs.
Tariffs, tax cuts.
Does that mean it'll be slightly inflationary? Maybe, but one thing I've always learned about things as broad as like things like inflation is things that cause inflation or cause inflation to get better are so broad, and there's so many factors that the fact that Donald Trump's going to be president is maybe marginal.
Since last time you were here, when you shrugged off the people concerned about the deficit, calling them the deficit people, the nonpartisan Congressional Budget Office ramped up its estimates for the U.S. budget deficit by 27%. There is growing concern about the U.S. fiscal trajectory. Does any of this concern you at all since the last time we spoke to you?
So this is why it really doesn't concern me long term.
So in 10 minutes' time now, at the bottom of the hour, we see the release of the Canadian CPI data for the month of May. Year over year, forecast is 2.6% on the prior 2.7%, with a range of 2.7 to 2.5% expected. CPI month over month, forecast for 0.3% on the prior 0.5%, with a range of 0.4 to 0.2% expected.
You buy U.S. Treasuries. That's what you do.
Bank of Canada give the core CPI numbers. Year over year, the prior was 1.6%, while month over month, the prior was 0.2%. For the CPI breakdown, the Canadian CPI median forecast is 2.6% on the prior 2.6%. The trim forecast 2.8% on the prior 2.9%, and the common saw a prior read of 2.6%. Canadian core CPI month over month saw a prior read of 0%. And for the US, we also see the release of the Chicago National Activity Index, forecast minus 0.25 on the prior minus 0.23.
In how it approaches markets, how it approaches the world, and working together with allies and some of these issues that do factor into the U.S. being the most liquid market in the world. And on the margins, some people say it's not going to happen all at once, but you could see that erosion. And people aren't worried about a wholesale blowout in yields, but just sort of more volatility on the heels of certain proposals and things of that nature. Are you basically saying it doesn't matter long term because we'll move past that and it'll just be these main themes? Or are you just saying that honestly
people
you don't
need
see
things
that
to talk about? So that, and they need something to kvetch about. Okay, so they'll kvetch. And we'll go, the deficit.
Yeah,
that's how they kvetch, But at the end of the day, the dollar's a dollar, and the U.S. government bond market's the U.S. government bond market. And as long as that remains the case, we can have deficits. Now, do I think at some point it'll be important? Maybe, but people are pontificating. Do you see rates going up? I don't see them going up. They're going down. So until then, next story, basically.
Okay, well, I'm going to do an adjacent story.
Fine.
I apologize in advance.
Don't apologize.
But one of the concerns about it
is that sure, central banks hold bonds, but the switch has happened. We're now foreigners, it's foreigner individuals who are the biggest holder of bonds. They've supplanted foreign central banks that are the biggest holder of bonds.
Right.
You're also in this environment where, because of more regulation, banks are holding less on their balance sheets. So all of a sudden there's more potential for upset in this bond market. Not necessarily that the deficit will necessarily cause it, but weaker hands are holding on to bonds now.
I don't think they're so weak. Is there any indication that they're weak? You know, 10 years gone from 4.5 to 4.2. You know, I don't lose sleep at night about this one. I just don't.
All right, so then I guess the bigger picture is how
I sleep very well, by the way.
I could tell, and you watch a lot of movies,
I do.
and you have a great life, and you've been along some of the bonds that have won, or some of the stocks, excuse me, that have won the biggest. I am wondering, though, exactly how you diversify then. Do you just not diversify? Do you have enough conviction to say, these are the things that are going to win, or do you need some sort of ballast that could be the bond market, that could be cash?
I mean, first of all, it's nice to be able to buy 3-month U.S. Treasuries and get more than 5%. So if you need to park some cash, that's fine. You know, owning some corporate bonds is fine too. But, you know, generally what we do is equities, and that's what we've always done.
So you do equities and you do movies.
And just U.S.
Yeah, and just U.S. You also do movies. Do you have any new recommendations, since you do have this list of 100 in the Steve Eisman catalog?
I don't have a new movie recommendation. I have there was a new show on Hulu called The Veil with Elizabeth Moss, which was pretty good.
She's excellent.
My favorite is that he's into Bridgerton. He's an equal opportunity reviewer, although not so into Marvel, right? You're pretty passionate.
Well, I'm very passionate about it. I'm just very upset about what's happened.
All right. Well, we'll get into that another time. Steve Eisman of Neuberger Berman, thank you so much for being with us. Always a pleasure.
Thank you.
Always insightful as he sort of touts the AI narrative. And I love that idea, Danny, of the idea of stories. And this is a market driven by stories more than at any time in recent memory. And you don't want to bet against a good story.
Not only is it a story, but it's a story that, like, our tiny little human brains have a hard time comprehending of the actual power of AI, of how this thing gets used and how quickly it advances. I mean, I think that's why ChatGPT caught us all so by surprise, because it almost seemed like overnight this like amazing thing appeared that we could all use. So it's trading a story that we don't even understand the potential for. And I think that's why so many people are excited about this stock and are willing to buy it even at its current valuations.
Meanwhile, I do wonder how much, Emery, we're looking at a territory where people can sort of bet on the preeminence of technology over politics. We don't hear that many people saying that politics just don't matter. I mean, that's actually a new one, I think, for a lot of people who come around this table.
It's true. Within 15 minutes, went from Greg Peters, who's basically saying November is going to be a coin flip and you should just hunker down for the summer and wait it out, to Steve Eisman, who's basically saying none of it matters. It really doesn't matter who's going to be president of the United States. On the margins, he thinks maybe it matters for things like natural gas, even though under the Biden administration we have record fossil fuel production, which they don't always like to tout. But he really doesn't think that that is a driving force right now in the market. So I guess it's what everyone says, hold NVIDIA.
Well, looking ahead to today, we're going to be watching lots of things that Steve Eisman is not, like the bond auction at 1 p.m., the two-year debt auction. We're also going to be looking at some Fed
in less than 5 minutes time now, at the bottom of the hour, we see the release of the Canadian CPI data for the month of May. CPI year over year forecast is 2.6% on the prior 2.7%, with a range of 2.7% to 2.5% expected. CPI month over month forecast 0.3% on the prior 0.5%, with a range of 0.4% to 0.2% expected. The Bank of Canada's core CPI reads year over year, the prior was 1.6%. Month over month, the prior was 0.2%. We also see the release of the Chicago National Activity Index, forecast minus 0.25 on the prior minus 0.23.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New season starts July 10th on Bloomberg Television. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every
1 minute
company
remaining.
needs to
I'll lead with the
become an
Canadian
intelligent software
CPI year over year.
Context changes everything. The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
10 seconds.
About 60 minutes until the start of the trading day. We do see a bit of positive momentum, maybe because it's all stories. The stories are pretty good right now. S&P futures up 0.2% at 55.27.
2.9%, 2.9%. That's higher than forecast. 2.6%. So Canadian CPI month over month at 0.6%, 0.6%. That's higher than forecast. 0.3%. Bank of Canada's core CPI reads year over year 1.8%, 1.8%. Month over month at 0.6%, 0.6%. So just noting some strength in Canadian dollar there, following Canadian CPI hotter than expected. Chicago National Activity Index at 0.18, 0.18, which is higher than forecast, minus 0.25. The breakdown for the Canadian CPI, the trim at 2.9%, 2.9%, which is higher than forecast, 2.8%. The median at 2.8%, 2.8%, higher than forecast, 2.6%. The common at 2.4%, 2.4%, and core CPI month over month at 0.3%, 0.3%. So again, headline Canadian CPI year over year, 2.9% on expectations of 2.6%, seeing strength in Canadian dollar.
Of Treasury auctions to really get a gauge on where investors are right now. Right now, you can see stability in the bond space. Yields just marginally lower by about a basis point on the 10-year and on the 30-year.
Just noting a prior revision to the trim CPI for Canada, prior revised down to 2.8 from 2.9%.
In this 470 to 475 level, 472.31. And in the currency space, you do see a bit of euro weakness, just simply banking on what we saw last week. Still above that 107 level, although really retracing back down, maybe even potentially crossing it. 107.09 right now after those French elections really remaining in the forefront. And Anne-Marie, this to me is where politics do matter. We saw a pretty substantial response in the euro region to this French election, the first round of which starts on Sunday.
Starts on Sunday, and you see the rhetoric really starting to ramp up going into the first round. Emmanuel Macron talking about the fact that there could be a civil war between the fact that you have the far right and the far left gaining ground. But we have seen Marine Le Pen's party come out and say, we are going to come in line. We are not the Eurosceptics maybe you thought we were.
We have posted out the Canadian CPI May report on the feed for anyone interested, as well as the Chicago National Activity Index report for the US.
More hyper-populist and potentially inflationary policies. Under surveillance this morning, NVIDIA's wild ride slows down for a hot second. The chip giant pushing into a technical correction yesterday, erasing $430 billion from its market cap, the biggest three-day value loss for any company in history. But it's still up 140% year to date. I feel like we need that asterisk, Danny, whenever we talk about this name.
Poor NVIDIA, only up 1,180% in over the past 4 years. Tiniest violin. But okay, so yesterday you get this sell-off in NVIDIA, and I noticed at the same time Bitcoin was also tanking a lot. It fell below 60,000. So there was this sort of flavor to it where it was like these kind of short-term momentum trades going into the market. The things that have been a little bit hot started to sell off. So I've been saying this all day, and I still think it's true. that the narrative hasn't shifted. To Steve Eisman's point, the story is still big and grand and wonderful, and you can still trade it. But I think it was pretty much consensus that it looked a little bit frothy. So if anything, I don't know, it didn't make that much of a difference. But maybe it's a tiny bit healthier.
Although Mike Wilson talking about the potential for some sort of growth shock, checking that idea, Steve Eisman shrugging that off, all the sides that make a market.
So
Apple,
Canadian dollar making back some of those earlier losses following the inflation data.
Several months
Last
ago,
down spot
after brief
1% against the dollar.
We're reporting this after what happened in terms of earlier reporting. Sources telling Bloomberg that the tech giants are not in discussions to integrate Meta's AI chatbot into the iPhone. The Wall Street Journal had reported a potential partnership. To me, the interesting aspect of this, AMH, is on one hand, Apple does seem to be in the market for a lot of partnerships. So regardless of what's right, what's wrong, there is that sort of overarching theme. On the flip side, who wins out, and when does it sort of stop the everyone wins kind of feeling in the iTrade?
Right. It definitely feels like Apple is looking for their dancing partners when it comes to AI. They haven't exactly built this in-house like they normally do with a lot of their products and software and hardware. What's interesting about Mark Gurman's reporting, which comes after the Wall Street Journal, is that he's saying that Apple decided not to move forward with formal Meta discussions in part because he doesn't see that the company privacy practices as stringent enough. So maybe Apple is concerned about some of these privacy concerns, the regulation battles that potentially they see coming down the pipeline when it comes to AI. It just leaves a lot of questions open. To your point, Lisa, who do they end up pairing with for the future?
I think this is just such a different Apple. I mean, Apple is a company that usually will go to the consumer and tell them what they want and be like, here you go, this is what you get. Instead, this is an Apple that's talking about doing different partnerships and letting consumers choose what kind of AI they wanted. I mean, Apple literally at the beginning, when they were contemplating how they incorporate the internet, they were thinking of having their own ecosystem where you can't go off and look at other websites. It's only within the Apple world. It has come so far, and it just shows you that AI is a complicated beast that maybe Apple is behind on. So they're kind of being forced to be a different company that takes on partners instead of being the leading force.
It's not a Macintosh, it's a Fuji. Oof, terrible. All right, meanwhile, San Francisco Fed President Mary Daly says the labor market could be at an inflection point. Daly saying, quote, so far the labor market has adjusted slowly, but we are getting nearer to a point where the benign outcome could be less likely. She added, inflation is not the only risk we face. This as investors keep an eye on this week's data, including consumer confidence, new home sales, and the PCE deflator. We also heard earlier this morning from Michelle Bowman the opposite, saying inflation hasn't died yet, and we have to be cognizant of that. And we did just get Canadian inflation showing a reacceleration over the prior month. So a lot of cross currents. Joining us now to lay it all out for us is Nuveen Sarah Balick and Mark Zandi of Moody's Analytics. Sarah, I want to start with you. This idea of growth shock versus inflation. Do you think that we have moved more to the growth shock risk than the inflation side?
I think it's the growth shock risk that I'm concerned about. Moves in NVIDIA and Bitcoin recently are telling us there is a cautious undertone to this market that's based on two reasons: a slowdown in the consumer and the employment markets. Consumer, we're seeing weaker retail sales, fast food companies discounting, less retail traffic. Employment markets, even though payrolls have been strong, that's been the unusual number. We're seeing unemployment claims at almost cycle highs.
The Bank of Canada July rate cut chances fall to 54% from 65% following the CPI data, according to swaps markets.
I think we are approaching a recession in a slow manner, and the depth of that recession will be TBD and what we need to determine in terms of market premiums.
Mark, I know you would agree with that kind of sentiment, that the bigger risk here is a more significant drawdown. Do you, like Sarah, see some sort of significant downturn or recession on the horizon in the near term?
No, I don't think the recession is likely, but I do think there's enough evidence at this point for the Fed to start cutting interest rates. The economy is slowing. I mean, we tracked GDP growth for this first half of the year at 1.5% annualized. It's down from 2.5% last year. And that's below the economy's potential. Unemployment starting to notch higher. Initial claims from unemployment insurance are starting to push up. Other labor market indicators are showing some softness. So, and given that inflation is coming in within spitting distance of the Fed's target already, particularly if you exclude the very problematic OER, owner's equivalent rent, the implicit cost of owning a home, which is very difficult to measure. So I think everything suggests very strongly that the Fed should be lowering interest rates. And now, if they wait another month, 2 or 3, maybe even after the election, I think we'll still avoid an economic downturn, but why take the chance? Why take the risk? And besides, in this kind of environment, the economy is very vulnerable to anything else that can go wrong. And goodness knows there's a lot out there that could go wrong, including the upcoming elections.
Well, Mark, you couldn't sound more different from Michelle Bowman, who today said that there is an upside risk to inflation still, and it is not time to cut. As Neil Dutta says from Run Macro, is the Fed looking at yesterday's data? Are they behind and in potential danger of making a policy error?
Yeah, there's a real chance that they're going to make an error here. In my humble opinion, I do think that the economy is softening very quickly. I mean, and so far so good. That's kind of to script. That's what the Fed wanted, and important to getting inflation back in the bottle. But I do think the economy is fragile. The other thing I'd point out is the financial system is under a lot of pressure. The yield curve is still inverted. That's just not a very good place for a lot of banks and other financial institutions. Loan growth is slowing because of the tightening and underwriting after last year's banking crisis. Credit quality is moving in the wrong direction. Still good, but moving in the wrong direction. Regulatory costs are up. So, the system is under a lot of pressure, and when it's under a lot of pressure for long periods of time, as it has been and will continue to be with this too high for this higher for longer strategy, something else could break, and the next thing that could break might not be conducive to being fixed like last year's banking crisis was. So, yeah, I think the risks are at this point asymmetric, and the Fed should start cutting interest rates.
By the way, not only is the yield curve still inverted, it's currently its most inverted since December. Sir, would you agree with that? That we're getting into the potential territory of a Fed policy error with, as Mark says, a fragile economy?
Well, I think the Fed needs to be careful here about not risking their credibility. We just saw inflation reaccelerate earlier this year. The Fed has stated they need to see multiple months of data points before they start cutting rates. We're just starting to see inflation come in below consensus just in the prior month. So I think we have many months to go before they cut. Perhaps September could be the first cut, but I still only see 1 to 2 cuts this year. I think the Fed still does need to be cautious because we still have to worry about auto insurance, financial services in that PCE number this week, healthcare, all of that is still remaining inflationary, and the consumer is still pretty strong, and that's been an inflationary headwind. And so I think all of that could cause the Fed to be cautious here and not overcut and then cause another inflation acceleration.
Forgive me, I feel myself being distracted by what we heard from Steve Eisman as we talk about some of these issues, whether it was the Fed, whether it's some of the political ramifications, because he came on here and said the Fed doesn't matter, politics doesn't matter, the auctions don't matter, the deficit doesn't matter. Mark, I would love your sense of just starting with this idea of the Federal Reserve and whether rate policy will matter, why it isn't necessarily just some sort of distraction every month or so as they come down and speak, given the fact that there is this sort of technological shift underway that's kind of taken main stage in terms of story building.
Well, I didn't catch exactly what your previous guest had to say, but in my view, all the things you just mentioned, they matter, and they matter a lot. I mean, to people. I mean, if the Fed doesn't cut interest rates, then people with credit card debt and consumer finance loans, buy now, pay later, auto loans, home equity lines of credit, they're struggling to make those debt payments. It matters. For businesses, small businesses that have loans that are tied to the prime rate, which is tied directly to what the Federal Reserve is doing, it matters. And of course, in terms of the upcoming election, that really matters. Obviously a lot depends on what happens with Congress as well, but these two candidates have very different perspectives and visions of how the economy is going to unfold and where it's going, what policies should be. And depending on who wins, we're going to go down different paths here, very different directions. So these things matter a lot in a broad macro sense, but they, probably more importantly, they matter a lot to the American people.
Steve Eisman, though, is not losing sleep at the moment about any of these things, Mark. Sarah, when you think about the politics and the geopolitics, you're actually looking at opportunities in places outside the United States. When a lot of people come around this table, they say that because everywhere is dealing with politics and everywhere there's uncertainty, you got to go for the least dirty shirt, which is the U.S. So where are you looking to set up ahead of what many are calling a coin toss election?
Sure. Well, first I'll start with three things that do matter for the second half, and that's earnings, the economy, and the election in the U.S. Now, the U.S. also comes with a premium because everybody kind of knows the U.S. story. So we've been interested in looking outside of the U.S. First of all, many of the big elections are moving behind us. We've had India, South Africa, Mexico. We're still kind of dealing with what's going on in France, but a lot of these elections are ahead of the U.S. And also in terms of inflation, many of these countries have been battling the inflation battle for longer than we have. So they're a little bit further along the curve. That makes them interesting. And then, of course, valuations are interesting. So some of the emerging markets, even India at this point, with the structural tailwinds of a younger population and consumption-based improvements over there, I think is interesting. We also like Japan, the tailwinds of better governance, the consumer in Japan, growth that's finally picking up, and benign inflation. That's also a favorable country to us. I think the EU is still challenged. They do have an inflation problem, but they don't have that growth advantage that the U.S. has because of its dominance in technology. So those catalysts plus valuations outside of the U.S. makes us want to look there for some attractive segments.
We have the first part of the French elections coming up on Sunday. Do French bonds attract you, or are they scary at this point?
I think there's just too much macro unknown in that region right now. We like to invest where we can get our arms around the fundamentals, and when you have kind of binary outcomes, I think it's challenging to invest even when valuations are in your favor. So that wouldn't be our first choice. Actually, what we do like fundamentally strong is U.S. municipal bonds, because not only are the yields attractive, but the municipalities in the states have such strong revenue bases now and such strong savings rates because of the strength of our economy. We think that's an area where you can take advantage of yields and also take advantage of strong fundamentals.
Mark, I also want to bring you into the conversation about political risk, not necessarily just here, but abroad too. We've seen it in multiple places. Sarah mentioned some of them. You saw India, South Africa, Mexico, the latest being France. The IMF data shows that 50% of French bonds are held by foreigners. So you have these markets where a lot of non-locals are participating in them. Do you think, unlike the U.S. election, we just haven't been paying enough attention to risk and political risk specifically abroad?
Well, I think we're paying attention. I mean, I give a lot of talks, and when I give a speech or talk to a board and ask what's on top of mind, the first thing that comes up is geopolitical risk, and it's hard to pinpoint exactly what.
So in 10 minutes' time now at 8:55 a.m. Eastern Time, we see the release of the US Red Book year over year. Prior was 5.9%.
France and Europe and the various elections across the globe. Of course, the Chinese-U.S. relationship, Taiwan, North Korea, what's going on with Russia. So there's all kinds of geopolitical hotspots that can boil over. So I don't think I don't think people are discounting that risk. I think that's really top of mind. I think the real difficulty is kind of gauging how significant a threat it really is, and what are the links back, what are the channels back through which it will affect our economy. That's a much more difficult task to do and much more difficult to gauge.
We have a number of Nobel Prize-winning economists coming out today talking about the difference between a Biden election mark versus re-election versus Trump winning. And this is something else that Steve Eisman basically shrugged off and said, doesn't really think it matters. But they were talking about the fact that Trump would be a lot more inflationary. Is that how you view Trump 2.0?
Yes, I do. I mean, just think about the policies he's putting forward. And here, of course, I'm assuming that he gets roughly what he wants. But if he does, then it's going to add to inflation. I mean, the tariffs by themselves are going to be quite significant, 10% across the board. He's talked about 60% on Chinese imports into this country. His immigration policy, particularly the deportations. I mean, that, if he actually could follow through on that, that would be highly disruptive to leisure hospitality, retailing, the mining industry, agriculture. Food prices would go back up. Think about the tax cuts. They're deficit financed. There's no plan for paying for the tax cuts, and he's talking about more tax cuts. Lowering the corporate tax rate even more, which will add to deficits, and that's a stimulus, fiscal stimulus, adding to the economy's growth when it's already at full employment. And of course, this is now more speculative, but there's been very credible kind of media reports about thoughts about President Trump, Reserve Board, and Fed independence, and of course, a bedrock of a well-functioning market economy is an independent central bank, and if that's eroded in any way, that's going to result in more inflation. I can go on, but you add that all up, that's a brew for higher rates of inflation.
Is that your sense too, Sarah?
Well, I think, first of all, there's good news and bad news about election years. The good news is that the markets tend to go up, which we've already seen. The bad news is markets tend to be more volatile, which is probably what we'll see in the second half. Over the longer term, it's still going to be earnings that drive the markets higher. And for, I think the next catalyst for the markets is second quarter earnings, where they're expected to grow about 10%, mostly led by technology again. So we'll see if that can be the catalyst that turns around this technology route that we're seeing. As for which president's in place, I do think we're going to have to think about international relationships, tariffs, also.
According to calculations, Russian oil and gas revenues to rise by more than 50% year over year in June to $9.4 billion.
Inflation that I don't think the president itself can be blamed just for inflation or which candidate wins, because there's so many other things like supply chains unwinding, China reopening, which could be inflationary, consumer spending, which has also been inflationary, and the employment markets, which have led to that consumer spending. All of those factors, there's so many of them that I think it's hard to pinpoint it onto just a presidential candidate.
It feels a bit like whack-a-mole, which is the reason why I think some people are saying just look at the earnings, and if the earnings are okay, then they can be all in. Is that sort of where you're at?
And second quarter earnings should be okay, expected to be up over 10%, a little bit broader this quarter than we've seen in the past, with non-tech earnings actually expected to grow about 7-8%. So we'll see if that happens. The market could broaden. That could be the positive that helps this market stabilize and recover from here.
Sarah Malik of Nuveen, thank you so much. Mark Zandi of Moody's Analytics, thank you so much for being with us today. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Fed Governor Michelle Bowman says she sees a number of upside risks to the inflation outlook and reiterated the need to keep rates higher for longer. In prepared remarks in London, Bowman said a tight labor market, geopolitical developments, fiscal stimulus, and a loosening in financial conditions are risks to the inflation outlook. Bowman also pointed to a more open immigration policy in the U.S. as a reason for differences between the U.S. and other major economies in recent months. Boeing has offered to buy Spirit Aerosystems in a mostly stock deal that values the company at about $35 per share. The latest proposal represents a switch from Boeing's plan to fund an all-cash offer. According to people familiar, the final details are still being discussed, and the terms could still involve a small amount of cash. It would also require Spirit to spin off some of its
So in 5 minutes time now at 8:55 a.m. Eastern Time, we see the release of the US Red Book year over year. Prior was 5.9%. And in 10 minutes time at the top of the hour, we see the release of the US Case-Shiller 20 year over year. Forecast 7% on the prior 7.4%. With this, the US House Price Index month over month forecast 0.3% on the prior 0.1%. Year over year saw a prior read of 6.7%.
More than 32 million people to fly between this Thursday and Monday, July 8th. That's your Bloomberg Brief. Lisa?
Yahira, thank you so much, and thank you for today. Up next, setting you up for the day ahead, this is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
Does anything matter except for AI and the stories? We can get into that in just a second. Counting down to the opening bell, this does matter. Here is the trading diary for the week ahead. We'll get consumer confidence data at 10 a.m., plus more Fed speak from Governor Lisa Cook. Wednesday, we get new home sales, the mystery of the housing market. Thursday, durable goods, plus another round of jobless claims, as well as the first presidential debate. We round out the week on Friday with a PCE deflator, the key inflation metric used by the Fed, and personal income and spending. And finally, University of Michigan consumer sentiment. I do want to just go to this question of this difficulty understanding where to look and what is important. Neuberger Berman Steve Eisman saying investors can put the campaign trail aside. Take a listen.
This is going to sound a little strange. I actually think it doesn't matter who's president for the market overall. I really don't. I just think some of these themes of AI and infrastructure are just so powerful that it doesn't matter. There'll be subsectors where things will be better.
So shortly expecting the US Red Book year over year. Also just over 5 minutes away to the top of the hour, where we get the US Case-Shiller 20 year over year, forecast 7%, prior 7.4%. House price index month over month, forecast 0.3%, prior 0.1%. And house price index year over year, the prior read was 6.7%. But again, we are shortly expecting the US Red Book year over year, just after 30 seconds.
I think some people are saying potentially yes. How far does the rhetoric go into policy when he talks about things like tariffs and tax cuts? But then there's still a lot of unknowns, like the makeup of Congress. But to Steve Eisman, it's all just doesn't matter as long as AI is still in play.
Well, and people might dismiss this as a little overly cavalier, considering the fact that immigration very much has affected the labor market, as well as just the upward pressure of wages. You could say the fiscal stimulus has been a tremendous boost to the U.S. economy and to consumer spending. He isn't totally off, though, when it comes, Danny, to this idea that NVIDIA has been such a huge driver of sort of the preeminence of the American economy, of the technological leadership, as well as this idea that we could shoot for the moon with some of these valuations.
Yeah, but it is interesting we've kind of just coalesced around NVIDIA, because there was a point where we're like, it is just AI. It is any company that has decided to incorporate AI. The flavor is kind of changed, because now you say there's some future potential for AI. There's going to be infrastructure that needs to build out. At some point, people will start to incorporate it. But for the moment, it seems like the bet still just needs to be NVIDIA, that this is the thing that benefits, and it's the only really clear part of the narrative. All the rest is a little bit theoretical.
Well, to me, nothing matters isn't really the takeaway for me as much as this idea of lifeboats from Mike Wilson. The idea that there are these lifeboats that people have been clinging to that are kind of independent of the macro cycle. And if one of them shows some holes and starts to flood or get filled with water, people jump to the next one. And sort of the only thing that could sink all these boats at the same time is a growth scare, which is what Mary Daly was highlighting, this concern it is not linear. It's the reason why consumer confidence is important. It's the reason why jobless claims are important. It's the reason why people are watching what we get for non-farm payrolls. Coming up tomorrow, Renmac's Neil Dutta has some pretty strong feelings on this, seeing something very similar to Mary Daly. Chris Harvey of Wells Fargo, BlackRock's Wei Li, and Bank of America's Jill Carey Hall. I'm very curious about her take on small caps at a time where they're trying to get some love and then falling back. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. So how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Aman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means. I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women
US Red Book year over year at
have
5.3%, 5.3%.
through their life journey. And all those skill sets that they've built.
Keep in mind, we are also
were
shortly
part of
expecting the
this first
ECB
chapter,
bond
right?
settlements
But
for the week.
how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
1 minute remaining. I'll be leading with the US Case-Shiller 20 year over year.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal.
The Deal. The Deal. That deal.
Effective Fed fund rate unchanged at 5.33%.
From New York City, for our viewers worldwide, I'm Matt
10
Miller.
seconds.
As NVIDIA bounces back, so too the market rises. The countdown to the open starts right now.
7.2%, 7.2%, higher than forecast 7%. US House Price Index month over month at 0.2%, 0.2% is lower than forecast 0.3%. Year over year at 6.3%, 6.3%.
3-day sell-off. Michelle Bowman warning that the Fed still sees upside risks to inflation. And Bloomberg Invest kicks off in New York City. We'll bring you conversations from the leaders in asset management, banking, and wealth. But we start with the big issue. Shares of NVIDIA helping to push the market higher yet again.
The market makes perfect sense. It's paying up for quality, and it's paying up for growth that is, idiosyncratic from the economy, and maybe some defensive properties. Okay, great. So I think the market totally makes sense. The question is, are those multiples now in those particular stocks too high? I think if you get a perfect, soft landing on this plane, it could be fine. If you get any aberration from that, it's going to be a problem.
Joining us now is Brent Schutte, CIO at Northwestern Mutual Wealth Management. Brent, great to have you on the program. Today we saw NVIDIA wipe $430 billion in market cap away in the last 3 sessions. We expected to bounce back at the open today. What's your take on what some people have been calling the most important stock in the world?
Well, I think it just shows to what Mike Wilson said how
Seeing the ECB bond settlements here. So the ECB holdings under PEPP are at 1.66 trillion euros as of last week. They settled 306.8 billion euros in corporate bond purchases and 2.263 trillion euros in public sector bond purchases. And they note that lending to banks rose $2.08 billion to $151.4 billion.
Where there is already a recession priced in. The S&P 600 trades at an 8 times price to cash flow, which is usually reserved for coming out of recession. And so that's where I think, ironically, the opportunities are in the future, even though I think there's still likely to be a recession. I just think some of those names have gone too far too fast, and that's where I think there are risks in the future. The question is, how much do you pay for those stocks? And I think that's still up for debate.
Hang on, so you see the big tech stocks, the Magnificent Seven, they've run too far too fast. And you expect them to come down as we get a recession?
I do. I think that's already where there's priced to perfection already. I mean, they're priced for economic insensitivity, which I'm not so sure there actually is. To me, it reminds me a lot of the late 1990s where a few stocks drove the market higher. I think these stocks have been bid up because that's where the only earnings growth has been, and that's where investors have paid up for that. I think you need to think about the other side of this, which could be a recession. or it could be an economy that broadens back out, which I think that means the earnings picture broadens back out. And I think that favors things that are cheaper in valuation, which every time I hear a strategist say valuations don't matter, that to me reminds me of late in an economic cycle where people are trying to justify their bullish outlook. And that's where I think valuations actually matter the most.
In terms of those big stocks, though, Brent, a lot of people, a couple of years ago when the market came down at the beginning of 2022, were saying these are defensive stocks now, not just growth stocks. You don't buy that argument?
Perhaps. I mean, I think you've seen them perform that way. I mean, you always have to tell me what's next, not what is right now. And that's where I think people have positioned more defensively over the past year because we've been talking about a recession.
We have posted our US Case-Shiller 20 year-over-year April report on the feed for anyone interested.
Maybe a sign to be on the opposite side of that trade. Or if, on the other hand, you don't get a recession, you get more of a soft landing, that's where I think you have optionality because I think the economy would have to broaden back out and the market would have to broaden back out where 7 names aren't just driving it higher. It would be driven higher by a healthier economy that has more participation, also in markets because earnings would broaden back out.
All right, Brent, sit tight. I want to dig into the economy right now with Michael McKee. We've got some data out in the last few minutes, and Mike is Bloomberg's chief economics and policy correspondent. So, Mike, what have we got, and what is it showing us about the economy?
Well, housing's become a more important issue in recent months because people aren't buying, and that's not a good sign for that sector and for the overall economy. Latest house price indexes are out from the Federal Housing Finance Administration and S&P CoreLogic Case-Shiller, long name there, and they basically show a slowdown, but still a fairly strong price increase over the last year. FHFA up 0.2% on the month and 6.3% over the year. Same thing for the S&P CoreLogic Case-Shiller, up 6.3%. Both of those down from the prior month, but still fairly elevated increase. And you can see even as mortgage rates start to fall, now these are delayed 1 month, this is April data, we're not seeing a real change in overall home prices. Now, the number of cities that S&P looks at, the 20 city number, comes in a little bit lower than we had seen for the year-over-year 7.2% as these others did. But the cities that are experiencing the biggest price increases include Boston and was just looking San Francisco, over 2% each still on a month-over-month basis. So we're still seeing some increases there. And if you want to look at, Matt, what the problem is overall for the housing industry, it's that we are seeing home prices contribute to inflation. And that leads us to a conundrum because the Fed is going to maybe lower interest rates, but right now they're not. And you can see what's happened here is we had a problem, of course, during the pandemic of everybody buying houses, and that pushed prices up. But now we're seeing prices come down somewhat, but not enough because the Fed keeps interest rates higher. And the fact that prices don't come down means inflation is higher, and the Fed needs to keep interest rates higher. So it's a sort of circular conundrum. And that was recognized last night by a couple of Fed officials. We heard from Michelle Bowman. She has been the hawk on the Fed, and she remains so, saying we're not still yet at the point where it is appropriate to lower the policy rate. She worries about home prices and the possibility that we're also going to see other inflationary pressures flare up. And Mary Daly worrying about unemployment, talking about future labor market slowing could translate into higher unemployment. So inflation's not the only risk we have. So at this point, something different from those Fed officials, but it just all feeds back into the what do they do? We don't know yet.
All right, Mike, thanks very much. Mike McKee there, Chief Policy and Economics Correspondent, talking to us about the latest data points and what we're hearing from Fed officials. Brent Schutte is still with us of Northwestern Mutual Wealth Management. Brent, so you're saying you see a recession ahead, or you could see a soft landing and a broadening out. Which data pushes you in either direction?
I think you're trying to transition an economy that was built upon low rates and lower for longer with regards to interest rates and inflation that people had as their mantra, and businesses operated that way, as did households, to one that's in higher rates. And I think that transition is going to be bumpy and still ugly. I think there's likely to be a recession because I don't believe inflation is sustainably back to 2%. And I believe the Fed needs to keep rates higher for longer, which eventually will tip the economy into a recession. And I think that's evident in their comments. To me, wages are the final frontier, and that's where I think they're still above where the Fed thinks inflation is sustainably at 2%. And I think that was in Bowman's comments. And so to me, of all these oddities like the housing market, the price is rising. I just don't think inflation is under control yet. And I think the Fed's going to err on staying around too long because they want to put that genie back in the bottle. And I think that eventually causes a mild recession because the unemployment rate has to rise.
What do you think about the labor picture? Because Bowman was saying, if we get more restriction in terms of immigration, that will curtail what has been, a healthy supply on the labor front. And then we could see, the market tighten up a little bit again.
100%. That's where I think if I'm going to be wrong, it has to be because more people come back to provide labor. The pool of labor increases, or AI is truly a huge productivity enhancement. And this kind of reminds me of the late 1990s where you had economic cycle overtime because you did have the internet, you had Y2K investment, and you had 25 to 54-year-olds stream back into the labor market. That's where I think the easy lifting has been done. I do think AI is for real, but I don't think it's in the here and now. And that's where I think wages are going to stay elevated, which keeps the backdrop for inflation sticky. And I think the Fed found out that if they actually try to cut rates or optimistically speak about that, like they did back in October or November, the market rallies, the economy recovers, and guess what goes with it? Inflation. And so to me, that's where I think they're going to stick around longer, just because they want to make sure they're not acting as if it's 1966, which led to 67 to 82. And I think that means that you're eventually going to have a period of time where the unemployment rate rises to kind of increase that labor supply, unfortunately, in that manner, which I think will eventually call a recession.
I'm interested to get your take on AI. Brent, you mentioned it there. You're a CFA and a CFP, but most importantly, you got your MBA from the Booth School in Chicago, so you're a numbers guy. That's why I think it's interesting to hear what you think about this emerging technology. Some people are calling it a revolution. What do you think?
I think it is, actually. If you think about the internet, it was also. It doesn't mean the stocks that were doing well in 1999 were the ones that drove it all the way throughout. And it actually probably benefited the economy and other sectors of the economy as you pushed into the 2000s. And so that's where I think the future is still optimistic. I think it's still bright. I think there's enhancements on the way. I think productivity is something that we have to have in this economy, in this country, because we are aging. But I just think in the here and now, I think right now, I think you want to just be aware of risks that are out there. I think anybody who manages money for individuals needs to remember that they also manage risk, not just chasing returns. And that's where I think the next few months, unfortunately, are going to be bumpy and volatile. And I think investors need to be aware of that and need to be ready for the reality that stocks don't always just go straight up, and they do have downsides sometimes. And that's where I think things like bonds, things like thinking about the other side, and thinking longer term are more important than what's going to happen in the next few months.
So if we do have a Fed that drives a recession here, Brent, why do you want to be in small and mid-cap stocks? Why do you want to look for value if the economy goes into a downturn?
Because I think those things are priced already for that downturn. Perversely enough, in the 1990s, the backdrop was very similar. And actually into that downturn and into the recession, small caps value actually provided less downside than their other names, which were priced more for perfection. That's where valuation starts to matter. And then I do think it'll be mild, and economic headwinds right now for those segments turn into tailwinds. And I don't think anybody can perfectly time when that magic point is, or when which people start thinking about valuation more and coming on your show and talking about that. And that's where I think you want to at least maintain your position there and think about adding over the next few months as volatility increases.
Are there industry groups, Brent, that you think are safer? I mean, is it just the traditional defensive sectors? And are there regions that you like, or is the U.S. still kind of the only game in town?
I don't know that the U.S. is the only game in town longer term. I think you have to think about international stocks longer term. And I know people have talked about this for a while, and I think investors get tired of hearing it, but it's reality. I think the one thing that investors need to think about going forward on the other side of this is the currency returns that they're likely to get, because the euro, the yen, things like that are incredibly cheap on a longer term basis relative to the dollar. And eventually, I think investors need to realize that currency, if those currencies do appreciate versus the dollar in the future, become a return enhancer. And so I think you want to maintain your exposure there. And so I think there are opportunities there, even though there are risks there, just like they are here. And I think being diversified is still the way that you deal with uncertainty, not being concentrated. And so to me, I do like those segments of the U.S. market. I like international stocks. And I just think it seems highly contrarian right now. But I think, a few months from now, I think you're going to be hearing more about that type of investing, which I think is more important. It's focused more on valuation, not just themes and dreams of growth in the future.
Oh, we always love a contrarian take, especially if it's from a conservative mouth. Brent, thanks so much for joining us. Brent Schutte there of Northwestern Mutual Wealth Management. Joining us now to talk about some of the stocks moving ahead of the opening bell this morning. Some of the individual names is Abigail Doolittle. Abby, what are you looking at?
Well, Matt, let's start out with the shares of NVIDIA. We're just talking about that bounce back rally. We do have the stock up more than 2% after sliding more than 10% in 3 days. So a fast correction. But we've seen this story before this year, from the March peak to the April low. Basically in a bear market, then the big move higher. Net right now on the year up more than 140%. As for some of the stocks that are dragging on the overall indexes, let's take a look at the shares of Boeing. They're falling in sympathy with Airbus cutting their earnings view and planes to be delivered on supply chain issues. Connected to Boeing, we have Spirit AeroSystems down 3.6%. Boeing is, of course, to buy a part of that business valued at $35 per share, but now they're talking about it largely being a stock transaction as opposed to an all-cash transaction. Investors apparently not liking that. And then Carnival sliding ahead of earnings, which should be coming out any moment. Bookings are actually expected to be strong. I'm just taking a quick look to see if that release has come out. It has not, but it should soon, and we'll be talking about that on the open, Matt.
Absolutely. We will talk about that. That deal is very interesting. Switch from a cash deal to a stock deal. And obviously, we're watching the aerospace area very closely. Abigail's going to come back in just a minute. We're going to talk about a pool stock. Have you put in the pool already? Are you planning to, or is money tight right now? Also, shares are taking a belly flop after the company slashed its forecast after the bell. So we're going to take a deep dive. Oh, so many puns. This is Bloomberg.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking? Yeah. I mean, like, what's that about?
We're not forcing everybody to be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier, right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have for the next 5 years, 10 years. What's the best way to contribute to the world?
Was going to keep rain World Cup. This is a three as the economic picture. Covering the intersections of Hollywood, Silicon Valley, and beyond.
The momentum is draining at Pool Corp. The stock is slumping after the pool supplies distributor slashed its full-year earnings forecast. The company warning of a more cautious consumer. Joining us with more is Bloomberg's Abigail Doolittle. Abby, I was thinking about this story when I heard the headlines yesterday. So is the idea fewer people are installing new pools? They're just not buying gear for the pools they have? What are they saying?
They're not installing new pools. And what makes this so interesting, so they slashed the profit view for the full year by as much as 22%. Making that super interesting, though, is just 2 months ago, they were saying demand was going to be normal. Now they're saying seasonal demand is weak. And they're also talking about the idea that pool permits, they're down, but that new construction activity, that's a piece of it, that remodeling activity on the year is expected to be down 15%. So you put all of this together, and it seems as though there's a little bit of an air pocket in terms of consumer demand. Now, the question is that people really struggling? And of course, these are going to be higher-end consumers who can afford a pool. Or you made this point earlier when we were speaking, does everybody who wants a pool already have a pool?
Right, because the high-end consumer, we're not supposed to be worried about the high-end consumer, right? It's the bottom hundreds of thousands, then tens of thousands of dollars.
Yes.
Those people should have the money, but maybe they already put in their pools.
Maybe they put in their pool, but they're talking about the housing starts for May being weak and that's a piece of it. And I actually looked up the average price of a pool. It was shockingly low based on what we were talking about earlier. It's $35,000. So it's those super high end.
Really?
Yes. So it's much cheaper than you would expect. I think then when you throw
I don't know that they have Westchester labor costs built into that.
Yeah, no,
because I can't imagine doing it for 35. Like if you want to put a pool in Greenwich.
Yeah, 35 grand is not going to do it, but it's going to be a six figure. But let's bring Winnebago into the picture, because Winnebago not so long ago, they missed estimates, they cut their forecast, and they were talking about a demand issue also. They're also blaming the Fed. They're saying that because the Fed has taken so long in terms of cutting, that's thrown off consumer sentiment, and people are just not spending money on those Winnebagos.
And I know the prices on those are high.
They
I've
are
looked
high.
at Winnebagos, at Airstream, RVs. You're talking about six-figure purchases here, $300,000. The problem there is a loan to buy one of those is going to be like 10% right now.
Yeah, I mean, that's almost like buying another house, and that's like buying the price of a house that an average consumer might look at. One thing I would say though here is this just people who have a lot of money pulling back, or is there something more significant? Because to your point, it is the bottom part of the economy, the bigger part of the economy that we're going to care about more generally. But if the sentiment at the super high end is off, and we think about Walmart recently saying, that
high-end consumers are pulling back. They're not going to maybe Whole Foods as much, but they're trying to save money at Walmart.
It seems as though maybe that they are picking up on signs of something out there in the economy that they're thinking about. I don't want to say hunkering down, but they're being a little bit more careful. And actually, Samantha LeDuc of LeDuc Trading is going to be joining Vonnie Quinn and I later today, and she's talking about the idea that you can already see that global credit is contracting, and when that happens, that is an early sign that economies could have a tough time. And at some point, the stock market, not in the immediate zone, but points of concern.
What time should people tune in for that conversation?
12:30 p.m. Eastern.
12:30 p.m. All right, I'll be watching that, because the pivotal question is, is demand drying up now, or was demand just pulled forward by the pandemic? And that's a debate that, but
maybe
the shares,
a little bit of both.
But the shares are acting as if demand has dried up.
Down 10%, and Winnebago's down about 25% from its last peak after that earnings miss and the guide down. So I think that there are signals. I mean, I think, and also if we bring in some of the luxury companies into the picture, I think that there are some signs that there's a little bit of softness for the high-end consumer at this point.
Yeah, consumer discretionary, the second worst performer on the S&P in terms of the industry groups.
Really?
Yeah, it's actually
down.
I
wouldn't have guessed that.
Year to date. All right, Abigail Doolittle, thanks very much for joining us. Day one of the Bloomberg Invest Conference is taking place today in the heart of New York's financial district. Man Group CEO Robin Grew is currently on stage with Bloomberg's Romaine Bostick. Let's listen in.
So my experience through navigating those things have been incredibly valuable. I think the other piece is I have run large chunks of Man Group, be it trading or be it ESG or be it our solutions business. And that evolution has been very, very useful. So I have the benefit of seeing the organization and financial services through many different lenses, and that stood me in very good stead.
You talk a lot about how the technology has increased productivity.
Yes.
When we talk about the new applications of AI, and I'm not just talking about the front-facing chatbots that we all know about, but really
all right, that is Robin Grew, the CEO at Man Group, speaking with Romaine Bostick at Bloomberg Invest in New York. You can continue to follow that conversation or watch, all day long. If you've got a Bloomberg terminal, just type LIVE GO, Live Go, into your terminal. Coming up, we're going to give you the morning calls, and then later, Mona Mahajan of Edward Jones joins us. What she sees as the risks to a soft landing. Man, a lot of recession talk today. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New season starts July 10th on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We're looking at gains right now in futures. S&P futures up about 0.25% right now. NASDAQ futures up about 0.5%. This as NVIDIA bounces back. That stock was down for 3 sessions in a row, and those drops wiped $430 billion off of NVIDIA's market cap. It's now worth less than $3 trillion. Let's get to today's morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up is TD Cowen upgrading the gap to a buy. The firm says that the company is in the, quote, early innings of its transformation across all 4 brands, that the growth potential there is underappreciated. Next up, Wells Fargo is raising Capri Holdings to an overweight. The analyst sees potential rewards outweighing risks and says investors have lost sight of the value in the Capri portfolio due to concerns regarding whether Tapestry's acquisition of the company will proceed. And finally, Raymond James is downgrading Penn Entertainment to a market reform. The analyst says the company's path to profitability in digital continues to be uncertain, and that he doesn't expect any dramatic shift in strategy in the near term, so he doesn't want to buy Penn Gaming. Coming up, Mona Mahajan, Edward Jones Senior Investment Strategist, tells us where she sees opportunity in the market and where the risks are to the potential soft landing. This is Bloomberg.
the linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is the countdown to the open. I'm Matt Miller. We are moments away from the start of trading. You can see that futures are higher on the
So we are looking now to the market on open imbalance. The S&P 500 seeing 140 million to the sell side. NASDAQ 100, 55 million to the sell side. Dow 30 seeing 30 million to the sell side. Mag 7 stocks also seeing 30 million to the sell side.
Reinsure investors that finances are stable ahead of that snap French election. Voting starts in the first round on Sunday. You can see the 10-year yield right now at 4.25, and NYMEX crude coming down just a bit, but still well over $80 a barrel at 81.39. One of the stocks that we're watching, maybe the only stock you need to watch, is NVIDIA, bouncing back after its three-day drop. $430 billion wiped away. For more on that, we're joined by Bloomberg Technology co-host Ed Ludlow. Ed?
Yeah, so NVIDIA's up more than 2% at the open, Matt. And I think it's a day where we look at the Bloomberg terminal and we get technical. You know, we entered a technical correction across those three sessions, a more than 10% decline. We're rebounding slightly from that, but a number of market participants would say, well, this is a stock that is trading significantly above its 50 and 100-day moving average. As you'll see in that key story on the Bloomberg terminal, $115 a share is identified as a key level of resistance. These are people that look to the charts for some justification after what was quite a serious rout. But I heard Abby talking earlier, right, about this idea that this was the first technical correction since April, when we went from that March peak to April low. But you also then have to come back to earnings. We had a 43% gain in the stock following earnings on May 22nd. And what the story has been is the street's struggle to keep up with forecasting revenue growth. So what the guidance was for the fiscal second quarter of the financial year 2025 in the earnings print is $28 billion of revenue plus or minus 2%. As we discussed yesterday, even
according to sources, oil loadings from Russia's western ports in July set to decline 23% month over month, as refinery runs are expected to rise, again according to sources.
Yesterday, in Bloomberg Technology, Ayako Yashioka at Wealth Enhancement Group. She holds more than 7 million NVIDIA shares. And she was explaining to me that when she came up in the market, she was always told, be cautious about a stock that has a price to sales ratio of 10 or above 10. This is a stock that has a price to sales ratio above 20, but she also acknowledges that NVIDIA may be supply constrained. In other words, the thing we're so hyped about, its product, it could be selling more of it if TSMC, its main contract manufacturer, was able to provide it such. So it's a mixed picture, but it's a modest rebound, 2.5%.
Well, and you want to look at price to forecast sales, right, Ed? Because the stock market's a discounting mechanism, and who knows what the sales are going to be.
Yeah, I think the other big unknown is that the product-specific categories are now important. We've raved about the H100, which is its main AI accelerator at volume, but they're quickly ramping H200, the next generation, and as we heard in earnings, by the end of this calendar year, they will start shipping in some tangible volume Blackwell. And so we just don't know what the revenues from that new product line will be with NVIDIA's commitment to bring a new AI accelerator online each calendar year. That's where the street has trouble. But yes, you're right, those numbers that I was giving, I'm talking about price to forecasted sales over the next 12 months.
Ed, thanks very much. Bloomberg's Ed Ludlow co-hosts Bloomberg Technology. You can catch that program at 11 o'clock Eastern time. Now, Carnival Cruise is out with its latest results just a few minutes ago, and Abigail Doolittle joins us for more on this consumer discretionary stock.
Yes, indeed, Matt. So here's a bright spot, because we were talking about some of the weak spots for discretionary not moments ago, some of those big spends in terms of pools and Winnebagos. But relative to cruises, which you can do in a relatively price-attractive way, well, they put up a good quarter. They put up a profit of 10 cents versus the loss, 11 cents, excuse me, above the loss of 2 cents per share. The forecast looks strong. They've raised guidance. So not surprisingly, the stock is up 3.2%. That is a fifth up day in a row. What makes it so interesting, though, Matt, is that in the pre-market, the stock had been down more than 1%, even down more than 2%. So there were some jitters, but this company has delivered, at least right now, ahead of the call, off of the lows, I think about a year, 2 years ago, up now more than 170%, but still well below the pre-pandemic, so sort of right there in the middle. But it does seem as though that their business is rebounding for those who like to cruise.
All right, Abigail, thanks very much. Bloomberg's Abigail Doolittle talking about the cruise stocks, always interesting. Let's get, though, to aerospace. It's been a hot industry to talk about the last few days. Now, Spirit Aerosystem is down. Boeing has switched its proposed funding for a bid from all cash to a stock, mostly stock deal. Bloomberg's global aviation leader, Benedict Campbell, joins us now from Berlin. So I guess Spirit Aerosystems shareholders want cash money and don't want shares.
Yeah, you're absolutely right, Matt. Cash is king in this case, and Spirit is a company that is really cash-strapped. But the truth is, so is Boeing. We've seen this company in a real sense of crisis since the start of January. They lost about $4 billion in cash in the first quarter and have warned that the second quarter won't be any better. So this is a company that's losing more than $1 billion in cash a month. Yeah? So obviously this company has a lot of issues, and cash is something they will want to preserve. We're hearing that the deal might be close, but these sort of final backs and forths are putting a bit of a strain on the timing. We're hoping that maybe they'll be able to get it over the line this week. It's an incredibly complex deal to unpack because Spirit is the main supplier to Boeing, but they're also a big supplier to Airbus, which is obviously the arch rival of Boeing. So sort of piecing that apart, making sure that the bits of Spirit that provide stuff for Airbus land in the right camp and the other parts land in the Boeing camp, that's really complicated. So you've got the financial element, you've got the operational part, all of which sort of make up a slightly messy picture, which is why this deal is dragging out.
By the way, in terms of Airbus, Benny, when I was with you in Berlin 2 years ago, I talked to Guillaume Fauré, and he said at the time his suppliers just weren't ramping up their production of the parts he needed fast enough, and that was a huge constraint on sales. Now he's said that the problem is worse than he's expected.
Yeah, I mean, this is the thing, on the one hand, no surprise, because as you said, this is something they've spoken about for years, coming out of the pandemic, probably even before the pandemic. Supplies were always a big issue. This is not a demand story, it's a supply story. The suppliers do not have the manpower, they don't have the equipment, and that's really rippling through the line. So will it get any worse? They might try and stabilize some of the most vulnerable suppliers, as we're seeing with Spirit now, but there are others out there that they're taking a very close look at. They might need to inject some money there and additional manpower. But he has said, as recently as this month, he told us, this is a problem that will stay with us for another 2 to 3 years, so no real improvement on the horizon there.
Has Airbus, Benny, managed to really capitalize on the big Boeing problems, the nasty headlines, the 737 issues, the whistleblowers? Has Airbus actually taken customers from Boeing because of that?
Not in a tangible way. I mean, this is always what people might think. You know, you've got these two players, so if one is down, the other one picks up business. But this is a really long-term operation. If you're an airline that's a loyal Boeing customer, you won't quickly switch. There's a lot invested in that relationship in terms of training, in terms of simulators, in terms of crews, in terms of maintenance. So you can't just go back and forth. And the other thing is, even if you wanted to go to Airbus, they just don't have the planes to sell. So, you know, you could say, hey, we'd rather go from the 737 to the 320. Airbus will say, great, but join the end of the line because we're sold out until the end of the decade. So they've picked up a couple of sales here and there, but not in a big business, in a big way.
All right, Benny, thanks so much for joining us. Bloomberg's Benedict Kamel there in Berlin runs our airlines, or our aircraft, I should say, coverage for us. And he's wearing an Ed Meyer tie, probably the best clothier in all of Germany, M-A-I-E-R, Ed Meyer. Check it out. All right, let's talk now to Mona Mahajan, Edward Jones Senior Investment Strategist, about the risks to a soft landing. Mona, I was talking with Brent Schutte earlier from Northwestern Mutual, and he was saying he expects a recession. Do you share the same bearish view of the economy?
Yeah, thanks, Matt. You know, for us, a recession is not a base case. In fact, it's probably a tail risk, if anything. Our base case is the economy can cool, but cooling from a position of strength. So last year, we were looking at 3.4% annualized GDP on average every quarter of 2023. This year, we're probably looking at closer to 2% or maybe sub 2%, but still in line with what we'd call trend growth levels. Now, clearly what we're seeing in the economy is a labor market that is starting to cool. We have a 4 handle on unemployment now. We are seeing early indicators like job openings that are cooling. The quits rate is coming down, so folks are not quitting their jobs at the rates they once were. And we're also seeing, you know, the consumer is quite comfortable when they feel very comfortable with their jobs. So if the labor market is cooling, consumption may be cooling as well, but certainly not to a negative growth rate. But perhaps from a position of strength, some normalization is occurring.
I'll ask you an uncomfortable question, Mona, because Michelle Bowman said that restriction of immigration would curtail supply in the labor market. And that leads me to wonder, does the election make a difference? I mean, clearly Biden has come out with some restrictive immigration policies, you know, just ahead of the vote, but Trump would be, I think, more restrictive. Does it make a difference who wins in November?
Well, certainly policy and presidential policy has long and variable lags before it becomes meaningful in terms of what we're seeing in real time. And so we'd say is real policy change takes time. Meanwhile, what the markets have demonstrated to us, and when we look back at history, we really see, regardless of who's in the White House, what tends to drive markets more broadly, and even to your point, the labor economy, tends to be things like what is happening with inflation, what is happening with the Fed funds rate, what is happening with earnings growth. And so those factors we think are lining up nicely still ahead of that November period and even in the years following. Also, what we see is, you know, in a 4-year presidential cycle, historically, year 3 has been the strongest. That was last year. But year 4 tends to be second strongest. And part of that is uncertainty is unlifted. Part of that is the administration is putting policies in place that might help voters at the voting booth in November. But more broadly, we'd say don't play politics with your portfolios. Think about long-term impacts from the fundamentals more so than any real policy changes.
But it must be tempting, I mean, especially for an equity investor, Mona, who's already racked up gains of 14% year to date, to say, you know what, I'm going to just sell now, take my profits before we even get close to November, and you know, maybe I'll get back in after. What do you think about that? Especially as the consumer, you know, shows some signs of weakening.
Yeah, look, you make a good point in that volatility does tend to be elevated in the 6 months prior to the presidential election day, November 5th this year. And even in the weeks ahead of presidential election day, markets do tend to show some pullback. But what's been pretty consistent is the 6 to 10 weeks after presidential day, markets tend to recover. And so what we were really thinking about is if you do get that period of volatility, and we haven't gotten much volatility this year thus far, so maybe that period ahead of election day will bring some. That's really your opportunity, especially if you haven't participated much in this 14% rally, to your point, 24% last year in the S&P 500. It is a great opportunity, we think, to position yourself, whether it's rebalancing, whether it's diversifying, whether it's adding quality investments at better prices. Think about that balance between growth and value, growth and cyclical parts of the market. We saw even in the last few weeks, as NVIDIA, the mega cap giant, AI giant, pulled back, the rest of the market actually held in there. And so the early signs of that broadening of market leadership starting to play out. We would use periods of volatility to our advantage. We want to be positioned for not only this year, but really the years ahead, where we do think the bull market phase has some legs ahead of us.
Wouldn't you? I mean, I don't want to talk about an individual name with you, Mona, but in terms of AI, right? If you see a decent AI sell-off, wouldn't you view that as an opportunity to buy in?
Certainly, we do think AI is in the early innings of what is a multi-year secular growth story. We think right now the enablers of AI, so the infrastructure players, the semiconductors, et cetera, the building blocks of AI are seeing most of the gains. Over time, we would expect that to broaden a bit. So the sectors that would benefit from the efficiencies of AI, think about healthcare, think about infrastructure and robotics and manufacturing, or even financial services. All of these sectors we think will benefit from the efficiencies. We should see it show up in the gains as well. But to your point, if we get a pullback in AI and you don't have the exposure you want, that is a great opportunity to get into long-term what we think is a theme that will have some legs ahead of it.
What about small cap stocks, mid cap stocks? I guess undervalued, or what a lot of people would view as undervalued stocks. Mona, you talk about rebalancing. Is that where you'd go?
Certainly, we are still favorable on large cap and mid cap stocks here. Small cap space is interesting. Keep in mind, they have been weighed down because they're highly leveraged. They tend to have a lot more floating rate debt. And so in this high rate environment, they have not benefited at all from rates remaining longer for a more extended period of time. That may reverse a bit as we get closer to Fed rate cutting cycle. But where we like to play is in that mid-cap space, where not only will they also benefit from a rate cutting cycle, but they have more profitable companies overall, a little bit better margin of safety in terms of exposure to economic upturn, and a more cyclical tilt as well. So we think mid-caps are really an interesting way to play a potential recovery and a potential Fed rate cutting cycle ahead. We continue to like large caps here, both on the growth and value side as well. But I think there are opportunities in both those spaces if we do see pullbacks or even volatility ahead.
All right, love to get your take, Mona. Thanks so much for joining us. Mona Mahajan is Senior Investment Strategist at Edward Jones. Coming up, Paul Singer is pitching Wall Street its own way to make America great again, and it's starting to gain real momentum. We'll talk about that next. This is Bloomberg.
I've seen firsthand how how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
In New York, I'm Manus Cranny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
It is less than 5 months until the U.S. presidential election, and this Thursday already, President Joe Biden and former President Donald Trump will be holding their first debate. The smart money on Wall Street is already pitching its own vision for Trump's America. Business figures led by hedge fund billionaire Paul Singer have poured nearly $200 million into a New York-based think tank to wage war on wokeness. Joining us is Bloomberg's Simone Foxman, who co-wrote this story. So, not a huge surprise that Wall Street isn't a huge fan of wokeness, but now they're really putting money behind that issue.
Yeah, this think tank is one that's been around for quite a while. It's called the Manhattan Institute, but under Paul Singer, who became chairman in 2008, and more recently under the stewardship of President Reihan Salam, it's gotten a lot more influence, and they've really focused on this idea of wokeness, color blindness, anti-racialism, and that has really come about in things like anti-DEI proposals.
In 10 minutes' time now, at the top of the hour, we see the release of the US Conference Board's Consumer Confidence Read. Forecast 100 on the prior 102, with a range of 106 to 96. With this, we also see the Richmond Fed Composite Index, a forecast -3 on the prior 0.
Model legislation, and what they do is they send it out to lawmakers, especially Republican lawmakers, and especially on DEI, but you know, it's getting attention on other subjects too. Sometimes these lawmakers are passing these rules literally word for word, citing this model legislation. In fact, Manhattan Institute claims that 11 states have passed its anti-DEI legislation in terms of universities. And so that kind of speaks to the amount of influence it's having, and it's trying to use this influence to gain some leverage in a Trump administration.
So they've also been kind of activated, triggered, if you will, by the rise in anti-Semitism that we've seen, right?
Absolutely. That is a key piece of it. And what they say, and they're among several voices here, is the idea that DEI on campus and this communist-inspired ideology, left-wing ideology on campus, has really turned into anti-Semitism on campus. Now, that's not an opinion everybody shares. Certainly.
You don't think that that's a fact, that you've seen a rise in anti-Semitism on campuses?
Well, certainly there's been a rise in anti-Semitism on campus, but not everyone believes that pro-Palestinian protests are anti-Semitic. They tend to believe they are. There are others who sort of take a different view on that and say, no, they're just campaigning for the rights of Palestinians. That said, certainly that what's happened on campus in the last year has played into some of the interest in the Manhattan Institute. They had a record fundraising at their most recent gala, $4.6 million in one night alone. And that, of course, contributing to that overall about close to $200 million that the Institute has raised for furtherance of its ideas in the last decade.
Well, the story is really well done. I recommend that everyone with a Bloomberg check it out. And indeed, even if you don't have a Bloomberg, you can see it on Bloomberg.com or in Business Week.
Not in Business Week.
Well, it should be in Business Week, Simone.
All over the internet, so please read it.
Simone Foxman there, co-writer of the story. Highly recommend you check that out. Let's get back to the market now. Shares of Walmart falling this morning. For more, we bring in Bloomberg's Abigail Doolittle.
Yeah, a bit of breaking news here, Matt. We do have Walmart down more than 2%, heading to its worst day of the year since November of 2023. And behind this, headlines out of a Bank of America London investor conference, with the CEO essentially saying that this current quarter is not going to be as robust as the last quarter. If you remember the first quarter that they reported, it was really pretty tremendous. But the CEO saying that this current quarter, that they believe that this is the most challenged comp quarter of the year. So it's interesting. We were talking about Walmart earlier in terms of the support from higher end shoppers. Perhaps that's waning. But the CEO also saying that that first quarter, that strength, they think that's a vision of how it could potentially be in another quarter. But again, not just this quarter. Again, the stock down 2%, the worst day of the year. As for some sectors on the day, we're looking at the possibility of a gain for the S&P 500, right now up about 0.2%. Interestingly, though, Matt, most sectors are lower. In fact, 8 sectors down. Materials, real estate, industrials, the worst, all down about 0.5%. To the upside, though, and it's very interesting, Matt, to see that a 0.9% gain for the tech sector, that it's not leading the overall index up more, but that is the case. And you were talking about discretionary being the second to worst quarter or sector on the year. Well, that is the case. So lots of consumer sentiment in the spotlight today.
Yeah, very interesting. How investors are viewing the consumer and how they're playing that in terms of the stocks. Abigail, thanks very much for that. Coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
So in 5 minutes time now, at the top of the hour, we see the release of the US Conference Board's consumer confidence. Forecast 100 on the prior 102, with a range of 106 to 96. This report representing the month of June. We also get the Richmond Fed Composite Index, forecast -3 on the prior 0.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Time now for the Trading Diary, what you need to be watching today and next week. We get June consumer confidence data at the top of the hour, and the Bloomberg Invest Conference is now underway. Definitely check out LiveGo on your terminal to follow that. Tomorrow we get May new home sales. Thursday brings the first debate between President Joe Biden and former President Donald Trump. And we round out the week with PCE, the Fed's preferred inflation gauge, on Friday. This was the Countdown to the Open. I'm Matt Miller.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports
1 minute
team
remaining.
that can
I'll be leading
perform
with the
at
USCB consumer confidence.
Talking a lot about the explorer spirit, how can we really tap into new things, continue being disruptive. We have 80 different nationalities head-on. It's very important to have a diverse team because we have a very diverse landscape of customers.
This June, in honor of Pride Month,
The Richmond Fed Composite Index out early at -10, -10, which is lower than forecast -3.
June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month.
We are 30 minutes into the U.S. trading
10
day.
seconds.
It is Tuesday, June 25th. Here are the top stories we're following for you. NVIDIA bounces back after 3 days of losses, wiped out $430 billion in market cap. And not so fast. Federal Reserve Governor Michelle Bowman warns of upside risks to inflation and says now is not the time to cut rates. Plus, taking stock of Whole Foods.
Still waiting.
The company's CEO talks inflation concerns, expansion plans, and
100
more.
spot 4,
Later this
100
hour,
at spot 4, higher than forecast 100.
I'm Matt Miller in New York, standing in for Katie Greifeld, who is currently down at the Bloomberg Invest Conference. If you want to tune into that, you can type LIVE GO, live go on your terminal. We are looking at the S&P 500 gaining only about 0.1% right now. NVIDIA is obviously a big help there, up 3.25%. A lot of investors saw the drop over the last few sessions.
So seeing the average 12-month inflation expectations ticked down slightly from 5.4% to 5.3%. June's write-in responses revealed that elevated prices, especially for food and groceries, continued to impact consumers' views on the economy, followed by the labor market and US political situation.
The snap elections, they start on Sunday, the first round of voting in France, and then they'll finish, of course, on July 7th. We also have consumer confidence data crossing the terminal right now. For that, let's go over to Michael McKee, Bloomberg's chief economics and policy correspondent, and get the details. Mike?
Well, we have a little bit less confident consumer out there today, Matt. The Conference Board's numbers come in for June at 102 for the headline, which is a little bit higher, or I'm sorry, comes in at 100.4, which is down from 101.3 the prior month. The present situation is also a little bit lower, 141.5, and the expectations number, 73, is a little bit lower. Now, the big number in the consumer sentiment index, consumer confidence index, is always jobs. And you and I were talking in the last hour about Mary Daly warning that maybe unemployment goes up, but the number of people who say jobs plentiful has gone up in this report. The number of people who say jobs hard to get goes down. And I got one more chart I'm going to throw at you, and that is the consumer confidence numbers versus inflation. A lot of talk about whether we're facing inflation and the Fed's behind the curve. And while consumer confidence drops during inflations for the most part, it only drops right before the recession begins. And if you can look on the right-hand side there, we're not anywhere near that kind of thing. The one thing that is interesting is if you look at the recession in 1991-92, or rather 99, that is the tech recession, the tech bubble bursting, and maybe we face a similar situation today where everybody was confident because the tech stocks were going up.
I remember that. I was there. Mike McKee, thanks very much for joining us, our Bloomberg policy and economics correspondent. Let's turn now to what's going on in the markets this instant. Joining us now is Stephanie Guild, Robinhood Financial Head of Investment Strategy. Obviously, not necessarily a second Stephanie, but great to have you in here to talk about what we've seen over the past few days, because you know, NVIDIA dropped, and I'm guessing investors, especially probably retail investors who are waiting, now see this as a sign to get in there.
Yeah, when you look at our Robinhood Investor Index, which tracks kind of what our customers are doing, NVIDIA is a core position. It's within the top 10, and we do see our customers trading around their core positions. So when it goes up, they tend to trim a bit, and when it goes down, they tend to take an opportunity to step in a bit more. And my guess is that they're probably doing the same for NVIDIA.
A lot of people have been talking about it as the most important stock in the world. There was obviously a split, which I guess, does that make it easier for retail investors to get in, or is this market nowadays one where it's easy to buy fractional shares?
Yeah, I mean, we have fractional shares. You can buy them in other places as well. So I don't think a split is that meaningful in terms of being able to invest. But I think it's a positive sign, right? I think it just still sends a positive signal.
What about the AI theme in general? I mean, you know, we talk so much about the consumer and worries about inflation and the Fed and all these macro issues that don't seem to affect the AI theme. I mean, it's not going to matter if a consumer decides to install a pool or not, right? AI is here, and it's going to be changing the way we live, we work.
Well, if you think about the market, right, if you look at the S&P 500, the top 10 names, which are driven by all these tech names, including NVIDIA, make up probably the highest concentration they have in a long time, 38%, close to 38%. I think it's 37% after yesterday. NASDAQ index is as well, right? Close to 60% is in the top 10. So, of course, these names are driving the market, but the market is still dealing with two different narratives. If you think about it, they have the traditional narrative of inflation. What is the Fed going to do? What is the consumer going to do? Are we heading for a recession? Which I don't like to say very often, but
do you think we are?
No, I don't think so. But it's something that you have to watch, right? I think you have to watch the job market to really tell whether we're heading for a recession, and what it feels like for the everyday person. What it feels like for an investor is very different, because it is driven by this tech supercycle that we are in, and how those two come together, I think, is what the market is also grappling with.
Well, we've seen, you know, the everyday person apparently not putting in as many pools, not buying as many Winnebagos, these big ticket spends coming down. Are you worried about the high-end consumer? I mean, obviously inflation has hit and is going to be very painful to the lower to the lower couple of quintiles, but the high-end consumer apparently now going to Walmart to save money instead of maybe Whole Foods.
I know, I saw that in their last earnings report. I think, but companies are listening, right? It's the consumer's fatigue, no matter where you sit, I think, on the income spectrum. And it's exhausting, and it's not really about so much as how much is inflation going to change. I think it's much more about, like, how does it feel? And the consumer's more discerning. And you've seen companies are listening, right? You've got Target, you've got McDonald's, you've got all of these companies that are saying, I'm looking for ways to provide better value to the consumer to keep their businesses going. And I think that's what's going to help bring inflation down.
So no longer ratcheting up prices. You think inflation is going to continue to soften?
Yes.
And then are you optimistic for cuts? Does that matter?
I think the Fed will cut at the end of this year, and I think they'll continue into next year. I don't know, like, I know the Fed expectations from last week were, 1% next year, 1% the following year. I see a world in which they kind of cut for a little while and then they stop, because I do think the neutral rate of interest, based on the research that we've done, is around the 2% mark. So I don't know if the Fed has to cut that much to kind of make it feel, in line with.
Well, nobody in this market is really expecting us to go back to ZERP, right? Or NERP. It's not going to happen.
Yeah.
All right, so let's talk then about where you would be investing, or if you'd be putting new money to work. We've gone up, 50% so far in this bull market since the drop in the beginning of 22. Do we continue to run up? Can we go higher? Are valuations feeling stretched at all to you?
I think in some places they are, and expectations can, in the intermittent period, get ahead of themselves. And I'm kind of, looking at something like a Micron to kind of tell where we are, especially in this period right now. If you think about it, this kind of time period in between earnings seasons often can feel stressful, and so I think the market can feel soft in the short term. But if you look back over the last 30 years, September's always been the worst month, and so we have this kind of joke amongst my teammates that you say, instead of sell in May, you sell in July and come back in September. That being said, I think for the long-term investor, I think we still have very strong growth ahead of us, but it doesn't mean that we can't have a correction sometime this year.
Right. Well, I mean, one of my viewers earlier was writing in, hey, why don't I just sell stocks now? I'm already up 14% year to date. I don't want to deal with the stress around November. I didn't ask him about September. But, it's been a good run, right? On the other hand, the average bull market going back to the 50s is a doubling, more than 100% gain. So you could lose out on a lot.
The market is made to make new highs over time, right? And one of the most famous investors, Peter Lynch, did say that, preparing for a correction has probably lost people more money than actually the correction itself. And that's sort of, I think for the right time horizon, I don't think you need to worry about it. For short term, if you kind of investing for the next 6 months, yes, you have to worry about the volatility and what that could mean. And look, cash is offering a pretty good return these days.
Yeah, all right, so you're still bullish, though. You're still in. You think inflation's going to come down, the Fed's going to cut at least a little bit, and this market's going to continue to run higher. Is it going to be are we going to see this broadening out that everyone's waiting for? You mentioned that 10 stocks are 38% of the S&P.
Yeah.
Are the rest of them, the 493, as I like to say, going to do okay?
I think so. I think there's a lot of opportunity, and that's the one thing about this environment that I feel like I've been waiting almost my whole career, maybe except for the first 5 or 6 years of it, is that it's a stock picker's market. And even if you look beyond those 10, there are a ton of opportunities. We've looked at companies that are not only in the growth space, but also profitable value stocks now. And I think that's where you kind of have to start saying, like, okay, if the Fed does cut, if we do have this soft landing, which I still think is a probability, where would you put your money? You'd probably put it in some of the places that have been hurt by a high inflation, high interest rate environment.
All right, Stephanie, great having you in the studio. Thanks so much for joining us. Stephanie Guild there of Robinhood Financial. Let's take a look now at what's moving markets with Bloomberg's Emily Grafeo. She brings us some of the movers she's watching. Emily?
Well, Matt, you said it at the top of the hour, the most important stock in the market, in your opinion, NVIDIA. I'm looking at that stock because it is stabilizing after that $430 billion market cap wipeout last week. The drop also pushed it last week into a technical correction. That's when a stock stock drops more than 10%, though technical analysts over at Oppenheimer point out that NVIDIA is still trading above its 50 and 100-day moving averages, which according to the folks over at Oppenheimer means that the longer-term trend for NVIDIA is still pretty strong. And I think most analysts would agree with that. Very bullish on this stock. And you want to look no further than the ETF market, Matt, to see just how much this stock and the moves here are really whipsawing investors. There's an ETF, I'm sure you know it, the 2X leveraged NVIDIA ETF from Granite Shares, the ticker NVDL. It saw a record weekly inflow last week. Investors poured over $700 million into that ETF. And then on Monday, the fund, of course, dropped 14% because we were seeing weakness in NVIDIA, and this is giving you that magnified move. So it's been a ride. I guess if investors haven't sold, they're hoping now that that ETF is going to rebound. But so far, that has been a wrong way bet for those traders that got in last week.
All right, you're looking at the Gap as well. What's going on with the owner of Banana Republic?
Well, that stock is seeing, I guess, a turnaround, at least according to TD Cowen, the analysts over there, raising their price target and upgrading the stock to a buy. Analyst Joanna Kim said she sees encouraging signs of a transformation at Gap's namesake brand, and she's also seeing more sustained growth at Old Navy and Athleta. The price target was raised to $30 from $28. And Matt, this follows last month's blowout earnings for Gap. Their comp sales beat in all of their 4 banner brands. The stock is up 185% over the last 12 months. I don't know if you've looked at their website recently or their advertising, but they're really trying to transform that namesake Gap brand from, you know, something you associate with jeans and sweatshirts to a more fashion-forward brand. They brought in Zach Posen as their creative director. They put Anne Hathaway in a Gap dress on a red carpet event. And so that's really what the analysts at TD Cowen are bullish about, this kind of transformation that Gap is undergoing right now. They also recently brought in a new CEO who's furthering that transformation.
All right, and then a stock we've been talking about a lot over the last, let's say, 16 hours, and that is Pool.
Yeah, Pool Corp, those shares down over 10%. This is a distributor of swimming pool supplies. And the reason why we're all talking about it is because we're trying to learn about the macro story that this company is telling us. The sales for pools are trending down about 6.5% in 2024. The company said they see new pool units down 15 to 20%, and they see full year remodeling activity down as much as 15%. So I guess the signal here is that less people are remodeling their existing pools, and they're not buying new pool projects and new pool supplies. So according to some, you know, that signals some weakness in the consumer, despite what maybe Gap is telling us.
Yeah, right. I mean, the question is, I was talking with Abigail Doolittle about this. Does that mean, you know, people are deciding not to get pools, or maybe those people already got pools because demand was pulled forward by the pandemic?
Right, yeah, there were so many pool construction projects during the pandemic. How often do you have to remodel your pool? You're probably not going to be doing it, you know, every 2-3 years. That's more of a maybe every 10-year kind of ordeal.
All right, Emily, thanks very much. Bloomberg's Emily Grafeo. She covers stocks for us, looking at the movers, some of the movers of the day. Coming up, the Bloomberg Invest Conference is underway here in New York. We'll bring you conversations from the leaders in asset management, banking, and wealth. This is Bloomberg.
So this will anchor, I think, a lot of our discussions throughout the day here. It's a really...
This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Boeing can't stay out of the news. It's now said to have offered to buy Spirit AeroSystems in a mostly stock deal. For the latest, let's get to Bloomberg's global aviation leader, Benedict Kamel in Berlin. And Benny, when it was cash, I guess people were happier. The shares in Spirit AeroSystems are now down.
Yeah, so, everyone wants cash and they don't want Boeing shares right now. But Boeing is a troubled company. They don't have the cash. In fact, they're losing a lot of cash. They lost about $4 billion in the first quarter. They've warned that they'll lose a similar amount in the second quarter. So you see about $8 billion in cash rushing out of the company. So they've changed their tune. They've reconsidered. And we're hearing that they are now offering more in equity for this one. It's not a happy marriage. Make no mistake. I mean, this is one company kind of being forced to buy the other. Spirit needs to deal as much as Boeing does. This is obviously prompted by, the January blowout of that fuselage part and Boeing realizing that they needed to take closer control of their key supplier. But this is an inherently value-destructive deal to begin with. They'll have to spend money. They'll have to take on the debt. That's another $4 billion almost on top of that. They might be able to fix the company longer term, but that'll take time.
Airbus, Boeing's chief rival, was literally decimated in Paris trading today, down almost 10%. I guess
taking a look at the Fear and Greed Index, 40 out of 100 equaling fear, and the Crypto Fear and Greed Index, 30 out of 100 also equaling fear. And looking at the VIX, currently up 0.3% at 13.38.
And you also saw it sort of ripple through the industry. If you look at some of the companies that work closely with Airbus, you had Safran in France who make engines, you had MTU in Germany, you had Rolls-Royce in the UK, the engine maker, all down. And some analysts really sort of shocked by this because what we saw was sort of an across-the-board reduction in Airbus's targets. They're going to produce fewer, they're going to distribute fewer planes this year. They're going to produce fewer aircraft. They're going to have less cash. They're going to have fewer earnings for the year. So really an across-the-board kitchen sink type revision of their earnings. And as you said, this has a lot to do with the supply story. They don't have the kit to make the planes. They don't have the engines. They don't have the sort of aerostructures. They don't have the seats and tables that go into the interiors. All those things together are creating a fairly toxic sort of cocktail for the company, and it'll take time there again to get out of that. Guillaume Faury, the CEO, he told us not so long ago this will be something for the next 2 to 3 years to get rid of.
All right, Benny, thanks so much for joining us again. Bloomberg's Benny Kamel covers aerospace for us out of Berlin. Now, let's take you live to the Bloomberg Invest Conference where Todd Boehly, Eldridge Industries Chairman and CEO, is speaking with our own Shanali Basak on the state of the equities market.
And ownership are significantly overlapped, right? The ability to be on the front foot is very different than when management and ownership are completely disconnected. So just take the media industry, for example. A24 is a company that we founded in 2012. 2 years ago, they were the first studio to ever clean sweep all big 6 of the Academy Awards. Best Picture, Best Actor, Best Director, Best Actress, Best Supporting Actor, Best Supporting Actress. So they clean sweep all 6. They're significantly owned by their founders. So they're in a position to figure out how are we going to use AI in order to make our content faster, better, quicker, cheaper, And at the same time, they have the credibility to bring the actors and actresses with them on, the journey. So, because let's face it, it's coming, right? So, you have to be able to figure out how do we win collectively, in this journey. You look at what's going on in, kind of large publicly traded media companies, and I think they're on the back foot playing defense because management and ownership really don't wear the same hat, right? They have a very disconnected view of the world.
Is what you're saying that this makes a difference in terms of how they invest in technology, in AI?
I think it makes a difference on whether they're on the front foot or the back foot and how they, kind of come to grips with, we have to embrace this, and figure out how to tackle it and figure out how to do it so we're all going to be on the same page going forward. But the reality is it's coming, right? So I think if you look at, insurance and how we're thinking about how it's going to affect insurance, processing of insurance, call centers, right? We're now using AI in all of our call centers to service our insurance policies, and it's just a better experience, right? We used to have to monitor, calls to figure out how the call center operators were doing. How many calls can you actually monitor, right? 50 basis points of all the calls? Now we basically get full transcripts of every call. When you hear tension rising, when you hear certain words, it automatically kicks that transcript to a manager who can then decide. And of course, what also was happening is every call center employee would have to give a summary of the call. So they'd have to take the call, write down the call, the description of the call, and as you can imagine, no call ever went wrong.
So I want to switch gears here and promised you sports. We'll get to sports because you were really a pioneer here. You're seeing more and more private equity executives, either on their own or through their funds, enter the sports world. From everything you've learned, let's talk about some of the teams that you have. What's the future of the Dodgers after owning it for this long?
I think we're scratching the surface on what the Dodgers can be. I think if I had to bet, the Dodgers will be the first team to hit $1 billion of revenue. I mean, I think we've got a global franchise. We've got...
That was Todd Boley there, Eldridge Industries Chairman and CEO, live from the Bloomberg Invest Conference, talking a little bit about A24, about AI, and about the Dodgers. Now you can watch in real time on your Bloomberg terminal. Just type LIVE Go, Live Go on the terminal. Still ahead, we're going to take a look at the companies making the most social buzz today. Social Climbers is next. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. From the world of politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Time now for Social Climbers, a look at the stocks making waves on social media this morning. First up, Carnival Cruises on social media after it raised its annual profit forecast for the second time this year. The cruising giant is banking on higher prices and strong demand. Next, Solar Edge, looking more like a black hole sun today. The solar equipment maker announcing that one of its customers has filed for bankruptcy. It's a customer that owes Solar Edge nearly $11.5 million. And finally, the world's biggest record labels are suing two AI startups, alleging they are unlawfully training their AI models on massive amounts of copyrighted music. The record labels are seeking damages that could amount to billions of dollars. You can follow all the latest company buzz on the Bloomberg terminal. Just type TRENGO, Trend Go on your Bloomberg. Coming up, Whole Foods continues to expand its daily shop concept. The CEO joins us next, and Katie Greifeld will be right back here in the anchor chair.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets. I'm Katie Greifeld, just back from the Bloomberg Invest Conference happening in Lower Manhattan. So let's get back now to what's happening in these markets. We're going to do that with Bloomberg's Abigail Doolittle.
Yeah, Katie, let's take a look at Whole Foods because, of course, we do have some exciting announcements coming out relative to their new the Whole Foods Market Daily Shop. There has already been one announced on the Upper East Side up on 3rd Avenue, but they're they've confirmed that there are 2 new leases. And of course, these stores cater to the fast-paced urban lifestyle. I happen to be in the Whole Foods on 57th Street last night. I would say that does a pretty good job, but the idea of being able to get in and out even faster, not a bad idea at all. And all these locations here in New York will also have the juice and Java in them as well. As for one concern around food, which I also felt last night, food inflation, but it's pretty interesting. If we use the eCan function in the Bloomberg terminal to break out the food component, both what you take at home and what you eat out, you can see back in 2022 a big peak. Interestingly, that growth there, it's less than 1.6%. It looks much more dramatic, but now we're back down. Hopefully that will be filtering into prices that we see at the stores far more. As for Whole Foods relative to some of the other food stores out there, so Whole Foods, of course, a part of Amazon. To the best of my ability to determine using the Bloomberg terminal, maybe 3 to 5% of revenue overall. If we compare it to the stock performance of Sprouts, Sprouts is really having a bounce back this year. They had some difficulties, but you can see Amazon up a very healthy 23%. Sprouts coming off of those lows. But then take a look at 2 of the other grocery stores. Grocery Outlet down about 19%, and then Albertsons, of course, one of the big ones, down 14%. So Amazon, not so shabby.
All right, Bloomberg's Abby Doolittle, thank you so much. Of course, it's hard to extrapolate out the Whole Foods performance from Amazon's stock performance itself, but definitely see the point there. Let's keep this conversation going with Jason Beekle. He is the CEO of Whole Foods. He is sitting next to me in studio. It's great to see you.
Great to see you, Katie. Happy to be here.
Let's talk a little bit more about the Whole Foods Market Daily Shop, your version of a convenience store. Talk to us a little bit more about this initial rollout and what locations you're starting in.
Yeah, so we've got our first store that's going to be opening this fall here in Manhattan on the Upper East Side. We've got 2 more stores coming here to Manhattan. We're also confirming we've got 5 stores in New York City coming after the very first store. This store is going to be approximately 10,000 square feet, plus or minus, depending upon the location. So it's about a quarter of our traditional Whole Foods Market store. And our goal here is to make it easy for customers to do a quick fill-in shop, grab-and-go food. The Juice and Java program, which was mentioned a little bit earlier, it's a quick way for customers to get the essentials that they need on the go. If you look at a place like Manhattan here, it's difficult to add an entire new Whole Foods Market store in a location, and it's a multi-year project, some cases 6, 7, 8 years. Here we can get a site really quickly with 10,000 square feet, open it quickly, and serve some of those unmet needs of our customers.
Yeah, space is definitely a commodity when it comes to this city in particular. So a bite-sized version of Whole Foods, a convenience store. What is the difference between this version, of course, the Whole Foods Market Daily Shop, and the 365 stores that you had a couple years ago?
Yeah, the 365 store was a much larger shop, and it was really aimed on the value customer. And so it ultimately was extending to a different spectrum and trying to expand sort of our customer reach. One of the things that happened when we became part of Amazon is we were able to reduce a lot of our prices. That's something we've been really proud of. And so as we did that step, we really didn't feel that a separate format was needed. And so this is ultimately taking the very best of Whole Foods Market, adding it in a smaller version, as you were saying. And our goal is to make it easy for customers to get in, get out. So, you know, the Columbus Circle store, as mentioned just a bit ago, you know, it's a really large store. A customer who wants to just go and grab a few items, this daily shop format's going to be allowing customers to get in, get out really quickly. And at the same time, you can go to one of our other stores and do a full shop when you have a chance as well. So we see a lot of customers shopping across both of these formats as we go forward.
So when it comes to the daily shop, it sounds like it's the format that is the differentiator. It seems like the prices themselves will be similar to what you would get in the full Whole Foods.
Yes, and we're going to have, you know, roughly 50% of the items we carry in our stores, there'll be less facings, but the essentials of what you need for everyday grocery shopping will still be made available. I know folks talk about it as being just a convenience shop, but the reality is this is sort of convenience plus. So think about all the essentials you need for grocery and a ton of on-the-go types of food, beverage, drink, etc. So it'd be a great way for customers who are in a hurry and still want to eat the high-quality products that we carry at great value.
And I hear what you're saying about, I appreciate the clarity that this is different from the 365, that once you were bought by Amazon, it sort of eradicated the need for that lower price tier. But that being said, are there any lessons that you took away from the 365 experience, applying it to this rollout?
Absolutely. One of the things that we really focused on was ways that we could simplify some of our experiences. These stores aren't going to have some of the same full service models, again, being a little bit smaller. So we took a lot of lessons learned from the experiment that we did with 365.
And we've been talking about pricing, and I want to talk about pricing a little bit more because, of course, inflation, even though the rate of inflation has cooled down, the level of prices is much higher than it was, especially on essentials such as food. And I'm wondering whether that's worked its way into the Whole Foods psyche at all, whether you've lowered prices or how you've tried to adjust around just the reality that inflation has been so hot for so many years.
Yeah, one of the things that we're really proud of this year is we've actually reduced across an average store 25% of our prices. We also really honed in on what we call our opening price point items, many of those being our 365 items. We reduced over 880 prices across our opening price points, and it's helping make our stores more accessible to more customers. We've also increased the number of promotions across the store and made them a deeper discount. And so what we're seeing is customers reacting to it. So we're seeing double-digit growth in sales of promotional items, as well as double-digit growth in the units that we're moving on the promotional side. So customers are reacting, which is great. The other thing that we really love to provide for our customers is some of the Prime benefits. So for all of our items that are on sale, you get an extra 10% off, and we've got special deals that we do throughout the week as well. So on Tuesdays, as an example, we've got about a half dozen offerings, including a rotisserie chicken, $2 off at any of our stores. On Fridays, you can get a $12 one-topping pizza. So it's great value for customers, and especially when you look at, we were talking a little bit earlier about eating in-home versus out-of-home. When you look out-of-home, that's where the prices are really going up. So we want to offer great opportunities for families across America to be able to have delicious food, healthy food at a great price point. And so our goal is to continue to invest to make sure that our customers are taken care of.
And it's really interesting to hear that you've seen such traction when it comes to those promoted, those discounted items, really seeing that growth. Because something that I've been wondering about is we've seen this trade down across industries, whether we're talking about food, apparel, other types of goods. And I'm wondering, has that hit Whole Foods? Have you seen that work its way into your market share?
Yeah, it definitely happens in certain parts of the store. So where we've had some, price increases take place. And I give an example, beef has been one of those areas that's been more difficult. So you have some customers who trade down to chicken, or they trade down to a different type of product in that space as well. So they might have bought steak before, and now they're trading down to something else. And so this is something we have seen to some degree. And what our goal as well, though, is making sure we can continue to provide the highest quality products with our quality standards. In the example of meat, our animal welfare standards. And one of the other things that we've seen, some trend on as well is where customers are looking at, well, this is what I'm going to pay to eat out of home at a restaurant. I can come get an amazing ribeye at Whole Foods Market, which we saw lots of customers do during Father's Day recently. And the quality is great and the price is great. So I think we provide a great spectrum of opportunity for customers during this time.
And just to crystallize that point, though, it sounds like you still are seeing that trade down. It's just that dollar is staying within Whole Foods and trickling down there.
Yeah, we do see some trade down take place, and I don't think that happens for every customer, but definitely customers who are watching their pocketbooks. That's something that they're looking at. What other options they can purchase.
And I do want to talk a little bit more about delivery. We've sort of nibbled around it here. And you rolled out in April $10 for delivery. What has the uptake been like? Who is paying $10 for delivery?
We have a lot of great adoption here. When you look at this is a great value subscription. We are part of Amazon Worldwide Grocery, which we're really proud of. And it's a way that we collectively as Amazon can serve all customer needs across all different facets of grocery. And this subscription program is one of the great ways of bringing these pieces together. So for $9.99 a month for all grocery orders over $35, you get unlimited delivery across Whole Foods Market and Amazon Fresh. And so it's great value for money. And when you look at what customers might be paying for delivery before, anybody who's placing more than one order, you're already saving money from Whole Foods Market perspective. And now you're able to get offerings both from Whole Foods and Amazon Fresh. So any needs our customers have across the grocery spectrum, we're able to serve.
Well, Jason, really appreciate you making the time. Great to chat with you, especially in person. Our thanks, of course, to Jason Beekle of Whole Foods. Meanwhile, let's get a check on these markets. Just over an hour into the U.S. trading day, we're going to do that with Abigail Doolittle.
We're looking at a very small gain right now for the S&P 500, Katie, up about 0.2%. Even so, it is the first up day in 4, and the 3 down days that we had into today, I think that was the longest losing streak since either early May or late April. In any case, a little bit of bearishness there, but the bulls have stepped back in, at least right now. The dollar is also higher, so this is an interesting day. Strong dollar, strong stocks. That actually is a signal of a strong economy, but these moves are so small you can't really make that correlation. But it's interesting to see that the up dollar not pushing stocks down. Now, the airframers index, the Bloomberg airframers index, down 2.8%. Of course, Airbus doing that pre-announce, cutting the view on for both the profit view and also planes to be delivered. This is weighing on Boeing, and of course, we also have Spirit Aerosystems down because the Boeing buyout of one section of their business, $35, but now a stock transaction as opposed to cash. Investors not really liking that. And then I was a little bit surprised to see this, Katie, the Bloomberg crypto index down 6.7%. Last time I looked, Bitcoin was rebounding, but it appears as though at least that's not the case for some of these stocks. As for the NASDAQ 100, well, we've had some tremendous gains, but it's not all bullish. What we're looking at here is and in fact, I would say this is a pretty bearish divergence. This is the NASDAQ 100 here in blue. In white, what we're looking at, the advanced decliner. So into the last January, a bit of a peak there. And since then, we're looking at a downdraft. So we have these new all-time highs being made. Of course, not today, but recently, but on less bullish activity. So many different bearish divergences out there telling you that investors are a little bit uncertain about what's ahead. As for beneath that surface on the S&P 500, up about 0.2%. Carnival up 4.8%. They beat. They put up an 11-cent profit as opposed to a 2-cent loss. Investors liking that. That stock up for a 5th day in a row. NVIDIA, nice rebound here. This is largely why we have some of the indexes higher. You would think maybe they could be higher, though, given the fact that NVIDIA is up 3%. That's the 3rd biggest contributor to the indexes after that official correction over the last 3 days into today, some cooling of a big rally. Boeing, here we have it, down 2%. And then Walmart, this is interesting, down 2.7%. The CEO at Bank of America London conference saying that the current quarter, it's not going to be as strong as that super strong first quarter. The first quarter, it might be replicated in the future, but this quarter is the most challenged quarter from a comp standpoint of the year. Investors not liking that. This is the worst day for Walmart going back to November of last year.
All right, thank you so much for that roundup. Our thanks, of course, to Bloomberg's Abigail Doolittle. Now, coming up, Novo Nordisk hitting a record high after announcing plans for a new U.S. factory. We'll give you the details next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal.
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
Wow.
Reporting from our world headquarters in New York, I'm Menace Crenny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Well, the company behind Ozempic is making a multi-billion-dollar investment to keep up with demand. Novo Nordisk plans to spend $4.1 billion to build a new factory in North Carolina. Now, the new plant doubles the company's production footprint here in the U.S., and as you can see, the announcement sending the stock to a record high. Joining us now with more is Bloomberg's Copenhagen bureau chief, Sarah Scholin. And Sarah, let's start, of course, with how much this will add when it comes to actually how much Novo is able to ramp up its capacity to actually meet all that demand that they're seeing.
Exactly, and I think this is the key issue that Novo is having right now. They're seeing such a big demand, but they can't keep up with the capacity they have. And this new factory, it will double the capacity in the U.S., but obviously these things are not going to happen overnight. It's still a few years out before we actually get any pens out of this factory, so it's not going to solve any problem immediately. But obviously this is something that the investors are taking a very positive note on.
Yeah, I was going to say, timeline, of course, we have to take a breath here. It's going to take a while to actually see this boost to production coming, but even still, you take a look at the share price. It's at a record high today. It's up 48% year to date over the past year or so, up nearly 90%. I mean, how much higher can it go before we see something like another stock split?
Yeah, like I think a lot of the analysts are tripping over themselves to upgrade some of their targets for the stock right now. What I'm sort of hearing from some of the Danish analysts right now is that today it passed that magic threshold of 1,000 kroner, and that could open up for a new stock split. It's not something that's going to happen tomorrow, but a bit further down the line. So we are starting to talk about that, which will obviously be another exciting moment for the company and for shareholders.
Yeah, absolutely. And of course, looking ahead, you think about Novo Nordisk's calendar here. They do report earnings in August. Of course, we're not going to see the impact to the current quarter that they're going to be reporting, but when you think about the outlook, might we see that change?
Yeah, there's definitely people here in Denmark. We have some other rules for reporting than you have in the US. So as soon as the company, they know that they have some information that could change the outlook, even if it's just a few hours before they release their earnings statement, they will have to put it out to the market. So this is obviously something we're going to be watching very closely from Denmark to see if we're going to get this upgrade to the guidance before the report comes out in August. But I'd also just like to add that what we're seeing today is not just the factory in the US, it's also the approval of Wegovy in China, which obviously opens up a huge market for Novo Nordisk. They haven't even sold any Wegovy there yet, and then yet half of Chinese population is either obese or overweight. So they're looking at a huge market opportunity there.
Yeah, absolutely. Definitely the double whammy they're combining to send the stock to another record high. And of course, you are Copenhagen's bureau chief. So maybe just put into context how important Novo Nordisk is when you think about the Danish economy, for example.
Well, it's everything right now. Like Denmark is many great things, but right now Novo is driving so much. And when we saw the Catalan deal earlier this year, that was $11 billion. It actually moved the Danish kroner. It weakened the kroner because Novo had to change so many Danish kroners into dollars to pay off this deal. So that's where we are. One company can change our interest rates and our currency. So it is really impressive. And in the Copenhagen area, which we have a big biotech hub here, they are just vacuuming up workers. it's really hard for some of the smaller biotech companies to find talented people or be able to match the salaries that Novo is offering them.
Yeah, it's just amazing. You think about the power and sort of the significance of this company to Denmark, and it's just so fascinating to watch. Really appreciate your reporting. Of course, our thanks to Bloomberg's Copenhagen Bureau Chief, Sarah Scholin. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Well, FedEx is due to report fourth quarter earnings today after the bell, and investors will be looking for any benefits from its cost-cutting programs. And here with more, I'm pleased to say we have Lee Klaskow. He is senior logistics analyst over at Bloomberg Intelligence. So Lee, of course, FedEx coming up after the bell. What are you expecting?
Yeah, and what we're looking for is continued progress with their ability to lower costs. The story with FedEx is really one, it's still a show me story, even though the company has been executing over the last couple quarters, but it's really about them bringing their costs in line to where demand is heading. So demand is heading e-commerce, that's the big growth area. So they need to kind of change the way their network operates to facilitate more B2C business versus B2B business. And that includes just, taking stuff that they might have had in their air network and putting it into their ground network, because they traditionally have operated two very separate networks, where UPS operates one more integrated network, and we're seeing FedEx kind of morph into more of that of a model. And they have a lot of things going on, and it should yield about $6 billion in cost savings over the next couple of years. And so we just want to see management's ability to execute on their plan, lower costs, get margins a little higher than they have been from a sequential standpoint.
And like you said, it's still very much a show-me story when it comes to that stock. How does that stack up to its competitors, though? I mean, when you think about the competitive landscape here.
Yeah, and so I don't have the Bloomberg terminal in front of me, but you can look at their stock price. Their stock price has really lagged the broader market, but if you look at relative to its comps, like UPS or DHL, it's actually outperformed in an underperforming sector. So, investors are happy in terms of what FedEx has been doing, but the reality is that parcel carriers are facing challenging times. Not only is demand, kind of low single-digit growth, if you will, but they are having higher costs. That cost includes labor, equipment, and other items that they're trying to really offset. And they're facing increased competition from third parties that typically aren't your typical logistic providers like an Amazon, which is I'm not going to say it's a significant risk, but it is a risk to volumes at FedEx.
And I'm glad that you brought up this stock price performance, because you take a look at the Dow Jones Transportation Average, and it's actually rallied a little bit in the past couple sessions, but still very much lagging the broader market year to date. Would FedEx alone be able to breathe life back into its peer group, or are you going to need to see some broadening out here for the transportation stocks to really rally?
Well, I think if FedEx comes on the call today and says that demand is improving, not only domestically but globally, I think that could provide a little shock for freight transportation logistics. A lot of the companies that I cover are dealing with, not only tepid or negative demand growth, but they're also dealing with rate pressures, especially in the truckload market. The less than truckload market pricing has been a little better, but we are seeing demand come in. So we really want to see where we are in the freight cycle. We're relatively optimistic about where we're heading from here. We think that companies, when they start providing earnings guidance.
So according to a Cluster 17 poll out of France, the latest, Le Pen party now has 34.5%, Macron group has 19.5%. Keep in mind, French election on Sunday this weekend.
Whether it's truckload, LTL, intermodal, or railroad, or even parcel providers.
All right, Lee, a lot to look forward to, of course, when FedEx does come out with those reports after the bell today. Our thanks, of course, to Lee Klasko of Bloomberg Intelligence. Now, coming up, we're going to hear from TCW Group's CEO Katie Koch, as well as SEC Chair Gary Gensler. Both will speak at the Bloomberg Invest Conference here in New York. But that does it for Bloomberg Markets. I'm Katie Greifeld, and this is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
This is Bloomberg.
bigger challenge.
Britain's next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
US to sell $80 billion in 4-week bills on June 27th to settle on July 2nd.
This is Bloomberg Technology. Coming up, Nvidia snaps.
Noting that the US Treasury has boosted the size of the 4-week bill auction.
Off its market cap. Full analysis ahead. Plus, Oracle warning of a financial impact to its business should TikTok be banned in the US. Details to come. And we go live to our Bloomberg Invest Summit, uniting leaders in asset management, banking, wealth, and private markets. Some key conversations to come. Let's get to financial markets, but the only thing that everyone is talking about is Nvidia. We have rebounded up around 3% in the Tuesday session, but it follows 3 straight days of declines, which total more than 10%, so therefore a technical correction, and also $430 billion of market cap shed. There's a lot of conversation narrative around valuation, but also the predictability of sales, how much money Nvidia is going to make. It's been really difficult, whether you're a sell-side analyst or even management, to correctly say how much revenue is going to come in, particularly with new generations of AI accelerator coming online. So from a market cap perspective, this is what we're supposed to look at. Nvidia down, that's the same chart. Market cap, the point is, it's below Apple, it's below Microsoft. So in that time period, Nvidia's gone from being the most valuable company in the world down a few pegs. Jump with me into my Bloomberg terminal and look at this chart. Because of all the anxiety around the sell-off, there is also some, I guess, sanguine thinking from a technical perspective. It's a stock that continues to trade pretty handsomely above its 50 and 100-day moving average. We're trading at $122 a share, and people see $115 a share, for those of you who follow the technicals, as a key level of resistance. Back from a short break, and I'm delighted to be reunited on set with Bloomberg's Ian King. I want to go back to that idea of how difficult it is to forecast sales, because over the weekend that's what we were all talking about. In part, it's because since this all kicked off in 2023, every time they book revenue, it always comes in pretty handsomely above the midpoint of the guidance that Jensen gives. And it's difficult for the sell sides to say, well, what happens next?
Yeah, no, you're absolutely right. They are effectively overshooting expectations at every point. And there are a number of factors that play into that, including supply, including this kind of lumpiness of demand because they only have really a small number of large customers. So all of those things make it very difficult. But at a certain point, you know, things will even out. Supply will catch up with demand. These big customers will decide they've got enough infrastructure for the time being. And then the story changes, then other factors come in. And it's when do we reach that transition point?
As you heard, Ian, over in New York City, Bloomberg Invest Summit's underway. Some big names have been in attendance. And what is it do you think they've been talking about? It's Nvidia. Listen to this real quick.
I mean, if you look at the chart on Nvidia, you can barely see the correction. So, I mean, you know, on a percentage basis, it's down something like 10%, but you have to like peer really, really carefully at the chart to see that move. So I don't think it means anything. The people who own that stock know it's expensive, but they're buying into a story. And as long as the story is intact, like Nvidia is obviously intact, the story is going to continue.
Steve Eisman of The Big Short fame, on Bloomberg Surveillance earlier today, he talked about the story. The thing that I think investors are finding difficult is the story of new products coming online. So H200 is the kind of middle ground generation AI accelerator that's ramping right now. But Jensen told us May 22nd at earnings that Blackwell, which is the next generation accelerator, will also ship this year. And so working out where they're going and how much money they'll make from them is really tough.
It is, I mean, but that's really something that the guys who run the Excel spreadsheets should be doing a good job with. What I think is more difficult and what causes more concern is all of this infrastructure that's being put into place. Is it paying off? Is it making money? Or is it just being basically thrown at the wall to see what'll stick? And I think that's where, if there is a fundamental concern, we want to see AI translate into real revenue and real profit at some of these guys who are paying all of this money for all of this NVIDIA gear.
Bloomberg's Ian King, who leads our semiconductor coverage at Bloomberg, but for quite a long time also led our stocks team. We will continue talking about NVIDIA. Bloomberg Invest is now underway in the heart of New York's financial district, where leaders in asset management, banking, wealth and private markets are connecting with world-class journalists led by Bloomberg's global finance correspondent, Sonali Basak, to track the future's greatest risks and opportunities. Now, moments ago, Philippe Lafont of Coatue was asked by David Rubenstein who would be the winner in AI, existing big tech companies or smaller startups. Listen to this.
At the beginning of these new waves, the new winners, 10 or 20 years out, some of them are existing companies and some of them are new. But the new ones that get big, there's maybe one a year, no more.
Delighted to say, as if by magic, Bloomberg's Sonali Basak joins us now with more. This is a really big event, and it's not surprising that whether you are in the private equity or private growth equity area of the market, or you're a hedge fund, or whatever it is you are, everyone seems to be talking about artificial intelligence.
It certainly does pervade a lot of the conversations we're having here today. And of course, Philippe Lafont is one of the perfect people to talk about artificial intelligence too. Earlier, as he was talking to David Rubenstein did ask him if he thinks there's a lot of hype around AI. And he really leaned into the opportunities that are happening in AI and really downplayed other types of opportunities, say quantum computing, for example. So what is he seeing in the AI opportunity? Some things got really wonky here. This idea of artificial brains being implanted in a robot that lives alongside humans, though that is probably about 15 years away, according to Coatue's Lafont. He's also seeing a lot of opportunity here in power. That is something that a lot of Wall Street is also watching, the banks, the hedge funds as well. And so certainly a more near-term opportunity. A little earlier also on the AI front, I would just say we also talked to Todd Bowley of Eldridge Industries, and he talked about how it's changing media and entertainment. The reason I bring this all up is because you hear different types of investors, Ed, really talking about the AI opportunity, particularly in private markets as opposed to public markets, and the growth opportunity you're seeing there, as well as the governance structures that exist around companies like that that would allow for that kind of experimentation.
As regular viewers of this show know, I'm a long-standing Chelsea season ticket holder, a member of Chelsea Football Club, so I go watch the Todd Bowley interview in full online. What's to come? You've put so much work into this, Sonali, along with our colleagues from the live events team. There are some big names to come in the next few hours.
There certainly are. Shortly, we'll be talking to Boaz Weinstein of Saba Capital, and I've got to say one reason that's interesting, Ed, is because we are just in the center of his dispute with BlackRock. We know that there are a couple of funds that he's targeting as activists in closed-end funds run by BlackRock. They have proxy voting that's going on in the last couple of weeks and in the next couple of weeks, so we don't really know yet if Saba is winning. We'll find out a little more what he thinks on stage. In the afternoon, we're going to have a couple private credit conversations as well. John Zito, I'm looking forward to Gary Gensler, the chairman of the SEC, of course, with Anne-Marie Hordern. We know the presidential debate is just days away, and hearing what Gensler has to say about what a change in administration could mean if there is a change in administration for the policies that he set forth today. Of course, a lot of people in tech and in general markets looking at the potential for an Ethereum ETF. There's some real potential for news later this afternoon.
Bloomberg's Sonali Basak, just an incredible lineup. Stay tuned. The Bloomberg Invest Summit is taking place all of today and tomorrow right there in New York City. Don't forget to tune in, check it out. We'll be right back. This is Bloomberg Technology.
So the 2-year and 10-year Treasury yield curve inversion steepens to more than negative 50 basis points for the first time this year.
every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
China's President Xi Jinping is urging the nation to step up innovation because other countries dominate certain key technologies. While he said China had, quote, made great progress in science, he added that original innovation ability is still relatively weak. Some key core technologies are controlled by others, and there is a shortage of top scientific and technological talents. Sticking with China, after initial reporting in May from Bloomberg that Huawei was secretly sponsoring a research competition run by Optica, a review
US Defense Secretary Austin says Hezbollah's provocations threaten to drag the Israel and Lebanese people into war. Again, it's according to Defense Secretary Austin, who says that diplomacy, again, by far the best option to prevent more escalation.
Bloomberg's Mike Shepard, who leads our coverage at the intersection of politics and technology. You know, the original Bloomberg report in May was astonishing, frankly. And the further details in this sort of a political environment and the headlines of the last 12 months are almost unbelievable. What have we learned?
Well, at first, let me commend you on the segue into this segment because it really highlights the importance of this story. It shows that China is really on the quest. It's on the hunt for the technological advances it needs to bolster its economy and gain that technological edge in key areas. And this shows one way it's been doing it. Huawei, which is it's an industrial champion in China, was not only sponsoring secretly this competition, but it was forging a much deeper relationship with Optica, and it was a two-way street. Optica is a century-old organization that whose members, 24,000 members worldwide, they do research in sensitive areas in light that apply to things like semiconductors that are essential to everything in the modern economy. So the consequences of this are significant. And Kate O'Keefe, whose initial report really broke the ground on this, and her latest reporting advanced the story further, she found that there was a whistleblower who flagged the risks that some of the work being done by U.S. scientists could be exported to China as a result of this.
I don't want to simplify it too much, but the basic idea is that the money came from Huawei.
So just in the energy space, noting ExxonMobil saying that there's a strike preventing delivery of materials needed by their refinery, and says they may have to halt the Gravenchon refinery if strikes continue.
They acted properly and in good faith. We're showing the response of Liz Rogan, who's the Optica CEO, on the screen, Mike.
And China's finance minister says we will implement proactive fiscal policy and enhance the effectiveness of macroeconomic regulation and control, as cited by Chinese state media.
Lawmakers have taken notice, and the top Republican and Democrat on the House Science Committee are looking into this. They express grave concern that U.S. scientific research could be exposed or even exported unwittingly to China as a result of a relationship like this. Now, the organization is saying that it acted in good faith, and to be fair, it did not violate any rules per se. in allowing this competition to be funded anonymously. And yet the appearance was complicated, for one, for the organization, but it was also a risk for the scientists who accepted the money without knowing that it came from Huawei. You see, many researchers in the U.S. have to disclose to other government and university funding agencies where their other sources of money are coming from. And if they don't tell those other funders, if they don't disclose that, hey, I am getting some money from Huawei, by the way, that could create a problem for them down the road as well.
Bloomberg's Mike Shepard, really appreciate your insight and reporting here on Bloomberg Technology. Thank you. We continue to talk about China. China-based ByteDance is facing a ban in the US in the form of TikTok. And Oracle is now warning that that would adversely affect its revenues and profits. This is a story that caught my eye pretty late yesterday. I want to bring in Bloomberg intelligence analyst Anurag Rana, and you've basically constantly crunched the numbers on what the impact would be. But it's not straightforward. You know, for our audience's benefit, Oracle was at the heart of TikTok's compromise by onshoring US user data in Oracle servers, basically. Now, if that's banned, what's the point of the Oracle relationship?
Yeah, it's hosting the actual application. So their infrastructure has been used to host that. So which is why if it goes away, they're not going to be getting that much revenue out. Now, they've never disclosed what the exact revenue amount is. But, you know, I think one thing that's happening good on the Oracle side is there's a massive demand for their infrastructure as a service.
NVIDIA shares extending gains of 5% now.
Microsoft, they're helping out. Also Google, they just did a deal with them. So that business is growing over 40%. It's running at a run rate of about $2 billion a quarter right now. So annualized run rate of about $8 billion. So, I mean, you know, it will be a setback, I would say, for a quarter or two, but they can make up that sales with other demand that's out there.
Stock's down a percentage point in the session in the moment, up more than 30% year to date. But what you said is interesting, right? We don't have a number. We don't know what the value of the relationship is. But you've covered this industry long enough, right? You know that if a company issues a statement saying this is substantive, material is the word, then it's worth looking into.
No, fair amount. I completely agree with you. But what I'm trying to say is that the demand for these kinds of work is so strong right now. So maybe it's a setback for Oracle for 6 months or 9 months, but they will make up that revenue from other sources. It's not as if it's lost forever, that particular revenue stream. You know, in the defense of Oracle right now, they are really becoming the 4th largest cloud provider out there. You know, right behind Amazon, Microsoft, and Google Cloud platform, because this kind of work is really the biggest thing in demand right now. Application software is struggling, but infrastructure software is doing well because of cloud resources.
And that was the focus of the research out this morning from you and Bloomberg Intelligence, narrowing the gap when it comes to cloud. Anurag Rana, Bloomberg Intelligence, thank you so much. Okay, staying with China, its spacecraft carrying samples collected on the far side of the moon returned to Earth today, marking an important milestone in China's path for further lunar exploration. The Chang'e 6 spacecraft landed in a grasslands region of Inner Mongolia and was the second mission by China to the more distant part of the moon, following the 2019 landing by Chang'e 4. No other country has sent a spacecraft to the far side, although NASA has plans to support missions there by a US spacecraft. Okay, coming up, Function Health co-founder Mark Hyman joins us to discuss the company's recent $53 million Series A funding round. We'll be right back. This is Bloomberg Technology.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New season starts July 10th on Bloomberg Television. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Okay, it's time for Talking Tech. And first up, in yesterday's show, we discussed a Wall Street Journal report that Meta and Apple had held talks on an AI partnership. After the show, Bloomberg's Mark Gurman reported or clarified the real situation. Apple dismissed Meta's AI chatbot months ago. According to sources, the iPhone maker held brief discussions about using Meta's Llama chatbot, but ultimately decided not to move forward, citing privacy practices that weren't stringent enough. Plus, OpenAI issues a warning to China. According to local media reports, OpenAI says it will begin blocking access to tools and software in the region beginning in July. It's unclear what prompted the move, and while OpenAI is unofficially available in the country, many can access its features through VPNs. And US defense startup Anduril has secured $1.5 billion of new capital, boosting its valuation to about $14 billion. That's according to a report by The Information. The startup, backed by Peter Thiel, makes drones and autonomous weapons systems, and recently won a major contract to develop unmanned fighter jets for the US Air Force. Another story we're tracking, the health platform Function reached $53 million in its Series A funding round. The platform focuses on preventative approaches to help individuals manage their well-being. Delighted to say that Function's co-founder, Mark Hyman, joins us now. You know, it's a significant sum of money. Congratulations, Mark, on the Series A. But actually, what caught my eye in the first instance is how many users you've onboarded, and how big the wait list is relative to those onboarded. Just explain that to me.
Yeah, well, thank you for having me. This is an incredible moment in medical history because we're seeing consumer-driven healthcare exploding, and we hit a nerve, a pain point, where people want access to their own data, their own biology. They want to look under the hood, not just rely on the healthcare system to provide access to their own health information. And so we've gotten 50,000 people as members in the first year in our beta, and 200,000 people on the wait list. And there's just a hunger for people to know about their health, to be empowered with the tools and have their own agency over their health using their data from their own body and having ownership of it, which right now is sort of held within the healthcare system in a very tight way that's hard to access for people, hard to understand, and we make it easy, accessible. And it's the first personalized health platform that allows you access to your own health data through initial 110 biomarkers for $499. It's about $15,000 worth of lab tests, and it provides deep insights from the world's scientific literature, from top knowledge experts, and provides guidance on what the likely things that are going on with you and what to do about them in order to empower you to change your behaviors and your lifestyle, which is really where more of the issue is.
Mark, just explain the basics of the technology. You know, every time we hear about a data-driven platform like this, we immediately start talking about artificial intelligence. But I think in this case, Function has, pardon the expression, a more simple function. Just explain the basics.
Absolutely. You know, it's hard to believe, but medicine is still in the dark ages. It's very analog. We don't have pen and paper. We have electronic medical records, but it's essentially pen and paper put in a PDF or an electronic medical record with no relational content, with no understanding of the interactions between the data points, with no correlation. And so it's really a unique moment in history where we can gather your own data from the blood, from eventually biosensors and wearables, from your electronic records, from omics, and into your own health platform that allows you to understand what's going on with your body. So it's a very simple process to sign up. It's 5 minutes. You go to functionhealth.com. You can sign up, and you get a scheduled appointment for your lab test at one of the 2,000 Quest laboratories. Your blood's drawn. It takes about 15 minutes. It's frictionless. You don't have to go through insurance or doctor. It gets away from the paternalistic healthcare system and allows people to be agents of their own health and the CEO of their own health, which I think is what we all need to be, given the epidemic of chronic disease that's now facing.
Mark, I just want to jump in on that insurance point. As you can tell, I come from the United Kingdom, where the healthcare system is very different. 6 years in, I'm used to the insurance-based system here. How does your business model work within the confines of that system?
Well, it's very interesting because people are going outside the system to actually learn more about their health, to get data about their health, whether it's home testing, whether it's wearables. Now this is accessible through your blood test, and you don't have to go through insurance. It's $499 a year. It's $1.37 a day, which is less than your Dunkin' Donuts cup of coffee. And it allows you to have deep insights about your health across the spectrum of your health, from nutrition to hormone to metabolic health to toxins to cardiovascular risk to all your biomarkers that relate to your overall well-being. And it's something that was never accessible to people before. And so when you go through your doctor insurance, there's a big resistance, a firewall, where they say, no, you don't need these tests, or you don't need that test, or they just want these small number of tests. But it's better to look at things early on in the trajectory of disease. And we've seen, just by this simple approach, we've saved lives. One man was in his 40s, 44 years old, did the panel, found out he had prostate cancer, was able to treat it early, get cured, and was able to then live on a healthy life with his young kids, as opposed to being at risk for death. So I think we are seeing incredible uptake. We're seeing incredible results from the users and incredible stories of lives changed. And really, this is all about ending suffering.
Mark Hyman, co-founder of Function Health, thank you for joining us on the program. Now, coming up, we're going to be joined by the CEO of Etch, Gavin Iberti, on how the startup plans to take on NVIDIA. That's coming up next. A quick look at shares of Microsoft. The European Commission has issued it a statement of objections, alleging that Microsoft's Teams and Office 365 fell foul of the EU's competition rules. The stock up 0.4%, a story we'll dig into. This is Bloomberg Technology.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Reporting from our world headquarters in New York, I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Welcome back to Bloomberg Technology. Ed Ludlow in San Francisco. Let's take a quick look at the markets. Broadly speaking, US equities are higher. The NASDAQ 100 up a full percentage point. A big part of that story, of course, is NVIDIA, now up 5% in this session, is the rebound from that technical correction. 3 straight days of declines exceeding 10% until now. And there's no real news flow around NVIDIA. This is about some serious gains. It was about a 43% jump from May 22nd when NVIDIA reported earnings. And the conversation around how hard it is to predict sales growth, because you're jumping from H100 to H200. Blackwell will start shipping at the end of the year, and the street is basically saying, we can't keep up with management's forecasts. What's going on? I also take a quick look at Bitcoin. Trades 24/7. We focused on it big time in yesterday's show, but we're back nearer to $62,000 per token, noting that there have been pretty substantive outflows from dedicated Bitcoin spot ETFs. I want to linger on the AI accelerator market for a moment. Etched is a young AI chip company making a big bet on AI. They spent the past 2 years building Sohu, the world's first specialized AI chip for transformers, or so they claim, and that bet is paying off. The company just nabbed a $120 million Series A round led by primary venture partners and Positive Sum Ventures. Let's bring in Gavin Uberti, one of the company's 2 co-founders and its CEO. Okay, let's go back to basics on this. There were a lot of big claims in that introduction. Your main point is that the specifically designed chip for the development of transformers or models is better than the GPU. But what is it that you're building? What is Sohu?
Well, Sohu is a kind of AI chip that is only able to do one very specific thing. An accelerator from NVIDIA or Google is flexible. It can be programmed to run many different kinds of AI models, like convolutional networks, LSTMs, or transformers.
Right.
Our chips are different. They are only able to run this one very narrow class of model, which we call transformers. But when running these kinds of models, they are vastly more performant, more than 20 times higher throughput than 8 H100s.
So what is it from an intellectual property standpoint or a technology standpoint unique to Etch that allows for that? What is the secret sauce behind Sohu that makes it any different from a performance perspective or a design perspective relative to H100, H200?
Well, we're able to burn the transformer algorithm into the chip. We're building our own silicon and our own servers. And this enables us to get more than 20 times higher throughput in terms of output words per second from models like ChatGPT or Llama. But you're also able to get much better latency numbers. If you measure the time to the first token, we can cut that by a factor of 20 as well.
You told my colleague, Pyle Zveri, that you think Etch can be the world's biggest company. That's quite a claim to make. Outline the pathway to that for me.
Well, we are taking a bet. Unlike every other company in the market, our chips can only run transformers. So if transformers change dramatically or go away, then we'll be in a bad place. But if we're right, and transformers keep being the dominant way that AI models work, we'll be the most performant chip on the market by an order of magnitude.
So let's talk about who your target customer is, because transformers, or let's use another term, large language model in the natural language context, for example.
This is a misconception, actually.
We'll fix the misconception for me.
Transformers used to be for just large language models. Other kinds of models, like image generators and video generators, used to be what's called UNets. But that's changed. Over the past year, it's turned out that transformers work better than other kinds of AI models for generating images and videos too. I don't know if you saw Sora from OpenAI, but that's a transformer as well. powered by the same underlying kind of model as ChatGPT.
But the point I'd like to get to with regards to who your customers or potential customers would be is that some transformers have parameters in the hundreds of billions. Sora may be a good example of that. What's happening now in AI development is more modest ambitions. Lots of companies working on models with a much lower scale in terms of parameters. Where do you want to go?
We are selling to the big transformer models. We have tens of millions of pre-orders from the customers you'd expect. But I expect that we are going to get much, much bigger AI models. The way we've gone from GPT-2 in 2019 to GPT-4 today is not by inventing new algorithms. The transformer algorithm is almost the same. Instead, we have made the models far bigger. It's no longer 1.5 billion parameters like GPT-2. It's 1.8 trillion.
In the tens or hundreds of billions or trillions of
1.8 trillion for GPT-4.
Let me ask you this, though. $120 million Series A, it seems like an eye-watering sum of money, but we've learned that this is a capital-intensive enterprise from an R&D perspective, a talent perspective. One thing that was of interest to me and wanting you to come on the show is that your contract manufacturing partner is TSMC. And not only TSMC, but their emerging business group, where they basically say, okay, you're just starting out, but we can help you to scale this product. What's that experience been like?
TSMC is a pleasure to work with. Working on their 4-nanometer node, one of their state-of-the-art processes, same one that NVIDIA is making their Blackwell GPUs on. And we're building a reticle-sized die, so a very big chip. That is a complicated kind of chip to build.
Well, in Blackwell's case, they had to literally split it in two.
That's a great point. Now, for Blackwell, normally what happens in chips is as you move from generation to generation, you move to a more advanced kind of chip technology. So from the A100 to the H100, they moved from 7 nanometer to 5 nanometer. But that's changed. They couldn't move to the new technology for the Blackwell chips. And as a result, they had to put two of them together. And if you look at the progress of GPUs over the past 4 or 5 years, they haven't gotten better, they've just gotten bigger. Performance per area has stayed constant.
Gavin, you are an incredibly confident founder, co-founder, CEO. It's a pleasure to have you on the program. And you're clearly ambitious. The difference between NVIDIA and Etch is NVIDIA is producing at volume. You have $120 million in the bank now. What do you need to use that cash for? And how capital intensive is the process of scaling this product, even if you have a partner like TSMC?
This is a capital intensive business. A majority of our Series A is going to go into building these products and scaling up the business. That is where the money goes. And I think the big difference too is, again, we are very specialized. That we are inherently taking a bet on the transformer architecture. A lot of folks in the industry will say that just like transformers were invented, there could be something else on the horizon that'll put us out of business. And we are gambling that's not the case.
Just very quickly, we just have 10 seconds. Have you shown Jensen your product?
I imagine Jensen's heard of us by now.
Gavin Iberti, co-founder and CEO of Etch. A lot of fighting talk, a lot of confidence. Thank you for joining us on the program. All right, coming up, we're going to tune back into Bloomberg Invest with its next panel interview. Boaz Weinstein, founder and chief investment officer at Sauber Capital Management. Stay with us. This is Bloomberg Technology.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking?
Yeah.
I mean, like, what's that about?
We're not forcing everybody to be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier, right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have for the next 5 years, 10 years. What's the best way to contribute to the world?
The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
Okay, back to the story we were discussing earlier. OpenAI has warned developers in China it will begin blocking their access to its tools and software from July. That's according to local media reports, suggesting the ChatGPT creators taking a more active stance to bar users from nations where it doesn't offer services. Bloomberg's Jackie Davalos, leading the AI beat, joins me out of DC. This is really interesting because it's kind of an old school tech thing that a lot of the access to OpenAI in China was through VPN, which is what people do to stream things in different places. But give me more details on this story.
Well, what we know, Ed, is that Chinese developers will have this access cut off starting in July, as you mentioned. This really originated through local media reporting, which cited screenshots that had this OpenAI memo to developers saying they were going to have this access removed. OpenAI has now confirmed the decision to Bloomberg News earlier this morning that it is, in fact, taking, quote, additional steps to block API traffic from regions where we do not support access to OpenAI's services. Now, this is not the first time that China has come against the crosshairs of American tech companies and even regulators here and U.S. officials who believe that China is using this technology for more nefarious purposes. Now, OpenAI really started ratcheting up its own actions against who it believes is bad actors and using its technology perhaps to manipulate public opinion, for example. Remember that report in May, Ed, that said Russia, China, Iran, and Israel were using OpenAI to manipulate public opinion. So you really see these actions really starting to take shape here.
There's two sides to the story, right? There's the use of the technology by malicious actors or unauthorized actors, and also, I think, a data access point. But there's also a competition side of the story, right? You have domestic champions in China like Baidu that are building large language models, big large language models, to support generative AI technology. Give me that side of the story.
Well, they were quick to pounce on the fact that now there's this wide swath of developers who need AI technology to turn to. And so what some of these local reports were saying is that they started appealing to developers and saying, hey, come switch to our tech. Really goes to show that there is this, not just this technology battle, but there's a need to really start ramping up its own internal AI capabilities. This is exactly what lawmakers here in Washington Washington, Ed, are concerned about, that AI is really ramping up their efforts, not just to have AI play a role in its economic capabilities, but military. And so, of course, this isn't just about what consumers have access to, but how it can be used against kind of national security. And this is exactly where we're seeing here in Washington actions on behalf of, for example, the Treasury Department imposing rules to curb investment that would support AI investment in some of these areas, and also, of course, curbs on chip exports. We're really starting to see both of these things really come together.
I think that what they're doing from a technical standpoint, I'm just reiterating what an OpenAI spokesperson told us, is that they are taking additional steps to block API traffic. I still find it astonishing that the origin of this story is people being able to access OpenAI from China through VPN. Just give me a little bit more on what you just said about the DC side of this. Joe Biden, President Biden, has some policy towards restricting Chinese products entering the United States, or tariffs, and the Treasury Department you mentioned as well. Are we expecting a sort of expansion of that activity?
That's a key question. I think if there's one area where lawmakers here in Washington have really come together, it's around the national security argument that China has capabilities in artificial intelligence and it will continue to bolster them. Now, you saw this with TikTok, really the concern that Chinese influence was coming through somehow in TikTok and influencing public opinion here through that tech. But then you look at artificial intelligence and what can be done with drones, for example, really things on the battlefield. This is where a lot of that concern is coming from. And so, of course, you're seeing chip manufacturing as kind of the hallmark example for the Biden administration, really starting to take the lead here. It's all part of this broader strategy to really undercut Beijing's efforts to have AI kind of bolster its military capabilities.
Bloomberg's Jackie Davalos. This is a pretty fast developing story. Grateful for you keeping us honest on it out of Washington, D.C. Thank you. We're going to take a quick break and then we'll be right back. Stay with us. This is Bloomberg Technology.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something. There's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female...
Necessary, unnecessary. See you down the line.
Were you worried the wedding would be too much?
Nah.
About capital management.
Proxy battle right now, with certain funds actually have already been voted on over the last couple of weeks. What we don't know, and what is a very important thing, you've been very vocal on Twitter usually on how these battles are going. You've been pretty quiet. How have the meetings gone? Have you won anything?
So it's always nice to aspire to break news on a conference like this, and it so happens that the fund that has gotten the most of my attention, which is called Big Z, B-I-G-Z, just had the voting close at 11 o'clock. So I can say preliminarily, I didn't count the votes, but they've announced it, that actually all the Saba nominees, there were 7, got more votes than all of the BlackRock nominees, and 4 of our nominees got more than 2 times as many votes as BlackRock, so more than 2 to 1. And when you win an election by 2 to 1, the voters have spoken. We all know landslide is like 60-40, 58-42. If more than 2/3 voted one way, BlackRock can no longer say that they purport to speak for the shareholder and try to create some divisions. The shareholder has spoken, we won, and the reason that there's been litigation, it's been outward, it's us to them, is because they have put in place election rules that would make Vladimir Putin blush.
So let's step back, big step back. This is one fund you said you were voting for today, but there are 10 funds. Ultimately, what is it that you want out of this strategy? These are closed-end funds, so you're locking up, or BlackRock has locked up capital for a longer period of time, forever, right, in many of these funds. So what is it that you're trying to accomplish by targeting them? I understand that you target them when they're trading below their net asset value. You want them to bring investors whole. But what's the end game here? You won at one fund. What else do you want?
Yeah, so ETFs, as we all know, can be sold at
So keep in mind, in 10 minutes' time now, at the top of the hour, Fed Governor Cook is due to be speaking about the economic outlook at an event hosted by the Economic Club of New York. A text and Q&A both expected.
Around for 100 years, 200 years, and so there are periods where the investors don't want them, and for some reason, there isn't a manager more than BlackRock that the investors don't want. It's nothing personal. I'm not looking to not be besties with Larry Fink. I'm not looking to be besties with Larry Fink. You know, I basically am just looking to make my investors money, and if the discounts are persistent and they're there year after year and you can buy it a literal dollar for 85 cents, you have the power, unlike in normal activism, to turn that back into a dollar, because if you change the fund structure to being an open-ended fund, like an ETF or a mutual fund, or the manager agrees to buy back shares at net asset value, just like Franklin Templeton did this month in 3 energy funds, the investor has a chance to go from 85 to 100. And as you all know, that's not even just 15%, because it's 15 over 85. That's an 18% return. Big Z today is at greater than a 15% discount. And it's a fund that lit its investors' money on fire. Now, I say that, it sounds dramatic. The last 3 years, we've been in more or less a bull market, not for everything, but Big Z has lost more than 50% of its capital from the stock prices going down and from the discounts going up. And so it's lost billions of dollars. And here we have investors resoundingly saying, we want change at the board level. But the part that many of you would be shocked to hear, why I mentioned that quip about Putin, is that they've decided to set election rules such that in order to replace their board, you have to actually get 50% of all the shares. Now in Big Z, preliminarily, they got about 51 to vote. So we would have needed 50 out of 51. Okay, winning 35 to 15 wasn't good enough. And so that kind of math makes it literally impossible, but ironically, it makes it impossible for them to put anyone else on the board, because they would have to go through their own arcane rules. And so as a result, the BlackRock nominees each sit on approximately 70 boards, 70 different boards. How can they do their job at 70 boards? At JP Morgan, each nominee sits on one board. It's horrific governance from a firm that's an incredible firm that actually prides itself in raising money to invest in good governance.
Now, I think importantly, as we've mentioned, this is one fund that you know the outcome for. Yes, it's a big fund for you to be investing in with a large discount, but what about the rest of them? If you were to be on course to lose, how would you react?
Right.
Do you know anything about those votes?
Right. So I can't announce what's going to happen for the other big funds. Big Z is something like $1.7 billion. It's really large. And that's also why this has captivated the media's attention and also individual investors. There's a lot of money at stake. Going to NAV just a few weeks ago was worth $1.4 billion to mostly mom and pop investors and to our investors, who include mom and pop. We manage money in these very strategies for 3 different state pensions, millions of pensioners. So the results are in limbo, even if we win, because it depends what the judge says. We've taken them to court this year for this election scheme, and last year we did it for a different election scheme, and we won in summary judgment against BlackRock, against Nuveen, and I have a lot of respect for our panelists from the last session from Nuveen, but BlackRock, to be fair, is not the only one, but they are by far the worst, and it's those legal victories that have helped us in order to get good results with other managers who don't want to be on the wrong side of the law. And so that's why this year, I was very proud that we won Institutional Investor Activist of the Year, back-to-back years. And no closed-end fund activist has ever won it before, and we were voted the best activist according to Institutional Investor.
You're no longer just a closed-end fund activist. You're also a closed-end fund manager, given that you've taken over some funds. And those funds are actually not trading at asset value. So how then do you turn around and attack BlackRock when your own funds are trading at a discount?
So firstly, there's two measures. Let's say there's how they performed, how much money did investors make or lose. You mentioned there's a lot of BlackRock funds where we went after. There are 10. 9 of them, the last 3 years, have lost investors' money. 9 out of 10. Think about the market we're in, where the S&P is, even where the Russell is. 9 out of 10 are in the red. Our fund that we've been managing for 2.5 years, that fund has actually made quite a bit of money. And in 2022, the first year we managed it, it was ranked #1 out of 257 funds where the motive was income-based funds, and we came in first. So BlackRock can say, well, their fund trades at a discount too, but what they leave aside, this is the rub, Sonali.
It's been 5 minutes time now at the top of the hour. We expect comments from Fed Governor Cook, who speaks about the economic outlook at the Economic Club of New York. The text and a Q&A are both expected in just under 5 minutes time now.
Capturing that discount, and we did a second tender. So we let investors out of 45%. 45% of the capital exited, and we let them out of NAV. BlackRock is not willing to do anything like that.
One critique I've heard you make is the idea of lowering fees here to attract more investment. But for these funds, they tend to run at higher fees than the ETF structure. Would you consider lowering fees for your own funds?
Right, so our fund that we took over in January, the ticker is SABA, is one of the lowest fee funds in the marketplace. It only charges 75 basis points. The other fund is more normal. It charges right around 1%, but it's also you get what you pay for. You know, I think most investors appreciate that if the fund is going to do interesting things, you mentioned credit derivative wizardry or whatever you said in the beginning, and we are doing really neat things in those funds. We're not just putting together a long portfolio and letting it sit. And so I think our fees are actually very modest. It's not for me to say, it's for the investors to say when you look at what you're getting.
Now, I want to read you BlackRock's statement because, of course, they have fought back. They have not let you just attack their funds. They said that BlackRock and the fund's boards remained focused on delivering value for all shareholders through concrete actions such as increased distributions and discount management programs. Saba is an activist hedge fund looking to arbitrage funds to capture quick profits. This attack is not about government's performance or discounts. It is about executing Saba's well-known playbook, buying controlling positions, and forcing short-term changes that harm retail investors to benefit Saba and its hedge fund investors. What is your response to that? And what do you do after these campaigns?
Yeah. You know, when I sit here and think, throw your best at me, Sonali. Like, they send you a question, just please, like, give me your toughest question. I'm not here to be, we don't have some friendly arrangement. Ask me anything you want. I fear none of their questions because they're so absurd, okay? When they say that we're using some purported playbook to help investors in the short term, where is the long-term pain of making investors money? Usually when you say you have a short-term motive, there's a long-term consequence. Having the funds have investors have a chance to get out at full value, where is the negative in that? And I'm not going to use my words, okay? ISS, which is independent, okay, which stands to tell the small investor how they should view this kind of rough contest that we're having. Here's what ISS said about this year, okay? The board is deeply entrenched. A direct intervention remains necessary. It is rare to witness a board so brazenly flout the most basic of shareholder rights in furtherance of their own enrichment. I'll read one more. The board actions are so grave that they would warrant adverse vote for incumbents in an uncontested election. What ISS has said is that even if we didn't run against BlackRock, they would have recommended against their nominees. That is literally how bad it is. And I want to just say, BlackRock's an amazing firm. They manage $10.5 trillion by last account. This might be big to us. This might be very big to our investors. This is tiny, small potatoes. And it'll someday be a case study at HBS of a strategy failure, that for $5 billion of action, of buying back funds at a discount, including their own employees who would get to make that money, including their shareholders, that they would say, look, we actually care about you. We're going to treat you the way other managers are treating their shareholders. They wouldn't have this problem on their hands. They have amazing products, but for closed-end funds, they basically have taken the position, no one is going to tell us what to do, and we're willing to do whatever it takes to squash the rights of the shareholder, which is enshrined in the 40 Act. The 40 Act is there, the 1940 Act, the Investment Company Act, is there to protect small investors. They don't need the same protections in ETFs because you can vote with your feet. You can redeem a mutual fund. You can sell an ETF.
So just less than a minute, 10 minutes to go now to expect the
my words.
So excuse me, just less than 1 minute to go now to expect the text release from Fed to Cook. So again, at the top of the hour here, 45 seconds.
Yes, they did support you on the director push, but they did not support you, ISS that is, to terminate BlackRock as the investment advisor. Is your ultimate end game to take over these funds?
So we've been in, this is not my first rodeo, we've been in about, I don't know, 80 campaigns. And across 80 campaigns, only 2 times did the end result come that we took it over. In the first case, actually, the manager resigned. They said, we'll stay on as manager until you can find a new manager. So we don't come into it with that goal. We come into it with the goal of making
10
our investors
seconds.
money. And it turns out all shareholders get to make the same amount of money. They don't have to pay the legal fees that we're paying. And by the way, BlackRock has sent tons of mailers. You saw the Chiron, you saw the graphic, Saba is trying to destroy your fund. That mailer went out 4 or 5 times.
Fed Cook says at some point that it will be appropriate to cut rates. Current policy is well positioned to respond to the economic outlook. The rise in inflation expectations would imply keeping monetary policy restrictive for longer. Says I'm very attentive to inflation expectations. Timing of any policy adjustment will depend on economic data and its implications for the outlook and the balance of risks. Monetary policy is restrictive. Inflation has slowed and the labour market tightness has eased. I'm fully committed to the 2% inflation target. And policy would also need to respond to a sharper than expected weakening in the economy and the jobs market. Says risks to achieving inflation and employment goals have moved towards better balance. The job market is tight but not overheated. Says I see 12-month inflation moving sideways for the rest of this year, slowing more sharply next year. I expect a 3 to 6 month inflation rates to move lower on a bumpy path. So progress on inflation has slowed, but I expect the disinflation trend to continue. I lean toward optimism on innovation and productivity, allowing a faster pace of non-inflationary growth. Rising credit card and auto loan delinquencies are not yet concerning, but do bear watching. I expect economic growth to remain near the rate of potential growth, somewhat above 2%. Monthly job gains needed to keep unemployment rate steady likely has doubled to nearly 200,000. So again, the monthly job gains needed to keep the unemployment rate steady have likely doubled to 200,000, Fed Cook says. A financial system not currently positioned to unusually amplify any future shocks.
We're so lucky in this business. The amount of money that management firms make, they have $10.5 trillion. To do this because they want to trap capital, they're basically blinded by this being long-term capital that cannot be redeemed, and they want to hold on to it. And so to me, it's like a very noble fight, and we've received, you could just look on Twitter, hundreds and hundreds of positive comments and basically not one negative comment. So I do enjoy the retail coming along for the ride. Yes, in that sense, it's personal.
So also to be clear, this is an investment strategy. This is a strategy that is meant to return money to shareholders. It's not just on concept. How profitable is it? And how big of a strategy has it become? Has Saba really pivoted from becoming a tail fund to an activist fund?
Well, give me a tail event, and I'll be a tail fund manager again. But we've had what have we had, like 40 straight days of the S&P not going down even 0.75%. It is a big business for us. We own $6 billion of closed-end funds. A full third of them are just this single manager, BlackRock, and many of them we think have good governance. They just are at discounts. We don't have a governance issue. So it is quite a big business for us, and I can't really on this stage speak to the returns, but we have an ETF, for example. The ticker is CEFS. It's been around for more than 7 years, and people can plug in how that did versus the 3 other ETFs that own closed-end funds. It's done very well.
How well?
All right, well, if someone were to plug it into Bloomberg and they put CEFS and then they put the Invesco version or the First Trust version, I think for the last 3 years, and it's held, a lot of it's been in fixed income, which has had a tough time. Those other funds have made between 0 and 2%, and we've made 10%.
So let's broaden out here again, because people have looked at you for credit markets for a long time. When we talk about the closed-end fund strategy, there's a deeper question. It's not really just about closed-end funds. There's a whole push by the private asset industry to push into retail, to push into interval funds, to find new strategies to bring money in. Are all of those funds vulnerable to activists?
So by the laws of depending on the structure, some are, some are not. In the interval fund, generally you only have the right to redeem 5%, so you're getting 5% back per quarter, but you can't, they also invest generally in deeply illiquid assets, so you couldn't just sell Microsoft or IBM and raise the cash. So It is interesting for me, as having been in credit at the forefront of all the innovation that came after 1998 with credit derivatives and synthetic securitization and all of this sort of stuff. And back then, retail investors were deemed unsuitable to own these things. You couldn't own high yields, really, if you were not a qualified investor. And now, whether it's CLO tranches, alphabet soup. And so this has been an amazing boom for the largest asset managers, the amazing managers like an Ares or Apollo that can bring these products, their reputations, and good governance, I should say, because we also see a lot of very good governance. JP Morgan has great governance on their closed-end funds. And we see that there is huge investor demand. The private credit space was a cottage industry a decade ago at less than $250 billion. Now it's $1.5 trillion, and it's growing like gangbusters. So this kind of illiquid credit investing that you're referring to allows the manager to lock up for many years. It's great for their stock price. It may be great for their investors, but we are in a little bit of a zero-sum world. Like, if making loans that are secured, that are safe, that have a lot of asset coverage at 12% or 13% is great for Ares, it probably ain't great for the borrower, especially in this higher for longer world. So just to close on that, just to say, I think people, just even 3 months ago, were really expecting rates to come down and that 13 to go to 12, 11, 10 and really alleviate that pressure. But I think higher for longer, we're headed for some sort of collision course between, if we have that in conjunction with an economic slowdown, we are going to have a default cycle. We are going to see which firms were good at private credit and which were not. Because private credit has been touted as this amazing thing, almost like NFTs or ChatGPT. I mean, what is private credit? You're making loans to smaller companies. I mean, how is that sexy? No, but it's very sexy for Ares and Apollo, and I look at it like this amazing force that will have hiccups in the years to come.
Now, one more question for you before I let you go is, we have a major catalyst around the corner, that is the U.S. presidential election. As a massive investor in credit, and also as somebody who looks at volatility very closely, what are you thinking about headed into that election cycle and what comes out of it, how to position?
Yeah, so it's coming closer every day, and it warrants our attention. And we'll also, if there's a change in the presidency, you'll have a president that people consider as someone that will be will be more unfettered, let's say, and maybe have scores to settle and have views about how to undo things. And so change generally means volatility. So it's really reflexive to think, okay, if Trump is elected, there'll be a lot of volatility. Now, he also is very interested in the stock market going up, which you usually think about in conjunction with lower volatility. So but might the ways he does that, whether it's a new Fed governor, cause some short-term gain for actual long-term pain, where interest rates in the front end come down, but in the back end go up, and certain firms are affected that way. As when I think through that Trump means volatility, the other side of me thinks back to 2017. We had Trump and we had Kim Jong-un, and he was calling him Rocket Man. He was kind of taunting him. And I remember during Rocket Man, it wasn't an Elton John reference, right? At that moment, the VIX hit single digits. The VIX was the all-time, it was at 9. I was crying because I'm a long volatility manager and the VIX is literally at 9. And so, the Trump presidency is, if it happens, is going to be in many ways unpredictable. So you think there'll be volatility, but let's also remember there was also a lot of economic stability, though maybe because we were in a 0% interest rate world, and now having seen the excess of that and the inflation, maybe we're not going to go back to that world, and there'll be volatility whether Trump is elected or Biden is reelected.
Who's better for the bond market?
Biden.
Why?
Because I think he's less motivated by the stock market and more motivated by what's good for America. On the subject of bonds, I'm not getting that political, just bonds.
We will leave it there. Boaz, thank you so much for taking all our questions. That is Boaz Weinstein of Saba Capital.
I'm Bonnie Quinn, and you've been listening to Saba Capital's Boaz Weinstein at the Bloomberg Invest event. Let's discuss now with Bloomberg's Scilla Brush. So, Scilla, Boaz said a lot of things there. We've been following this sort of battle between Weinstein and BlackRock in some ways. I'm not sure if they'd see it as a David-Goliath battle. Did he say anything that tells us this might move the needle, that BlackRock might actually do something about these closed-end fund managers?
So I think we're right in the middle of a series of elections and meetings, effectively annual meetings of these funds, and some votes have taken place, and we're kind of in this in-between stage where they're preliminary votes. So what he's basically saying is, in one of the funds, one that he has a very large position, in excess of above 20%, that a lot of the votes are going his way. And I think what we need to do is at this point see sort of the final tallies and see who else has voted his way. And why this matters is basically who gets onto the board of the fund. And basically who gets on the board of the fund, if he gets his nominees, the broader issue will go his direction. So we need to basically wait for the certification to see where the preliminary votes shake out.
He mentioned he's getting a lot of retail support, right? Is he also getting support from the community? Because this is pitting sort of investor against investor, manager against manager in some ways.
It is, and I think, judging and seeing how retail votes is actually really pretty difficult in these closed-end funds. Retail often doesn't vote, and that's why sort of seeing how the votes actually shake out is important here. He has a very large position, and of course he's going to vote his way, and it's really important to see who he brings along on his side. Of course, BlackRock, disagrees with him vehemently, as you'd expect, and has, urged shareholders to vote Boas down. And this has become a pretty tense campaign throughout this proxy season.
It is a fascinating one, this ISS urging shareholders to reject Saba Capital's proposals to terminate BlackRock as the investment manager for 4 closed-end funds. But we'll continue to follow the story, and Scilla will as well. So thank you so much. That is Bloomberg's Scilla Brush. And of course, don't miss other big names, including Gary Gensler at 2 p.m. from that Bloomberg Invest event. You can watch it all on LiveGo on your Bloomberg. We also, just a few moments ago, got some headlines from Fed Governor Lisa Cook saying that there is a rate cut warranted and it will be appropriate to reduce interest rates, but at some point, that's a direct quote. She added that she expects inflation to improve gradually this year before more rapid progress in 2025. So let's discuss this more now. I'm joined by BondBlock's co-founder and COO, Joanna Gallegos. Thank you so much for joining. Anything new in these Governor Lisa Cook comments?
I don't think there's anything new. I think June and a few weeks ago, we heard some surprising news from the Fed in terms of the way they've reduced their outlooks for both rate cuts this year, going from 3 to 1, and also their approach for the neutral rate in the future. So I think what she's saying is largely aligned with that. It's been 8 consecutive meetings where they've kept rates steady. And even though June was notable, we did just come off of, before June, three or so months of data that told us that inflation was slightly rising. So we need more to see what's next for the summer before we can conclude anything major.
With the right strategy, if rates are coming down, we know they are, and we know, as Governor Cook says, it's going to be at some point, which maybe isn't that helpful. But is the right strategy just to hold on to what you've got right now?
It can be, definitely on the shorter end of treasuries. I think that you want to ride along with stable rates. I mean, at BondBlocks, we do feel that rates are going to be higher for longer. Even if there is a cut in 2024, we're not expecting deep cuts or multiple cuts in 2024. So, on riding along with stable rates and higher for longer means you can be, on the short side earning 5% in treasuries right now. But what we think is more interesting and compelling is to take a look and remind, and everyone has this story every day, growth has been resilient and company fundamentals have been resilient over 6 quarters, over 2 years since 2022. So really the backdrop of this for corporations means they're able to cover their interest rate ratios, they are able to support their bonds. So we like people thinking about higher spread products even into high yield and corporate debt.
We heard Saba Capital's Boaz Weinstein talking about volatility and how it was, crazy low during the Trump era. And just recently, we've had some volatility in the bond market. Not the last few days. It's been exceedingly quiet the last few days. But the MOVE index has been way outperforming, let's say, the VIX for a long time. Do you see that continuing, or do we know now? Have we more of a signpost of what the bond market is going to do?
Yeah, even despite the rally from the last few weeks, year to date, most sectors in fixed income are going to underperform. underperform a bit. So that would be on the long-dated treasuries, long-dated corporates, even in the Barclays Ag. So I think there's more to come here. I don't think that means that we're going to see a lot of rebound because we haven't really seen, and we're expecting more of a softer landing towards the end of the year in the economy. And if that happens, as we at Bond Blocks believe, the rates are going to be higher for longer, and you will see some moderate growth, but you won't be a runaway rally.
All right, Joanna, thank you so much for joining us. We have as well a 2-year auction at 1 p.m. We'll bring you those results. That is Bond Blocks co-founder Joanna Gallegos joining us. Back now to Bloomberg Invest. Todd Bowley is planning to create a new firm with at least $65 billion in assets in the next year that combines a number of his businesses at Eldridge Industries. He spoke with Bloomberg's Shanali Basak earlier today about opportunities in credit.
I don't think that the boom in private credit all of a sudden suggests that private credit is bad asset class, right? We're seeing a general debanking going on, and the credit sources are transitioning, into, frankly, less levered holders. Right, so if you look at the BDCs, right, the BDCs are a lot less levered than banks. So I think it's a lot safer for systems that are moving credit into lower levered institutions than traditionally where they were formed. But we think there's a big opportunity in credit. And what we want to do is just be all things credit, in partnership with our insurance company.
I want to talk more about credit for a moment, but really recently in the market, it was very widely reported that you were looking at buying a fairly sizable private credit firm out of Europe. That firm, we've reported, has gone off to seek potentially a management buyout instead. What does this say about your ambition to consolidate the asset management industry? Are you looking at more private credit firms? How large would you make of an acquisition?
Well, I think if you look out there again, there's a lot of these businesses that are somewhere, let's call it between 30 and 50 billion of AUM. And they're trying to figure out what's their growth strategy. And I think in partnership with an insurance company that's growing, scaling, and is reinvesting its capital into that growth, there's a lot of opportunity because the insurance company, as it grows, the asset manager grows, right? So you get the benefit of the scale of the insurance company generating more spread-related earnings, and then you get the benefit of the asset management growing and generating more fee-related earnings. So it's this great combination where through kind of $1 of equity capital, you get 2 benefits.
So this will anchor, I think, a lot of our discussions throughout the day here. It's a really interesting environment for credit. Interest rates, even if you believe that you'll get 1 rate cut this year, they're higher than they've been in the last decade. What kinds of opportunities is it creating for you in the credit market more broadly?
So I think there's a couple places that are very interesting right now. I think real estate credit is a good place to be because I think you see regional banks are pulling back. And I think the value of real estate has it stalled out a little bit. So you're going to have to be in a position where you need to refinance these loans, and with SOFR where it is, you're making kind of 9, 10, 11, 12%, on an unlevered basis. So I think those are really good rates of return. We see opportunistic examples, like, for example, we bought $1 billion of loans out of PacWest Bank. When the regional bank tremor occurred, the banks were trying to figure out how do we fortify ourselves, and therefore they're selling assets. And generally the way that works is they sell their best stuff first. So we were able to buy $1 billion of loans out of PacWest, and already roughly 20% of those loans have already refied themselves out. So it was a good opportunity to be well placed and to be able to move quickly. I think another place that we're excited about is this world where there's a bunch of these kind of growing disruptive tech firms that maybe raised money in 2021 or 2022, and they're going to need some growth capital. There's clearly value in the firms based on the fact that other businesses would love to buy them, because I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses. So real estate credit, kind of structured credit, and growing disruptive tech firms, and then opportunistic credit. Because there's definitely going to be some things that go wrong. So to be in a position to be able to move quickly. We're working on one right now where we're buying senior secured debt at 50 cents on the dollar and taking control of a position.
What goes wrong? If you think about the next 6 to 12 months, there's a lot of concern that these prolonged interest rates will start to create serious cracks in the market. Where are you starting to see them?
Well, there are definitely places where, there's been, I think, if you look at the liability management exercises that are going on, there's been something like 30 or 35 of them. And 14 or so have been kind of what we'll call repeat offenders, where the borrowers have already done a liability management exercise, so they didn't end up kind of solving their problem. They just kind of kicked the can down the road. So I think it's specific to industry, right? If you go back and you look at defaults ripple through industry, right? So generally there's something going on in an industry. So defaults generally spike, in an industry. I think everyone obviously talks about the real estate stuff. I've never found that anyone has been able to predict the thing that's been the problem, right? Generally the thing that is the problem is a surprise. So, I think we're going to see this sort itself out would be what I would bet. But obviously, I think we're also living in a world where, a 4 1/4 10-year people think is high. If you go back and look at time, a 10-year at 4 1/4 is not high, right? So I think we'll see over time the front end of the curve come down, and the back end of the curve will kind of stay where it is. But I just don't see that the higher for longer is necessarily going to be the thing that crushes us.
Todd Bowley there. Well, still ahead, Paramount is raising prices to boost profits and cut costs as the streaming wars heat up. We'll discuss. This is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how 1/3 of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. Go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Welcome to Bloomberg Markets. I'm Bonnie Quinn. Time now for our stock of the hour. We're watching shares of streaming stocks. Paramount raising the prices of its streaming service by at least $1 per month, and that's starting in August. Goldman, too, reinstating its coverage of some media companies, and it's giving Paramount a sell rating. Bloomberg's Chris Palmieri covers all things entertainment. So that makes now 13 sells for Paramount. Should Shari Redstone have taken the deal, Chris? Was it a mistake?
Yeah, she should have been a seller. Well, time will tell, right? She obviously felt this wasn't the right deal for her when she turned down the offer from David Ellison. It certainly was a controversial one. But there's such flux in the media land now, and it's really separating between the winners and the losers. Netflix, Disney, appear to be the winners. Companies like Paramount and Warner Brothers still struggling with their debt load and trying to get traction in streaming.
To that point, it's an ad-free Paramount Plus with Showtime, which is increasing its price by $1 in August to $12.99 a month, which is pretty hefty, and even increasing its more basic service to $7.99 a month. That's $2 for the more basic service. Will customers pay it, Chris?
That's a 16% increase, by the way, on the ad-supported one. This is getting up there now. Paramount said its prices were, competitive with the market, but the thing is, everybody's been raising their prices, and it's really a test of how many services people will stick with. We're already seeing this as a business with a lot of churn. People watch a few shows that they want to watch and then cancel and move on to the next service. And these kind of price increases aren't going to help that. Now, this is clearly about getting Paramount Plus to profitability. It's just about the least profitable of the big services now, and that's really a big focus for them.
Yeah, and it does appear that shareholders are very upset as well. John Rogers basically saying, look, we're in a catch-22 situation. There isn't really anything we can do. Chris, thank you so much. We'll continue to follow these stories. That's Bloomberg's Chris Palmieri. Paramount itself down more than 2%. In a day when we are seeing the market take a breather, I don't want to say rally big because it's really just certain stocks, but certainly Nvidia is back up more than 4%.
Says there are challenges measuring housing inflation.
Of an increase, and we are seeing the major indices, particularly the NASDAQ 100, back up 1% after several days of declines. We also have that bond auction coming up at 1 p.m. Eastern, a 2-year auction. We'll see how that goes, but in anticipation of that, we're seeing bonds really just in a range. The 10-year yield 4.2554, the 2-year yield 4.7509.
And Fed's Cook says it is defensible to include owners' equivalence rent in CPI.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building
Fed's Cook says there has been a long-standing shortage of housing.
So over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
Ted Cook says the Fed is watching the unemployment rate, but it's still at a low level.
Welcome back to Bloomberg Markets. I'm Vonnie Quinn. Let's get a check on those markets now, where we are seeing at least a bit of a breather today after some definite selling at the beginning of this week and the end of last week. The S&P 500, as you can see, though, up about 0.2%. Not all of the sectors are higher. In fact, very many of them are lower. We're thanking the semiconductors for a lot of this move. And as you can see, we're also seeing the SOX index increase. That's partially because it is the semiconductors that are moving. So NVIDIA, for example, up 5.5%. And then just take another one or two of those stock companies, or at least AI-related companies. You can see they're not all moving the same direction. So Supermicro Computer, for example,
Fed Cook says the Fed has the tools to adjust if there's unexpected shifts in unemployment.
By about 3%. And then some of the other areas that are moving higher, well, it's the cruise stocks, right? Carnival, Norwegian, they're also seeing some gains after a pretty big sell-off when we got monthly data just a couple of weeks ago. Well, today we had a bright outlook from Carnival, and that stock is up almost 8%. But do keep an eye on this market, because we could be in for a reversal towards the end of the day in some of these sectors. We'll have to wait and see. And for a closer look at equities now, let's bring in Bloomberg's Abigail Doolittle.
Well, honey, we may have the indexes at a surface level taking a bit of a breather today, but over the last couple of years, that's not the case at all. We're up this year, we're up last year. Of course, 2022 was difficult, but over the last 5 years, smoothing out for the pandemic, we're looking at big gains.
And Fed Cook says there is ample evidence that monetary policy is restrictive.
87%. Take a look at the NASDAQ 100, though, up 159%. SOX, the chip index, really outperforming, up 290%. And then you were mentioning NVIDIA, a rebound today from that brief correction. We'll take a look at these gains over the last 5 years, up nearly 3,200%. Some of that, of course, was initially the Bitcoin excitement, and now more recently the AI. Now, given the degree of these gains, one big question is, are we going to continue to see a robust bull market rally, or are we going to see some kind of a pause, consolidation, or at some point are we going to see a real rolling over? Let's take a look at a really interesting chart here. This is the NASDAQ 100 relative to the NASDAQ 100 equal weighted index, something that we really don't take a look at very often. And usually we don't we don't draw a trend on the top of a chart, a resistance, but because the buying of the NASDAQ 100, in particular some of those big names, Microsoft, Apple, NVIDIA, so on and so forth, relative to the other names within that index, we are doing that. And you can see that there's very defined resistance over the last 10 years or so. In 2020, we briefly went over it. Same deal at the end of 2021. In 2022, on that correction, we went below. But now take a look at this parabolic move up and out of this ratio, Vonnie. It really begs the question of how much further can we see the NVIDIAs, the Apples, and the Microsofts go higher, or when is more likely the real question, when are we going to see a return to the mean, and will we be going dramatically below it? Interesting times ahead, potentially.
So many open questions, right, Abigail? I wouldn't want to have to answer them for a living. Bloomberg's Abigail Doolittle there is staying with us as we look at what's ahead for the markets this year. And joining us now is Samantha Leduc, founder and CEO of Leduc Trading, which focuses on global stock market analysis. So, Samantha, you must get these questions all the time. Will there be a reversion to the mean? Is this time different?
Right now, we're having profit taking, and it is due. But I still think we have a bullish market backdrop. For the most part, options expiration, which ended last Friday, kind of suppresses volatility. And then we have the end of the quarter, or I should say we are into the end of the quarter this week. So it is very extended this AI tech ecosystem of stocks. There's no question. So they are having some pullbacks, some I would call profit taking. You also noted in Bloomberg the terminal that you've got Dell doing some CEO doing some very large insider selling, with Avgo CEO also 25% position. Now, keep in mind that's not necessarily a top call. They did the same back in 2019, and the market, the stocks continued to quadruple from there. But the point is, they're taking some chips off. And we're going into a blackout period for earnings coming up in a few weeks, where 80-90% of those buyers are going to be on hold. And then you kind of add the Treasury right now, TGA, which is a Treasury general account, is kind of on its low for liquidity. Put lots of stuff together. You've got that end of month, end of quarter profit taking on very extended AI tech stocks that were due a little pause.
Yeah, and you mentioned Broadcom there. It's down about 0.6%. So how much of this move is related to yields, Samantha? Because we do see that quite frequently. We see, if yields are repricing because of some Fed comments, we do see a move in the market. Is any of that due to potentially, the idea that the Fed might be changing its mind on when it will move?
I definitely think there's an underpinning right now where the macro backdrop is getting a little concerned, not just with this euphoria in the AI tech space. Forward earnings have been very robust, and that's also feeding, on a baseline bet that the economy is growing, and therefore earnings will grow. Jobs have not percolated to a danger level of unemployment where the Fed would have to intervene, but we are absolutely basing and starting to head higher in unemployment claims. So basically, the Fed has really this pause mandate, and yet other central banks globally have started to cut. So this is the big question. Are they cutting just kind of political expediency, or are they sensing that there is a reduction in global demand of credit? And that's typically kind of a precursor to why a central bank will begin a Fed cutting regime, is if they start to see that global demand of credit roll over. So we're going to really need to watch banks this earnings season to see how they're performing on credit, on lending, on their net interest margin, to see if we do have some signs of more bearishness or concern to this market advance.
Really interesting points there on global credit and the possibility that the overall picture is tightening, given the fact that other central banks are cutting. So given that, when the Fed does cut next, knowing that we do need more color from some of the other banks, but if you were to guess right now, based on all of the different macro points and the cross-asset class studies that you do you think that the Fed will see the next cut or a couple of cuts, if they were to come, as true accommodation because they are needed to support a sagging economy?
So I think we will really get a tell if the yield, the 10-year yield drops below 4.2%, which is, by the way, short-term bullish for equities. It also kind of loosens up the frozen housing market, but it would also indicate that we have more global demand of credit falling, and that would, I think, spur at least accommodation talk at the next July meeting, and potentially a move sooner than what is priced in, which has been, by the Fed's own admission, Waller and Powell and others, end of this year, beginning of next year. So most are focused on that narrative of Fed rate cuts have been priced out in time. I think we're actually going to start to pull that forward after this summer, and we can go down and break that 4%, that 4.2% for the 10-year.
Yep.
As the unemployment is starting to percolate higher into 4.2% unemployment.
So that would be a real shift in narrative if all of a sudden the Fed is talking about accommodation as opposed to just these cuts that people are thinking about after inflation spiking. Hi, Samantha, that chart I was taking a look at, that is from you. Wonderful chart, really shows how overextended things are relative to some of these big tech names, the AI craze, the weighting to those names. And when I put that against the backdrop of the possibility of global credit tightening, but I know that you say topping is
Fed's Cook says it will be a challenge to push productivity beyond the long-term average.
The other key tells in terms of whether or not that we're going to see a big rollover, as that chart suggests at some point is likely.
Well, right now the bullish backdrop is that we're in an election year, so really, it's Fed and Treasury will help support this market, and this will be a lagging impact from the higher for longer. And typically, by the way, it starts to bite about 18 months later. So I think the margin debt, as it relates to a tell, is typically rolling over when we have real more confidence that the economy is decelerating. And right now, I mean, we're going to get GDP for Q1 on Thursday, probably 1.3. So we have still slow growth backdrop. But when margin debt typically rolls over, it is a sign that folks are selling things. So the fundamentals start to matter a lot more. Right now, I think the concentration risk in AI tech has really helped disguise or camouflage the weakness in the market. I mean, small caps to SPY, relatively speaking, are below 2009 lows. Transports relative to SPY as a ratio are below 2004 lows. We still have that chart that you just mentioned, which is NASDAQ to NASDAQ equal weight, will have a reversion, and then we'll have to see how it does once it kind of stabilizes on this profit taking. It could pick up speed to the downside this summer. Volatility typically bottoms seasonally in July. So we do have some shake and bake to look forward to, I think, end of this summer.
Some shake and bake. Samantha, thank you so much. That is Samantha Leduc, founder and CEO of Leduc Trading, and of course Bloomberg's Abigail Doolittle with us as well. And coming up, if you missed Boaz Weinstein earlier this hour, don't worry. Next, we discuss his comments about his fight with BlackRock. We go back live to Bloomberg Invest. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every
US stocks extending their fall, with the Dow Jones down 1%.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
And welcome to Bloomberg Markets. I'm Bonnie Quinn. Bloomberg Invest is underway with some of the biggest voices on Wall Street, which include Saba Capital's Boaz Weinstein. Bloomberg's Shonali Basak spoke with him earlier this hour about his fund's proxy battle with BlackRock. She joins us live now from the event. So, Shonali, some fiery language, as you said. Horrific governance from an incredible firm was one of the quotes that I took away. What stood out to you from your conversation?
One thing that stood out to me, and let's explain what's happening here. Boaz Weinstein, long known for being a very significant credit investor, betting against the London whale. This is a reinvention of sorts. He's been an activist investor lately, targeting closed-end funds, which lock up investor capital for a longer period of time, sometimes perpetually. And so he's targeted 10 BlackRock funds and sought to swap directors at those funds. We know the results of one of those votes, according to Boaz this morning. Take a listen to what he had to say.
It's always nice to aspire to break news on a conference like this, and it so happens that the fund that has gotten the most of my attention, which is called Big Z, B-I-G-Z, just had the voting close at 11 o'clock. So I can say preliminarily, I didn't count the votes, but they've announced it, that
Fed
actually
bids for 2-year notes total $2.4 billion.
Than all of the BlackRock nominees, and 4 of our nominees got more than 2 times as many votes as BlackRock, so more than 2 to 1. And when you win an election by 2 to 1, the voters have spoken. You know, we all know landslide is like 60-40, 58-42. If more than 2/3 voted one way, you know, BlackRock can no longer say and that they purport to speak for the shareholder and try to create some divisions. The shareholder has spoken, we won, and the reason that there's been litigation, it's been outward, it's us to them, is because they have put in place election rules that would make Vladimir Putin blush.
So let's step back, big step back. This is one fund you said you were voting for today, but there are 10 funds.
Mm-hmm.
Ultimately, what is it that you want out of this strategy? These are closed-end funds, so you're locking up, or BlackRock has locked up capital for a longer period of time, forever, right, in many of these funds. So what is it that you're trying to accomplish by targeting them? I understand that you target them when they're trading below their net asset value. You want them to bring investors whole. But what's the end game here? You won at one fund. What else do you want?
Yeah, so ETFs, as we all know, can be sold at net asset value, or the market maker can redeem them for net asset value, and then the manager, BlackRock, will go and sell the assets and give back net asset value. Closed-end funds, you're trapped. Many of these funds have no maturity. They could be around for 100 years, 200 years, and so there are periods where the investors don't want them, and for some reason, there isn't a manager more than BlackRock that the investors don't want. It's something personal. I'm not looking to not be besties with Larry Fink. I'm not looking to be besties with Larry Fink. You know, I basically am just looking to make my investors money, and if the discounts are persistent and they're there year after year and you can buy it a literal dollar for 85 cents, you have the power, unlike in normal activism, to turn that back into a dollar, because if you change the fund structure to being an open-ended fund, like an ETF or a mutual fund, or the manager agrees to buy back shares at net asset value, just like Franklin Templeton did this month in 3 energy funds, the investor has a chance to go from 85 to 100. And as you all know, that's not even just 15%, because it's 15 over 85. That's an 18% return. Big Z today is at greater than a 15% discount, and it's a fund that lit its investors' money on fire. Now, I say that, it sounds dramatic. The last 3 years, we've been in more or less a bull market, not for everything, but Big Z has lost more than 50% of its capital from the stock prices going down and from the discounts going up. And so it's lost billions of dollars. And here we have investors resoundingly saying, we want change at the board level. But the part that many of you would be shocked to hear, why I mentioned that quip about Putin, is that they've decided to set election rules such that in order to replace their board, you have to actually get 50% of all the shares. Now in Big Z, preliminarily, they got about 51 to vote. So we would have needed 50 out of 51. Okay, winning 35 to 15 wasn't good enough. And so that kind of math makes it literally impossible, but ironically, it makes it impossible for them to put anyone else on the board, because they would have to go
So
through their
S&P
own
500 raised gains
rules.
flat on
And
the
so as a
session now.
result, the BlackRock nominees each sit on approximately 70 boards, 70 different boards. How can they do their job at 70 boards? At JP Morgan, each nominee sits on one board. It's horrific governance from a firm that's an incredible firm that actually prides itself in raising money to invest in good governance.
Now, Vonnie, that was just part of the conversation. And remember, this is only one fund that he's talking about that they know.
Fed's Cook says we know there are problems with commercial real estate.
Says about the voting process as well.
Commercial real estate issues loom larger for smaller banks.
Personal, he said yes. I mean, he believes this is a matter of justice. So in the world of asset management here, it's certainly an interesting one. It also draws bigger questions here, not just about closed-end funds, but liquidity for retail investors. As we know, private capital firms have BDCs and all sorts of other vehicles that they are forming for more retail investors to get into. It really raises the question whether funds like Saba will become bigger activist investors. Should they raise those large dollars to put to money towards working toward these activist campaigns to look for change at these more illiquid funds?
Yeah, and it's a fascinating battle, actually, Shonali. We'll continue to follow it. But also, Saba is a long volatility manager normally, and it's been kind of quiet in VIX land, right? What did he say about the prospects for, you know, maybe what our previous guest called a little shake and bake, maybe later on in the summer?
Yeah, he was very funny about it. He said, I'll become a
It's been 10 minutes time now at the top of the hour. The US is due to sell $69 billion in a 2-year note sale. The prior bid to cover was 2.41. The prior high yield was 4.917%. JP Morgan strategists note that given the recent decline in yields and limited scope to extend it in the near term, they see the auction as needing a modest concession from Monday's closing levels in order to be digested smoothly. Also make note of the latest CFTC positioning data. This shows that speculators were net short 1.3 million 2-year note futures, a possible source of covering demand.
Thank you. Well, neither is Bloomberg Invest, so definitely catch Shonali Basak and more of our coverage at the Bloomberg Invest conference. It's on all day and all morning tomorrow on Live Go on your Bloomberg. And let's check the markets because we suddenly had a reversal, wouldn't you know, for the S&P 500. Now we're back positive again, but we did dip into negative territory. Fewer than 100 stocks actually in the S&P 500 are higher right now. Many of them, though, chip stocks. This is Bloomberg.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking? Yeah. I mean, like, what's that about?
We're not forcing everybody to be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier, right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think.
Fed's Cook says it is a good idea to pay attention to the distribution of Fed dots over the median.
What's the best way to contribute to the world?
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Billionaire Philippe Lafont, founder of Coatue Management, says he's bullish AI. He spoke with David Rubenstein at the Bloomberg Invest conference this morning. Have a listen.
Short run, it's true that the mentions of AI in every TV and written form is very high. And so one could say, wow, if everybody talks about it, it must be priced in. And the only reason why I'm more positive is I remember when I invested in Apple in 2009 when the iPhone first came out. And for years, people told me, why are you invested in Apple? Everybody talks about Apple. And obviously, it had an incredible run. So I actually think that sometimes because someone speaks a lot about something, it might be actually a good sign versus an overhyped sign.
Now, some people on Wall Street say the best way to invest in AI is go invest in the big companies that are already doing AI, Google, Facebook, Microsoft, and so forth. Others say go find the smaller companies that might grow into the next NVIDIA. So what is your own view?
I'm conflicted. On one hand, the history of technology seems to be that the big get bigger. But also, sometimes out of nowhere, a new company gets created, like Facebook or TikTok. And at the beginning of these new waves, the new winners, 10 or 20 years out, some of them are existing companies and some of them are new. But the new ones that get big, there's maybe one a year, no more.
All right, let's suppose I say I missed the AI wave, I wasn't smart enough to get there, but there's another technology wave always coming along. So what's the next technology thing I should invest in if it's not AI? What's coming behind AI that's going to excite tech investors?
So in 5 minutes' time now, at the top of the hour, the US is due to sell $69 billion in 2-year notes. The prior bid to cover 2.41, prior high yield 4.917%.
With data centers or utilities with power. I find the power.
Keep in mind, we do get the Treasury's pre-sale when issued yield at the top of the hour. Auction results normally follow a couple of minutes after this, so auction results expected in around 7 minutes' time.
With AI. On the new thing, AI is sort of going to be this amazing sort of artificial brain. What I wonder is what happens when you put that brain inside of a robot, and we humans need to then live side by side with humanoids. I'm like, wow. I don't know exactly when it happens. Maybe it's 10, 15 years. Musk says it's 5. Other people say it's 25. Take the average, 15 years. That's going to be pretty exciting.
Philippe Lafont of Coatue there, and do continue to watch Bloomberg Invest on your terminal at LiveGo. I do want to mention the $69 billion auction we have coming up at 1 p.m. Eastern. In advance of that, we have the 2-year yield at 4.7509, up almost 3 basis points on the session. And then just once again to point to the S&P 500, just losing some of its gains. It's still up about 0.1% as we hit the heavy trading here going into the lunchtime hour. I'm Bonnie Quinn. That does it for Bloomberg Markets. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New season starts July 10th on Bloomberg Television.
Morning from our world headquarters in New York, I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
So we're shortly expecting the results of the US 2-year note sale. The Treasury's pre-sale when issued yield is due at the top of the hour.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
The Biden campaign targets cheap fakes ahead of this week's debate. Welcome to the fastest show in politics as the president's team tries to knock down attacks on Joe Biden's age as both candidates prepare for a big night this week. I'm Joe Matthew alongside Kaylee Lines in Washington. Kaylee, you can't go on social media right now without seeing a montage of Joe Biden looking old.
Yeah. Either wandering off or pausing in a speech. The White House contends a lot
Treasury
of these
when
have been
issued
edited
2-year
to make
yield
him look perhaps,
4.706% before the $69 billion
is, but it
auction.
speaks to what's at stake in this debate that's coming up on Thursday evening. It's not so much about what you say, but making sure that you say it with gusto, perhaps with energy, and don't have any of the gaffes that could
Fed's
risk
Cook
going
says,
viral
I'm
when
aware
everybody's
things
just
can
scrolling
change
through
rapidly in the
TikTok
jobs
next.
market.
Unless, of course, the strategy is to go viral so they see you on TikTok the next day.
Well, fair enough.
It's going to be an interesting strategy for both of these candidates to deal with on Thursday night. And of course, we're going to bring you the debate live. Josh Wingrove from our White House team doing some great reporting, Kaylee, today on how the two are preparing.
Yeah, and we'll have more with our political panel on the what's at stake question as we look ahead to Thursday. First, though, let's take a look at what's happening in trading on this Tuesday and go to Charlie Pellet with a check on the markets up in New York. Hey,
Thank you very much, Kaylee Lines. We got our daily debate between the Bulls and the Bears. Right now, we have got the Bulls holding on barely, up 1 point, a little changed. S&P now at 54.49, up less than 0.1%. A rally in the world's largest tech companies lifting stocks. Traders taking in stride weak economic reports this morning. Dow Industrial is now slumping 364 points, down by about 0.9%. NASDAQ, though, heading the other direction. NASDAQ up 135, up 0.8%. All about NVIDIA, with NVIDIA shares advancing by 4.5%. 10-year at 4.25%, with a 2-year that's yielding 4.74%. Spot gold now down $16 the ounce, down by about 0.7%. And West Texas Intermediate crude 81.01 a barrel. WTI down by 76 a barrel. Sources tell Bloomberg Boeing has offered to acquire Spirit Aerosystems Holdings for about $35 a share in a deal that is funded mostly with stock. That word sending shares of both companies lower. Boeing down by 2.9%. Spirit Aerosystems Holdings down by 6.3%. So again, recapping here, we've got the
Bid cover issue 2.75, 2.75. High yield 4.706%, 4.706%. The US sells $69 billion in 2-year notes and awards 53.94% of bids at high. Primary dealers take 13.48%, direct 20.93%, and indirect 65.58%.
Alongside Joe Matthew. One person, though, not in Washington today, hasn't been for several days, in fact, is the President of the United States, as Joe Biden is still at Camp David.
Yeah.
Or maybe we should call it Camp Debate, doing debate prep ahead of Thursday.
It's nice up there, you know, this time of year. We
I'm
just
sure
never
it
get to
is.
see it. Even Josh Wingrove doesn't get to stay at Camp David. That's like the one spot you go when you don't want the distractions. You don't want people around your desk. You're trying to focus. It's a different approach than, of course, we've been hearing Donald Trump taking. He's going to fundraisers and riffing with the staff, trying to come up with one-liners and so forth. We'll find out which works. But it's interesting in the preamble here, Kaylee, we're seeing the Biden campaign try to knock down what they're calling cheap fakes. These are not deep fake videos, but allegedly altered in some way, edited in some way, and put together to make Joe Biden look like a very old man, too old to run for office. Yes. This is what Josh Wingrove is writing about here. Bloomberg's White House correspondent at the table. Great to see you, sir.
Hey, how are you?
This is, I'm sure, something they love talking about.
You guys wouldn't deceptively edit me, would you?
Well, no, this is live. You know how it goes on Bloomberg. We just don't have the chance. Cheap fakes, that's not bad. Did they come up with that?
Yeah, so they, we've been seeing a lot of these. This, by the way, is part of the reason why there are concerns on Capitol Hill about TikTok and, what algorithms would feed what content, regardless of which president is in office. They're worried about this because these videos are surfacing. They're being amplified by conservative media and the Trump campaign to, stoke concerns about the president's age. One in particular from the G7 was edited deceptively to trim it so it looked more like Biden was wandering off as opposed to gesturing to parachuters, which was the case. I was there, saw it with my eyes.
You were there.
So there.
Did you watch that happen?
That is, yeah. It was a good parachuting show.
Was anyone struck? I bet it was cool. No one talks about those guys.
Yeah, they came in like cute little Italian cars. It was very
Was
nice.
anyone saying though, "Oh, he's wandering off," or you saw this later on social media? You said, "Wait a minute, that's not really happened."
The initial unedited clip took off. Pretty quickly, and then the edited clip, which made it look worse. But he was gesturing to those people. So that's the issue here. Is they Democrats will say, yes, he's old, he's 81, but there are often explanations, innocuous explanations for these videos, but still the videos are not helping. Biden campaign chair Jenna Malley-Dillon saying on a podcast yesterday to make your own blanking TikToks to combat this, calling on supporters to flood the zone. So the risk for Biden on Thursday is, of course, any moment, any pause, any freeze up, any stumble, which certainly I've had, on TV or radio or what have you, can be exacerbated to add fuel to this fire on the question of the age concerns. But they see another side to this coin, I should note, and that is that Trump has been saying a lot of eyebrow-raising things, even if you've sort of priced in Trump being a little, on the front foot on some of these things, saying stuff that makes your eyebrows raise. Trump, is saying different stuff than even he said in 2020 and 2016. And so the Biden people think that this is a double-edged sword, and that voters who are just tuning in will see some of the stuff Trump is saying and think, oh boy, that is even different than what we've come to expect from Donald Trump. And so that is the framing for this. They're both in this race right now to set expectations. Trump has spent the last 2 years calling Joe Biden Sleepy Joe, essentially saying that his brain is, fading. And now he's going out of his way to compliment Joe Biden as a debater. It's wild. You should see this. The Trump campaign sent a statement saying what a great job Joe Biden did in 2012 against Paul Ryan.
We're making this too easy.
Yeah, so there's some expectation setting going on. I should note that 2012 stuff feels like now. At the time, you remember Barack Obama delivered a real stinker of a debate against Mitt Romney. Democrats were a little bit despondent about that, and it was Joe Biden who came out swinging against Paul Ryan. Bunch of malarkey being the key takeaway quote from that. They really helped rejuvenate that. And that is really, I think, part of the final point I want to make here is that the expectation setting is as much about
At 1:15 p.m. Eastern Time, we're expecting comments from ECB's Nagel, who gives a speech on digitalization in Frankfurt.
Well, on the subject of expectation setting, it does seem that at least for the Trump camp, part of that expectation setting has to do with the rules of the debate, the format that they agreed to.
They're working the
We
reps.
should make very clear the Trump team did agree to these rules. The CNN moderators, the mics getting cut off if you're speaking over time, the lack of a live audience. How does that change the nature of what's about to go down on Thursday?
They are setting this up as a, quote, 3-on-1 because they want to be able to sort of say it was rigged. Sound familiar? So that's what we are expecting from it. They did agree to the rules, and there's sort of two schools of thought about why Biden's campaign sort of floated this in the first place. And one is that a cynic might say that they didn't know whether Trump would say yes or not, right? Because Trump has been saying, anytime, any place, let's do this. Let's have a ton of debates. Trump is also floating the notion of whether they should both be drug tested, which, that is a different kettle of fish. So right now, this is the earliest debate we've had in the modern era by a long shot, by a couple of months. Biden wants this to be, putting both of them on stage saying, this is the choice. Notably absent from that are other third-party candidates. Yeah. Trump wants the same thing. He wants to hammer Biden on immigration. He wants to hammer Biden on inflation, which are concerns that poll after poll, including Bloomberg's own poll with Morning Consult, shows are top issues for independent voters and voters more broadly. So, Trump wants a window to go at Biden. Biden wants a window to frame the choice as a binary choice for voters. It's their view that any vote not for Joe Biden is a vote for Donald Trump, either whether you stay home or you pick someone else.
All right, Josh Wingrove, Bloomberg White House correspondent, looking forward to Thursday night.
Big Thursday night.
Your coverage indeed will, of course, be having coverage of that for you on Bloomberg TV and radio, 8 to 11 p.m. We will be simulcasting CNN's presidential debate. And on the note of that debate, as we continue to look ahead, let's assemble now our political panel. Rick Davis is with us, Bloomberg politics contributor and partner at Stone Court Capital, joined today by Joné Wortel, partner at ARC Initiatives and Democratic strategist. Welcome to you both. Joné, I'd like to start with you, as we were just discussing with Josh, this whole idea that the Biden campaign, the White House, is already struggling immensely with these cheap fakes, with videos that circulate of the president looking old at 81, something that he cannot change. How much power does he have to change that narrative on Thursday night?
Well, I think what's important to think about when it comes to this debate is that the president is going to deliver a clear and concise message to the American people about what's at stake in this election and why he is the right choice for another 4-year term, and rightly contrast himself with Donald Trump. I think that what's important here is for him to show the energy and enthusiasm that he has in his months on the campaign trail, traveling to battleground states all across America. So I think that contrast and that kind of rebuttal to, the claims that he's too old to be president or other things that have been said is for him to show up on that debate stage Thursday, ready to really put on display for the American people why he is the best choice to lead us into the future.
Rick, a fascinating study here from Media Matters today. I wanted to ask you about. You can both take a swing at this if you want, because it challenges the idea of the left-wing media bias when you consider specifically the issue of age, as Kaylee brings up here. They reviewed articles in 5 of the top U.S. newspapers by circulation: Washington Post, Wall Street Journal, New York Times, L.A. Times, USA Today. Rick, they found out of the 144 articles focused on either of their ages or mental acuities, 67% focused only on Joe Biden's age or mental acuity. Only 7% focused only on Donald Trump's. What do you make of that bias?
Look, I think it's, a bias, I guess, by virtue of the data. But, remarkably, Donald Trump doesn't appear very old. He puts on these shows and these rallies. He stands up there for over an hour on a monologue. He goes on the most crazy rants in the world, but nobody thinks of him as being old and feeble in the process of doing it. Crazy maybe, but not old and feeble. Joe Biden get up to announce an award for somebody, and you think the guy's going to teeter over at any minute. You literally hold your breath, hoping that he gets through the event. And that's just because of his appearance and the way he talks. And sometimes he gets so quiet, you think, he's just sort of not got enough air in him to produce a sound. And yet, at the same time, he produced a great performance at the State of the Union, where everyone's like, hey, if he could just do that every day, we wouldn't even be talking about age. Look, let's face it. These are 2 geriatrics running for president. Age is an issue. Whether they like it or not, the American public have basically said they don't want either one of them because they're both too old and out of sync with where America is today. And so they got to put up with this kind of scrutiny because it is what it is. And American public is not happy with these choices. It's why 70% of the public in most of these polls say they'd rather have a different choice than both of them. So these are 2 guys standing on the stage Thursday night where the majority of the country would rather have somebody else to debate on both sides of the equation. So they have a job to do, which is overperform, to look energetic, to appear ready for the job, to think you can survive 4 more years of this kind of tough gruel as a president of the United States. And I think voters deserve that. They want to see that it's survivable.
Joné, I'd love for you to weigh in on what Joe was just asking Rick, the idea that the age question is just covered more when it comes to Biden. than it is for Trump, who is just 3 years younger at 78.
Yes, well, we see much more of President Biden in the media because he's on, the world stage. He's both the commander-in-chief and leader of the free world, and also a candidate for a second term. And so, when you talk about what his schedule must be like, or must have been like over the last couple of months, you're talking about somebody who is participating on the world stage, meeting with foreign leaders. You're also talking about somebody who's traveling to battleground states across America to make sure that the message of this campaign is heard in communities all across the country. And so when you look at the rigor that President Biden is under, with the amount of work that he has to do to accomplish that list of things, yes, you would find that anyone would be probably a little worn out. But what I think we've seen from President Biden, especially on the campaign trail, and I've been on the ground and I've seen him at rallies, I've seen him in small group settings, is a president who is energized, who's enthused, and who's ready to take on Donald Trump on Thursday night.
Rick, we started this hour talking with Josh Wingrove about something the Biden campaign is labeling cheap fakes as opposed to deep fakes. And it's this idea that they're seeing edited, maybe slightly altered video of Joe Biden looking old. And they're basically asking, not only calling them out when they see them, but they're asking supporters to flood the zone with their own videos to make Donald Trump look crazy with some of the things that he says. You've run presidential campaigns. How would you handle this new element, this new reality of cheap fakes, as they call them?
Look, I mean, campaigns have always had trouble with being taken out of
Shortly
context,
expecting the results of the Federal Reserve Repo operation.
Broader context that makes it sound bad, and I'm always torn because I think in this case, the more they draw attention to it, the more we talk about his age, and his age is the vulnerability. It's not Trump's. I think that the Biden campaign could do a better job of attacking Trump on his own gaffes and infirmaries. I mean, there's not a single event goes by that Donald Trump doesn't go off on something about like how much water in a toilet bowl. I mean, like, does the American people really care? I think that these campaigns could sharpen their attacks a lot more, and certainly the Biden campaign can. He basically left Donald Trump alone for 6 months, when the campaign started.
74 counterparties take $466.31 billion at the Federal Reserve Repo operation.
Starts talking about how they're being treated unfairly because he's old, because they're just reminding voters that he's old, and it's not avoidable. There's nothing that the campaign can do to change that status.
Janae, I'd like to ask you about an essay that Hillary Clinton wrote in the New York Times today, in which she points out that she is the only person to have debated both Donald Trump and Joe Biden. She writes in part that it is nearly impossible to focus on substance when Mr. Trump is involved. She goes on to say it is a waste of time to try to refute Trump's arguments like in a normal debate. It's nearly impossible to identify what his arguments even are. He starts with nonsense and then digresses into blather. How does Joe Biden debate against that on Thursday?
Well, you have to focus
Janae?
on what is. Yeah, well, I think you have to focus on what is President Biden's job on that debate stage on Thursday. His job is to set up the contrast between him and former President Trump. His job is to tell the story of how his administration has led this country out of 4 years of Donald Trump and helped to, recover the economy, helped to lead us out of a health crisis. And so while it is no secret that Donald Trump is likely going to come with a number of insults and jabs and an incoherent kind of tirades about any number of things, who can know, who can guess. I think it's important for the president to look presidential, right? To present these arguments, to present the plan, to present his accomplishments and what he's done over the last 4 years. And I think that's really the only way to truly create contrast between him and former President Trump. A lot of that will frankly play out itself, right? There's a lot that President Biden, by just standing up and being presidential, will create an immediate contrast with former President Trump. And I think that's his job on that stage on Thursday night.
We're going to see it and hear it right here on Bloomberg TV and radio. Big thanks to our smart panel. Janae Wartell, come back and see us again. And Rick Davis, smart take on the fastest show in politics. Charlie Cook is up next on Bloomberg.
The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month.
From the world of politics to the world of business, 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lyons deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern. Only on Bloomberg TV and radio. Context changes everything.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. A decidedly mixed market. Dow Industrials now down 336 points, a drop of almost 0.9%. S&P had been swinging between gains and losses, back in the green, up 7 right now. 54.55, up 0.1%. We've got NASDAQ up 165, up 0.9%. 10-year at 4.24%. The 2-year now yielding 4.74%. Bitcoin today up 3.6%, back above 61,000. Gold down 0.7%, and West Texas Intermediate crude down 0.7%. A rally in the world's largest tech companies lifting stocks. Traders taking in stride this morning's weak economic reports. Among those tech names rallying today, NVIDIA up 5.3% after 3 days of losses. Reporting after the close of trading today, we will be hearing from FedEx. FedEx ahead of earnings, down 1.1%. Again, recapping stocks mixed. S&P up 7 right now. That is a gain of 0.1%. Balance of Power continues. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, up in New York, thank you so much. New York, of course, a state we're paying special attention to today, even from down here in Washington, as it is primary day. And there's one race in particular, Joe Matthew, that we are paying the most acute attention to. It's in the 16th Congressional District, in which the incumbent Democrat, Jamal Bowman, a member of the squad, could be the first incumbent to go down this primary season, up against a challenger in George Latimer, who is painting a very significant contrast over the issue of Israel.
That's right. It comes down to Israel, it seems. We talked to Emerson Polling yesterday. They had Bowman down, the incumbent, down by 17 points, I think, roughly 3 weeks ago. The most recent numbers that we've been looking at here, Kaylee, and would be the first member of the so-called squad to lose re-election. So significant here. As we consider the states in play, New York, Colorado, Utah. By the way, we're still waiting for the Bob Good race to settle in Virginia. And there's a question about whether this is really a time where we're seeing the centrists advance here. And the extremes on both sides run into some headwinds. None other than Charlie Cook is with us to talk about it. Cannonballing into the pool today, the namesake of the Cook Political Report. Charlie, it's great to have you back and good to see you on Bloomberg TV and radio. Is the moral of today's story going to be centrists win?
Well, in New York, I mean, Bowman sounds like he's in huge trouble, and I think George Latimer seems well positioned to take him out. But that's sort of the center up against the hard ideological left. A lot of the primaries that we've been seeing in recent weeks and today on the Republican side, it's basically between the far right and the really, really far right. It's not the classic moderates or centrists and ideologues at all. So, but it is. You took the words out of my mouth a minute ago when you said none of the squad have ever, have had any real problems before. This is the first one, but pulling a fire alarm in the Capitol building. I mean, when you look at it, it's like, wait a minute. That kind of crystallizes behavior in the minds of voters where, the members can get away with a lot, but there are limits to it. And I suspect that Congressman Bowman may have hit his limit.
Wow.
Yeah, the infamous fire alarm incident, of course, was during the government shutdown fight in the fall. He was trying to make it to a vote. He maintained that he thought he could exit through the door that ultimately triggered the fire alarm. It was quite a saga. So considering the potential flaw, and that being one of this candidate, Charlie, should we be looking at this primary race in New York as idiosyncratic, as something unique to these candidates and specific issues, or something that could be a tell on the division we are seeing in the Democratic Party over the Israel issue, something that could translate into November?
Well, it's a little bit of a tell, but frankly, we're not seeing it as quite this big a deal in other primaries yet. I mean, it may get there, but so far we haven't. And I think AIPAC, American Israel Public Affairs Committee, they're picking their shots very carefully and sort of rifle shot going after specific members that they feel like they have a good shot of taking out. As opposed to, being seen as a paper tiger going after lots of people and not succeeding in many or any of them. And so I think it shows some sharp targeting on the part of AIPAC to concentrate their fire on where they seem to have a really, really good chance and not places where, it'd be a long shot.
I'm really glad you mentioned that, Charlie. AIPAC's Super PAC has dumped almost $15 million into ads against Congressman Bowman. That is an all-time record in American political history. With that said, maybe this is the new normal, but what would this race look like without AIPAC's money?
It would still probably be pretty close, but let's remind ourselves, this is the New York City media market. This isn't Dubuque. So if you're trying to get through to voters, it's going to be awfully pricey these days. Although, granted, television isn't as big an advertising vehicle as it used to be. But they were playing. AIPAC was playing for keeps here. No question about it. But and for future, a member's going to think, geez, I'm not sure how I'm going to vote, but I remember what happened to Bowman. And I sure wouldn't want to be Bowmaned. And, that can affect behavior. A lot of times members of Congress will look for the path of least resistance. And this clearly was not it for Bowman.
Charlie, of course, it's not just New York that has a primary today. There's also primaries in Colorado as well as in Utah. And Utah specifically, in the congressional races and the Senate race, we're questioning the power of the Trump endorsement. In the gubernatorial primary, Trump didn't endorse, despite the incumbent governor being pretty critical of Trump. Trump hasn't stepped in to advocate for his challenger. How should we be thinking about the nature of the Trump endorsement in this election cycle and how it is different compared to, say, 2022, other cycles before that?
Well, former President Trump was incredibly effective in forcing out the infidels, people that had voted for impeachment of him, and where they either jumped or got pushed out pretty effectively. But looking at these primaries, we're talking about the difference between chocolate and Rocky Road ice cream here. You're talking gradations of two really conservative people, but one of them happened to have Trump's endorsement, but the other one can hardly be portrayed as anti-Trump. So, I think there are limits to how far I'd want to extrapolate some of these things. And the same thing in that Virginia race that we had last week that's still undetermined with Congressman Good. We're talking about some really conservative people here. This isn't between the Mitt Romney center-right and Trumpies. This is between flavors of really conservative people.
All right, you went there, Charlie. So what about Bob Good and John McGuire? A race now, this election is a week old. It was last Tuesday in Virginia. This is the head of the Freedom Caucus, Bob Good. And we talked a lot about this, the strange bedfellows that came together to oppose Bob Good. Donald Trump and Kevin McCarthy swinging together along with establishment Republicans on Capitol Hill. It's still not called. In fact, Bob Good, who thought he was going to get a recount, looks like they will not be within the margin. And John McGuire's margin is actually, he's picked up a couple of votes. He's at 373. But Charlie, Bob Good says he's not done. And he said yesterday he will try to block certification of this vote because of irregularities in Lynchburg. Is this the beginning of the whole rigged conversation going into November?
I kind of doubt it. The thing is, with elections like this, the big jumps in numbers typically come in the first 24, 48 hours, where somebody, made an arithmetic error totaling up columns. You don't generally see big time switches, shifts in votes, this far away from an election. So my guess is that Good's defeat is probably going to stand, and that when one really conservative Republican is saying that another really conservative Republican stole an election, that just doesn't quite get the traction that some of the charges that former President Trump has leveled over the years. And, although frankly, there's very, very, very little. This country, we have a lot of problems, and there are lots of things that government doesn't do well. We actually count votes pretty well, and there's not enough voter fraud to even laugh at, anymore. But if people want to believe it, they'll believe it.
Well, and certainly Donald Trump is still out there talking about it in the case of the 2020 election. And Charlie, on that note, we have been talking endlessly about Donald Trump and the debate that is upcoming of him versus Joe Biden on Thursday on CNN. The question is, what does the debate actually change, if anything? How much potential does it have to change an election that we all know is likely to be very, very close, in which many voters on either side for either candidate are already entrenched and have their minds made up?
Well, debates typically don't make that much difference. The typical normal, well-adjusted person does not spend an hour and a half out of their lives watching a political debate. It's usually partisans that are watching to cheer on, their favored candidate or jeer the opposition. But occasionally they do. And this is obviously a close race, but I would look for, rather than, and I was a high school debater, rather than think who was smoother, who performed better, I'd say, who got a moment? who had a moment, something happened, positive or negative, that people will be talking about at work or in the grocery store.
U.S. State Department says Israel's Defense Minister Gallant confirmed to Blinken on Monday that Israel wants a diplomatic resolution regarding tensions in north with
And we can
Hezbollah.
all think of cases where that's happened, but most debates don't move the needle much at all. And the little 8 or 10% of people that are really, really, really undecided, they don't read, watch, listen to news. They're not Bloomberg watchers. These people are kind of pretty much out, and they only check in late if they check in at all. But they're not debate watchers. They really aren't.
Everyone should be a Bloomberg watcher. Come on, Charlie.
It's the coverage of the debate that's more important than watching the live feed of the debate.
Yep, the spin and the clips that circulate on TikTok the next day. Charlie Cook of the Cook Political Report, thank you so much, as always, for joining us here on Balance of Power. Now let's get a quick check on world and national news. Amy Morris has that in the 99.1 newsroom here in Washington. Hey, Amy.
Hi, Kaylee. The National Transportation Safety Board holding hearings at this hour on last year's fiery freight train wreck in East Palestine, Ohio. Dozens of freight cars derailed, including 11 carrying hazardous materials. Now, today's hearings will look at the cause of the crash and why officials chose to deliberately burn off some of those chemicals. And a key point in today's hearings will be the recommendations from NTSB for safety improvements. Hours after the news broke of WikiLeaks founder Julian Assange's deal with the Department of Justice that would effectively end his incarceration and allow him to go back home to Australia, his brother Gabriel Shipton says they are awaiting the moment when he finally steps back onto Australian soil.
We're looking forward to welcoming Julian back to his family in Australia, and really, I think his freedom is the main thing.
As part of the deal, he'll appear in court tomorrow to plead guilty to a single charge of the Espionage Act, and if they accept it, he can avoid prison time. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something. There's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow trading lower, down 308 right now, down by about 0.8%. S&P up by 10. That is a gain of 0.2%. NASDAQ right now up 169, a gain of 1%. 10-year at 4.24% with a 2-year that's yielding 4.73%. Spot gold down $15 the ounce to $23.19, a drop of 0.7%. And West Texas Intermediate crude down 0.7%, 81.03 for a barrel of WTI. A rally in the world's largest tech companies is lifting stocks. Traders taking in stride this morning's weak economic reports. NVIDIA among the standouts after 3 days of losses. NVIDIA today up by 5.6%. FedEx reports after the close of trading. FedEx ahead of earnings, down 1.1%. Carnival Corp, the cruise line operator, has raised its full-year earnings outlook after strong demand for cruises helped it post a surprise profit last quarter. Carnival Corp up now by 8.1%. Rival Royal Caribbean up 3.4%. Norwegian Cruise Line Holdings up by 5.7%. Recapping S&P up 11 now, a gain of 0.2%. Balance of Power continues. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
Charlie Pellet, thank you, and thanks for joining us on Bloomberg TV and radio, the Tuesday edition of Balance of Power, live from Washington on this primary day. Happy primary day in New York included, where, Kaylee, we started this hour talking about a very difficult challenge for New York Congressman Jamal Bowman, and it has everything to do with Israel, with Joe Biden's policies in Israel and outrage from progressives over this. He is expected to lose if you believe the polls. But there's bad news not only for Joe Biden on Israel, potentially Benjamin Netanyahu today as well.
Yeah.
As the Israeli Supreme Court makes a landmark ruling here, unanimous, I should add, that the military must begin drafting ultra-Orthodox men for compulsory service. This would end a decades-old system, Kaylee, and many think it could lead to the undoing of Benjamin Netanyahu's government.
Considering that the coalition government he has formed includes those on the far right, ultra-Orthodox, who had, in part, in joining this government, wanted to make sure that the non-mandatory participation in the military service for those ultra-Orthodox individuals would be enshrined into law. Mm-hmm. And here the Supreme Court is doing has a ruling that does the exact opposite. Of course, the court's grounds for this is essentially the ongoing war, which is now almost 9 months in. And they said in the midst of a difficult war, the burden of inequality is more acute than ever. The question, Joe, is whether this also makes the burdens on Benjamin Netanyahu even more acute by extension.
Well, that's absolutely right. And it's happening on what could be, as we've discussed, the eve of a new front opening to the north as Israel considers waging war against Hezbollah.
Yeah, there's a lot to pay attention to, and we want to dig into this a little further. And welcome now Jennifer Kavanaugh. She's Senior Fellow in the American Statecraft Program at the Carnegie Endowment for International Peace, also an adjunct professor in the Security Studies Program at Georgetown University. Jennifer, welcome back to Balance of Power. If we could first begin with this decision from the Israeli Supreme Court, how much more difficult could this make Benjamin Netanyahu's life domestically?
Well, it would be a big policy change if it actually comes to pass and is implemented as the court laid out. Benjamin Netanyahu is very dependent on his coalition to stay in power, and this ruling could really split that coalition between those who are supportive of the ruling and those in the right wing that are opposed to it. And I think that it's not surprising at all that the court ruled this way, or that this issue is getting new scrutiny in light of the ongoing conflict and the burdens that that's placed on military families. It's also evidence, I think, of the increasing social and political pressure inside of Israel writ large, which could put a bottom-up pressure on Netanyahu's position.
I want to hear you speak more to that. During arguments before the court, the government's lawyers argued that forcing ultra-Orthodox men to enlist would, quote, tear Israeli society apart, unquote. Were they right?
Well, that's a very difficult question. A lot of terms there that would need to be defined. But I think a bigger pressure that the country is facing right now is the burdens of the war and the ongoing ramifications of the October 7th attack on Israel. Many families now have lost service members and have service members serving in Gaza. And it's also important to note that there's also this other looming front up in the north and a potential additional set of call-ups of the reserves to fight against Hezbollah. So this is not a short-term issue. And I think that the court then has to weigh these decisions, the different pressures, the pressures from military families and the pressures from the Orthodox community. I will say that it's not uncommon for there to be conscientious objectors and personnel who are uncomfortable serving in military positions, even in the United States. But there are often ways to bridge that gap in terms of having them serve in support roles or administrative roles. There's lots of roles that need to be filled in a wartime. So it seems that this should be something that could be bridged without tearing apart the fabric of the community, as the government's lawyers stated.
Well, Jennifer, let's expand upon what you just raised there. This notion, or what seems like it could be a growing risk, that Israel actually does open up a second front in this war on the border in the north with Lebanon and go after Hezbollah directly. As you were just speaking there to already, the burden that Israel is facing in regard to the first front of the war, the ongoing operations in Gaza, the toll it is taking on Israeli citizens, on families, on the Israeli economy, certainly. Can Israel afford to go against Hezbollah directly at this moment, whether in like actual economic sense or in personnel sense?
Well, it'll be very difficult, and it would require the Israeli government and military to make some tough choices in terms of how to allocate resources and personnel. The operation in Gaza is likely to continue for some time. The military and Netanyahu has indicated that the most intense phase is drawing down, but also continue to hold tight to the goal of eradicating Hamas, which is not a short-term goal. It's a long-term goal. So that suggests a long-term presence in the Gaza Strip. And taking on Hezbollah is going to be even more difficult than Hamas because it is much better armed, much larger, and has many more resources. So that's going to be an even more costly and difficult conflict were it to occur. So the decision to do that would be difficult for Israel and would require significant sacrifices from the population and the government. The United States has indicated, the Biden administration has indicated that it would be there to back the Israelis up if they chose to make this move. But that probably doesn't mean U.S. troops on the ground. It probably means a continued military assistance.
Jennifer, Yoav Gallant, Israel's defense minister, is in Washington right now, a third day of meetings and talks with Biden administration officials. And today he's spending time with our Secretary of Defense, Lloyd Austin. The conversation is squared directly at the potential for a war with Hezbollah and what the U.S. hopes is the potential to avoid one. We know Amos Hochstein is in the region to try to conduct talks preemptively, getting into this with all of the stakeholders involved in the region. Can the U.S. keep this from happening?
I guess my question really is whether or not the U.S. is willing to take the steps it would need to stop it from happening. It's true that the United States is pushing diplomacy, and that yesterday Secretary Blinken urged the Israelis to avoid additional escalation. But at the same time, it's also been made pretty clear that the United States sees this as a decision for Israel to make, and have sent messages both to Israel that it would be there to back them up, and as well as to Hezbollah to avoid escalation on its side. And the Biden administration has indicated that they will continue to flow forces into the region. The USS Roosevelt is moving from the Pacific Theater into the Mediterranean, and there's some additional Marine Corps assets in the region as well. So I question whether or not the Biden administration has the willingness to actually leverage U.S. influence to stop this from happening.
So there's the question of what the U.S. either attempting to make sure it doesn't happen would be, or its response would be, in the instance that Israel does pursue this and Hezbollah pursues Israel back in return, as there's a risk assessment certainly that has to happen on both sides. There also is the question of the backer of Hezbollah in Iran. Jennifer, we were speaking last night with your colleague, Aaron David Miller, who suggested if you see the second front open, what actually opens is potentially the regional conflict the U.S. has been trying to avoid all along, as it would draw the U.S. in directly and Iran in directly. What would that really look like if it's not Iranian proxies that we are talking about, but potentially Iran itself?
Well, that's obviously a very dangerous situation. I think all actors involved are hoping to avoid a regional war of that kind. It's important to recognize that any tiny step up the escalation ladder moves us closer to that point, whether that's just an Israeli-Hezbollah conflict or Iran gets involved directly. And I think, if we have U.S. forces on the ground and Iranian forces on the ground, that starts to look like a very different conflict. It's important to recognize that the Iranians have significant military capabilities and are not all that far away from potentially having a nuclear weapon, and that any conflict that involved the U.S. and Iran in the region could easily spill into surrounding countries. So I would say, in terms of trying to imagine the scale of what it could be, I'm not saying that it would be, but it would be much worse than anything the U.S. experienced during the U.S. invasion of Iraq in 2003. So really something to avoid on all parties' behalf.
Well, maybe you can tell us the right question to ask in this case, Jennifer, but what would the U.S. posture be in that scenario?
Well, the Biden administration has been very cautious in terms of any sort of commitment of U.S. forces on the ground. At the same time, there are already U.S. troops stationed in the region that have come under attack. I think the U.S. would do everything possible to avoid having its own forces fighting directly with Iranian forces, just as it's done everything possible in Europe to make sure that it's never U.S. forces directly engaging Russian soldiers. So I would imagine they would try to stick to military assistance for as long as possible. At the same time, we know from just over the past few months that the U.S. Is willing to be pretty engaged in terms of protecting Israeli territory. So I would say the U.S. would try to keep ground forces out of the picture for as long as possible, but would not rule out things like helping Israel protect its airspace and water space.
Jennifer, it's great to have you. We'd love to have you back. Jennifer Kavanaugh, Senior Fellow in the American Statecraft Program at the Carnegie Endowment for International Peace. It's going to be interesting to see what role this whole story plays in the debate on Thursday night. And Kaylee will remind everyone it's just, well, a month minus 1 day that Benjamin Netanyahu is supposed to be here in Washington. This Supreme Court ruling is another challenge to that idea.
Well, certainly it raises the question of what kind of circumstances we'll be under when that visit comes on July 24th and who will be in attendance, as many Democrats have suggested they will not be attending that address.
Yeah.
On the subject of court rulings, we're obviously talking about the Israeli Supreme Court, but we've got a handful of them here in the U.S. as well, including in New York. The judge who oversaw Trump's criminal hush money trial, in which he was convicted on 34 felony counts of falsifying business records last month, and of course was placed under a gag order during the course of that trial, and is still technically under it, at least in part. That judge, Juan Merchan, has now ruled that Trump is lifted from the gag order when talking about witnesses and jurors in that case.
This is fascinating. It's exactly what the campaign argued for us, what Donald Trump wanted. And as we consider Thursday night, Kaylee, just imagine what this means for Donald Trump on national television in a primetime debate with the sitting president of the United States. He could go to war against the witnesses. He could talk openly about this case in a way that he has not been able to since the early phases of the trial.
Yeah, it's worth noting there are still limits on what he can say, including some connected to the case. He still cannot identify individual jurors, according to the judge, but still certainly this gives him much more clearance to say more than he has been able to directly at this point, keeping in mind that during the course of the trial, it wasn't Trump who was speaking on his own behalf, railing against the case and the judge and what have you. He had surrogates coming into Manhattan to do that job for him.
The thing is, consider this case. This is the hush money case that involved a porn star named Stormy Daniels.
Yes.
A very well-known figure in American politics, I guess we can say, if just not American drama. Michael Cohen, the former fixer, said to be a liar. These are actually household names. Wouldn't take a lot for the president, the former president, to be talking about these folks without mentioning their names and have everyone know who they are. And it'll be interesting to see how he does this. You have Truth Social up there? We should keep our eyes open for.
Yeah, we certainly should. And of course, we'll be keeping our eyes open and ears open to what he says this Thursday night in that CNN presidential debate. But it's worth pointing out 2 weeks from Thursday, Joe, is his sentencing in this case. It's on July 11th, and that's another date we all
just
have
think of the
to
month.
look
Yeah,
forward
we've
to.
got a Republican convention that we need to have and a vice president candidate that we'll be picking too. So
That's true.
the sprint begins now. That's why you have the fastest show in politics, and we'll do it again at 5 o'clock, Kaylee.
Indeed, we will. Right here on Bloomberg TV and radio.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New season starts July 10th on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers Studio here in New York, streaming on YouTube and Bloomberg Originals. It is Tuesday, June 25th, 2024. Carol Masser and Tim Stenevec are at the Bloomberg Invest Conference over the next hour, but not to worry, I'm here. Deputy Team Leader for the U.S. Stocks team, Jess Minton, but then also I have David Gura joining me as well over the next hour. I know it's going to be a lot of fun.
Great to be here, and as you said, this conference taking place today and tomorrow, some big names coming up, including Gary Gensler.
At 2:10 p.m. Eastern Time, we expect comments from Fed's Bowman, who gives a recorded opening remarks at the Midwest Cyber Workshop. Text is expected, but no Q&A.
Bloomberg. She's also going to be speaking with Cliff Asness. He's over there at AQR Capital Management. He's going to talk about potential frothiness that he may or may not have been seeing when it comes to his quant firm. Also, get ready because Odd Lost's co-host Joe Weisenthal, as well as Tracy Alloway, will be at Bloomberg Invest as well. And
I have yet to see them live.
I know,
and
they're
I'm very
everywhere.
eager to
I briefly saw Joe up the escalator, kind of waved and he waved back, so I know he's busy. And then, of course, Gina Martin-Adams from Bloomberg Intelligence will be at Bloomberg Invest as well. So keep an eye on that. Also, Nuveen CIO Sarah Malik will also be at Bloomberg Invest. So we have a lot of good,
Just an
exciting
incredible
things coming up.
event, and Shelley Bossack putting it together over many weeks and months. So
She's been doing
killer
this.
lineup that she put together.
And then towards the end of the show, when Carol and Tim are back, there's going to be talking with journalist and author Audrey Lim, who's going to be talking about her book, Free the Land, How We Can Fight Poverty and Climate Chaos. A lot more coming up, but first, let's get a business flash from the one and only Charlie Pelton.
Hi, thank you very much. Great having you both on board. We're looking at a decidedly mixed market right now. Dow Industrials, they're slumping down 311 points, a drop right now of about 0.8%. S&P, though, pushing higher, up 13, now at 54.61, a gain of about 0.2%, while the NASDAQ Composite Index is higher by 192 points, up now by 1.1%. 10-year, 4.23%, with a 2-year, 4.74%. Spot gold is down 0.7%, now down $15 the ounce to $23.19, while West Texas Intermediate crude is down 0.6%, 81.15 for a barrel of WTI. A rally in the world's biggest tech companies propping up stocks. Case in point, NVIDIA, surging now by 5.7% after 3 days of losses. Right now we got NVIDIA at 124.89. The big event coming up after the close of trading today will be FedEx. FedEx shares lower now by just about 0.9%, 254.09 on shares of FedEx. Rival UPS lower by 3.2%. But key takeaway perhaps, NVIDIA shares
shares, again up 5.7%. They are showing signs of steadying after a $430 billion sell-off sent traders searching for signals as to where the bottom may be. Indeed, the stock does look set to snap a three-day rout that had pushed it into a technical correction. That's when a stock drops 10% or more from a recent peak for the first time since April. So again, recapping, we got NVIDIA up by 5.7%, all part of a broader tech rally that's seeing the S&P up 0.2%, NASDAQ up 1.1%, and the NASDAQ 100 index higher now by 1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Jess Mitten and David Gura here in the Bloomberg Interactive Broker Studio. So coming up in a couple minutes, we're eagerly awaiting Anne-Marie Horton, as David was mentioning earlier, who's going to be interviewing Gary Gensler, obviously the chair of the SEC, but kind of looking at overall markets. I mean, Charlie was just talking about NVIDIA, right, David? So this is, if you do the MOV function in the terminal, actually, if you look at NVIDIA, the biggest point contributor here to the S&P 500 of about 20 points here. It's up about 5.6%, but seeing that stock recover after, obviously, everybody wanted to talk about a correction in the stock, but that stock was trading around $550 in mid-January, and to where it was above $1,300, I mean, I feel like it makes sense, right, when you see something pull back a little bit.
I was so eager to get to the studio to talk to you about this, because this is a stock that has surged so much. It's been going in one direction. I just wanted to get your sense of what you think has happened here over these last few days, the route that Charlie Pellet was describing just a moment ago.
So, well, what's interesting, because everybody knows about the stock split that obviously went into effect. It was June 10th, and so before the trading on that day. And usually what we've seen, not just for NVIDIA, but other stock splits as well, is you typically see those stocks continue to run up, and then once the split happens, you tend to see those gains come in. So it kind of hasn't been surprising whenever I'm speaking with my sources, and they're still obviously very bullish on this stock. And we're going to get more indications from other technology, and then of course chip makers that are going to be coming up. And when you think about like Micron Technology and some other companies, as far as when they're obviously working in partnerships with companies like NVIDIA and what they're seeing, because really we don't have the big banks reporting until mid-July. So when you're thinking about some of these catalysts, obviously though, we have the Russell reconstitution at the end of this week. So even though we are in the doldrums of the summer, right, David, I still feel like potentially some
moments
people are
of
looking
excitement away. You know, it's funny, you know, talking to my sources as well about NVIDIA, this is a company that has been the focus of so much attention, sort of is analogous with AI and all the excitement and exuberance perhaps surrounding it. There is this sense of sort of
at 2:10 p.m. Eastern Time, we expect comments from Fed's Bowman, who gives pre-recorded opening remarks at the Midwest Cyber Workshop. Text is expected, but no Q&A.
In recent days, the fact that it didn't sag as much as NVIDIA did is a good sign. We should say that it's not as perhaps narrowly held as we thought it might be.
That's right, because everybody to nauseum, especially since last summer to now, because we were talking about the first half of last year and the outperformance when it came to some of these big tech names, and then people were questioning a year ago, how much longer could this continue? Obviously, we've written a lot on my team, on the equities team, about the divergence when it comes to breadth for like the equal weight index for the S&P 500 versus the broader one, but you are starting to see that move out to more of the equal weight, as well as the Dow on certain days that have outperformed. But again, if you're looking at small caps, I mean, right now it's actually on pace, if you're looking at the Russell 2000, for its worst half relative to the S&P 500 in history. We'll see if that can hold through Friday's close, because that's the last day of the second quarter in the first half. But still, Gina Martin Adams actually and her team over at Bloomberg Intelligence, they've written a lot about this, and they're still kind of wondering, because the reconstitution we were just talking about with the Russell indexes later this week, you're not going to have super micro, obviously, in say the Russell 2000 will graduate to the Russell 1000. You also have some other companies as well, and so when you take some of those out, actually year to date, the Russell would be actually down about 4% according to Gina, versus kind of relatively flat right now. So kind of questioning, you're looking at her data where they see multiples potentially going, but obviously that ties into the Fed and the trajectory of rate cuts and what it means for its balance sheet run-up.
David Gura here with Jess Menton, filling in for Carol Master and Tim Stanovic, who are at the Bloomberg Invest Conference. We're paying close attention to that, as Jess mentioned just a moment ago. Gary Gensler, the chair of the Securities and Exchange Commission, scheduled to speak with Anne-Marie Horton, of course, the co-anchor of Bloomberg Surveillance, in just a few minutes, and we'll bring you that conversation as soon as it starts. I'm curious what your hoping to hear from him or wanting to hear from him. We had this big movement, I guess, just about a month ago now to this T+1 settlement in stocks. And Gary Gensler is somebody who is, I guess, both reviled and beloved for his tack when it comes to crypto. We are still waiting to see what the timeline might be for kind of an ETH, sort of different kind of securitization of that coming forward. So he's somebody who's been so integrally involved, has really focused on crypto, has focused on these new assets, and has certainly tried to make his mark on the SEC in the same fashion in which he made it on the CFTC when he was in the Obama administration.
That's right. Well, especially thinking about, to your point, David, when you think about some of the top priorities here, and especially in the second half of the year that Anne-Marie Horton is going to be speaking with him about, but then also how he's sort of staying the course despite, when you think about, to your point as well, the disapproval from a lot of different industry critics. So you're going to have those regulation questions ongoing, of course, when it comes to Bitcoin, crypto, all of the things, all of the above, and then, other things when it comes to that regulation. And then, of course, we do have a U.S. presidential election coming less than 5 months away. So I'm sure Anne-Marie will have questions about that toward Gary Gensler as well.
Gary Gensler, who has spent most of his career in the public sector, as I mentioned, ran the Commodity Futures Trading Commission in the previous administration, now at the SEC, rumored to be somebody that, should President Biden win a second term, might be considered to be Treasury Secretary as well. So there are questions to ask. We'll see what kind of answers Anne-Marie can elicit from Gary Gensler, who is kind of notoriously close-lipped on a lot of this and has often said he's happy in the job that he's in now, but should be a fascinating conversation and a wide-ranging one, again, at this conference that's happening today. We got this new read on consumer confidence this morning, showing kind of more muted outlook for businesses based on the job market and incomes. And we're seeing this economy sort of struggle so much as it is under the weight of what the Federal Reserve has been doing here. This the latest indication of sort of how people are feeling about this economy. And you bring up the presidential election. I'm headed down to Atlanta in a couple of days for that debate between Joe Biden and Donald Trump. This is still such a fascinating facet of all of this. You look at kind of the harder data.
Shortly expecting comments from Fed's Bowman.
The Federal Reserve, but there is this, I won't say a yawning gap, but a sort of a gap of some size between how people are feeling about the economy, a lot of people are feeling about the economy, and what the data are telling us.
That's right. And of course, the GDP numbers tend to be backward looking, as we know. And so we saw that just above 1% for the first quarter there. But if you look at the Atlanta Fed GDP Now model, it's actually hovering around 3%. Of course, we're going to continue to get data through this as the second quarter rolls on. But that's something else to keep an eye on because growth is still strong, David.
A couple of Fed speakers today as well. We were paying attention to what they had to say. Michelle Bowman, the Fed governor, Lisa Cook as well, talking about their timetable, their expectation for rate cuts. Of course, the parlor game continues here. Expectations for one at the next meeting, quite low. Both of them saying essentially that they don't feel like when they look at that
Fed's Bowman doesn't comment on the rate outlook in the prepared text.
Enough confidence that they could go ahead here and cut rates perhaps as soon as the market might want.
All right, well, now we're going to toss over to SEC Chair Gary Gensler, who's going to be joining Bloomberg Surveillance co-host Anne-Marie Horton right now on Bloomberg Television.
Thank you so much for being here. Thank you, SEC Chair Gary Gensler, for joining Bloomberg. We're so excited to have you. I want to start with the uphill battle, some would say, you faced at the helm of the SEC in terms of you have this very ambitious agenda, one of the most ambitious we've seen at the SEC in years, but it's faced a lot of legal troubles, pushback from Wall Street, corporate America. A stat here, as I have, is your rules are facing a record number of court challenges. So given that backdrop and the legal hurdles you faced, how would you grade this SEC? Is it an A for effort, or would you say it's a bit more?
Look, Anne-Marie, I'm proud to be in this role. It's a privilege every day to fight on behalf of Americans, investors, and issuers. And it's really that. It's like William O. Douglas, our third chair, and he went on to be on the Supreme Court, said we're the investor's advocate. But we also look out for people raising money, the issuers. The folks in the middle, some of whom are in this room, the broker-dealers, the stock exchanges, the investment advisors, and so forth, ultimately, the investors and issuers are their customers, and we are trying to update the rules for the 2020s. Now, we put out an agenda of about 50, 55 items to do. By the way, my predecessor, Jay Clayton, did 64. But we have already finalized and implemented really consequential rules, like in the last couple of weeks, implemented shortening the settlement cycle in half to 1 day from 2 days. That means if an investor sells their stock on a Monday, they get their cash Tuesday. They don't have to wait till Wednesday. But we also did a lot around corporate governance, how insiders sell their stock in the market and some important rules there to restrict the use of non-public information, or even settling down some challenges that we had with China, and China being in our markets. And in the cyber world, that public companies have to report material cyber events, but also we just finalized a rule that all of us in this room, if our information at a broker-dealer or investment advisor gets hacked, they have to give us a notice on that. I mean, these are things that are consequential that we've been able to been successful. So I think it's a great agency, and we continue basically fighting on behalf of the American investor and American issuer.
So the most recent rebuke, though, came from the Fifth Court, which I think you know about, of course. Your attempt to regulate private equity funds and also protect private investors like pension funds. This is what the panel had to say from the court. Quote, it exceeded the statutory authority by adopting the rule. So now what's your next move? What's your response to this?
Well, one is we do everything within the law and how courts interpret the law. We're still assessing and looking at that ruling out of the Fifth Circuit down in Texas and Louisiana and Mississippi. And so we're still assessing that as a commission. But at its core, what we were really saying there was investors in private funds, which has grown to $30 trillion in assets under management. Investors in those funds, the limited partners, would get quarterly disclosures about their fees, performance, and arrangements with others, so-called side letters. And it was under authority that was put into law under Dodd-Frank. The court had a different view of that new authority, but we're still assessing what to do. But we do everything, again, Anne-Marie, within what the law is and how courts interpret it. And if need be, we pivot.
What are the risks to the financial system, say, that this doesn't happen and you're blocked for good?
At the core, what we were seeking to achieve as a commission was greater transparency to investors, not to the public, but to the investors in these funds. And who's behind those investors? Those endowment funds, those pension funds. They're the teachers, they're the firefighters in every single state in the US. They're the universities' endowments that are investing in these funds. And so it was really about greater transparency, instilling greater competition in an important part of the capital markets.
This came from the Fifth Circuit. You mentioned Texas. A lot of these rebukes that are coming to the SEC are going through.
And to other agencies.
Right.
Across the administrative state, you're seeing more filings and in a couple of maybe leading in certain circuits.
Yeah, so what's your response to that? That a lot of this is happening through Texas, Louisiana. Does it feel political to you?
Well, we respond in whatever court we're in, and I deeply believe in our democracy. Parties have a right to go into court. We're a law enforcement agency. We bring 700 or 800 law enforcement actions a year. Many of them settled, but some of them that go into court. And we really respect the courts and follow what they say.
We also have frozen right now the emissions disclosures, because that's also facing a ton of lawsuits. So the SEC decided to freeze them. What happens if they become unfrozen? How quickly do companies need to disclose these kind of emissions?
Just a little background. We're a disclosure agency. We're a securities agency, and what President Roosevelt pulled together with Congress 90 years ago, we just had our 90th birthday. It was kind of cool. And what they pulled together is that investors get to decide on what investments they want, and that we, the SEC, are merit neutral. Further, we are not a climate regulator. We are not an environmental regulator. We're not an ESG regulator. We're a securities regulator. But what we found when I came into office, many investors are investing in companies based on their climate risk disclosures. And of the top 1,000 market cap companies, the so-called Russell 1000, 90% already are making disclosures around climate risk, and nearly 60% are already making some disclosures around greenhouse gas emissions, that what you asked. Therein, I think we had a role And what we finalized the rule to say, if material, it's only if material, investors would need to make those disclosures to their investors because the investors are already making decisions on it. But you're right, it's front of a court. I'm not going to get ahead of our really terrific lawyers who will have a chance to lay out that in front of a court.
I guess the question I have is, will there be a timeline that companies will know that they need to start disclosing this? How quickly can you move with the rules once it's out of the courts?
Anne-Marie, it's a good question. Of course, it relates to what a court tells us. We laid out a set of it's called implementation timeline over a course of several years, depending upon what the court says. We did stay the rule, so that means it's stayed. But once we hear from the courts, I think you've got a good question.
So another place that you've been trying to tighten the rules.
Sorry if we didn't make news there.
Yeah, so it's okay. Maybe here we can. I know a lot of people are interested in this. There's a lot of messages when you tweeted that you were going to be doing this conference, a lot of messages from the crypto community. This is a place that you've tried to also tighten the rules.
$120 trillion capital markets, and lo and behold, I made it 6 minutes and 15 seconds, and now you bring up crypto.
Well, there's some other, other legal challenges.
I know it gets views, it gets clicks for Bloomberg.
Well, people are interested in this, and actually it's becoming a political issue. So, but I first want to talk about how do you reconcile broadly going after some of the issues in the industry, but at the same time as approving things like the Bitcoin ETF and potentially the Ethereum ETF.
So in terms of these exchange-traded products, any investor can express themselves and purchase Bitcoin, for instance. And when I came to the agency in 21, actually there were some filings around mutual funds, and they ultimately led to Bitcoin futures exchange-traded funds. Those have been around for 3 years. The courts ruled around something called spot exchange-traded products. I know it's kind of technical, but ruled that we should be consistent. We pivoted. We approved those in January. I would say this, what the investing public has now is an exchange-traded product on regulated stock exchanges. Now let me compare that to how people generally buy crypto. They're buying it or selling it often on non-compliant platforms. Why do I say non-compliant? These platforms also include significant number of tokens, and without prejudging any one of them, many of them are securities because it's the law of the land. We follow the Supreme Court's law of the land regarding this. There's 15 to 20,000 various tokens, and they're offered in investment contracts, schemes that are investment contracts. And you look at it, the American public is not getting the proper disclosure that they are required to get by law, but they need. We're merit neutral, but you all, if you're investing, if you're listening to the public, you're not getting the disclosure that you're supposed to get. And the intermediaries in the middle of the market, those so-called exchanges or broker-dealers and so forth, if they've got hundreds of offerings on that platform, think about it. How many of those offerings don't have some group of entrepreneurs in the middle? It just sort of belies logic. The result, this is a field that the leading lights from a couple years ago are either in jail, about to go to jail, or waiting extradition. Think about it. This is that field. That's the field right now where the public has really been harmed. And there's significant non-compliance in the field. And so, yes, we're bringing that in front of courts, and those will play out because folks that are not complying with the law hurt the American public.
But still, you're approving ETFs, and the one I think there's a lot of excitement around is this Ethereum ETF because we could potentially see it very soon. Will we see it?
There are actually, just so I can help you out, there, as of last year, was already an Ethereum exchange-traded fund based on Ethereum futures. Ethereum futures have been trading on the Chicago Mercantile Exchange for 3 or 4 years. We actually went live last year, an Ethereum futures ETF. But yes, we had filings around cash Ethereum exchange-traded products. Again, I apologize to be that technical, but these already exist in some form, but we approved those filings. What is in front of us, and it's done at a staff level, is what's called the registration statements, the disclosure statements. And again, these disclosures are really important. They're important to investors making investment decisions.
Will we see that in the next few weeks?
I don't know the timing, but it's going smoothly. You can almost follow it publicly. You see these filings. Bloomberg then reports on them. You get more clicks.
Do you think we'll see it before the election?
I'm not trying to determine what the staff is doing, but it's going smoothly, and I just envision it will at a staff level and smoothly play out. And it's really about the asset managers making the full disclosure so that those registration statements can go effective, and those lawyers know what that is. It's something our Division of Corporation Finance handles hundreds or if not thousands of times over anybody's career. It's smoothly functioning. It's really up to the asset managers to make the proper disclosures.
Back to some of the crypto companies, though. A lot of them have moved abroad to places like London and Singapore. So in that sense, do you think that investors are actually safe? Because they're still innovating, and they're still out there in the marketplace. They're just not in the United States.
To the extent that they're operating within the basic protections of providing the full disclosure, what Roosevelt called complete disclosure. He called the
SEC's Gensler says the process to spot Ether ETF approval is going smoothly.
And they're making the disclosures and properly registered. And then if the intermediaries are operating within the law without the conflicts, and look, so much of this field is highly centralized. It's not decentralized. That's not what's happening here. It's highly centralized around a few platforms that are also centralizing and commingling things that we would never allow anywhere else. And we don't. The law doesn't allow you to be trading against your customers and operating a so-called exchange and trading in front and possibly also taking investments in a investment contract or security and then listing and getting the listing pop. I mean, happening potentially at these. And again, we see some of the leading, 2 years ago that would have filled a room much bigger than this if they were sitting on this stage, are now sitting in jail or awaiting jail.
Part of the reason why also...
I say this and you giggle, but this is a serious thing. These are a lot of folks that are not living within our securities laws, but they're not necessarily living within our Bank Secrecy Act around anti-money laundering. And they're not necessarily living within the Commodity Exchange Act. Like, this is a field that's sort of built up on a business model that it's a non-compliant model. And it's not ticky-tacky. It's about real protections for investors and for other people that want to access the capital markets. It's about trust in those capital markets.
As you know...
Have I been clear?
Yeah, you're being very clear. As you know, crypto, though, is becoming almost an election issue. There's reports that former President Trump is going to speak at this big Bitcoin conference. He said that he will end, quote, Joe Biden's war on crypto. And there's one more. It's become such a big deal that Mark Cuban has actually said that you, Mr. Gensler, could, quote, literally cost Joe Biden the election. What's your response to this?
I'm going to be easy with you, Anne-Marie. I don't speak about elections.
You don't have a response to Mr. Cuban?
I just really, look, my role as a securities regulator, as chair of this great 5,000-person agency that oversees $120 trillion capital markets, we are here to look out for investors, look out for issuers, and where appropriate, to be a cop on the beat. And we have a set of rules that are pretty clear. There's nothing inconsistent about crypto securities and the securities laws. Unfortunately, there's a number of people that are non-compliant with the laws.
Let me ask it a different way. Are you surprised by the political movement we've seen around crypto?
Again, I mean, I'm a securities regulator. I'm focused every day on that part of my job, which is protecting the investors, looking out for issuers, access to markets, fair, orderly, and efficient markets. And with all respect, I hope your listeners understand that's my role. Other people can speak about elections.
So the election is coming up, though, and although your term...
Anne-Marie,
although your term
take three.
Although your term goes beyond November 5th, is there something you want to get done? Do you feel like you're up against the clock to get something done before the presidential election?
Look, it's such a privilege to be in this role. I really mean it. I can't believe I'm serving my third president and been through Senate confirmation 6 times and all this. I just can't believe that. And every day, I think, is a privilege to help the American public. Our clients, 330 million Americans. It's about chasing down insider trading. It's about making sure that there's the proper disclosures. It's about implementing. We still have some significant things. We just implemented this big transition to having the clearance, the settlement cycle to 1 day. But we're also working on the implementation of our Treasury clearing rules. And our $27 trillion Treasury market is way too jittery. It has fragility and jitters in it every couple of years. And settling that down and sort of implementing that set of rules. But yes, there are still some rules that we proposed and we have not yet adopted that we're working on, but we're not doing it against a clock. We are basically trying to promote these markets, enhance these markets on behalf of the American public. And if I've honored to serve through my term, which is through 26, great. If it's earlier, that's democracy. Democracy in action. And I deeply believe in it. But we're going to do everything we can for the American public.
I guess what you're insinuating there is that if we were to see a Trump 2.0, you likely would potentially be out of a job. Election or not, timelines or not, what is your #1 priority at this moment?
It's my #1 priority is the American public. That's the client. And so that's who we represent. It's, of course, implementing some of the rules that we've already adopted. It's considering the public feedback on the rules we propose and not adopted, but not against a clock. It's your clock. It's like,
Well, it might
you kind of run the field as well as you can run the field. And when the ref calls the clock, you see where you are. I just with all respect. And of course, it's also being a cop on the beat. You know, half of our agency is examination and enforcement. Another 10 or 15% of our workforce reviews all these disclosure filings and gives feedback to the issuing public. And it's doing that well.
SEC Chairman Gary Gensler, thank you so much for your time.
Thanks, Anne-Marie.
That was Bloomberg's Anne-Marie Horton interviewing SEC Chair
NYMEX
Gary
diesel
Gensler
July
at
futures
Bloomberg
settle at
Invest.
$2.50 a gallon.
David Gura in the Bloomberg Interactive Broker Studio, but I feel like Gary
NYMEX
Gensler
gasoline
really
July
tried to avoid
futures
as best
settle
as
at
he could the
$2.51 a gallon. NYMEX WTI crude August futures settle at $80.83 a barrel. And NYMEX natural gas July futures settle at $2.75.
That election, he said a couple of times, I don't speak on elections, but as we expected, a wide-ranging interview that she gave, and he did talk about Bitcoin ETFs and spot exchange-traded products, noting that the SEC pivoted on those, did approve them back in January. Something we're all curious about is the timeline for these spot Ether ETFs. no real clarity from him on that
Right.
front either. But that and sort of emissions disclosures, ongoing legal matters, there's a lot for him to talk about, and they did cover a lot.
That's right. And he did say as a regulatory body that the SEC is trying to seek greater transparency. He did say, though, that the SEC is assessing its Fifth Circuit hedge fund regulation ruling there. But we'll have more coming up soon. But first, let's get a business flash here with Charlie Pellet.
Hi, thank you very much, Jess Minton. Here's what's going on. We've got the Dow lower right now, but the S&P 500 index, yes, best level of the day right now, up 20 points, 54.68 on the S&P. That's an advance right now of 0.4%. Dow Industrials trading lower by 0.7%, down 261 points, down 261 on the Dow. NASDAQ up 216, up by 1.2%. 10-year 4.23% with a 2-year 4.73%. Gold down 0.6%, 23.19 the ounce, and West Texas Intermediate crude down 0.9%, 80.84 for a barrel of WTI. Cannot ignore the move in Bitcoin today, up 4% right now, 61,860 on Bitcoin. Carnival Corp has raised its full-year earnings outlook after strong demand for cruises helped it post a surprise profit last quarter. Today, we've got Carnival shares up 8.4%, rival Royal Caribbean up 4.3%, and shares of Norwegian Cruise Line Holdings up 5.6%. NVIDIA up 5.8%, FedEx after the close of trading. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Jess Minton and David Gura here in for Tim and Carol, who are at the Bloomberg Invest Conference at this hour. But one of the most read stories on the Bloomberg terminal today, David, is about how Paul Singer, he's pitching a Wall Street's own brand of MAGA. I'm sure you caught this as well, but one of the most read here on the terminal today.
Yeah, Simone Foxman, one of the reporters who reported out that piece about the money that Paul Singer, has poured into the Manhattan Institute, and Simone joins us now. For those who aren't acquainted with this think tank, which has been around for a few decades now, what's it been historically, and sort of what has Paul Singer wanted it to be and indeed helped it be through pouring really millions of dollars into it over these last few years?
I mean, it's traditionally been a free market, free ideas kind of think tank. They have a very influential publication. It used to be actual magazine, City Journal, that they've always had some diversity of opinion in. And this was sort of a sleepier organization until relatively recently, until certainly the last 5 years, but I think we can go back even a little bit farther until the last decade or so, under which Paul Singer has been chairman. They've been particularly active in trying to get legislation that they author passed, trying to get it in front of particularly state lawmakers, because they think that they have a little bit of an in there. And specifically, they've been extraordinarily successful at that for anti-DEI legislation.
Who are these wealthy donors that y'all worried about?
Well, so Paul Singer is a key one, but this is actually a group of donors that includes a lot of Wall Street. Cliff Asness, who's coming up at Bloomberg Invest. Dan Loeb. Recently, it has included new trustees like Betsy DeVos, Bill Barr, Rebecca Mercer is a past trustee, John Paulson, who hosted that fundraiser for Trump, also a noted hedge fund manager or former hedge fund manager. He's one of the most significant donors in the last couple of years. And, I spoke with Raihan Salam, the president of Manhattan Institute, at length, and he says, these donors, they don't necessarily want payback for a specific policy. They're not coming in and saying, well, give me lower taxes, and that's what I'm paying you to do. And this is a nonprofit organization. That said, the whole goal here is we're going to give people actionable policy ideas, and we want to see them instituted, not in some long, lengthy, distant future, but as soon as possible.
You point out this delicious irony in the piece that you have these state legislatures, many states across the country, who are passing this anti-DEI legislation on other issues as well, and it's almost like they're photocopied. I mean, the language is eerily similar in each of these many states. Anyway, the delicious irony is this is being cooked up and put together in Manhattan, of all places, where, of course, Democrats greatly outnumber Republicans. How does that mechanism work, and did you get any insight just into that strategy? We can talk maybe in a few minutes just about sort of the degree to which this think tank is sort of solidly behind former President Trump or not, but How do the mechanics of it work? How have they been so successful kind of pursuing this grassroots strategy?
Yeah, and I should note model legislation, as it's called, is something that's been pursued both on the right and the left. Essentially, you have think tanks, you have commentators. Sometimes you even have legislators, though not in Manhattan Institute's case specifically. They sit down, they say, I really think that we could have a good policy for this particular issue, and they'll do a lot of the hard work, and then they'll go out and send this to various legislators or groups across the country. That is essentially what's happened here. Specifically, when we talk about the anti-DEI model legislation that's been so successful, that has included noted conservative commentator Christopher Rufo, Ilya Shapiro, also a conservative commentator. Both of these people are pretty well known in right-wing circles, certainly like center-right, but definitely right-wing as well. And so they are the ones who authored this specific piece of legislation. But I should mention that MI has plenty of other legislation, whether it's on the energy transition, restricting subsidies to EVs, solar, wind, et cetera, what you should teach about gender in K-12 education, how you should handle immigration, who gets to come into the country. So there's a lot. This is only the beginning. They've been really successful at this thing, and they're going to try and do some other stuff too.
You also worked on this story with Emily Beerbaum and then also Jeff Green, and then y'all write about how, especially for Singer, that was just necessarily the beginning. So I'm wondering what else is to come in his view.
Well, what's amazing about this organization is they've publicized years and years of their events. So you have to go sit there and listen through them for, I think the count was like 14 or 15 hours.
You did the hard work.
I heard a lot of Paul Singer.
Yes.
But at one point, he in 2020, he compared what he wants to do with, especially one program of the organization, the Adam Smith Society, to the Federalist Society, which has been incredibly successful at getting conservative judges on the court. And he said he wanted to create the Adam Smith Society at business schools that would function in a similar way, and really made that comparison. I think that's fair to say. That's the kind of comparison, that's the kind of influence he really wants to generate with this sort of organization.
I said I'd come back to this, and that is, how much is this think tank kind of solidly behind Donald Trump? And maybe you can kind of situate this in this larger moment, because you had Steve Schwarzman throwing his support behind the former president in this campaign. That kind of opened the dam a little bit to other big, prominent Wall Street figures throwing their support behind Donald Trump. How does this work as a mechanism for that? We know that Paul Singer is Paul Singer and has espoused these political beliefs for a long while and supports the former president. How much is it solidly a Trump-focused think tank?
Well, Singer for himself, he was in support of Nikki Haley, and at the last time I looked, he had not donated specifically.
Brent crude futures settle at $85.01 a barrel. That's down $1 or 1.16%.
$1 million for his inauguration. So that, I think, is a way that a lot of these donors jumped behind DeSantis. They jumped behind Nikki Haley, was a popular one. So they don't love Trump, but I think there is here an understanding that they have an ability to be influential under a Trump administration, a knowledge that they have built those bridges, whether it's John Paulson, who may end up Treasury Secretary. They had Scott Bessent, another hedge fund manager, at one of their recent events speaking. There's clearly an attempt to curry influence because they believe they will be receptive. These are not the MAGA guys in the sense that these are not sort of middle of the country, rural, poor white Americans. These are hedge fund guys, free market, not neo-populists. But they still believe that they have this line to the Trump world.
Right. Of course, we have that presidential debate that's going to be Thursday evening. What do you think we need to be focused on here as far as through the lens of what you were writing about?
Well, I mean, we write a lot about diversity and race in America because a lot's changed in the last years since the murder of George Floyd. I think culture war issues, like the ones that Manhattan Institute has been looking at, are incredibly divisive. And so even though people say, they're going to vote on the economy, or they're going to vote on, how they feel about the price of groceries, say, I think a lot of what may ultimately drive this election is these culture war things. Is abortion, for one, which is not really addressed by Manhattan Institute, but for which there's a lot of political money, but also things like wokeism, DEI, feelings about race, feelings about immigration. You know, these are issues that I think really do matter to a lot of people. So it's important to understand where the money that behind these ideas is coming from, both on the right and the left.
This is Bloomberg Business Week. David Guerrero with Jess Menton in for Tim Stenovic and Carol Masser, who are at Bloomberg Invest, and we're going to turn to them in just a few minutes as the show continues. Simone Foxman with us talking about her piece, which, as Jess mentioned, is one of the most read on the terminal today. And Simone, you mentioned you spoke with Reihan Salam, who's the president of the Manhattan Institute and has been there for many years. What did he say about the degree to which these donors, including Paul Singer, have a direct effect on the policy agenda or what scholars and fellows there are pursuing? How much can they influence or shape the direction of this particular think tank?
Look, Reihan talked to me about how there's a degree of academic freedom among the fellows, and that everyone should be free to write whatever they want. And frankly, I spoke to people who were current and former employees, and they disputed that characterization, that there is a desire to kind of color within the lines. And even in the past, one fellow, according to an email we obtained, had complained that or had said that Paul Singer had complained about an article they wrote on gun control, and that person had been asked not to write for outside publications anymore. Now, they returned to write for outside publications. Ultimately, it's a little unclear whether that continues into the Reihan era, which started in 2019. But it's clear, and donors themselves told me, trustees are extremely active. They feel like they really do have a voice in shaping the way the organization goes. Some of it's self-selecting. You know, the degree to which it comes from the top, there's policy directives. Certainly there's some influence there. The extent to which I think is probably disputes based on exactly who you're talking to and how happy they are exactly with some of the ideas that are promulgated.
It's interesting because from a stock market perspective, usually it's gridlock in Congress is what traders typically look for rather than just who's going to hold the presidency, because if there's gridlock, then it's harder for different regulations to swing either way. If you think about energy or big tech or healthcare kind of regulation, I'm wondering, when you're speaking with your sources, what are they saying from that kind of point of view beyond even the presidency, but what they're expecting if you're thinking about the House or the Senate?
I mean, I think there's a lot of uncertainty going into this election. I think that a lot of Wall Street remembers the lower tax legislation that Trump put in place. Certainly, that's not something that can pass if you have an incredibly divided House and Senate. I think that low tax, light regulation has been a real appeal for Wall Street, which is surprising considering the way stocks and markets have broadly performed under the Biden administration. That said, I think they would like to see some of those tax policies continue. And they think they can control. I think this is the message. They think that there is an ability to control Trump, to rein in some of his wildest urges. Not to leave NATO, not to do something wild that would throw the country in uproar. I don't know if that's true, and it's not my, again, as a journalist, we try and be objective here. They seem to believe this strongly. Say the critics on the left say, no, they can't. Who's to listen to Wall Street anyway? Why was Middle America listen to wealthy people on Wall Street in this political climate?
Fascinating piece, and fascinating
really
too when you just think about sort of the vacuum that this has filled. I mean, we think of traditional conservative think tanks, be that the Hoover Institution or the Heritage Foundation in D.C., and this, I won't say exploiting, but filling this vacuum that's been filled by this new brand of conservatism, certainly in the wake of and perhaps in advance of another Trump administration. Simone Foxman, thank you very much. It's a great piece.
Thanks for having me on.
Right, taking a check here and looking at the markets, the S&P 500 up about 0.4%, the NASDAQ 100 up more than 1%. So, of course, David and I were talking about earlier with NVIDIA being the biggest point contributor, up about 20 points today, of course, more than 5% after pulling back in recent sessions there. So when you're looking at that, still broadening out if you're seeing some improvement there in some of the equal weight indexes, David.
Yeah, absolutely. And I think that'll continue to be the focus as it has been this week, just on NVIDIA and what sent that stock sagging over the these last couple of days, the rebound that we're seeing today. We talk about AI today. We've been talking about AI for many months and longer than a year now. But NVIDIA is certainly like the lodestar and what people are looking to as an exemplar of that. David Gurr was just mentioned here in New York as we await the next interview at the Bloomberg Invest Conference, which Shonali Basak, our colleague, has put together with some of the biggest names on Wall Street. Cliff Asness, who we were speaking about just a moment ago of AQR, scheduled to speak with her about his trading strategy, the difficulties that he's facing.
Where he's seeing potential frothiness and where he's not seeing frothiness. So that'll be important to watch there. And then not even just the big AI names, but sometimes there's other players too. If you look at utilities, particularly the data center subcomponent there, those have really taken off this year just because that is also part of an AI story. So you are seeing those kind of income-driven places as well. So now we're going to go to Cliff Asness, who's AQR Capital CIO with Bloomberg News Global Finance correspondent Shonali Basak at Bloomberg Invest on Bloomberg Television.
This part of the program, has the market gone awry? And in addition to, of course, being a high-flying hedge fund in Greenwich, Connecticut, you're known at AQR for being quite nerdy, let's say. You are very much coming out of the school of...
Not just at AQR, since middle school.
So let's put it this way. Out of the School of University of Chicago, under Eugene Fama, studying efficient market theory, the question is, do you think the markets are still efficient?
I took Gene's class, and then I was the teaching assistant for 2 years. And I was terrified to get something wrong, so I sat through it for 3 years. About the third week of class, he looks and he tells the students, the market is almost certainly not perfectly efficient. And you get a big gasp. Now, only at the University of Chicago and only Gene's class do you get a gasp with that. Everywhere else in the world, people either go, yeah, we know markets aren't perfectly efficient, or they have no idea what you're talking about, which is often quite common. What he meant, he's an honest guy. He believes they're more efficient probably than I do now, but perfect efficiency is silly. Nothing is perfect. The question becomes, how efficient are they? I think it's fair to say someone like Gene thinks they're pretty darn efficient. Efficient is this idea that prices are accurately reflecting fundamentals. You can get really geeky on how to define that, but let's just be colloquial. I do have a view, it's not a short-term view, it's not a market call, that, again, markets are never perfectly efficient, but over my career, which is annoyingly about 32 years now, I guess the opposite would be even more annoying, but it's a long time. I'm a little obsessed these days with those internet memes of when they show you like an actor like Ed Asner and Mary Tyler Moore was 10 years younger than me when he did the role. It's very upsetting. But over my career, I actually think markets have gotten somewhat less efficient, meaning prices are a little bit more disconnected from reality. It ebbs and flows. It's never the same at each point in time. But I find that an odd view because one tends to think, as technology in particular advances, that things should march towards better, with better, I think, being efficiency in this case. And I actually think maybe I'm biased by having a front row seat, but I think over the last 30 or so years, I'd say the market is somewhat less efficient than when I started.
So why do you say that is? What is causing it to be that way?
It's, well, first I start out by just observing a few facts. And I am, of course, biased by what I've lived through, but I loved Gina's presentation. The dot-com bubble stuff was bringing, PTSD-like memories for me. We try to very formally measure how disconnected from reality or not, or how reasonable are stock prices. In particular, not the price of the whole market, but within the stock market, are cheap versus expensive stocks. You could define that very narrowly in a quant sense in terms of just multiples. You could define it more broadly in terms of a Graham and Dodd sense. Yeah, you want to pay a low multiple, but what's the quality of the stock? What's the risk of the stock? But either way, measured very formally, the dot-com bubble saw by far the largest disparity between cheap and expensive we had ever seen in about 50 years of data. We survived that. It was a little ugly for a while, but we actually thrived through it if you take the whole round trip. But when you almost die in the first half, you tend to remember that. If you had asked me in, say, 2002, when all of that excess was pretty much worked off, are you going to see something more extreme than that in your career? I think I'm smart enough, even back then, to never say never. We don't live in a business where any of us should say never. It's a dangerous word. But I think I would have said it's highly unlikely. That was the craziest thing we had seen in 50 years. I would have said, well, in 20 years, people like me will still be around, I hope, who with some memory. It's not 100 years where everyone is forgotten. And then pre-COVID, it was close. And then after COVID hitting, we saw things measured very similarly. Price multiples, or even price multiples scaled by quality, to go to levels well beyond the tech bubble and lasting about doubly as long as the tech bubble. If you ever have the misfortune to have an investment that ever goes down for any amount of time, you will learn something that they don't teach you in a PhD program. Severity is bad, but duration is underrated when it comes to pain. 3 years of pain, even if it's cumulatively not worse than a year and a half of pain, is a ton worse. The first year you go back to your clients and go, we think we're right, look what's going on here. And they go, okay, okay. The second year they're like, that's the same thing you said a year ago. And you go, yeah, but it's still going on and we're still going to be right. The third year, I mean, your mom's still invested, but it's getting tougher. So duration counts. So we've seen both the severity and the duration of those. So I start out just observing facts. And then trying to fill in why. Admittedly, this is a lot of op-ed. This is very hard to prove. And I love to, I'm a card-carrying quant. I love to, produce tables. I can show you these spreads, but why? And I tend to have, I think it's a multitude of things. I think the number one thing is probably the thing we all love to blame, the internet and social media. I think a lot of people naturally assume such a thing would bring us information so quickly and so ubiquitously, knowing everything, that prices would be very efficient. But that's never been the hard part. When I started in this industry, we got earnings within 20 minutes. The difference between 20 minutes and a nanosecond matters to an HFT. It doesn't matter to almost every other investor. We didn't really materially get more. And I do think that level of information overload gives people a lot of illusion of control. I don't want to go into this deeply because I know you'd like to get me going on this, but I think the meme stock examples, I don't think they're the norm by any means, but I think they're the ultimate example of a little bit of information making you think you really know something very deeply, and I think that gets into market prices.
I'll be careful to keep this a little reined in, but on the meme stock issue.
I knew I'd get that started.
How much are the retail traders that are bidding up prices of stocks like GameStop contributing to this idea that markets are less efficient to you?
I think they are a very small part in dollars. They may be poster children in some sense for the effect. The whole idea that this disconnect in prices can come in a world where we have all the information at our fingertips. I think we're all raised, at some point we've all read about the, quote, wisdom of crowds, the way, if you take a crowd that on average people have 51% information, but you poll them, hope many of us here are old enough to remember Regis Philbin and Who Wants to Be a Millionaire? The absolute best lifeline was always poll the crowd, right? Because if they asked a question, what does it say on the back of a quarter? 85% of the people don't know. But they're evenly split. And the 15% who do know all go one way. But there was always a little unspoken footnote to the wisdom of crowds. To have a wise crowd, it's got to be fairly independent. If everyone got to talk about the quarter, not look at a quarter, that's cheating, but talk about it, the people who are wrong convince the people who are right and whatnot. A crowd where everyone is coordinated and not independent has the risk of becoming a dangerous mob. And I don't know about you guys, but I can't think of anything better at turning a wise, independent crowd into a dangerous mob than the internet and social media. So I do think they're kind of the poster child. I don't think economically they are that important. I don't want to disparage either side of it, but it's $9 in terms of, You know, NVIDIA laughs at that on a daily basis. The entire meme stock phenomenon is like a little part of a day of NVIDIA. But I think it is a poster child for the concept I'm talking about. There are other candidates. People talk about the role of passive. That's really complicated. I'm not one who just looks at passive and goes, that's causing all kinds of havoc.
What is it causing?
Okay, I'll disappoint you here. People, I don't think we really quite know yet. First of all, here are the things we know about passive. Not everyone can be passive. The whole world breaks down. Even back when I was a PhD student, so this is the early 90s, this is what happens when PhD students in finance get drunk late at night. They sit around going, what if everybody tried to be passive? And that's a black hole. That's a singularity in finance. Nobody's looking at individual stocks. And that just can't work. Passive is a free rider on active managers, making sure prices are somewhat reasonable. But the question of how many people can be passive, nobody really knows.
Do you think it's contributing to inefficiency? And is efficiency, frankly, another way of saying wild swings in markets?
I would guess yes, but I think it's pretty small versus the social media, the illusion of control, the data overload things I'm talking about. It's not clear theoretically. Imagine you had a world where you had a certain amount of passive and active, and suddenly a lot of active moved to passive. Whether active is now easier or harder, whether it's more or less efficient, depends on who moved. And let me be really obnoxious and go, there were sharks and minnows. There were people who were good at it and people who were bad. If all the minnows move, markets get really efficient because sharks are trading with sharks. They all are pretty good at valuing these things. And the sharks don't make a lot of money. We don't really know who moved. My reasoning here is really just correlation, not causation. This has occurred at the same time that massive price disparities have grown and lasted longer. So as a pure guess, I would have to go, it's probably contributed something. It's very hard to assign. Another one is, you know, I'm probably the billionth person to mention this, but over the same period, we've had 10 years prior to a couple of years ago of ultra low nominal and real interest rates. I am not a person who thinks that means growth stocks should go to the moon. I've written papers on the math of that's kind of wrong. They're not actually that much longer duration. But the market disagrees with me. The market thinks when interest rates fall, growth stocks should go to the moon. And so ultra low interest rates have probably contributed to a fair amount of that also. So I think it's a witch's brew, but if I had to put the three, I think maybe I'm just an old man ranting at TikTok, but I think the feeling that you own all the information and are on a level playing field, and therefore you can own two stocks and be very confident about it.
All right, that was Cliff Asness, AQR Capital CIO, and Bloomberg Sonali Basak at Bloomberg Invest. David, any sort of final thoughts here?
No, I relished his humor and thought that his perspective was great. And you can follow the rest of that at Bloomberg.com, of course, Sonali Basak and Cliff Asness at Bloomberg Invest.
That's right. Up next, Bloomberg Business Week continues with Carol and Tim at Bloomberg Invest. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
An almost one-for-one flip-flop out of small caps and in to big tech. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. So that NVIDIA break was short-lived.
Yeah, we kind of knew it was going to be short-lived, but 3-day drop and entry point for a lot of folks today.
Yeah, all right. So let's get to where we are within the market. So it is that NVIDIA rebound. You have the S&P up by about 0.3%. Obviously, tech is outperforming as NVIDIA moves over 5% higher. Now, digging in a little bit, though, we do have FedEx after the closing bell, and transports overall, the Dow transports are getting hit down by about 1% there. So that that's interesting too as we had continued into some of those earnings seasons. And the Bitcoin. Bitcoin is up by 4%. I don't know if you saw this, Romain, but the correlation between NVIDIA and Bitcoin is actually like 0.4 right now over the last 60 days. They're kind of moving in tandem, and I wonder what that says about that risk on appetite.
Yeah, absolutely. Definitely a barometer for that risk on appetite, and maybe a barometer for the broader market as well. In fact, the best performing major market in the world, showing exactly why it remains that resiliency. A bounce back in the NASDAQ after 3 days of losses. Chris Montague over at Citi saying the tech-heavy index remains the most bullish of all of the markets out there. Steve Eisman over at Neuberger Berman says, stop obsessing over valuation. It's a death wish, he says, as that NVIDIA AI narrative is a multi-year story that's still intact. Excuse me. And that multi-year AI story has been the talk of the Bloomberg Invest Conference, a 2-day affair taking place right now in New York City. Felipe Lafont, the Tiger Cub founder over at Coatue Management, giving a rare public interview on the main stage this morning. Here's what he had to say about where to look for the emergence of winners in this AI steeplechase.
At the beginning of these new waves, the new winners, 10 or 20 years out, some of them are existing companies and some of them are new. But the new ones that get big, there's maybe one a year, no more.
We're going to show you a lot of highlights from that conference, but there was a report out earlier today by Synergy Research Group that says one of the unlikely winners in this AI race could be the debt markets. A fresh report saying AI is accelerating digital infrastructure growth, with global spending on data center construction likely to top $55 billion by 2030, and most of that money, at least according to Synergy, will need to be financed through the asset-backed debt markets for financing.
All right, well, let's get more of that interview with Philippe Lafont, Coatue Management founder and portfolio manager.